joining in with us to set us up for trade and tell us the important stocks to watch out for as well. Good morning, Gaurav, as well as Sudarshan. Before I come to you all, I'll just take you all through what are we watching out for in terms of important cues that we are keeping an eye out on in terms of Indian markets. Now, obviously, US also gave us a strong handover coming in overnight, right? S&P 500, NASDAQ closing at those record high levels. We had those mega cap companies like Alphabet, Tesla. All of those were buzzing in trade in the trading session for US markets yesterday because of their earnings that they expected to report this week. Also, update that came in from Scott Wesson saying that US will not be rushing in for trade deals ahead of this August deadline. So that will be important to watch out for. In yesterday's trading session, we saw a bit of a pressure coming in from FIIs because they sold 1,681 crores, while DIIs were net buyers of around 3,500 crores. Important earnings came in post-market hours, so Indian markets would be reacting to that as well. Some of those mid-cap companies. So keep an eye out on DCM, Shriram, PNB Housing, Sagar Cement. Good numbers that came in from these companies. So we could see a bit of a move here, while some bit of a muted performance coming in from Havells, Oberoi Realty, CIE Automotive, some of the names that we'll be keeping an eye out on. Today, important earnings to watch out for. We have Colgate that will be reporting numbers. Creditex has Grameen, M&M Financials, 197 Communications, Dixon Technologies, some of the names that are expected to report numbers. So we'll keep an eye out on the move on these stocks during the trading session. Important cues today that we'll keep an eye out on. Jane Street will be allowed to resume trading in India. This is what the SEBI has said. There are some conditions that apply to this, so keep an eye on that. RBI is conducting the government bonds auction, so that is important. And 361 WAM, we'll keep an eye on that because Bain Capital affiliate there's a block deal that is expecting here, so we'll keep an eye out on that. Now, Nifty yesterday closed above the 25,000 level. Important support level for Nifty is 24,800. Today, where we move will be key to watch out for. But let's go across to Gaurav, who's here to tell us which are the important stocks to watch out for. Gaurav, good morning.
Well, let's talk about PNB Housing. A good set of numbers is what we have seen here. 23% growth in net profit, and this was basically because company actually reported recoveries which were higher than expected. Havells India, on the other hand, actually reported weak set of numbers. Profit actually declined almost by 14% on a year-on-year basis, and this weakness was specifically led by Lloyd and ECD segment. Sagar Cement, once again, actually, when we talk about this company, the company actually reported profits after 4 consecutive quarters of losses. And at the same time, there is another news flow here, is that the management has now proposed to enhance grinding capacity at one of its facility in Madhya Pradesh at a cost of around 120 crores. So there is expansion plan which will keep the stock in focus today. Bajaj Finance is definitely going to be in focus because there is a management reject. Mr. Anup Kumar Saha has resigned as managing director, and Mr. Rajiv Jain will be taking over as Vice Chairman and Managing Director of the company. SBI is also going to be on our radar today because company has completed its QIP. The largest QIP of 25,000 crores is what they have completed, and they have also mentioned that the demand was actually 4.5 times higher than the actual QIP size. Brigade Enterprises is also in focus today because company is acquiring 20 acres of land in Bengaluru for around 580 crores. With this, they are planning to get a project worth 5,200 crores on a mixed use development setup. Lastly, let's also focus on Shyam Metallics because board meeting is going to be there where company will consider fundraising today.
Okay, Gaurav, thank you so much for that. But let's go across to Sudarshan, who's here to tell us the important cues in the world of FNO that we should be keeping an eye out on. Good morning, Sudarshan.
Good morning, Vinny. So we started a week on a very strong note thanks to the financial heavyweights like HDFC Bank and ICICI Bank. Both the companies are the top Nifty contributors as well as the top contributors to Nifty Bank. And at the end, both the stocks ended the day's high, and that helped Nifty close firmly above 25,000. Also, Nifty Bank with healthy gains. For today also, GIFT Nifty following global cues is indicating a positive start, currently up almost 50 points. Now, talking about the flows. In the cash market yesterday, we saw FIs selling around 1,700 crore, but it was fully offset by DIs, which had bought more than rupees 3570 crore. In the index futures, after like so many days of selling, yesterday we saw FIs buying nearly 600 crore. And also, they have reduced short positions of almost 3,100 contracts. And as far as long position is concerned, there was a minor reduction of 240 contracts. Now, FI's long exposure remains around 15%. On the option front, 25,200 call has seen shedding of around 14 lakh shares, but addition was seen in 25,300 call. On the put side, 25,100 put has seen addition of almost 50 lakh shares, and 25,000 put has seen addition of more than 33 lakh shares. Now support for Nifty, immediate support will be 25,040, and if we breach that, next support comes around 24,900, that is the yesterday's low, and resistance comes around 25,330, that is the 20-day moving average. Now talking about the stocks in focus, two stocks remain in the bank, and those are RBL Bank and Bandhan Bank. Two stocks have come out of the bank, and those are Hindustan Copper and Angelon. Apart from this, keep an eye on Eternal and Ultratech because the management commentary was positive after the earnings.
Okay, Sudarshan, important updates coming in there. Keep an eye out on Eternal and Ultratech also on the back of management commentary. Thank you so much for that. But let's move on and get that update that's come in on Jane Street right now. The market regulator SEBI has allowed Jane Street to trade in Indian markets after they have deposited 4,843 crore rupees in an escrow account. Now, SEBI has, however, set some conditions and has asked exchanges to closely monitor all of Jane Street's future trading positions and also barred the firm from using any of the trading patterns identified or mentioned in the interim order. Now, the regulator has also stated that the investigation in the matter is still ongoing and this order is not the final clearance that's coming for the firm. But on that note, let's just take a very quick break. And after the break, we'll get you updates that have come in from India and US in terms of the trade deal talks. What's going on over there after the short break? Welcome back to Power Breakfast on CNBC-TV18. Now, like I said, we'll talk about that India-US trade deal and this deal ahead of that 1st August deadline, which is unlikely. We're not expecting that. Now, both nations will hold further trade deal-related talks in Delhi as well next month. Parikshit is joining in with us to give us details. Now, what are we expecting and what should we watch out for going forward? Good morning, Parikshit.
Well, yes, the trade deal talks are clearly stalled before the 1st of August, and any interim deal is ruled out for now. The reason being, the United States wants to impose the same tariffs on India as it is offering to impose on Indonesia and Vietnam. The US wants to impose 20% tariffs on India and is expecting 0 tariffs in return. Now, this is something which is not acceptable to the Indian side. We have also wanted and consistently said in negotiations with the US that we want a mutually beneficial trade deal and we want a competitive edge over Indonesia, Vietnam, Cambodia, Bangladesh. So if we are going to be offered the same tariff arrangement, that is not acceptable to us. But the big sticking point is agriculture and dairy, with the US president seeking inclusion of market access for agriculture and dairy in any deal with India, even if it's an interim understanding on a mini trade deal. Now, India has put its foot down, saying that we cannot have any compromise on agriculture and dairy. We've refused to participate in any talks in the month of August, any further talks for the moment. This is the reason why the U.S. government is sending a team led by their trade negotiator, Brendan Lynch, to try and see if a breakthrough can be achieved before September or October. Donald Trump was set to visit India in fall this year for the Quad Summit and also oversee the signing of the bilateral trade agreement. But for the moment, there is no consensus on the deal. There is a 10% baseline tariff on India right now, and U.S. has threatened to impose a 26% reciprocal tariffs, but it's currently on hold till the 1st of August. But for the moment, India has put its foot down, saying that we cannot have a trade deal in this kind of format with the kind of demands that the U.S. is making.
Okay, Parikshit, thank you so much for that. But let's also listen into U.S. Secretary Scott Bessent and what he had to say on the pending trade deals.
Talks are moving along, but the important thing here is the quality of the deal, not the timing of the deals. And President Trump has created maximum leverage, as only he can do. And what we are seeing is like these imbalances built up over 20, 30, 40 years. And we are more concerned with high-quality deals than getting these deals done by August 1st. Our trading partners were told that the rates could boomerang back toward the April 2nd levels. We can continue talking then, but again, we're proceeding apace with the negotiations, but we're not going to rush for the sake of doing deals.
Okay, that was Secretary Scott Bessent. But let's get to the highlights of from the U.S. markets, because S&P 500 and NASDAQ closed at those high levels, record high levels. And this is amidst that increased optimism over earnings as investors fear over the last and the latest trade deals that are shaping up and the developments there, which were shunned because of these earnings that are expected. Now, both the indices hit an all-time high level intraday trade. Dow Jones slipped marginally in yesterday's trading session. What more other updates coming in from U.S. market? We have CNBC's Bertha Coombs joining in with us for that.
U.S. markets were mixed across the major indexes in Monday trading, with the NASDAQ closing at a record high while Wall Street waits on big tech earnings coming later this week. The Dow dropped 19 points, but the S&P 500 was up 9 after touching a new record during the session, and the tech-heavy NASDAQ added 79, closing at its highest level ever. In an interview Monday on CNBC, Treasury Secretary Scott Bessent suggested that the Federal Reserve should undergo a review. He said the central bank needs to be examined as a whole to see whether it has been successful. Now, it wasn't clear what form a possible review would take or who would actually perform it. Comment came amid an intensifying conflict between the White House and the central bank over interest rates and cost overruns in a $2.5 billion Fed complex renovation. And Southwest Airlines says its more than 50-year-old open seating policy will officially end on January 27th of next year. Customers will be able to buy tickets with assigned seats starting on July 29th. Southwest announced the end to the policy along with its 2 free checked bags perk earlier this year, as the airline looks for new revenue streams to keep up with more profitable rivals. That's what's happening here in the U.S. Back over to you in Mumbai.
Thank you so much for that. But as Bertha mentioned, that U.S. Treasury Secretary Scott Bessent called for a review of the entire Federal Reserve, and if they have been successful, listen into what he had to say.
I think that we should think, has the organization succeeded in its mission? If this were the FAA and we were having this many mistakes, we would go back and look at why has this happened? I mean, look at as you said at the top of this broadcast, there was fear mongering over tariffs, and thus far we have seen very little, if any, inflation. We've had great inflation numbers. So, I think this idea of them not being able to break out of a certain mindset, all these PhDs over there, I don't know what they do. This is like universal basic income for academic economists.
Meanwhile, the former Federal Reserve Vice Chairman Lael Brainard says that the White House pressure is counterproductive and goes against the Fed's credibility. Listen to what he had to say.
Certainly, we haven't seen this level of pressure on the Federal Reserve for some long period of time. It certainly serves as a useful deflection for the White House. It certainly serves as a way to perhaps place blame for an economy that maybe is not firing as strongly as had been predicted. But it's not good for the Federal Reserve's credibility in fighting inflation. And ultimately, I think it's counterproductive for the White House to undermine the Federal Reserve's inflation-fighting credibility.
And former St. Louis Fed President James Bullard believes that the Fed needs to lower its rates further. Listen to what he had to say.
I think that the committee does need to lower rates further. They had a campaign, a recalibration campaign in the fall of last year, and some of those effects are coming on board right now, and they should re-engage with their recalibration campaign in this fall, probably starting in September, and that seems to be where the committee is at right now.
And now getting you the latest on Trump-related developments, we have Diya joining you with us in our special segment, Trump Watch. Over to you, Diya.
The White House on Monday barred the Wall Street Journal from traveling with U.S. President Donald Trump during his upcoming visit to Scotland after the newspaper reported that he wrote a bawdy birthday message to his former friend, alleged sex trafficker Jeffrey Epstein. White House Press Secretary Caroline Leavitt defended the decision, stating, as the appeals court confirmed, the Wall Street Journal or any other news outlet are not guaranteed special access to cover President Trump in the Oval Office, aboard Air Force One, and in his private workspaces. She added they will not be one of the 13 outlets on board Air Force One. Meanwhile, the White House says President Trump was caught off guard by Israel's recent strikes in Syria. According to spokeswoman Caroline Leavitt, the president has since discussed the matter directly with Israeli Prime Minister Benjamin Netanyahu, though no further details of that conversation have been made public. President Donald Trump's recently enacted tax and spending law will add $3.4 trillion to U.S. deficits over a decade and leave millions without health care coverage, according to a new estimate from the nonpartisan Congressional Budget Office. The CBO score for the law reflects a $4.5 trillion decrease in revenues and a $1.1 trillion decline in spending through 2034 relative to a current law baseline. The Trump administration has also released hundreds of thousands of pages of records about the assassination of Martin Luther King Jr., despite concerns from the civil rights leader's family citing the sensitive and potentially distressing nature of the materials. And lastly, the Trump administration will begin withdrawing 700 Marines that were deployed to the Los Angeles area last month, the latest de-escalation of the president's contentious crackdown on the city's anti-deportation protests. That's all for today. Now back to you.
Okay, Diya, thank you so much for that. But on that note, we're going to slip into a very short break. We'll get you the cues in the world of commodities after the break. Welcome back and thanks for staying tuned into Power Breakfast on CNBC TV18. Now we have Manisha Gupta joining in with us as always to tell us what to watch out for in the world of commodities. Manisha, what are you keeping an eye out on this morning? Anything specific that we should watch out for in crude and the metal front?
Oh, yes, crude and, metals, both of these areas, Vinny, because crude has seen a decline for a third straight day. The U.S. trade negotiation uncertainty is weighing on the demand, and so is the European Union and U.S. trade talks. I mean, that is in focus as well. And, the European Union sanctions on Russia energy exports may not have an impact on the global supplies, what the street is working with, and is the reason we've seen a decline come in for the crude because of that as well. And to add to that, Iran is looking to resume nuclear talks with EU this week on Friday itself. So that uncertainty or premium seems to be getting off the prices also. When it comes to metals, it's a different story because you've seen gains come across. Gold is trading at a 1-month high. We saw silver prices gain up by 2%. Iron ore is now trading at a 5-month highs with 3% of gains overnight. Platinum saw a surge of 2.5%. Steel is trading at a 3-month highs as well. So everywhere that you look, it's a second straight day that the metals are doing extremely well in the Asian markets.
Okay, Manisha, thank you so much for that. We'll keep an eye out on crude and metals as well. But, in some political news updates that we have, the Vice President of India, Jagdeep Dhankar, tendered his resignation to prioritize his health care and abide by medical advice. The resignation is effective immediately. He was serving as the Vice President of India since 2022 and previously served as the Governor of West Bengal from 2019 to 2022. The tenure of the 74-year-old Jagdeep Dhankar, who is also the chairman of Rajya Sabha, was till 2027. Now, the election for the new vice president has to be conducted within 60 days, and the Election Commission is likely to announce dates for the election of the next vice president soon. And with that, we are absolutely out of time on this edition of Power Breakfast on CNBC TV18. Thank you so much for tuning in. Up next, your Bazaar Morning Call to take you through all that market action.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Tuesday morning. We are coming to you as always from the CNBC-TV18 Motilal Oswal studios. Overnight markets back at record highs once again. The 10th or the 12th odd for the S&P or the Nasdaq. Here in India, can we stage some more recovery after what we saw yesterday? That's the question. I'm Prashant. With me, my colleagues Nigel and Suri. Guys, morning.
Hi, morning, folks. Morning. Well, of course, earnings to go over, global markets to go over. And there's lots of other news as well that we need to look at, whether it's SEBI on Jane Street, whether it's a sudden change of management at Bajaj Finance. Yes. So plenty of exciting stuff to note today.
Well, that's right. And the US markets continue to make fresh all-time highs. When is our chance? Yesterday, at least we saw a bit of a pop-up. Yeah. Let's see whether or not we can, drive home the advantage.
Absolutely. Actually, the US almost seems to be in a low volatility. But apparently, retail participation is back at like 2021 meme levels. When you had that GameStop mania, etc.
Volumes were very high last night as well.
So it's all retail apparently, and because institutional action, etc., is 30-40% of the market should be higher. So we'll see. But it seemed like a bit of a melt-up, low-volume melt-up, if we can put it that way. But for what it's, of course, it is what it is. Price action is what it is. So US has hit another record high, both the S&P and the Nasdaq. S&P about 0.14 higher, Nasdaq about 0.4% up. Verizon was up about 4.5% after strong numbers. So that was one single stock which kind of did pull its weight. Nasdaq hit a record high for the 12th time this year. The S&P hit a record high for the 10th time this year. So those are some kind of sort of records along the way. Wednesday's tech earnings, I think I'm just putting out, not today, but tomorrow evening, you will have Alphabet and Tesla, which basically will report numbers. And as we're kind of getting closer to it, these are important, big, large numbers. So will be interesting. By the way, about 25% of the S&P 500 report numbers by the 25th of June, between today and the 25th. So, we'll have a large cohort to assess what earnings strength looks like. It's been very good last few quarters, despite tariffs, etc. Dollar had a bit of a move. The dollar index, 97.85. So this is the broader dollar and 0.63 odd % lower on the dollar index. Now, in terms of some local news flow, the India-US trade talks are going to continue beyond the 1st of August deadline. Said another way, before the 1st of August, and this is government sources telling CNBC-TV18 that it's unlikely that a deal will be reached before the 1st of August Trump deadline. That this is the India-US trade deal. US trade officials are due to visit India in mid-August. Remember, 5 rounds have taken place. Indian negotiators were in the US talking to their counterparts. They came back over the weekend. And the 6th round is scheduled for mid of August. And of course, government sources tell us that, there is disagreement on sensitive, important sectors on which India and the Indian government is not ready to give an inch. Agriculture, for example, is one. We'll talk more in detail as we kind of go along. But now this deadline watching, the 1st of August watching, I think we'll have to sort of look beyond. We've heard it from US officials themselves. I think the Commerce Secretary said 1st of August is a hard deadline, but we'll continue to talk with partners in terms of trade and sort of agreements, etc., that can be reached. Now, just to kind of come in and tie in the levels here, bulls yesterday defended 2 things. One, the 61.8% retracement on a closing basis. This is the level we put out yesterday. And then on top of it, it reclaimed the 40-day exponential moving average yesterday. So the question is, are these early signs of a reversal? Sentiment is pretty, it's not bad, but positioning seems to be a bit of an extreme. And Nigel will talk more about that in terms of short positioning, etc., in the market. So it's a question. Early signs, we'll have to see. But we did reclaim the 40-day exponential moving average yesterday. That's the graphic. Now, resistance for the Nifty, if we are to go higher, is 25,255. This is the recent high. And then 25,369 which is nothing but the 61.8% of the entire decline that we have seen. Support for the Nifty comes in the near term at least at 24,882, which is nothing but the recent low that the index has seen. The Bank Nifty bounced strongly yesterday from the 40-day exponential moving average. And of course, ICICI, HDFC was a slew of financial earnings over the weekend, and the large caps pulled their weight. So that showed up on the Nifty Bank. Resistance here is 57,085, which is the 61.8% retracement of the entire decline we've seen. And support stands at 56,204 for the Nifty Bank. So just some levels to focus your mind in terms of where we might go from here. But yesterday was not bad. Of course, you could sort of chalk it up to ICICI and HDFC in a large way, but you had other sort of parts of the market which were looking a little better by close. Zomato, Eternal, etc. More on single stocks as we go along. GIFT Nifty will give you a quick sense of how we're likely to start. 62 points higher is the indication this morning. Surbhi.
Absolutely. I mean, at least so far, the large, Nifty earnings that have come in, they haven't disappointed too much. It's been pretty okay so far. So the market will hope if we get more of that. Let's start off by looking at Asian cues. And most markets across Asia have actually lost their mojo. They started off in a very positive way, building on those Wall Street gains. And remember, Japan is coming back after a holiday yesterday. And today is the first day the Japanese market is reacting to the weekend election results, where the sitting Prime Minister, Shigeru Ishiba. Remember, he lost his majority, but the result is not as bad as what some market pundits were hoping for, and there's some talk about whether he'll continue on as the Prime Minister of the country. So Japan opened with a pop, but that pop is fizzling out very soon. In fact, there's a fair amount of red now in the markets. If you look at the Hang Seng, for instance, or even the mainland Chinese market, they're flashing a little bit of caution and a little bit of red. All these markets will, of course, keep tracking a lot of the US action. That's the dollar yen. The dollar yen was very strong yesterday. The yen had surged 1% versus the dollar. There's an incremental slight gain on the yen even this morning as we speak. Now, today, Asian markets will track a lot of the US action, which includes big earnings. Philip Morris is, declaring today, Coca-Cola, Lockheed Martin, and tomorrow the tech names that Prashant mentioned. So it's a heavy earnings calendar, which markets are focused on. Yesterday, we had the Conference Board's index of leading indicators, and that fell more than expected in June. So far, the US economy has been rock steady. This was at one number that came in. The fall was 0.3% in June. Expectation was a 0.2% fall. So let's see. More economic data slated during the week. Speaking of economic data, here back home, we had the 8 core sector industries data come out. It remains very, very anemic. I mean, look at the numbers. 1.7% growth versus 1.2%. So month on month, at least that number is looking better, but it's still very weak. I've picked out the stars in the core sector industries, and it's steel and cement. Look at the numbers. I mean, 9.3% steel production increase, 9.2% cement production increase. And Nigel's been telling us about this. A lot of the companies have been reporting better numbers, and it's showing up in the macro data as well. Now, let's talk about the market. Yesterday, we had some support at the lower levels, which is what the bulls really will take heart from. But it wasn't the FPIs. It was more of domestic buying. So let's look at the cash market figures now. You had FPIs sell almost 1,700 crores in the cash market yesterday, but domestic institutions are more than offsetting that. Look at the strong buying, almost 3,600 crores of domestic buying coming in yesterday. Now, one more thing that the market will focus on is the fact that Jane Street has been allowed to come back to the market. The regulator approved them going back to F&O trading, with the obvious caveat that there cannot be any direct or indirect manipulation. And exchanges have been told to keep a very keen eye, a hawk eye, on all the trades and all the activity. So will that lead to some kind of a pickup in volumes? We'll see. Wait for that. And coming to single stocks and the action over there, plenty of interesting, names to track today as well. There's Havells, which has been weak in terms of the action. There's news on Bajaj Finance, where there's a change of management. The current CEO has stepped down, very quickly, actually, in just 4 months. And Mr. Jain is coming back. So that's something that we'll watch out for as well. So a lot of the individual, news flow, stocks news flow will keep the market fully focused today. Nigel.
Well, the bulls, yesterday, the good news was they went ahead, they defended that crucial 24,900 odd mark, and we saw a good bounce back. And the Nifty ended virtually at the high point of the day. That's good. All eyes are now on the 20-day MA. Can the bulls go ahead and conquer that mark? That's going to be the key trigger on the upside. Well, if you're looking at the action yesterday, well, the cash market volumes are rather high. And in the F&O market, you had a bit of short covering that played out for the markets on the whole. Remember, there's an element of rollovers as well, but the Nifty as well as the Nifty Bank, both of them ended higher, and you had the open interest that was lower. Even the FIs, we mentioned this point, they're getting very, very aggressive on the short side. And yesterday, there was a tinge of some kind of short covering that we saw. Close to around 3,000 contracts were covered out, though they continue to remain net short with close to around 85% of their positions on the short side. Even in absolute terms, it's still at elevated levels of around 1.45 lakh contracts on the short side, while the clients are gradually moving towards the 1 lakh contracts on the long side. That's the positioning from both the big participants in the market. The clients as well as the FIs should come up for you on the screen. Moving to the options data then, the call writers, they were having a gala time. They were writing calls, on a day-to-day basis, eating the premium. Yesterday, they got stumped, actually. The 25,000 call, 25,200 call, both of them, there was some panic out there. So that's an interesting sign because otherwise, the bears, they felt that they had it. Call writers were going in there, they were writing calls, and they were eating into the premium. Yesterday, they got stumped. Now, important to see that this 25,100 put as well, it was one of the most active strikes yesterday. And it added 50 lakh shares, premium close to around 100 rupees. So that vicinity of around 24,900 to around 25,000 becomes extremely important. If you want a reference mark, well, we appear to be in this 450, 500 point range. On the upside, we need to get past this 25,320. Important mark to track. If the bulls can have enough in them and move past this mark, it's going to be important. Well, the reference point on the downside is yesterday's low. So keep an eye on that mark. The Nifty Bank, if we need to move up from here, that one needs to be in top form, and it was in top form. In yesterday's trading session, it was up 700 points. And what it did was, it ended at the 20 DMA and it defended the 50 DMA. So that's looking good. Stocks that I'm tracking for today, well, two stocks because they come out of the F&O ban. Angel One, I believe that today, in fact, the capital market stocks will be in focus. So besides coming out of the F&O ban, Angel One is one stock that I'll look at. The other one is Hindustan Copper because it's come out of the F&O ban and copper prices have been fairly strong as well. So I'll keep an eye out on this one, the only direct play on copper pricing.
All right, we'll keep an eye on those names as trade starts. Ed Clissold is Chief US Strategist at Ned Davis Research. He's with us. Ed, good to have you with us here. Thank you very much for your time. As a lot of the these estimates start to come in, and we were talking about this yesterday morning as well. This how much US will collect in new tariff revenue. So $250 billion, $300 billion a year. The Trump administration, in that sense, will get more emboldened, right? To push back, ask, and firm up their stance with regards to deals, etc. I'm talking about this in the context of what's happening here with India. When before April, it looked like India would be first in line to perhaps get a deal. But now, of course, we understand that it's not likely before the 1st of August deadline. What is your sense, Ed, just to sort of begin the conversation there?
It seems like the Trump administration has backed itself into a corner somewhat by putting on first a 90-day pause and then another 30-day and now almost indefinite, where if the countries they are negotiating with don't like the deal, then they can stand firm, and then the Trump administration likewise will just extend it. So it seems that it's going to be extend and pretend for a while until both sides can come to an agreement, and that extends to dozens and dozens of countries. So this is probably going to be a story that's going to be with us for months and months to come.
Ed, hi, good morning. Good to have you on the show today. What do you make of the market's interpretation, and maybe the market's latching onto exactly what you said, that this is going to go on for months, the negotiations, even with the EU, right? We had comments overnight saying that nothing stops countries from talking to the US, even after the 1st of August. So do you think this, from an economic perspective, will not be that disruptive, at least this year?
So in terms of the actual economic impact, I think it will be a slight negative, but probably not enough to cause a recession in the U.S., which of course was a big fear a few months ago. My concern is the longer this goes on, the more it's going to lead into capital expenditures not coming to fruition. If a company has a CapEx plan that's already been executed, they're probably not going to stop it because of a tariff negotiation. But they're probably also not going to do some of the new projects until they know what the new rules are. And so if it's a 90-day pause, that's one thing, but this is something that goes on for 6, 9, 12 months, then that's going to show up in the actual economic data. So the soft data that's been kind of weak could become percolating through the hard data. And, the U.S. is such a consumer-based economy. CapEx is not as big of an impact or a bigger part of the economy as some other markets, but it has an outside impact on the growth rate because the multiplier effect on CapEx is so much greater than it is on consumer spending. You could see U.S. economic growth slow down quite a bit, not necessarily into a recession, but you could see a significant slowdown if these tariff negotiations drag on for a while.
Hi, Ed. Good morning. Good to see you in. This is Nigel on this side. In terms of equity market allocation, you're overweight emerging markets. Tell us, where does India fit into this scheme of things from the emerging market basket? And, what about valuations? China seems to have a cushion out there, but India has growth, earnings growth. So how are you positioning yourself within emerging markets?
India has been one of our longer term favorites for lots of reasons. Better demographics than many other countries around the world, including many emerging markets, and potential for growth in a lot of sectors that seem to be doing well globally. So I think there's a lot of positives for India. That's a longer term call. For the most part for us. But so within emerging markets, we think India is probably a pretty good place to at least have a good market weight or a little bit overweight allocation.
Ed, data has all been pretty strong, right? I mean, one can nitpick, but US data, and actually this is the views so far about the US has been that H2 will be weaker and it'll all start to show up. Maybe it will. But so far, what we've seen has been rock solid data and rock solid earnings as well in the US. And on top of that, now you are talking about potentially a new stream of revenues every year, hundreds of billions of dollars. So the Trump team would think, well, they're winning, and they may be winning. I just wanted your thoughts there, Ed.
Well, I think first of all, there's no such thing as a free lunch, and so I think there's a long-term danger from tariffs that isn't going to show up in 2025, maybe not even 2026, where the U.S. economy will become less competitive if we don't have as much competition from other countries. And that was a problem in the U.S. in the 1970s, and then through deregulation, we became more competitive. But the challenge was there was a whole swath of the country, the manufacturing sector, that suffered from that. So there needs to be somewhat of a balance there. So that's a longer term situation. But short term, the U.S. economy is driven by consumer spending. As long as we're adding 100 to 150,000 jobs a month, which we have been doing, then I think there's a pretty good chance that the expansion can continue. And so far, the earnings numbers have been very solid. The big banks have already reported for the second quarter. Most of them exceeded expectations. Now, they're not going to have as much of an impact. In fact, a lot of them had great trading revenue from the market volatility. We'll get a better sense in the next, say, 3 or 4 weeks as more companies that are more directly tied to the real economy report. My hunch is there'll be a bit of a mixed bag. Most companies are still going to be okay, but you're going to start to feel the pinch of tariffs, which showed up in last week's CPI data as well.
Yeah, a little bit of an increase coming through. But as you're saying, I think the base case right now is no recession, maybe a bit of a slowdown. And the markets are taking that in their stride. But we'll see. We'll see what the next couple of weeks bring. Thank you very much, Ed, for joining in. Good conversation. We look forward to many more in the near future. Well, let's now move on, tell you what else we've got lined up for you on the show today. Plenty of interactions coming up. At 8:35, the management of Dodla Dairy is going to be joining in to talk about their first quarter numbers. At 9 a.m., we will be having with us Jashandeep Singh Chadha of Nomura to talk about key trends in the cement sector. Some strong numbers coming in over there. At 9:20 a.m., Manishi Ray Chaudhary of Emma Capital Partners joins in. He's our market master of the day. At 9:30, we speak with the management of Angel One, talk about the first quarter performance and the implications of a lot of regulatory changes as they've played out over the last few months. Then we have Girish Kausgi of PNB Housing Finance with us. They give us an outlook on the year ahead after the first quarter. At 9:50 a.m., Param Desai of Prabhudas Liladhar joins in, and we talk about the expectations from the pharma sector in Q1. And towards the end of the show today, Lata will be chatting with the management of UCO Bank on their Q1 earnings.
Time to take that short break. Come back. We'll go full throttle on the top 10 stocks that we're tracking for you. Titan, Ultratech Cement, PNB Housing Finance, Sagar Cements, DCM, Shriram, all of them will be reacting to positive news flow today. Add to the list BL Kashyap, Afcon Infrastructure. But on the flip side, Bajaj Finance, 361 BAM and Havells could be reacting to negative news flow. Take that break, come back. We'll get into further detail on all of these names.
Welcome back. Our, of course, team has the list of top stocks to watch. The implications, like we're telling you across Asia, are that markets have cooled off a little bit. Let's pull up the implied open and see what it's telling us, because yesterday the bulls had a nice fight back from the lows of the session, and they'll want to prevail, and that's a very inspiring implied open start, 60 points higher. So let's see if we can actually get to it. Now let's talk about the stocks, because there's not just earnings, but plenty of other corporate news flow that makes stocks interesting to look at. So let's get to it, guys. Morning to all of you. And the first stock that we're going to look at is Bajaj Finance. And no, we're not talking earnings and numbers here, but a sudden management change. Gaurav, morning.
Well, yes, definitely it was an unexpected move from Bajaj Finance, because Mr. Anup Saha has now resigned. Why this was actually negative is that he was recently elevated as MD in April 2025, and now he has resigned, citing some personal reasons. Now, he was associated with Bajaj Finance since 2017, and let's also not forget that, as we had reported earlier, he was also one of the plausible candidates for the leadership position at IndusInd Bank. So definitely this move was actually unanticipated. On the other hand, what is happening is that now Mr. Rajiv Jain will be designated as Vice Chairman and Managing Director of Bajaj Finance. Now, this is actually a positive move, we could say, because he was a CEO of Bajaj Finance for the last 15 years, and he was recently elevated for the position of Executive Vice Chairman. Now, what Street is expecting is that they are expecting smooth transition, given that Mr. Jain's availability as well as experience is Bajaj Finance. But in medium term, definitely we will be watching out on how the transition is going to be. Let's also not forget that on 24th of this month, company will come up with their results. So this is a key thing which will be in focus during that conversation as well. But as of now, shocking news from Bajaj Finance, given that MD has resigned.
Got it. All right. Thanks a lot for that, Gaurav. Well, let's hop across to Mangalam. He's here to tell us about Titan, who's gone shopping in the Middle East. Mangalam, tell us more.
Titan's gone shopping in the Middle East this time around, and they've gone ahead and bought 67% stake in Damas Jewelry at an enterprise value of nearly 2,439 crores. This is converted from AED. And this deal, of course, will expand their presence in the GCC and West Asia. And it's done at an enterprise value of less than 1 time sales. Because if you look at Damas, overall revenues in the last 3 years has been between 2,700 crores, grown all the way up to 3,400 crores as well. And the company this time around has also signed a path to acquire the remaining 33% by 31st December 2029. So that caps any sort of upside potential that they would have in terms of valuation that they'd have to pay for this business as well. It's a good deal because it's done at a relatively, fairer valuation, and it expands the company's own aspiration of becoming a near $500 million company when it comes to international revenues. As of last quarter, the annual run rate has been close to $150 million. So, this accelerates that. And to add to all of this, also strengthens their presence amidst competition which is present in Middle East. So you have Kalyan Jewelers, you have Malabar Gold, etc. They are fairly strong there, and Damas is a recent, decently strong brand. We've grown up knowing that they've sponsored a lot of popular events here in India too. So should be a good deal.
Okay, all right, Mangalam. Good deal is what you think about it. Going with green on Titan. Well, I'm going green with UltraTech Cement, and they had their con call yesterday, and on the whole, things actually sounded positive. If there was one thing that the street could have potentially been disappointed in yesterday, it would have been the volumes. But they're saying that Q1 was soft. Now they're expecting spends to pick up in the remainder of the year, and that's why they're guiding for around 10% volume growth. You like that? On pricing, imagine in the month of July, they're talking about prices being a little bit higher in July in comparison to June. That's very, very good news. That's telling the competitive intensity actually is getting pushed back a little bit. And particularly the small increases have been seen in South as well as East India. So that segment of the market seems to be doing well. In fact, on South India, they say that, it's in good shape out there. And they're saying South could be the new North. That's very, very encouraging from a pricing perspective for South Indian participants. On in India Cements, they say that, it's going to be scaling up to around 1,000 rupees mark by 2028. So that's encouraging. And they already said that, the capacity expansion is going to take them to around 212 million tons. But they're going to announce a fresh round of capex sometime during this fiscal itself. So we'll wait by for that. For this year, the capex that they're putting out is around 10,000 crores. They've already spent close to around 2,000 crores of that. Brokerages like what they saw. So good news coming in from the big daddy of the cement space. Numbers look pretty okay as well. Going with green on this one. In fact, we'll have Jashandeep Singh Chadda of Nomura, who will be joining in at 9 a.m. to talk about the cement earnings. Well, let's go across to Nimesh. He's here to tell us about 361 WAM. Nimesh, good morning.
Morning, Nigel. So, there is going to be a large block in 61 today. Bain Capital is looking to sell 1.5 crore shares, which is 3.7% of the company's equity via block deal. The indicative price is around 1160, a 5% discount to yesterday's closing price. And the deal size is 1740 odd crore rupees. Now, if the deal gets executed in the block window, you might see a bit of an uptick. But given the discount, the stock may open in the red to start with. Bain Capital owns close to 22%. So they'll still be left with 19% stake in 361. But now they have a 120-day lockup after today's block deal. So I'll start with red because there is a discount and unlikely that the deal will happen in the block window today.
Okay, all right. We'll see if this one goes through, as Nimesh says, in the block window. Nimesh, thanks very much for that. PNB Housing Finance is the next one we're going to focus on. Gaurav is here with details on this one. Gaurav, morning.
Well, it's good set of number from PNB Housing Finance in this quarter. When I talk about good numbers, now the profit has increased almost by 23% on a year-on-year basis, and this was specifically because of the write-backs, which were stronger than what the street is expecting. So net interest income increased almost by 17%. The same trend followed in the operating profit as well. There also we saw 16 to 17% of the growth on a year-on-year basis. What remained a key thing, positive thing, was that the write-backs were high, and as a result, provisions actually were again negative, and that is the reason why we saw this spike in the profitability. When it comes to loan book growth, it was at around 16% on a year-on-year basis, but again, when we talk about retail loan book specifically, that grew almost at 18%. Disbursements also remained healthy in this quarter, and net interest margins remained stable at around 3.74% versus what it was earlier, quoted at 3.75% just a quarter ago. So definitely good set of number is what we can say. We will definitely watch out if management is going to change their guidance. We will be meeting the management soon in our next segment, but definitely as of now, good set of numbers from PNB Housing Finance.
Absolutely. I mean, no complaints there. Decent loan growth, margin steady, and we'll ask your question for sure to Mr. Kosgi in terms of whether they will increase their guidance for the year, because the start has been pretty good in the first quarter. That's coming up at 9:40 a.m. Okay, so after the good, some not so good. And that brings us to Havells. Upasana is joining in. Upasana, so they're blaming it on the untimely rains and the low summer?
Certainly, Surbhi. So all in all, it's a weak set of numbers below our poll. Now, it was a challenging quarter for the companies, what they've indicated, because of the weak summer. Now, the weakness is mainly led by Lloyd and ECD segment of the company's portfolio, while the cables and wires continued look to show a robust growth with a volume growth of 21% and a value growth of 27% on a YoY basis. Now, coming to the numbers first, the revenue saw a downtick of 6%, and this was mainly impacted, as mentioned earlier, by Lloyd and ECD segment due to the weak summer demand. EBITDA was also down about 10% below our poll. EBITDA margins in the meanwhile largely stood in line at 9.6%, and PAT saw a downtick of almost 14%, which was below our poll. Now, management has also said that it thinks that the Q1 challenges are transitory in nature, and it believes that the revenue and margin is likely to improve going ahead. The company remains optimistic about the recovery in H2 onwards, which will be mainly led by festive demand and rural market expansion is what they have indicated in their con call. So all in all, weak set of numbers for Havells, and I expect the stock to open in red today.
Okay, all right. Thanks a lot for that, Upasana. Well, Sagar Cement, a few days ago, we were highlighting out here that South-based companies will be in focus. Why? Because of potential consolidation, and this quarter's earnings will be good. And Sagar Cement's numbers actually are very good. Top line growth of 20%. That's led by a couple of factors out there because, the volume growth is by around 11%. So there is an element of higher realizations out there because of the strong pricing in South India. And also there's an element of incentives that could have weighed in favor of the top line. But the EBITDA number, 122 crores looks very, very good. Big growth on a sequential basis, big growth on a year-on-year basis as well. The margins, beautiful looking margins. From single digits, they moved to around 18%. And the EBITDA per ton has come at the highest we have seen since Q1 FY22. So these numbers look quite good. Power and fuel costs, other expenditure as well, didn't grow as much as the sales, telling you that operating leverage should play out. And they reported a net profit for the first time after 4 consecutive quarters of losses. For Sagar Cement, what always works in their favor is on a valuation basis, it trades at less than $60 per ton. So going by all that we have seen, the stock should open up well in the green. Though keep in mind, it's seen a big run in the last 1 month or so. I think if I remember correctly, it's up 15 to around 20% as it is. But these numbers look good. Let's go to Ria, though. She's here to tell us about some other stocks and news. Ria.
Well, morning, Nigel. First, let's talk about DCM Shriram. We've seen good growth in revenue and profitability in Q1 of FY26. In the chemical segment, the caustic volumes have gone up by around 20% after the capacity expansion that the company has undertaken. ECUs were also higher by around 8% for the chemicals business. For the sugar segment, domestic volumes have been lower by 23%, but prices were better by around 4%. In terms of the outlook for the chemical segment, the company has said that they expect volume growth to continue, although tariff uncertainty will keep caustic prices volatile going forward with a downward bias. For the sugar segment, the global demand and supply will remain in a deficit due to a downward revision in global production, and domestic prices are expected to remain range-bound going ahead. Moving on from this, Afcon's Infra is another one in focus. This is expected to open in the green after the company has emerged as the L1 bidder for a railway construction line project in Croatia. The order value for this is approximately 677 million euros, which translates to about rupees 6,800 crores, and the completion period is 72 months for this one. The next stock is BL Kashyap. They've also secured an order for the construction of civil structures for residential towers. The order value is rupees 910 crores, and they're expected to execute this within the next 36 months.
Okay, all right, got it. Thanks very much for all the details over there, Ria. We'll quickly recap our list of top stocks to watch then. The ones that have positive news flow this morning are Titan, Ultratech Cement, PNB Housing, Sagar Cements, DCM Shriram, BL Kashyap and Afcons. The ones that have negative news flow around them would be Bajaj Finance, 360 One Wealth Management and Havells. Okay, so those are the top 10 stocks that you should watch out for today. Let's talk about commodities as well and see what the latest is. Manisha is joining in. Manisha has been giving us good news on metals last couple of days, and those metal stocks have been shining. But Manisha, good morning. What's the latest you're tracking today?
Well, Surbi, the metals have continued to gain even right now. Overnight has been a string of good gains yet again. You've seen steel gain up by a percentage point. Iron ore was 3% higher. Platinum gained by 2.5%. Silver gained up by 2% as well. So everywhere that you touch on a metal, it's trading on the stronger side right now. If not multi-month, then multi-week highs absolutely is how the metal is trading. When it comes to the crude oil prices, though, there's good news from here as well, because we've seen the prices decline for a third straight day. The US trade negotiation uncertainty is weighing on demand. The markets also will watch out for the European Union and US trade talks that are in focus. And then the European Union sanctions on Russia energy exports have not impacted global supplies. The prices cap has been brought down, but the global supply continues to be on the stronger side. And then the markets also are looking at some geopolitical premium easing as well, as Iran will resume nuclear talks with EU this week on Friday itself. So while the energy prices have seen a decline, most of the metal prices, industrial commodities are trading on the positive.
Manisha, thank you very much for that. So, yeah, these commodities up on your screen and should be in focus. Remember, the dollar is down about 0.6% this morning, so that's a natural lift to stuff priced in dollars. We'll take a quick commercial break here. We'll come back with the management of Dodla Dairy to talk about their first quarter earnings. So that's an interesting conversation you don't want to miss. Stock's done very well. We'll also have Amnish Agarwal of PL Capital for some fundamental stock analysis coming up.
Welcome back. Well, let's welcome our first corporate on our radar, Dodla Dairy. Well, their gross margins witnessed a contraction in quarter one, and that seems to have disappointed the street, and that's what impacted their profitability as well. Well, let's discuss more on the company's performance and the way ahead. We're joined by Mr. Sunil Reddy, the Managing Director at Dodla Dairy. Good morning, Mr. Reddy, and good to see you. And as always, thanks a lot for speaking to us here on CNBC-TV18. Well, the sore point in the numbers was the gross margins did contract. But as you've mentioned, it was impacted by seasonal impact. There was inventory liquidation as well. What is the outlook on margins from year on? If you could help us out with that number. And for the year, what kind of revenue growth should we pencil in?
Revenue growth, as you've seen currently, even in the first quarter, was at around 10%, a little more than 10%. We are looking forward to keeping up the revenue growth between the 10 and 15%. So we should be around 12 to 13% of revenue growth. That is not considering our acquisition that we have done. Regarding the margin profile that we look, the first quarter has been a tough quarter because procurement prices did go up and the commensurate sale prices didn't go up. And due to rains also, value-added products like curd, lassi, buttermilk, and all those things were not there, which were normally giving us a very high return. And also, if you have to look at it, our previous year, the same quarter, was a phenomenally large quarter for us. We had done extremely well because that was the first time we had actually moved from being a net seller of a commodity rather than a net buyer. keeping these in view and looking forward, I think we'll maintain the similar numbers like how we have always been, keeping that top line growth at that between 10 and 15%, and also keeping the bottom line growth in the high single digits between 8 to 10%.
EBITDA margins is 8 to 10%. Is that correct?
Yes, EBITDA margins will be 8 to 10%.
And you're talking about organic growth between that 12-13% vicinity, or 10 to 15% if you want to have a wider horizon.
Yes.
But inorganic growth will contribute to how much? If you could give us a number, absolute terms, what kind of revenues are you looking at?
We have just taken over Osam Foods that they had a number of 280 crores last year. So this year we won't get the first 4 months of operations, and then we will be adding the other months of operation, the remaining 8 months. We should at least conservatively look at it between 150 to 200 crores.
Okay, so the acquisition will then also add in. Morning, Mr. Reddy. You said that the commensurate increase in the customer level prices did not happen, which is why the margins were under pressure. What is the outlook? I mean, is there a lot of competition in the market, which is why prices are not going up? Will they go up? Maybe not for milk, for some of your other value-added products. Just give us some idea of the market, the competitive intensity, your market share, and the pricing strategy.
So basically, the market intensity has remained the same. It's always been the cooperatives versus the private sector, where the cooperatives have a lower pricing and the private sector has a little higher pricing, as we call ourselves a mass premium brand. The only thing that we faced was the procurement prices, which were going up. They went up a little more than what the price increases we had taken. We did take a price increase of a smaller portion because we are anticipating the procurement to come down again, and rightfully so. It has come down in July, and it's starting to show better results for us already. So continuing this price trend, which will, if it comes down by another rupee or so, we don't have to increase the selling prices. So that was the intention of the not increasing the selling prices totally to the extent, because we were waiting and watching to see how much the procurement prices would come down.
So just on the market share point as well, within the southern market and of course within the state, when you talk about private sector players, what is your market share at present?
We should be around 6 to 7% market share.
And do you see that increasing?
Yes, we've been able to keep the growth going. It is, but although it will be marginally, because it will be 6 to 6.5% is what we see the market share growing, not tremendous growth in market share.
Mr. Reddy, hi, morning. Prashant here. What is the share of what you describe as value-added products, sir, as a percentage of total annual revenues now?
Now it's around 36%, Prashant, sir.
Okay, and where can this head to? I mean, what's your sense?
This should go up by 1-2%, not much more than that, because it's basically like how our plate profile is as what we eat at home. I don't think there's been much of change. Yes, we have improved our value-added sales in products like paneer, which Southern India is beginning to consume a little more. And we are hopeful that other products like paneer, which are moving up, will add to the growth of that 1-2%. Curd will remain static where it is because of the weather is already the prime months of curd, where curd sales would have been the highest, has not taken off as much. So curd would be where it is, and it will remain at the 36-37% for the current year.
So you'll base 1-2% basically at an absolute level from here. I mean, basically that's where it should consolidate and remain essentially, right?
Yes.
Okay. And on both sides, on value added as a aggregate, can you, if it remains at this 36-38% odd range, what are margins and what can you do to increase margins here? What's your sense?
Basically, like I said, it's always been a play between procurement pricing and the consolidated pricing of our sales product mix revenue. This time the growth you see in revenue, the product mix of not having higher value products like curd has seen the contraction in the gross.
I'm saying, Mr. Reddy, fundamentally on a slightly longer term basis, can you do some, I don't know, rebranding, launch some other products, kind of sort of, move into another, which allows you to premiumize and charge more for what you sell across your value-added portfolio?
We are doing that, and right now we have increased our advertisement spends. We have got much more depth in advertisement that we are doing now. Even for from the EBITDA margin contraction, if you see our two major drivers other than the gross margin contraction has also been our increase in ad spend and increase in the increments in terms of the salaries and wages, because we have also hired a lot more people now to make sure that we take it forward into growing our market share and increasing our depth.
Okay, very quickly, what is your current procurement capacity? And you had mentioned that it was likely to move up as well on a per day basis. So update us on that front.
Currently, we are at around 18 lakh liters per day procurement that we are doing, and we're looking at moving it up to 19 to 20 lakhs in the short term. That is where we'll come to. That is the outlook that we have.
Okay. All right, Mr. Reddy, we'll leave it on that note. Thank you for joining in. Good conversation, gives us a quick perspective on the business as well. Thanks for being with us. That's Dotla Dairy. Stock down sharply because of that compression in margins, but the management says that it should get better from here on. 8 to 10% is the range for EBITDA margins going forward into the year. Well, with that, let's move on and say hello to Amnish Agrawal, joining in from PL Capital to discuss a couple of stock ideas. Amnish, I actually want to start with Bajaj Finance first because it's a pretty sudden change. I don't think anybody was expecting this. Though Mr. Jain, of course, this is such a well-respected name in the market, so he comes back as MD. Do you think it has any implication for the stock?
Hi. So I think as far as Bajaj Finance is concerned, it is not going to have any negative implications because Mr. Saha was there only for a brief 3-month period in this role. And going forward, till the time Mr. Rajiv Jain is there, I think there is not going to be any problem as far as Bajaj Finance is concerned. So I don't see any negative reaction on Bajaj Finance coming due to this. In fact, there will be, I think, some market might actually give it a little bit of thumbs up.
Positive. That's what I was saying. That when I said implications for the stock, I meant could it have positive implications because Mr. Rajiv Jain has been known to lead the company, right, to such heights.
Yeah. So that's what I'm saying, that in the near term it could be, but in the longer term now, because they had the succession plan and Mr. Saha had come in, so they would definitely be looking for someone else to fill in the shoes.
Got it. Okay, all right. Hi, Amnish. Good to see you in. What do you make of Titan's overseas acquisition? They've gone shopping in the Middle East. One would say, you have a highly underpenetrated market in India, maybe stick over here. Or maybe, in fact, the numbers coming up from the India business are not showing up according to the expectations. So they have gone ahead with their ambitions to going to the Middle East. How do you view this transaction?
You see, we need to actually know and look at how much is the profitability of that business, because whatever have been shared with certain, you can say, numbers with regards to the money which they are paying or the top line which that company is having. So it will all depend on how much profitability that company generates, because running a retail business, whether it is, you can say, US or Middle East, etc., it is not a very easy proposition. And the fact is that the company will be partly funding it through internal accruals, partly from, you can say, some debt will also be taken in this process. So it all depends on, you see, it broadens your horizon. It takes you, you can say, it gives you one more strong market where actually you can grow over a period of time. But at the same time, we need to look at how it is being, you can say, funded, how much is the profitability and how much can it contribute to the overall business of the company in the longer term. In terms of, say, overall, if you look at the top line of, you can say, Titan's jewelry business and this, so it is hardly, I think, something like, say, maybe 7%. So it is not that meaningful. But if you combine this with Carrot Lane and all, then actually it gives you, you can say, another engine of growth which is coming for the company. So I think in the near term, slightly difficult to say how it will pan out unless and until we have got more clarity on the margins and profitability.
Amnish, speaking of consumer stocks, Eternal, what a show yesterday and how it silenced the critics. But now this is one quarter, so I think it's going to be a big debate. This morning I've seen some price targets going up to 400 on Eternal, Zomato. What's your sense and what's your recommendation on the stock, the target on the stock if you cover it?
We currently don't have a target on the stock, but if you look at the numbers, particularly the food delivery business is now more or less stabilizing. So in terms of margins, in terms of growth, in fact, earlier people were expecting, say, 17-18% kind of a growth. So they are now saying that the 20% number for, you can say, NOV growth in food delivery, it might come only in FY27. That is one. Secondly, what might have been working positive for them is that if you look at particularly their e-commerce business, so despite so much of competition, the growth here was quite strong in top line, and actually the EBITDA margin loss narrowed from -2.4 to -1.8. So that is something which is positive. But having said that, whether the competitive intensity has abated, whether we have reached a steady state, whether the business of Blinkit is closer to, you can say, being break even or turning profitable or reaching their desired level of say 5%, 6% over the next 2-3 years. So these are some of the question marks which are still there. But definitely, given the strength of the balance sheet, I think it is the performance looks quite good. And if you look at say the entire, I think landscape and how now in the coming couple of quarters in particular, how they manage the transition to inventory-led model is something to be watched out for. But definitely, I think the numbers are positive now. The targets and all, I won't go into at this point of time.
Okay, all right. What we'll do is we'll take a quick commercial break here. Amnish, stay with us. We're going to come back in just a bit from now. There's some technical trading ideas coming your way. Sudarshan and Mitesh will help us with that. And then more conversation in a bit. Okay, welcome back. 9 minutes to go for close, and we are basically waiting for the market pre-open. Sudarshan and Mitesh are with us. Gentlemen, good morning. Good to have both of you here. Another 60 points after yesterday's recovery. Early signs of a bit of a reversal, Mitesh. How would you play it?
So, Prashant, I'm not looking at this as a reversal. I've been saying that we might have a corrective pullback to about 24,900. We broadly got there, 24,882 being the low yesterday. This level is very important. There is some important moving averages which we use, which are not the normal ones, the modified moving averages. If this level is held, then I think we might see some base building between 25,200, 5300 on the upside to about 24,900, and then we should reinstate or get into an uptrend again. My only worry would be if we start closing below this. So for the time being, I think 24,900 was the level to take profits on the short side and look at the markets possibly getting back to 25,250, 300, 320 zones. Once that is captured, I'll be more aggressive on the long side.
Yeah, no, absolutely. Sudarshan, what about you? How are you looking at yesterday's sort of bounce, and maybe if you get a 50-60 point higher start, what's the recommendation?
Well, yesterday's bounce was very unusual. I would have thought that markets will just move sideways, but then the markets do their own thing. I still assume that we are in a trading range. The trading range will face resistance sometimes at higher levels. I can't say which level, but soon enough, maybe as Mitesh said, 25,300, 25,400. So I'm not looking at a very big rally. Seasonally also, September and October are very dull months, although there's one more month left in that. So what we are looking at is if you have momentum in the morning, consider buying. but don't carry positions. And anything below 24,900, same levels as Mitesh, you go short. But for today, buy on a small dip and do not carry.
Okay, so buy carefully seems to be the advice coming through. Good morning, gentlemen. Let's also talk about individual stocks and what one can focus on. Mitesh, let me come to you. What's your list looking like today?
Yeah. On the stock side, I have all four buy calls after a long time, after a few days of decline. So I have a buy on DLF with a stop at about 840 for targets of 875. Bajaj Auto had a good price action yesterday, so buy here with a stop below 83.90 for a target of around 85.50. Amara Raja Batteries, that's a cash stock. That's a buy with a stop at 980 for targets of 1,050. And Bajaj Finserv, it's a conditional buy. It's just closed below that pivot of 2060. I think the closing is around 2050 to 53. So buy about 2060 with a stop below 2040 for targets in excess of 2100.
Interesting. Bajaj Finserv. Of course, finance is the stock in sharp focus today. We'll see what happens. Sudarshan, coming to you as well. Your stock list, what are you working with today?
Well, mainly buys. That's what happens. AB Capital, Aditya Birla Capital is a buy with a stop under 267. Ambuja Cement is a buying opportunity with a stop under 602. M&M is a buy with a stop under 3180. I have one intraday short, that is IndusInd Bank. Keep a stop above 870 and look for an intraday shorting opportunity. But primarily, if the Nifty shows some momentum, then stay on the buy side.
Eternal, Zomato, Sudarshan, any thoughts here?
Yes, Zomato has been a strong outperformer, far beyond my understanding of the charts. But because it is in that parabolic range, I think there is significantly higher levels coming. So if you are a momentum trader, you really want to buy every small dip, every small breakout.
All right, we'll talk more at 9:10, gentlemen. Sudarshan and Mitesh, thank you very much for joining us right now with those trading ideas. We've got a discussion lined up on Ultratech results, some cement in general. We'll have Jashandeep Singh Chadha of Nomura joining us to talk about the performance in that space. Stay tuned.
Welcome back. About 17 minutes to go before we start getting our trading rates for today. In a bit, we'll have the pre-opening rates coming through as well. Amnish is still with us. Amnish, what's your takeaway on the banks yesterday, particularly the tier 2 ones where there was immediate profit taking coming in because of weakness in numbers, like AU small, right? The market is a little nervous about their credit cost guidance being increased. RBL, AU, all the ones that fell yesterday. What's your sense and view on them?
See, the main thing is banking always moves like a wave. So, say for example, yesterday we have seen very strong up move coming in HDFC Bank and ICICI Bank. And even among the large banks, there is no very clear demarcation between, you can say, top 2 or 3, where some growth visibility is there, balance sheet is in a good shape, NPAs have not been rising. So that is, you can say, one class even among the large ones. And now what happens is that when the large banks, they start doing well, the reason why people look at, say, the smaller banks, whether these are small finance banks or some of the other banks, is because they expect that these are you can say, given the size and the opportunity, they will be growing faster. And usually in case where there are disappointments over there, usually the impact of any, you can say, negative news is also bigger. Now, if the larger banks, particularly if the concentration continues to be there in the, you can say, top few, and they continue to give you better performance, then any negative news flow or any sort of, you can say, disappointment in numbers will not be taken kindly by the markets, and that is what is exactly happening in some of these smaller banks. So I think the numbers going forward, they will be important because currently the credit cost is rising for some of these. That is one. Secondly, you have your overall credit growth is not that great, and all hopes are on the situation if it will improve in the coming quarters. So I think it's better to stay put with the bigger ones as of now.
Okay, so be with the big banks. That's the verdict coming in. Amnish, good to have you on this morning. Thank you so much for joining in. Appreciate your time with us. Well, as promised, now let's turn the spotlight on the cement space, because this is one space where some good news has started coming in. Whether you look at the macro numbers like the core sector numbers that came out yesterday where production is up, or you look at the micro numbers, look at what the companies have been reporting. We have Jashandeep Singh Chadda, Vice President Equity Research at Nomura, joining in. Jashandeep, great to have you on. A lot of excitement in the market. A lot of people are now watching out for the cement space. And my opening question is exactly that. The slight increase in pricing uptick that we're seeing, some improvement in volumes, do you think this is going to be durable? Is cement in for a very strong second half, especially once the monsoon period is over?
Yeah, hi, good morning. When we talk about, the positivity that we are seeing in this sector, one part is that the pricing in the first quarter have improved significantly, 4% up quarter on quarter. But however, I think, another thing that we need to focus is that the volume growth expected in the second half is also very strong. So both factors, revenues of factor of both volumes and pricing. Pricing has been strong. I believe, because of seasonal factors, second quarter might see some dip in the pricing, and then they'll recover in the second half. But the volumes are also, strong, and in the second half, I believe the volumes will be much higher than, the first half. So I think there is sustained positivity in the sector.
All right. Hi, Jashandeep. Good to see you. Thanks a lot for joining in. Give us a few details then. Prices that are expected to be softish in a seasonally weak quarter, which is the monsoon. But it's encouraging to see actually prices are holding up in July, which is, giving you a sense that competitive intensity could be cooling off a little bit. For the year on the whole, what kind of price increases are you looking at for the industry?
Yes. Hi, Nigel. Good morning. So, we have been building around 3 to 4% YOY price increase in FY26. We maintain that view. We believe that, 4% percentage increase in first quarter, then there's slight dip in the second quarter, and in the third and fourth quarter you will see that the prices will start to improve. So 3 to 4% of YOY in FY26 is an estimate that we built in.
Okay, got it. All right. What do you make of the comment coming in from the Ultratech management that South could be the new North? How are you positioned geographically? South is a tricky one. Sometimes they have their span of good news, and then those stocks can move up 30-40% and they can correct 30-40% as well. Case in point being a Sagar Cement. Today it's up. The numbers look quite good, but we have seen that one correct from 300 to 200 very swiftly as well, and then move from 200 towards 300. Your view on the South pack particularly?
So, if if we look at South versus North, in the current context, South yes look better because there have been significant price increase in South versus North. But there are two things that we need to be cognizant. Firstly, the significant price increase we are seeing because South for a very long time have seen depressed price, whereas North has steadily seen incremental increase in prices. So North is at a level where their prices are all-time high, and we don't expect any significant increase coming from them. And the 30 rupees or 20 rupees per bag price hike in South, historically it used to happen like that also, and the prices go down in similar fashion also. So that's why there is a lot of volatility when we talk about South players share stock price. But the second thing that is very important is the volume growth. I believe that there are far more structural, projects that are coming in the North and also supportive government in North. So hence, I believe the volume growth will be, more robust in North than we compare it to South. So, again, revenue being a factor of both volumes and pricing, it's very hard to say that, South will be better than North. What I can say is that if you are not able to decide, maybe a pan-India player like Ultratech is the way to go.
All right. So Ultratech is one stock which you like, and I think it's your preferred stock in the segment. What about the smaller stocks like Nuvoco? It's a far cry away from the IPO price. Investors who got in there, they haven't seen that price. Now the results are looking up, though that inorganic acquisition that they have done, we'll have to see how that pans out. What's your view on that one? From the mid-cap space, what do you like basically?
So right now in the mid-cap space, our pick will be Ramco Cement. Because of a couple of factors, the pricing being one, we believe there is a lot more delta in cost that the company can, use. There are still a lot of power and fuel cost saving measures that they can do. So hence, despite a lot of competitive intensity in their region, they can improve their unitary EBITDA by just focusing on the cost front. So Ramco is one stock that we like. For Nuvoco, we believe the inorganic expansion is like, in FY28. It's an expensive expansion that they have done. We will have to see how much of the capex they will have to incur in bringing that asset to their cost structure. So we are right now, we do not have a buy rating Nuvoco, but Ramco is one stock we like.
Okay, all right. What about the Adani Cement twins? They've been going about their branding exercise as well. With putting Adani Cement on those bags as well. What is your view? ACC is extremely cheap on a valuation parameter, but besides the cost, matrix that play out, I think the street is fearing that at some point of time it gets folded into Ambuja, which normally happens at, a preference for Ambuja shareholders. So your comment on these twins, and if in case they do come together, then what is the view?
Right. So, talking about, individually, we have we prefer Ambuja. We believe that these, sustainable cost saving measures that they are doing and at what scale they are doing, there is, a scope for very high incremental EBITDA. For them. ACC, we believe there are structural challenges in that asset. So we, on a standalone basis, we do not prefer that. We agree to your view that, and the street's view that at some point in future, there might be a case that, merger might happen. And in that case, Ambuja stock holders might be preferred. So we prefer Ambuja over ACC in Adani Twins.
But all the synergy benefits mostly will be in the price, right? Because they have been undertaking various master supply agreements.
Master supply agreements, and also on the cost front and capex, 80% of the capex is happening in Ambuja, right? On the cost front also, most of the cost levers are Ambuja. So incremental unitary EBITDA of Ambuja will significantly improve versus, ACC.
All right, Jashandeep, thanks a lot for joining in this morning. 3 to 4% pricing growth for the year. Preferred pick from the cement pack is the big boy Ultratech. And if you're looking at mid-caps, Ramco Cement is one that you like. Appreciate you joining in. Thanks a lot.
Well, that is Cement in Focus for you. Let's talk about and get you an update on the US-India trade deal as the 1st of August sort of deadline comes up on us. Now, sources tell us that a deal before that date is unlikely. My colleague Parikshit is joining in with what he's picking up. Parikshit, good morning.
Well, yes, the trade deal seems stalled as of now. There are a couple of reasons for this. One being the United States wants to offer India a similar trade deal to what is being offered to Indonesia and Vietnam. Essentially, Donald Trump and the U.S. administration wants to impose a 20% tariff on Indian goods coming into America, but they want zero tariff duty treatment from the Indian side. This is definitely not acceptable. The U.S. side is also adamant that they want concessions on agriculture and dairy in any kind of deal or even an understanding that is reached before the 1st of August. India at this stage has put its foot down, saying there can be no further negotiations, at least this month. They are open to negotiating a BTA and also a deal by fall this year when Donald Trump is supposed to come to India by September or October. But we cannot give concessions on agriculture and dairy, and the tariffs and the deal has to be reciprocal. So US, if it imposes 20% tariff on India, it has to accept a similar tariff from the Indian side on US goods as well. So currently things seem stalled. A negotiating team from the US is set to arrive in India in August to try and see if a breakthrough can be achieved. But for the moment, any kind of understanding or an interim deal before the 1st of August looks difficult.
All right. Parisha, thank you very much for that. So, talks will continue, but nothing before the 1st of August. That is essentially what is coming through. The question, though, remains, on the 1st of August, will tariffs kick in at that 26% rate? Will it be different? We'll have to kind of wait and watch, not for much longer, already the 22nd. Well, let's just get back to Sudarshan and Mitesh with what they want you to do as far as 9-10 calls go. Sudarshan, you go first. What do you have?
Well, buy Aditya Birla EV Capital with a stop under 267.
Mitesh, what about you?
Yeah, I'll go with a buy on Bajaj Auto for targets of 85.50.
Okay. Aditya Birla Capital from Sudarshan and Bajaj Auto from Mitesh. Gentlemen, thanks very much, both of you, for that. Let's just focus back on Eternal. I think we'll have the pre-open, I think it's almost ended. The stock will come up, a big mover, last 40 minutes after numbers. Mangalam has got more. Mangalam.
Well, the stock was the stock of last evening and perhaps likely to be the stock of today as well on account of the numbers that the company reported. But more importantly, thereafter, the management commentary as well. The numbers told you that the worst may perhaps be behind, and the management commentary confirmed that. They said in the near term, despite the competitive intensity, quick commerce margins have bottomed out. And remember, now quick commerce is the biggest contributor to their overall gross order value. And in food delivery, which is stabilized, they believe growth has bottomed out as they recover from slowdown as well. The third vertical, District, they believe can actually be a near $3 billion annual opportunity with $150 million of adjusted EBITDA at some point over the next 5 years. So all three verticals firing well for the company. Brokerages are, very happy with that as well. A lot of thumbs up coming in. Jefferies has upgraded the stock to buy, raised the target price to 400, saying that worst seems behind, at least on competition. CLSA has an high conviction outperform and a target price of 385. They're saying Blinkit now bigger than food delivery. Goldman Sachs, they're saying the street is underappreciating the market share gains for Blinkit over the last 2 to 3 quarters. So that's important. And Bernstein too has raised its target price to 320, saying it remains its top pick and is poised to benefit from structural shift to quick commerce. And this comes in the context of the stock having not done much. While it has recovered from lows, it's still about 10% away from its 52-week high. And it's not just about the distance, about the time as well. And in terms of valuations, now at around 72 times, not particularly cheap, but the growth that it offers, the street's betting on that at 38 times FY27 EV to EBITDA.
Okay, all right. Thanks a lot for that, Mangalam. That's clearly the stock of the morning, up close to around 8%. I recall when they did that, there was that MSCI and FTSE rejig. The stock was between, I think, 225 to around 235. And all that $1 billion of selling got absorbed, and from there, the stock has just looked up. Good numbers, street likes it. Let's go across to Upasana. She's here to tell us about Havells. Upasana?
While the company has reported a weak set of numbers, it was certainly a challenging quarter for the company. The numbers stood below our poll. Now, weakness was mainly led by companies Lloyd and ECD segment, while companies reported a robust growth in its cables and wires segment with a volume growth of 21% on a YoY basis and a value growth of 27%. Now, coming to the numbers of the company, the revenue has seen a decline of 6%. EBITDA has seen a decline of 10%. EBITDA margins, while largely stood in line with our poll at 9.6%, while PAT saw a downtick of 14% on the back of higher operating expenses. Now, management in its con call has highlighted that The Q1 challenges are transitory in nature and it expects the revenue and margin to improve in the upcoming quarters. Company also remains optimistic about recovery in second half led by festive demand and rural market expansion is what they are eyeing. Now let us look at the brokerages. Now Morgan Stanley has given an overweight on the stock with a target price of 1884 per share. CLSA has given an outperform rating with the target price of 1950 per share. Motilal Oswal on the hindsight has given a neutral rating with a target price of 1680. Mind you, the brokerage has cut its EPS estimates by 8% for FY26 and 7% for FY27 as it cuts the revenue and margin estimates for companies' key segments such as Lloyd, ECD and lighting. On the back of this, they have made the EPS cuts. So all in all, weak results for Havells.
Okay, all right, got it, Upasana. Thank you very much for that. So Havells, not bad. I mean, given that it's not been a great quarter, still up 1.5%. Bajaj Finance, some stocks in news, up about 0.5%. Titan is managing a 0.5% increase as well. Last I checked, yeah, still about 0.5% higher on the possibility of them looking at a chunk of Damas, which is large, a player out of UAE. But it is Eternal that completely takes our breath away. Very quickly, Mitesh, if you could just give us levels, 15% in a span of 2 days. Almost now 300.
So disclaimer, I have some positions over there. The stock, made a weekly high of 293 way back in September 24. I think that should be the first level, and the highest ever weekly closing is about 303. That should be the second level. But more importantly, I think the way these charts are shaping up and this big gap up will happen. I think once this 302, 305 zone is clear, the stock should head towards 340, 350.
I think we are now, 8%. That's a big move on Eternal. Stock of the day, once again, as Mangalam said, after it being the stock of yesterday pretty much, and kind of sort of stole the limelight from under with that last 30-odd minute move, which kept going. So almost 300 rupees, lots of upgrades, etc., as Mangalam has been pointing out. As well. Just running into market open. So, of course, Eternal is one. We'll see if some of the large banking names have got more steam, like ICICI, HDFC Bank, etc. There is Ultratech, of course, which reported numbers and the markets responded to it yesterday. Havells is another one, which, of course, we've been sort of highlighting, and a bunch more. But at an index level, it's a higher, better start, about 1/3%. So, yeah, 25,160. That's the opening bell. 25,150 actually. The Nifty Bank is up at about 57,120. That's about 1/3% higher. 1,230 stocks are higher. 330 stocks are lower. And this is, a pretty decent start out of the gates. Right at the word go. The mid-cap index is flat to slightly higher, and the small-cap index will come up on your screen as well. The heat map, 30 up, 20 down. That's the overall picture as things stand right now. I can spot a bunch of financials, not the big ones, the big ones as well. But there's IndusInd and Bajaj Finance along with Zomato, that is Eternal, as far as the gaining corner is concerned. Surabhi.
Oh, that's an eternal performance, at least as far as yesterday and today is concerned. Look at that, 10% on Eternal. And mind you, a lot of the price targets that we've just heard from Mangalam as well, they're still northwards of where the stock is right now. Price targets of the bullish camp are ranging anywhere between 320, going up all the way to 400 rupees on Eternal, with Jefferies being the biggest bull. They have that 400 rupees price target on the stock. What a move. Okay, let's go beyond Eternal and see what else is working for the market. Bajaj Finance, like we were discussing earlier, actually Mr. Jain has been such an old hand and responsible for such good business and growth in the company that his return, even though it might be interim, it's being seen as a positive. So 1% higher on Bajaj Finance. Trent is up 1%. IndusInd Bank is rising about 2%. And HDFC Bank is still continuing its good show from yesterday, as is ICICI Bank. So yes, both the banks are still firing and firing well. In fact, even Axis had joined them last I checked. Yes, there's a little bit of green on Axis Bank as well. So overall, large cap banks are looking good. The Bank Nifty is outperforming the Nifty at this point in time. Very quickly, just to see the downside of the screen, Reliance is still dragging. Reliance is down about 0.5%. Eicher Motors is a bit weak. Kotak Mahindra Bank and Infosys are some of the other names, but no problems. Eicher and Reliance are the only noticeable losers. Otherwise, it's a pretty good solid start. 73 higher on the Nifty now.
Well, that's right. Let's pull up a few stocks. The street is saying, let's look at Zomato. But some part of the street is saying Zomato is locked in upper circuit. Let's look at Swiggy, and it's swigging its way right now. That one, in fact, is up close to around 5%. Big move is what we're seeing on that particular name. AGI Green, that's the other one that's moved up on rather good volumes. The numbers look quite good. Revenue growth of 20%, EBITDA growth of around 20%, and net profit jumps up by around 40%. Street likes that, 5%. That one is flying away. IndusInd Bank, Street believes maybe, in fact, the new CEO, new MD, could be pretty much, sooner rather than later, at least for the time being. Volume's massive on that one. Stock is up close to around 2%. After Ritu put out that clarification, in fact, yesterday, the stock has gained close to around 5% from the lows. Well, pull up Tilak Nagar Industries as well. They have put out that clarification, rubbishing those claims, saying that it's quite dated. They have submitted everything they need to do. The volumes are very, very large. Remember, yesterday the stock was around 440 rupees. It corrected to around 410, and then it saw a big pop-up. More than 3 crore volumes yesterday. But the clarification has helped because the stock is moving back towards the high that we saw yesterday. BL Kashyap, that's the other one that's won an order out there. And that's the reason why that's moving on very, very large volumes. Keep an eye on some of these capital market plays as well. BSE, case in point, that's buzzing around. Jane could be back, probably. So that one, in fact, is up close to around 1%. And I'll pull up Angel One as well. That's the other one that could possibly be in focus because it's come out of the F&O ban as well. So that one as well up close to around 2%. One of those two stocks that I said could be, stocks in focus. Angel One as well as Hindustan Copper. Both of them coming out of the F&O ban, and they have some tailwinds as well. 361 WAM. Large trade getting cleared out. Nimesh told us, keep an eye on that one. 2 crore shares changing hands.
Eternal and Swiggy are the top two volume-led gainers in the market right now, the NSE, by far. So, 10% locked up, Swiggy 5%. So, the Eternal results doing some good for Swiggy as well. Up on your screen, and very large volumes in Swiggy right now. Paradeep Phosphate, was a big mover yesterday. It's up another 2.5%. And the only reason I'm mentioning this is because it's the third biggest volume gainer on the NSE. There is Afcons, which is up 2.5%. Nuvama, this is on the back of, the Jane if you want to call it relief from the regulator. They deposited money, and with ample supervision, they are going to be led back into the market. But Nuvama is a broker. There is, what else? Religare is up 3%. Decent volumes for this point in the day. MRPL, Nigel, you were talking about MRPL and CPCL yesterday. MRPL is up 4%. So 145 on this one. There is Naukri, InfoEdge, which is up about 3.5%. Latent View is coming up with by about 3.5% pop right now. So it's basically 4:1 advances to decline. It's still early and we'll have to wait, but it's looking good. 361, of course, that block, and that's why the volumes are humongous. Anthem, which listed yesterday with almost a 30% pop on top of the issue prices, down 3.5%, nothing very large. And I can spot a Voltas, which is down about 2.5%. Maybe throw in Supreme Industries and Parag Milk, which are also down. Supreme is down 2% and Parag is down about 2.5%. Just some stuff with over 2% moves with volumes on the downside as well. So that's the overall picture. The Nifty has got about 30 points on it.
Yeah, just a point, since we're talking about those refiners, Prashant, Yes Securities, they have been quite positive on it. And yesterday they put out this note about global refinery closures could indicate a medium-term tight supply. So MRPL yesterday was down. It's made up all those losses. There was a con call as well. And CPCL as well, that was down more than 5% yesterday. That as well has made up out of it. Very, very tactical. Remember, you need to be very careful. JRMs are very volatile. But for the time being, the street, is reading the commentary coming in from MRPL positively.
Absolutely. Well, let's welcome in Manishi Chaudhary, who's with us. He's Chief Executive Officer at Emma Capital Partners. Manishi, good to have you with us here on the program. Thank you. Just a quick word, Manishi, on the earnings season that we've seen so far. If you've compiled and looked at the entire stack which has come until now, and how does it compare to your expectations, and what does it mean? Very soon, if we've not already done it, many have already done it, you start looking at FY27 numbers. Go on, Manishi.
Right. We're still in the, looking at the first quarter of FY26. So by the time we start looking at FY27, it'll possibly be towards the end of this year, end of this calendar year. Now, the earnings season has been, mixed at best. So if you look at the large banks, not all of them. So Axis Bank was a disappointment because of, the asset quality issue. HDFC and ICICI were okay. IT services, on the other hand, were a bit disappointing. One would expect them to be so if the US and the entire Western Hemisphere are going through an uncertainty. So, at this point, it's still very early stage, but at this point, the earnings season is mixed at best. What is perhaps more important is the earnings estimate trajectory. And this is the point I've been harping on, on your channel, on several other media interactions. Earnings estimates for India, after a brief interregnum, after a brief recovery, I think around March, April, they're again on their way down. And this is happening across all sectors. It's happening across even those companies which have reported reasonably better results. It's happening across financials, across IT, across consumer discretionaries, across industrials. That is, a bit scary, especially for a market which is still trading at premium valuations, notwithstanding the correction that we have had over past months. So that is the key issue that I, and I'm sure many other market participants, would be watching for the foreseeable time horizon.
All right. Manishi, hi, good morning. Great to have you on. Food delivery and quick commerce. I mean, it's such a strong debate, and all those who remain believers in Zomato, when these companies, most of these companies came out and said, right, that we're expanding our dark stores, there's going to be cash burn. But those who remain believers, they're being rewarded today. But what do you think? I mean, is this just one quarter? Should we be cautious? Because a lot of the broker notes this morning are saying the worst is over. I mean, market share gains are great. They have a very strong going out business that they're building as well. So, gets a little heady when you have this kind of commentary. So what's your view?
In the short term, they do look good, in these quick commerce and food delivery companies. But if I draw, from the experience in China, these food delivery companies, despite skyrocketing growth, skyrocketing top line and volume growth, the stock prices have, kind of collapsed. I wouldn't say collapsed, but they have underperformed significantly simply because of one reason. And that's unbelievable degree of competition between the likes of Meituan and JD, and even Alibaba has its own food delivery outfit right now. So this is something we have to be careful about. As of now, India is kind of a benign oligopoly, and we haven't seen that crazy market capturing price war. But, it is something, if I take some kind of a leaf out of a larger market, which is China, and which I'm much closer to, this is something we have to be very careful about.
Manishi, but what's your take on
And sorry, just to complete that point, Nigel, once again, I completely take your point on competitive intensity, which is why I think we need to see if this is the last of it or not. On what about valuations, Manishi? Because Mangala, my colleague, was just telling us that on 1 year forward earnings, Zomato is trading at over 70 times. So it's not like you're getting it at a rock bottom valuation either. So again, just give us the valuation comparisons as well to a market like China.
That's a great point. That's a great point.
Yeah.
And think of an international investor sitting in London or New York or Hong Kong who has the entire canvas to choose from. So he can choose from Zomato or Swiggy trading at maybe 60, 70 times P multiple 1 year forward, or Meituan, or any of the others like JD. I mean, these are not pure, pure food delivery. Meituan is, but these are trading at high teens. So it's a striking comparison that an investor has to choose from, and that is certainly a second point, which I'm sure would make the investor base a bit careful about these companies. Now, of course, these are in different stages of their life cycle. So Meituan started somewhere around 7 to 8 years ago, and it has reached a degree of maturity. So the growth is not really as high as that of Swiggy or Zomato. But it's at some point of time, even the Indian quick commerce companies would reach that stage. And the question to ask is, how far away are we from that moderate growth stage, as far as the Indian companies are concerned?
All right. Hi, Manishi. Good morning. Good to see you win. Well, the Indian markets actually have been resilient, right? We had geopolitical issues. You've had Trump's tantrums or tariffs, whatever you'd like to call it. You have the regulator that's tightening the screws and volumes are down. And still we're at around 25,000. What's your sense, from year on, in the next 12 months or so? Could the Nifty be much higher from year on? Are we entering the next phase of the up move? Because the RBI as well has solely focused on growth. Inflation's under control. That's another booster shot. Your take.
Right. So let me break down that question into 3 or 4 different parts. First, India is in a very curious position right now. If you look at the macroeconomic fundamentals, they're actually quite good. You have declining fiscal deficit, you have a sharply declining current account deficit, which is hardly about 1% or so. You have sharply declining inflation, CPI came out at 2.1%. So these markers of macroeconomic stability, they're actually doing fine. The problem is with the micro, where earnings growth is disappointing. Almost every quarter, almost every month, earnings estimates are being brought down. So what we thought would be a 17 to 18% earnings growth year, fiscal 26 and 27, now looks like it'll be about a 14 to 15%, maybe even a percentage point lower. So this is what the investors are grappling with. So the real enthusiasm for India would really come back when we are able to put this period of earnings growth estimates being whittled down, when we're able to put this period behind us. When would that happen? That's a $1 million question, possibly late this year, when the impact of government capex increasing gets felt again among the industrial companies, when the impact of RBI's jumbo rate cut and possibly 1 or 2 more going forward begins to be felt among the consumers. It usually takes about a couple of quarters or more. So I'm thinking about the last quarter of this calendar year when the earnings estimates would bottom out and then begin to increase again. And now I'll come back to your first point. On an isolated basis, India looks like very resilient. Yes, it has held on to that, about 24,500 to 25,000 for the Nifty, somewhere around 80 to 82,000 for Sensex. It has increased. It has appreciated hardly about 2.5 to 3% this year. Look at Asia ex Japan. MSCI Asia ex Japan is up 14%. If you simply bought an ETF on MSCI Asia ex Japan, which is almost a zero-cost ETF, you would have made 14% in 6 months, and that's stupendous returns. So in comparison to its Asian markets, India hasn't done really all that well. And, I think that is something that we have to look forward to.
Like they say, gains beget gains, success, brings more success, right? So eventually, once we get our mojo back, then everyone will come. That's what's happened in the past as well. But we'll see. Earnings have to pick up. Take that point, Manishi. Great conversation as always. Thank you so much for joining in. And we look forward to the next one. Quick pit stop to check the market before we get to our corporate conversation. Holding steady on the Nifty, 30 points higher, but mid-caps are a little wobbly. Mid-cap index is flashing red now. Just a bit of profit-taking coming in on that side of the market. But anyway, let's move on and discuss more earnings and more corporate commentary. Angel One is the next company on our radar, and it reported an operationally slightly weak quarter, you can say. The company's profitability was impacted by IPL expenses and higher employee costs. In fact, some ESOP costs as well that they had to take on board. We have Amrish Kengi, Group CEO at Angel One, joining in to give us an outlook on the business. Amrish, great to have you. Thanks so much for being with us. It's interesting. I was taking a look at all your parameters as well, and the market has gone through so much of regulatory change, right? So April, May, June, the average daily turnover is kind of hovering between 35 lakh to, in the good months, about 30, almost touching 38 lakhs as well, or 37 to be tops. Your overall revenue has managed to grow 8%. But there's still a lot of chatter. There's some chatter in the market that there's more to come. Maybe they'll change the weekly options expiry timeline from weekly to fortnightly. So how do you sum up the performance and revenue growth in this environment? And do you expect more in terms of F&O regulation, particularly on the weekly expiry side?
Hi, good morning, Surabhi. Thanks for having me here on the show. I think, look, we had, I think, a solid execution quarter. You mentioned 8% revenue growth. When you look on an adjusted or normalized EBITDA basis, we actually grew by 30%. On a normalized PAT basis, we grew 26% quarter over quarter. So solid execution quarter. We've given this guidance before also that I think we were bottoming out in Q4 last year, and this Q1 we are showing that there is clear growth there. In terms of what you mentioned about the macro, I think in the short term it's been a little bit of a perfect storm, right? As you know, you've got some of the, of course, regulatory changes, which I think in the long term are super helpful because it makes the ecosystem stronger. But of course, we had the tariff conversations, the Pakistan escalations, you had the sort of war in the Middle East. So all of those things, despite that, I think the market has been fairly resilient. In terms of what is coming next, I think it's kind of a fool's errand to try to predict that. I do think that the regulators have balanced it quite well. I think they're continuing to balance both the trust that the consumers have in the market, but also balancing the growth of the market and making sure that you got the right set of price discovery, you have the right set of instruments in there. So I think I don't want to sort of predict what the regulator would do next, but all the conversations that I'm seeing, I think they're being very balanced about how they think about the retail investors as well as the markets overall.
So can you give us some, I don't want to speculate on this, but just to know, in case something like this does develop, if the product is changed from being a weekly product to a fortnightly product on the option side, to what extent can that impact your revenue and overall volumes?
It's hard to exactly predict how consumer behavior changes. I think that's like the holy grail in any case. But what I can tell you is that, look, if you look at our earnings, about 45% of our revenues came from F&O broking. So while people may think it's a very large amount, people think it was probably even larger, but it's really only 45% that's coming from F&O. In terms of fortnightly expiries and changes like that, I think it all depends on the nature of it and how it is implemented and executed. But I don't think there is any indication from the regulator. So I think there's a lot of chatter, but I haven't seen any specific indication from the regulator. So my suggestion would be, I think we should just wait and see what happens there.
Right. Amrish, hi, morning. Prashant here. Now we're talking about the numbers for April to June, right? But early July, we got SEBI, which came out with that order on Jane Street. Now, I don't want to talk about a specific entity, of course, but they were such an outsized contributor to volumes, etc. And a lot of people are saying, well, volumes are down since then. And maybe they are because, of course, what they were doing, but also because of others doing what they're seeing in the market, and that what was happening in the market was being caused by this one entity. So, participants had to adjust their positions in response to what was happening in the market, which was in turn being caused by this one entity. So volumes are down. Can you give us a sense since then? Because this is, we'll get a real sense of what's going on, since that order.
Hey, Prashant, good morning. I think anything like this does create a little bit of a shock in the system. Again, and it's a large player we are talking about. And a sort of a very significant order that was passed. In the short term, I think you always see, you always see certain good things happen. You see exuberance. In the short term, when something like this happens, there is a bit of a shock to the system. What I can personally see is actually there's been some recovery since then. From we of course will publish. We are probably the only entity who publishes our numbers at the end of the month. You'll see orders and everything come out. I do see some recovery from that. I think markets are not dependent on just one entity. I think there is a lot of, of course, there is, FPIs making investment, but you see a lot of DII.
Amrish, if just to get a sense, and you said, we're almost at the end of the month, so maybe I'm asking you to give out the numbers before you publish them. But to the extent that you can, say from a baseline of 100, where are we now post the Jane order?
Look, I don't want to.
Are we at 80? Are we at 70?
Prashant, I wish I could give you those numbers. I don't want to sort of jump the gun because I think it ends up, things end up changing across the month. There are different sort of ups and downs that you do see during the month. I do think, you see the sort of markets recovering. You're seeing some of the things recovering. I can't comment on exactly like what percentage impact these things have. That's hard for me to say. And we don't worry about day to day as much. I think we really have to worry about the fact that and celebrate the fact that overall macro fundamentals haven't changed. Like when you look at the next 3 to 5 years, nothing has changed. I think India's GDP is growing phenomenally well. The demographic dividend is in place. How you see retail investors have grown both in derivative participation as well as overall equity. Like you see overall equity, right, over the last 5 years, I think investment in equities has gone from like 16 lakh crore to like 70 lakh crores. So that is continuing to happen. So I wouldn't worry about sort of the daily or monthly gyrations. That's, that sometimes ends up giving the wrong perception.
All right. Hi, Amrish. Good to see you in. Nigel on this side. Let's get a couple of numbers, though. You've taken us through the macro, some parts of the micro as well. Let's focus on margins first. It mistreated expectations, right? Because of that 47% jump that we saw on a sequential basis in employee cost. Because of the stock options. You're also scaling new verticals, asset and wealth management and the likes. Given that, this employee cost has spiked up, it could be a little bit sticky, scaling into newer verticals. What is the outlook on margins on a blended basis for FY26? It's been declining for 3 straight quarters, so I ask you this question.
So Nigel, hi, good to see you. The way you have to look at it is that if you look at our earnings, you would look at some normalizations that we have done. So the last quarter looked, the employee costs looked a little bit lower because there was a one-time adjustment we had taken for variable pay. So therefore, you saw that, that's why you're seeing that kind of appearing as increasing. But once you adjust, the cost actually hasn't gone up as much. And if you look through earnings, it's almost sort of flat from Q4 to Q1. In terms of margins, if you adjust, if you look at the adjusted EBITDA margins, that would come out to 34% once you adjust for IPL costs and this employee costs that I talked about. So that's been sort of a healthy margin. We do think that margin will increase from here and in Q4 get closer to 40% margin. So that's something that we've given guidance on. At the same time, we are a big believer in long-term investments. Angel One, you guys are aware of it, but your viewers may not be as aware. But Angel One has been a company that's been around for 30 years, and actually in some form even more than 30 years. And we've been able to transform ourselves with all of these changes that have happened, and we've transformed ourselves into a sort of large technology company at this point. But you're also seeing us diversify. So if you look at wealth management, if you look at that AUM, that's grown very healthy. It's more than 5,000 crores now. On the AMC side, you saw that our AUM went up more than 340 crores. And it's very early days and it's growing well. On lending distribution, our lifetime so far was 700 crores. We added 230 crores more of that distribution, and you'll see that. So while we are transforming ourselves continuously into a technology company over a period of time, but you're also seeing us diversify. And all of these seeds, once you sow them, they're going to show you much more later on. And we look at it like a 3 to 5 years.
Okay. Absolutely. Sorry, Amrish, so sorry cutting you short. Earnings seasons are just back to back. But very quickly, if you could just leave us with some numbers. One important number is you're saying your margins will get back to 40% by the fourth quarter of the current year. You're also investing in the wealth business and some of the other related businesses. So what is the total investment you've planned? And what should be a top-line expectation for FY26, full year?
So we don't talk about specific investments in those areas. We are not breaking it out right now. As we go along, we'll break that out. Same thing with the top line. I think it's very, very early investments right now, so we don't break them out. We broke out our revenue in terms of distribution, that's 3%. But wealth and AMC, it's still very early days, and it ends up being back-ended. You invest first and you end up getting revenue.
You reap profits later. I mean, the wealth business, of course, is booming, has been booming. So we'll look forward to touching base later on. And of course, look forward to the end of the month numbers, as you said, right? For that full month impact, the lack of Jane in the system. and what is the impact on orders. Amrish, thank you very much. Good luck. Appreciate you coming on this morning here on CNBC-TV18 for that quick conversation.
Thank you very much. Really appreciate it.
All right, PNB Housing is on our radar. First quarter was a healthy quarter for them with profits above estimates and good growth in loan book and disbursements. To talk about their first quarter performance, Girish Kausgi is Managing Director and CEO at PNB Housing Finance. He's with us. Girish, great to have you with us here. Thank you very much for your time. Prashant this side. If I can start by asking you, Girish, how much of the rate cut impact is already, have you taken into account this quarter? How much is left to be accounted for in the next couple of quarters? NIMs have remained stable sequentially. And I think your guidance is now about 3.7% on the net interest margin front. What gives you the confidence? Just break that down for us.
Sure. Good morning, Prashant. So if you look at repo cut in last 6 months, it was close to 100 bips. So in our cost of borrowing, we could see a benefit of about 8 odd bips. So we will be passing on 10 bips effective July. So we have baked that into our Q2, and any further cuts, we will figure out what is the benefit we are getting, and then we will try to pass on the benefit to the customer. So we are pretty much confident on the NIM. So earlier the guidance was between 3.6 to 3.65. Now we are upping the guidance to around 3.7% NIM. So we are pretty much, we are very confident. What gives this confidence is basically because if you remember, we are now trying to move segments. Our focus is now more on affordable and emerging. If you look at the origination in quarter one, it is close to 50%. And on book now, it is about 37%. So by FY27, we expect it to cross 50%. So 50% of the book will be affordable and emerging. So in each of these segments, that is prime, emerging, affordable, and the loan against property, the new vertical which we started this year, in all of these segments, our attempt is to try and increase the yield. And therefore, we are very much confident on NIM being stable at around 3.7% for this year.
Okay, all right. Hi, Mr. Kausgi. Thanks a lot for joining in. So your focus clearly has been on emerging as well as on affordable segments. And as you said, it comes as a better yield. No worries, though, on asset quality? Everything stable on that front?
Yes, I think last quarter, the asset quality GNPA was 1.08. Now it is 1.06. I think going forward, you'll be able to maintain between 1 to 1.1 on a steady state form.
Okay, what about, let's clear out a couple of numbers. What kind of growth guidance can you give us for the year? And you've gone ahead and upped your NIM guidance, I think, a little bit by around 10 basis points. Give us the guidance on both those two numbers.
On retail loan growth, we have guided 18%. We stick to our guidance. Maybe it could be slightly better by end of the year. In terms of NIM, it was initially 3.6 to 3.65. We are very confident and therefore we have upped the guidance. So it will be around 3.7%.
And the retail book you had mentioned earlier, you see it going to 1 lakh crore. Which quarter does that happen?
So this will happen by March 2027. The retail loan book will cross 1 lakh crore.
Mr. Kausgi, hi. Good morning, sir. Great to have you on. So just trying to understand, since you're focusing more on the retail book, could that growth be higher? Could it eventually lead you to perhaps even surpassing your own guidance for overall AUM growth this year?
It could. So which is what I mentioned. So we have guided 18% book growth
for retail.
And with the market, see, as of now, market is quite robust. It is very good. Quarter one being cyclical, you might see most of the companies, posting lesser growth on disbursement and lesser growth on book. This is quite normal. You take any year, quarter one will be muted. Otherwise, demand is quite robust. We see very good opportunity in all the segments. But our focus is more on emerging and affordable and, of course, loan against property. So there could be chances that we could surpass a guidance of 18%.
Where is the ROA headed, sir? This year, negative credit cost guidance is what you have given. On a steady state basis, how do you see the ROA scale up?
So I think currently, if you look at this quarter, we are at about 2.57. So it will be around 2.5 to 2.6 in that range.
Okay. All right, Mr. Kausgi, thank you very much for joining in. Really appreciate it. And good luck to you with all of those plans. Very, very steady start to the year and pretty steady guidance on margins and growth. perhaps 18% on the retail book, and maybe more than that overall as well. That's PNB Housing. Well, in a minute from now, we'll put the spotlight on the pharma space. What can the first quarter earnings season herald for the pharma sector? We'll talk about that as we go on. Just a quick check on the market. It's still very, very stable. Not too much has changed. The headline of the day continues to come in from obviously the food delivery and the quick commerce space. Now that little freeze that happened on Eternal, that obviously opened up, and now the stock's up about 11%. Swiggy is up 5%. So those are the big movers of the day. And some of the larger banks, they started the day on a positive note, still continuing. 0.5% up on HDFC Bank and ICICI Bank up 1%. So some of these big stocks are keeping the Nifty's head above water, 40 points up overall. I think we can take a quick break. We'll take that break, come back. We'll have Ekta joining in and the analyst from Prabhudas Leeladhar to tell us what the first quarter could spell for the pharma sector.
Well, it's time for our special segment, Quarter Se Quarter Tak, where we bring you expectations from each sector. Today, we turn the spotlight on the pharma pack. Ekta joins us to help us out with what are the expectations. Ekta, take it away.
Thanks for that. Well, for pharmaceutical stocks as well as healthcare stocks, expect a steady quarter. Now, for pharma companies, you are expecting around a 10 to 11% growth in revenue and a growth in EBITDA, which would be similar this quarter, along with profit between 5 to 10%. Now, expect the US growth for generic companies estimated at around 3 to 4% Q-on-Q. Growth X of Revlimid generic would be something to watch out for. Now, that would, overall growth in the US would be led by stability in US generic pricing, volume growth in existing products, and a pickup in recent launches. Expect lower Q-on-Q sales in Revlimid generic for companies such as Aurobindo, Cipla, Dr. Reddy's, Sun Pharma, according to analysts, as price pressure increases. Now, for Sun, watch for the specialty portfolio growth. That would be the key thing to watch out for. For Biocon, watch for growth in the biosimilars portfolio. Now, the range for domestic growth is wide, anywhere between 8 to even 16%, according to some analysts. Now, domestic-focused firms such as Torrent, Ipca, Alchem expected to see good growth this quarter. And watch for commentary on Torrent's acquisition of JB Chemicals. Now, most API companies are likely to see a volume uptick this time round with an estimated 8 to 9% growth year on year. Expect over 15% growth in some CRDMO companies driven by the likes of Bluejet, Divi's, Loris Labs, Sai Life Sciences. While Syngene and Piramal Pharma could probably see a muted quarter due to inventory destocking on key molecules. Now, moving on from pharmaceuticals to the healthcare front. On the healthcare front, expect around a 20% growth in EBITDA, driven by over around 20% growth in hospitals and around 10 to 11% growth in diagnostics as healthcare companies recover after a softer Q4. Apollo hospitals might see continued impact of international patients slowing from the likes of Bangladesh. Commentary on the recent restructuring will be watched. Expect steady margins for the likes of Dr. Lal's. Watch for recent acquisition integration for Metropolis, which has been on an inorganic drive. Now, let's leave you with the valuations. First, for the pharma stocks, as you can see, Sun Pharma ruling the roost, most expensive, along with a couple of others such as Divi's Labs. So a lot of probably the good news is factored in. For diagnostics, Dr. Lal's as well as Metropolis, FY26 PE stands at around 50 odd times. And finally, for hospitals, the likes of Apollo Hospitals and Max ruling the roost in terms of valuations there.
Okay, all right, got it. Ekta, thanks very much for prepping us up with the pharma and healthcare report card. Let's take this forward with Param Desai, who tracks the sector at Prabhudas Leeladhar. Param, great to have you on. So what's your sense? I mean, hospital stocks anyway have been doing really well, but if we talk about pharma, with so much going on and still the sword hanging in terms of what the eventual US policy is going to be with respect to import of generic medicines, let's start right there. I mean, in terms of just pure earnings growth, best-in-class earnings growth, which company will deliver in the first quarter?
Hi. Overall, if you see US, the growth will be slightly on a softer side. The base is on a higher side given the Revlimid. And we are seeing most of the companies Revlimid, there is an erosion on a Q1Q basis. So on a large cap side, whoever's having a higher Revlimid exposure will have a slightly flattish growth in the US from a YY perspective. Having said that, I think domestic pharma will be a pretty steady quarter. For most of the guys, the growth will be in the range of 8 to say around 13% among our coverage universe. The acute season has also been started pretty well. So slightly acute heavy companies like Alchem, Ipca, Mankind should do well during the quarter on a YY. But net is the US which is basically keeping the growth slightly muted on the pharma side.
So I take your point on Revlimid, and that's where that high base will come and play a part. But X of Revlimid, overall, when you talk about US business volumes, then what's the picture like? And from large cap pharma perspective, again, I go back to the growth question: which company could deliver the best in class growth?
So from an X of Revlimid, the base business I think should be a steady. There should be some price erosion, product specific price erosion will be there depending upon the competition. But overall, I think the price erosion continues to in a mid single digit. So we expect the base business X of Revlimid to grow on a YOY basis. Among our coverage universe, from a Q1 perspective, I think Lupin will see a highest growth YOY, largely aided by one of the product called Tolapatin, where they have an exclusivity. Barring, I think, Lupin among our coverage, the growth largely among the large caps is largely a flattish on a YOY basis.
Okay, so that's as far as growth is concerned. Just run us through some of your favorite top picks and why, and also throw in that margin perspective. I mean, we've discussed growth. From a steady margin to maybe even a growth in EBITDA margins, is there anyone to watch out for in Q1?
Yeah, so margins largely will be pretty much steady. If you see the raw material prices continues to be pretty benign. So gross margins will continue to remain healthy for most of the guys. Yes, there could be some kind of margin erosion because of kind of a Revlimid-led erosion. Otherwise, margins are expected to remain pretty much steady across the majority of the companies. With respect to our topics, we preferred on the pharma side, we prefer Sun, Lupin, among the large caps and DVs and Eris. These are the preferred names in the large and the mid cap names. So Sun, clearly, I think the story on the specialty side, we are structurally very positive on that space. I think they have interesting pipeline to go out. Two launches lined up in this year, and beyond 26 also, they have some good pipeline to play. So specialty is a segment which will drive in case of Sun. They have a less dependency on the US generic. So that is clearly a preferred pick among the large cap names. followed by Lupin, which has a zero Revlimid exposure, and they do have an interesting US pipeline with a couple of products on exclusivity side this year. And beyond FY26 also, they have some couple of niche launches in the US, which will drive their overall growth story beyond 26 also. So these are the two names among the large cap. And in the mid cap, we like Eris. It's a pure 85-90% domestic play story. Some of the inorganic initiatives what they have taken last year, I think that has been shaping up pretty well. And there is also a GLP story which will come into play in case of Eris from 27 onwards. So I think we almost see PAT getting double in the next 2.5 years in case of Eris. So this is one of the name which look in the mid cap name.
So Sun Pharma, Lupin and Eris. Sun, yeah, there was some positive news, the news flow on their Illumia drug as well in the next phase of trials, I believe. Very quickly, Param, finally, hospitals. Apollo Hospital has been a dream stock for many in the market. I think it's still your top pick, but, do you like anything else? And again, from an investment perspective, should more money go to hospitals, pharma, split it up? Just quick final take.
Sure. So we have structurally very positive on the hospital space. I think even this quarter, if you see the growth is around 18 to 20% EBITDA growth. So another quarter where the growth remains pretty much steady. So we prefer hospitals over pharma, given the kind of growth profile. And the important thing is next 3 to 4 year journey in the hospital is largely aided by the bed expansion. Most of the guys are almost doubling the bed in the next 4 to 5 years. And this expansion is largely coming function of brownfield, inorganic and greenfield. So that will not drag the P&L, which was the case in the last CapEx cycle. So we remain structurally very positive. We see around 18 to 20% of EBITDA growth story to continue in the hospital space. And among our preferred picks in the Apollo, KIMS, Jupiter, these are the preferred names in the hospital space.
Apollo, KIMS and Jupiter. Thank you very much. Good speaking with you there and getting that perspective, Param. So that is the sort of healthcare and pharma space on the back of the earnings which are expected from the space. Let's talk about markets which are now absolutely, they've gone back to being flat on the Nifty. Just under 25,100, 25,090 or so is where the Nifty is trading at. But it's not as if stocks are not moving, they are. I mean, Eternal and Swiggy remain the top movers. Angel, we just spoke with the management, is the number 3 volume-led gainers list, 4% there. Info Edge is up 4%. Tilak Nagar, MRPL, I mean, there's enough happening on a single stock basis. Religare has started moving higher as well. So about 280 odd rupees on Religare. There's India Cements, which is up about 2 odd percent. Gabriel, 6% move on Gabriel on decent sized volumes as well. But what should you do in terms of trades now? As always, Mitesh is back with us with that. Mitesh, morning again. What do you have?
So I have one buy and one sell call right now, Prashant. I think Canara Bank and the banking pack is looking slightly weak. So Canara Bank for me is a sell with a stop at about 113 and a target of around 104, 103 half can be looked at. And UPL, it's done well. Yesterday there was a good movement. Today this mild pullback. So around 710, try to buy into this one with a stop at about 695. Look for targets from 745.
Okay, all right. Well, thanks a lot for that, Mitesh. Let's focus on some stocks, though, that are moving around. Ria's with us to tell us about AGI Greenpack, which is reacting positively to its numbers. Ria?
Well, yes, Nigel, AGI Greenpack has come out with its Q1 numbers yesterday. In terms of the revenue, that has gone up by around 21% over the previous year. The EBITDA and net profit have also jumped up by 20% and 40% respectively, although the margin has contracted by around 37 basis points. But coming to the important news flow here, the company has diversified into the manufacturing of aluminum beverage cans. They are going to build a new facility in Uttar Pradesh for this, and the capacity will be 1.6 billion beverage cans per year once they finish the entire capacity addition. In phase 1, they're going to add around 950 million cans, which is planned to start by Q3 of FY28, and in phase 2 will be implemented by the end of March 2030. Now, the total capex for this is rupees 1,000 crores, 850 crores in the first phase, and the balance in the second phase. And this is going to be funded by a mix of debt and internal accruals for the company. Now, the management has also said that they are entering this segment with a clear goal of becoming the top player in this segment within the next 1 decade. And remember, at the end of Q4, the company had also given guidance for the full year of FY26. Revenue growth target is at 8 to 10%, and EBITDA margins will remain in the range of 22 to 25%.
All right, got it, Ria. Thank you very much for that. That's AGI Greenpack. But let's get back to the stars of the day. Has to be Eternal and Swiggy. And I think in a related excitement, even Info Edge, last I checked, was up some 3-4%. Manglam's back with us. What a move, Manglam. It's really silenced its critics, at least for this quarter.
What do they say? When it rains, it pours. And that's exactly what has taken place when it comes to, Eternal. If you look at the last couple of trading sessions, the stock going into the numbers was about 15% away from its record high. And today morning itself, post-opening, the stock has gone ahead and hit a fresh record high for the first time in the last 6 months or so that I remember for Eternal. And there are a couple of reasons for that. One, the initial sign of the numbers told you that the worst is behind, and thereafter the management came and confirmed that in the food delivery business, growth seems to have bottomed out, and from here on things are looking on the mend. Even quick commerce, despite the competition that they've seen, perhaps the worst is behind in the near term for the quick commerce margins. And these are businesses that are growing, at least on the quick commerce side, over 100%, and has now become the biggest contributor to the company's overall revenue as well. Earlier, it was just the biggest contributor to their valuation. The third engine, which is District, is likely to be a $3 billion business over the next 5 years as well, with $150 million adjusted EBITDA annually. All of these has the brokerages fairly excited. Jefferies has upgraded the stock to buy. They have a target price to 400. CLSA has a high conviction outperform, a target price of 385. Goldman Sachs, 340 rupees, positive on the stock. And Bernstein too has raised their target price to 320. When Zomato runs, it's not just that, because you have a comparable company on the bourses as well. Swiggy. Swiggy is higher as Eternal management expects growth to return. So the growth is returning for the sector. Swiggy stands to benefit as well. And the only thing that plays out between Zomato and Swiggy is the valuation discount. Swiggy currently is at a 45% discount to Zomato when it comes to price to sales valuation. So that stock catching up as well. And finally, you have Info Edge. They invested about 13%, or they hold about 13% stake in Zomato as of June 2025. And their stake after this up move is all the way up to nearly 40,000 crore rupees, or $4.5 billion. What does Info Edge's own market cap look like right now? It's around 94,000 crores. So nearly 35 to 40% of Info Edge's current market cap could be valued as holding in Eternal.
Absolutely. Manglam, I can tell you when customer preferences shift so quickly without we even realizing it. And as a customer, I'll say maybe District was a masterstroke. It's a one-stop shop. Now you don't hop across multiple apps, so that it's movies, booking a restaurant seat, going to a concert. It's all on your District. So, whoa, what a strategy really.
The interesting thing is, if you just look at the Swiggy shareholders letter and look at the cover, that tells you exactly what the company is all about. And this is Eternal, right? So if you look at the shareholders letter, they have 3 pictures. On one, there is a hoarding which says, Aaj kya khaoge? On the second, there is a hoarding which says, Aaj kya mangwaoge? That's Blinkit. And the third one is, Aaj kahan jaoge? Which is District. So what do you call for in your house? What do you eat? And where do you go? All of that in Eternal.
Absolutely clear. And I myself am a customer that's getting completely captured in that ecosystem. I find that happening and in a very subtle way as well. Thank you so much for joining in with the details over there. But guys, we have Nimesh now joining in. And he's got a very interesting analysis. Actually, let's go across to the wall, because Nimesh has been looking at a lot of data that kind of ties in the perspective with what happens to stocks and companies when there is a change of guard. So is there a clear correlation? Let's ask Nimesh.
Oh, absolutely, Surabhi. We've discussed in the past as well that normally when we see a leadership change, it's a case of a re-rating for the stock as well. So I've looked at the data since the start of 2021, and this is a BSE 500 data. Across the BSE 500 companies, more than 100 companies have seen a change of guard in the last 4-5 years. And interestingly, more than 20 companies have seen a stock price reaction between 30 to 200%. So that's the kind of reaction you see in the stock price, or the re-rating that you see in the stock price. But there are some companies which have given more than 200% return as well in the same period. So I'll start with that list first. The first stock on my list is Persistent System. Look at the kind of reaction to the stock price. The stock is up 850% since Sandeep Kalra took over as a new MD and CEO in October 2020. 850% in the last 4 years. That's the first stock we've seen a big reaction there. Next in the list is, no, this is not Persistent System. The second on the list is Newgen Software. They got a new CEO in 2021 and the stock has reacted 285%. The third on the list is Himadri Chemicals. That stock is up 500% since the new CEO came in 2022. Again, a big move there. The next stock is Zensa Technologies. Even that stock, the company saw a new leadership change in 2023, and since then the stock is up 275%. These are the few names which have rallied between 300 to 800% in the limited period of time. So that's the kind of data, you know, which proves that a leadership change leads to a big re-rating. Remember, this is the BSE 500 data. If I look at NSE, one stock which will stand out for me is Bombay Stock Exchange. It's only listed in NSE, and we've seen a massive reaction to that stock price as well, but that doesn't show up in the data. So now the question is, will the history repeat itself? And that's something to watch out for. Which are the few companies where there has been a leadership change announced, and can that stock see the re-rating in the near future? The first on my list is HUL. A woman CEO now, Priya Nair, has been appointed as a new CEO on July 10. So need to see in the next few quarters whether you see a big re-rating in the stocks like HUL. The next stock is Cyient. Even Cyient announced a new CEO in February 2025. The stock is still not reacted, but we'll have to wait and see as to what the strategy is for Cyient going forward, and will the stock react or re-rate further from here on. Titan, we all know that there is going to be a fresh change of guard from January of 2026. Across the various verticals, you're going to see new CEOs in Titan as well. So Titan will be the stock to watch going forward. Across, as I said, you know, watches business as well as jewelry, there are going to be new CEOs there. The next on my list is Cyient DLM. Again, you know, they've appointed a new CEO in July 1st. So again, fresh appointment, but we'll have to see whether going forward even that stock re-rates or not. And the last but not the least on my list is Max Financial Services. Sumit Mandal has been appointed as a new MD and CEO of Axis Max Life, which is the insurance arm of Max Financial. They are going to see a new CEO from October of 2026. So again, massive changes are happening, and we've seen big reactions to the stock prices as well. History suggests a change of guard leads to re-rating. So we need to see if there is a fresh change of guard in many companies. Only recently we saw a big reaction to something like, for Arvind Fashion as well, right? I mean, we saw a big reaction to that when they appointed a new woman CEO. So history suggests that a leadership change normally leads to a big re-rating in the stock price as well.
Okay. And we'll have to see if history indeed repeats itself. And that's amazing, right? Because a lot of these companies are from the consumer space as well. The ones where there'll be a management change and at an interesting crossroads, at an inflection point, perhaps, when it comes to
If you want
growth.
more perspective on this, Nimesh, Surabhi, you should log on to
TV18 Access.
TV18 Access.
Correct.
And you can find a full 35-40-minute discussion on this, various perspectives.
Yes.
But you have to have access.
Leadership change, what that may mean for companies and for stock prices. Well, speaking of stock prices, by the way, that's important news flashing on Tata Power on your screens. Just keep sight of that. All 5 units of Mundra are going to go in for a planned maintenance shutdown. IIFL believes it could lead to about a 6% hit on FY26 profit estimates. So, yeah, stock's down about 0.5%. Take a break on that note. Come back on the other side. We'll have Manisha joining in with the latest on the commodity markets. Welcome back. Well, the equity market has quietened down, but let's train our eyes now on the commodity markets. We have Manisha joining in. Manisha, so tell us, what's the headline today? What are you watching?
Well, I'm looking at metals for a second straight day. The kind of gains that we saw yesterday is not what we are looking at today. But the important point is that we are still trading on the higher side, and we still are at around multi-week to multi-month highs. So overnight markets have seen steel prices gain up by a percentage point, and with that, we're trading at a 3-month highs. Good gains coming in for nickel as well after a very long time. By the way, it's a percentage point higher at a 6-week highs. Iron ore prices are your gainer, by the way, because in Shanghai, in US markets, we've seen very strong gains come in for this one. And overnight has been yet another 3% of gains, and that has taken the iron ore prices to a 5-month highs. Other metals also have seen a spillover effect because of that. So you have zinc and aluminum prices gaining 0.5% per piece, and 3 to 4 month highs coming in for these as well. It's not just about the base metals and the ferrous metals, but we also have seen the precious metal prices gain up, by the way. So if you look at platinum, that was at 2.5% on the higher side, and near 2% of gains coming in for gold and silver as well. So while we are trading very close to multi-year highs in case of platinum and silver, gold prices hitting $3,400 an ounce is a 5-week highs coming in for this one as well. Well, the metals are supported because of one point, and that is the dollar index, which has slipped below 98. That clearly has been supportive. And then traders are pricing in a 60% chance of a rate cut for the month of September. That also seems to have given a new lease of life when it comes to many of these precious metal prices. For industrial metals, it all comes in from China. Remember, the economic data that we've seen come in from US has been positive. And from China, the construction of world's largest hydropower dam in China has begun. And China has been putting out statements and updates onto that, and that has been supportive. Well, to tell you, the largest dam is estimated at a $167 billion, and a lot of steel, and that means iron ore and nickel, and then construction, when it means that, would also need other metals as well. So this is going to require steel and various other metals, and that has been supportive. In any case, China has said that they will continue to issue more of such construction projects. They are looking to reform industrial policy to align to their overcapacity, and a Chinese stimulus measures is what the street also is awaiting for. So all of those factors very, very supportive for the metal prices going forward. What the street will now also want to watch out for is the EU-US trade negotiations in this week, if any final statements come in from that. As of now, we're working with 30% of tariffs that could be slapped on European Union. And then it is also about the ECB policy meeting, where the expectation is that the interest rates would be kept steady at 2%. And finally, the US Fed policy next week, well, it's not going to be changing anything in interest rates, but any guidance statements from Jerome Powell is what the street will react to.
All right, Manisha, thank you very much for that. We'll take a quick commercial break here. On the other side, Lata is going to be speaking with the management of UCO Bank on the back of their first quarter earnings. Stay tuned.
Welcome back to Corporate Radar. UCO Bank has reported a good set for the June quarter with advances growing by 16.5%, deposits by 11.5%, both well above the industry average, even if lower than their own previous quarter. The net interest margins have fallen, but by only 4 basis points to 3.18. On the other hand, slippages have gone up a bit from 1.08% slippage ratio in March quarter to 1.18 this quarter. There is also a slight fall in return on assets and return on equity, which would bother investors. Joining me to discuss these numbers is the Managing Director and CEO, Mr. Ashwini Kumar. Mr. Kumar, good morning, and thank you very much indeed for joining me. Can you tell us what will be the progress in terms of both loan growth and margins? Your loan growth is lower compared to the last quarter. One can understand that. The March quarter is always a busy quarter. But can you steady yourself at around 16% loan growth?
Thank you, Lataji, for having me on your show. First of all, let me share with you that for last 2 years, we have been growing in our advances and deposit growth also. Deposit growth last year, we were not growing much because our CD ratio was lower. So this year we have started looking at the deposits also, and you can see that the March quarter and this June quarter, our deposit growth is more than 11%. So, and that momentum will continue because now we have achieved our CD ratio of 75%. Going forward, if you look at our advances growth, last 4, 5 quarters or 6 quarters, we are growing our advances, and these advances growth is mainly coming from retail, agri and MSME segment. And that segment still continues in this quarter also. Our home loan growth was around 18%, vehicle loan was 66%, MSME grew by 20%, and agriculture 15%. So these are the 3 engines of our growth which are growing at a good pace. And I expect that these growth momentum to continue because our 3,300 franchisee in the field branch network is working towards reaching out to retail customers, agri and MSME. So this growth momentum will continue.
No, your growth momentum, you have guided for something less. You're guiding only for 12 to 14. So you think 16 is tough to maintain?
See, guidance is always on a conservative basis. Last year also, if you look at our guidance was 12 to 14, but we achieved more than 17. But looking at the current market scenario where the credit growth has slightly come down, though the guidance continues to remain 12 to 14%, but being small in our base is a little small. So I expect we may surpass the guidance.
Okay. What about margins? You've managed it very well in the current quarter. Almost every other bank has lost from between 7 to 27 basis points in terms of impact on margins. Will there be more now that the full 100 basis repo cut comes into force? By the way, how much of your loans are linked to external benchmarks?
Our external benchmark loan links are around more than 50%. I think 53% are linked to external benchmark, where full transmission has happened. In MCLR also, we have already reduced MCLR by 10 bips. And next month again, ALCO will happen, and then the call will be taken about the MCLR also. So the repricing of MCLR loan also will take place little bit. But simultaneously, if you look at the deposit market, our deposit rates have also come down, not only in the bulk market, but in the retail deposit market also. So the deposit repricing will also start happening from this quarter. And I think by December quarter, the bulk deposit repricing will be over. And by March, retail repricing will also be substantially over. So I expect that by the year end, the margins will stabilize. Maybe in this quarter, we'll see another 2, 3, 4 bips of decline in the margin, because this will be the full quarter where we'll have a 1% reduction in the repo rate. In the last quarter, we had only 1 month. So this quarter, we will have the full impact.
No, fair enough. And then after September, you will have the advantage of CRR. So what may be the exit margin? Exit margin will be well above 3. Will it be 3.2? I mean, last quarter.
See, our guidance for the margin is 3 to 3.10%.
Okay.
And we expect by March, we will reach to this level.
All right. Okay, slippages. That is the sticky point. Where did it rise, sir? I was trying to look through your PowerPoint presentation. And in slide number 33, it looks like corporates are the ones that have reported higher slippages.
See, I think it's not corporate. We have a slippage in one MSME segment, 337 crore, out of which 300 crore, total 300 plus crore. Out of that, one was mid-corporate segment. That is one account only, 137 crore slippage was there in that account. Because of that, slightly slippage is higher in this quarter, but overall slippage is within the guidance of slippage ratio we have given. Our slippage ratio guidance is 1 to 1.25. And annualized slippage ratio is 1.1 time, 1.18.
Okay, no, fair enough. Sorry, I was looking at not slippages, but SME. I'm sorry. In SMA, the only worry I have, and by the way, for those of you who don't follow this jargon, SMA is simply loans which are overdue. So SMA 0 if it is overdue for 30 days, SMA 1 if it's overdue for 60 days, and SMA 2 if it's overdue for almost 90 days. Now, what I notice is that your SMA 3 has gone up. SMA 2 has gone up from 0.03 in the last quarter to 0.3 in this quarter. Almost a 30 bips rise. And over there, I think it is the corporates which are showing higher SMA. Are you worried that your slippage will continue, even in this quarter?
See, Lataji, if you look at our overall SMA figure, more than 1 crore we report. We are the bank, we report more than 1 crore SMA figures, SMA 0, 1, 2. SMA 2 figure in this quarter looks higher because previous quarter, it was because of the February impact, it was 59 days. So certain accounts which were technically in SMA 1, actually they were in SMA 2. Because of that, if you look at our trajectory of SMA over the previous quarter, it is in the same range.
Okay, so you're saying there's no danger that this is more a technical number because of the number of days. Yes. Okay, what about the recoveries, possible recoveries from the NARCL? You have given a detailed table, but I was not able to make out how much money you will make from NCLT and NARCL. Should we expect some recoveries?
See, in this quarter, we had around 275 crore of recovery through in NARCL. And one account is already under discussion, which is amount of ₹75 crore. That is already identified. Due diligence is going on. So I expect that account also to be resolved. There are further accounts which are getting identified for discussion with the NARCL in the times to come. So we expect that certain more accounts will be added in this quarter and the next quarters for the resolution through NARCL or through NCLT.
Okay. What about capital raising? Government has 90% in you. This is a damn good time for you to raise. I think you all have a 2,700 crore capital raising resolution also. Yeah. Isn't this a damn good time to raise? Should we expect something soon?
See, last year in the March quarter, we raised around 2,000 crore and we reduced our government stake from 95% to 90%. This year also, we have taken an approval from the board and the shareholders to raise QI money. And we will plan in the next quarter at the opportune time when the time is ripe. That time we will plan for coming out of our plan for taking the money.
Okay, well, you have got a damn good example from State Bank. They have managed 35,000 crore. So 1/10 of that shouldn't be a problem for you. There will be an OFS also, right? Sometime now from the government?
Sorry? Yeah,
OFS, offer for sale?
Possible. There are discussions going on. I think Deepam has come out with RFP also for onboarding certain merchant bankers. Okay. So the discussions are on. Let's wait and watch.
Okay, well, just a final big question. Bank of Maharashtra is only slightly larger bank than you in terms of loans and deposits. But they are reporting a ROA of nearly 2. Of course, they had some tax write back. That was a very big advantage. But why is your ROA and ROE falling? Do you see that bottoming out? Can we expect 1% ROA sometime soon and even ROE to go back above 15?
See, if you look at our net NPA is still 0.45 and we are working to bring it further down. And our cost to income ratio is slightly higher than the Bank of Maharashtra, which you just spoke. And we are working very closely and to reduce our cost to income ratio. That is the main factor. And we are working on two things on that. One, we are working on employee productivity and we are working on branch productivity. If you look at our employee per employee business is growing on a quarter-on-quarter basis and similarly per branch business. So I think that will give us a delta in the coming quarters. And I think anytime in the next year, we'll see more than one ROA.
This is so heartening to hear. Thank you very much. We are seeing public sector banks giving private sector banks a run for their money in terms of the pace of growth, even if not in final ratios. That's a heartening sign. Thank you very much, Mr. Ashwini Kumar, for joining us. Have to wrap up on Bazaar. Chartbusters ready for you.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And as we speak, markets trading with a mild positive bias. The broader markets, there is some profit taking we're seeing on select stocks. Mangalam.
A lot of stocks doing extremely well this morning. Top of the pops is Zomato. But in the broader markets, we do have, a few stocks which are under pressure. IT stocks actually, surprisingly today, are doing a lot better after the drubbing that we've seen all of last week. So the IT index has seen a bit of a spike. We'll keep an eye out on all of that. Let's talk about Havells. That's the stock on our radar. The company faced a challenging quarter in the first quarter. Results below expectations, a large part of it impacted by the unseasonal rains and a weakish summer for some of their important summer products. We have Mr. Anil Rai Gupta, who joins in now to detail the numbers going forward. Mr. Gupta, the first quarter understandably weakened by the unseasonal rains that took place, and that's impacted your fans business in particular, your coolers business as well. And at the same time, we've seen Lloyd's as well underperform this time around. So the question then is, how much can you improve upon what has happened? What proportion of these sales are lost forever? And in light of that, what does your revised outlook for this year stands at? Because at the start of the year, you did not anticipate this coming.
Sure. I think, obviously with a very strong summer quarter last year, the entire industry, including Havells, was anticipating a very strong summer this year as well. And the industry was prepared. The inventories were lined up. The channel was prepared. I think, starting from south and then to the entire country, we experienced intermittent rains, and that loosens up, slows down the tertiary demand completely during the quarter. And you asked about recovering lost sales. Usually it doesn't happen because the summer season starts slowing down anyway after the June quarter. So we will, now start getting prepared for the third and the fourth quarter, where there is again pickup of summer products start happening. Of course, fans is more of a structural demand, so should start from the second quarter itself. But coolers and air conditioners, we expect third and fourth quarters starting to normalize now.
So how does this change your outlook for the year versus what it was when you started?
I think overall, we are still quite strongly motivated towards the second half of the year. I would say that the consumer demand has been slow, at least in the first quarter. But we are enthused by the fact that the volume growth in lighting has been good. The volume growth in cables and wires business has been good. With a stronger, monsoon, I do believe that the second half should be better for the consumer products as well. So hopefully we should be recovering quite well.
Okay, all right. Hi, Mr. Gupta. Good to see you again. Thanks a lot for joining in. So for the year, if you had to put a number to it in terms of revenue growth, what could it be? A rough, broad range.
Well, you know very well we don't give guidance, but I think overall, if you say we don't see any market share losses, at least in any of our product categories.
Yeah.
So that's why it gives us confidence. The coming quarters should bounce back very well.
And how was the first quarter when it came to market share? Yes, there was understandable weakness, but did you decline less than your competitors and the unorganized?
Actually, I think the best way to look at it would be to see the first half of the calendar year from Jan to June. We believe that because, many companies have different strategies of how they work with the channel, but I do believe that we are still amongst the top 3 players in air conditioners in the first half.
Okay, let's focus on your cables and wires segment business. It reported actually robust growth, which is great. Wires growing slightly faster than cables. What's the mix here? And what is the volume growth trend you're looking at in the coming quarters? Also, just, since we're talking about growth, what about input costs? How do you see RM prices fluctuating?
So I think the volume growth has also been steady. We have seen over 20% volume growth in wires and cables business. Wires contributes almost 60% to our overall business. But I do believe that, wires was also benefited by a little bit of volatility in raw material prices. There was channel, I would say channel, it has stopped some inventory at the end of the quarter. So there will be some normalization in the second quarter. But we do believe that, with our capacity build up in underground cables, power cables, that I think will continue to remain strong in the coming quarters as well as years. So we are looking at a strong growth in cables and wires during the rest of the year as well as in the coming few years.
What's your prognosis for Lloyd's? The first quarter obviously impacted by summer, down 35% in sales, and you are still investing behind it. Does that push your margin expansion plans and market share expansion plans in Lloyd's?
No, absolutely. I think we are very positively inclined towards the performance in Lloyd. In fact, if you compare Lloyd's 2 years performance, so the quarter before last year, the revenue is almost the same, where the margins have almost doubled. So, and our investments in brand and people or feet on the street continues to remain high. So that's giving us confidence that we are on the right track, and we'll continue with the investments in Lloyd.
And break-even and margin expansion by when? Break-even has happened, obviously, but margin expansion
has already happened. We have obviously, first quarter was an aberration, but I think we are in for a good few quarters now.
Okay, all right. If you could give us a sense on the lighting part of the business, that reported a bit of a degrowth. What is the trajectory out there, and how do you see profitability improve?
I think lighting also, we did see a value degrowth, but there is volume growth, and we see that the price erosion is now plateauing, so we should be expecting good growth. But in the meantime, we are also developing capabilities towards becoming one of the leaders in the lighting industry. which we are quite hopeful of. And I think if we really see, while the profit margins may be looking lower, but our contribution margins continue to remain strong. They are in fact industry leading. And one of the reasons is also that Havells Lighting is focusing a lot on innovation rather than just being run-of-the-mill products. So we'll continue to invest behind lighting in terms of innovation as product development, and hopefully turn out to be one of the top 2 or 3 leaders in this segment.
Top 2 or 3 leaders in this segment. What about solar? Because you are considering that as to be your major growth driver as well. What proportion, what size has it reached right now, all the solar related products, and at what pace versus your overall company do you expect this business to grow?
So there is focus on renewables overall. When we had made this investment in Goldie, we mentioned that we are looking to secure our supply chain to have a very fast growth in our solar business as an overall renewable space. And this happened at the end of the quarter. I think we are expecting very fast growth in the coming quarters in solar business.
What's the aspiration here? How big do you want to be?
Well, it could be much higher. Last year we did about 400 crores. We're looking at over 1,000 crores in the next financial year.
All right, that would be something that the street would like. So despite understandable seasonal weakness, your commentary of having held your market share and things improving, especially in the second half of this year, when the second round of purchase for summer products comes in, notwithstanding the lost sales this summer, street likes that, and we've seen a bit of a spike on the stock from the lows as well. Solar, that was 400 crores last year. Next year is likely to be about 1,000 crores as well. So that's the management of Havells detailing their first quarter earnings, more importantly giving you the outlook for this year as well. Take a short break. On the other side, we have another management for you. Rajratan Global joins in. Stay with us.
Welcome back. You're tuned into Chartbusters here on CNBC TV18. Well, let's focus on the next management we have on the show. That's Rajratan Global Wires. The company reported a mixed set of numbers, profitability seeing 11% decline, but revenues jumped up by 12%. We're now joined by the CMD, Mr. Sunil Chaudia, to discuss the past quarter's numbers. Hi, Mr. Chaudia. Good to have you on the show as always. Thanks a lot for joining in. Well, let's clear out a couple of factors then for the remainder of this year. What kind of volume growth are you looking at in the Indian operations as well as in the Thailand operations? And also, if you could tell us, what is the margin outlook from here on? Give us the band.
Yeah, so as I told you earlier, we continue to say that we'll grow by 15% in volume this year, which will be combination of around 4,000-5,000 tons of growth in Thailand and another 15,000 tons of growth from Chennai facility, which is up and running. And on the margin side, on a consolidated basis, I'll talk about a band of 13 to 15% this year.
All right, 13 to 15% on the margins basis, and you've given us the volume guidance as well. What about the capacity utilization? You have new capacities coming up in Thailand, which is just over 50% utilization in Chennai as well. Where do you see that happening, and what's your prognosis on that?
Thailand is operating at 80%, so there is a further headroom of around 10%, 10 to 12% capacity improvement. And that is how I am saying another 4,000-5,000 tons can be added from Thailand. You can see that Chennai is now achieving around 40% capacity utilization in the first quarter. And going forward, we are expecting it to be around 50% plus capacity utilization. And that capacity utilization will be breaking even.
Just for simplicity sake, Mr. Chodia, if you could tell us in absolute terms, what is the capacity at Chennai right now? How much of is it in Thailand? And what is your volume outlook for this year from both Chennai and Thailand? And what could the revenue outlook be?
So, Thailand capacity is 60,000 tons, and we are targeting to reach around 48,000 tons of sales from Thailand this year.
And Chennai?
Chennai is currently 30,000 tons capacity, which is expandable by small investment to 60,000 tons. But when I talk of 30,000 tons capacity this year, we'll do a little more than 50% of utilization.
Okay, so 48 from Thailand, 15 from Chennai. And what would the prices be and revenue?
Revenue this year, total target is 1,100 crores.
1,100 crores, all right.
Even in the past, you've told us that exports as well, you're looking to scale it up, right? Out of the total mix, how much will exports contribute?
This year, our total export target out of India and out of Thailand is 25,000 tons, which is roughly 25% of the total revenue of consolidated revenue of Rajasthan.
Got it.
In the first quarter, there is a sales of around 20 crores, which is still on the ships and which could not be booked in the sales.
Yeah. Okay, all right.
In the next quarter. Yeah.
Okay. Can you give us an updated market share?
We continue to have 35% market share in India and 31% market share in Thailand.
Could you give us a sense of your revenue mix right now? What proportion comes in from value-added segments like wire ropes or higher diameter bead wire, and what is the commoditized products?
No, we do mainly bead wire. So all this revenue, 95% is bead wire. There is some small sales of black wire and patented wire. Otherwise, we do only bead wire. Our wire rope project is not yet started, so there is no revenue of wire rope. We plan to start trials of wire rope project by third quarter, and we are projecting full revenue for the next year.
And how much would that revenue be, and what's the margin differential between wire rope and the others?
I cannot say exactly the margin, but wire rope business, if we look at the other businesses, is around 17-18% EBITDA business. So similar, I'll project a similar profitability in wire rope business, and our capacity would be 10,000 tons a year.
Yes.
So a revenue of 100 to 120 crores from that.
120 crores at optimal levels.
Yes.
All right. And I think in the past you've said that wire ropes margins are, I think, a little higher than mid-teens, as you're saying, in comparison to black wire, which is high single digits. That's correct, right?
Correct. For us, it will be more value-added product and more margin for us.
What about Europe? You had said that Europe is about 5 to 7% of sales. You've set up a marketing office in Europe, got two regular customers as well. You expected that to increase. With the kind of global headwinds that we're facing in terms of demand, how has that business turned out for you?
Yeah, so Europe is, we continue to supply to those two customers, and trials have started in one more company, but not major business from Europe. But we have got quite a good success in US market, where we are supplying regularly now.
I think the Korean market as well was something that you were looking at, right? What's the opportunity out there? Have you started sending some of your production there?
No, not much to Korean market. Unfortunately, we didn't get much volume from Korean. We continue to work with customers, but as of today, not much of success.
And what about overall strategy when it comes to competition? Domestic, you have Tata's, obviously. In the Thailand market, there was a Chinese competition coming in. And in an environment where there's so much tariff-related uncertainty all over, do you think there could be a downside risk to margins? Because everyone would want to sell their products in countries where they can.
Yeah, so, when we talk about India market, yes, that today, currently capacity is more than the demand, and there is a continued pressure on the price and margin, which will continue for some more time till the demand goes up or some capacity reduces. About global market, we are successfully competing with China, which is very aggressive. And not today, China is aggressive for many more years. Okay.
Exactly. So what is the downside for your margins from here on? What is the least they can go to?
I'll assume that we are already in a down cycle as far as margin is concerned. I don't think it will further compressed because a lot of companies are not making profit at this level of pricing.
Just to reconfirm, sir, volume growth for the year is 15%. Revenue target is 1,100 crores and margins will be around 13%. EBITDA margins.
Yes, 13 to 15 on a consolidated.
Always good speaking to you, sir. You're sounding optimistic about the future. Let's hope it plays out that way. But clearly you're, guiding for better times ahead. And as you said, pricing is likely to have bottomed out. Appreciate you joining in. Well, for the time being, let's, shift focus. It's now time to recognize the champions. Get ready for an evening that honors India's most promising SMEs. The champions behind our nation's remarkable progress, from groundbreaking innovation to grassroots impact. These businesses have powered growth, inspired change, and redefined ambition. HSBC presents CNBC-TV18 SME Champion Awards, Season 2. India's most coveted SME Awards platform is all set to finally announce the winners on 25th of July, 3 p.m. onwards.
Welcome back. You're watching us here on Chartbusters on CNBC-TV18. The market continues to hold on to the greens, and this despite some of the pressure that we've seen in the banking names as well. Just pull up the intraday chart of the Nifty Bank that comes up for you, and thereafter we have the mid-cap index too, which is meandering around the lows of today's trading session. The Nifty Bank has moved off the highs. But let's get you some ideas for profit in this market. We have our colleagues at Money Control Pro joining in. Today we have Kanchi Shah with the stock that she's tracking.
So the company that I've chosen to talk about today is TVS Motor Company Limited, which is a prominent player in India's two- and three-wheeler market. Over the years, TVS has steadily built a strong presence, especially in the scooter segment, with its popular Jupiter model. In June, the company posted a solid 26% on a year-on-year growth in scooter volumes, indicating a robust consumer demand and strong brand traction. In the electric vehicle space, TVS is making remarkable progress. Its iQube electric scooter has helped the company emerge as the undisputed market leader with a 26% share of India's electric two-wheeler market. This leadership positions TVS well as EV adoption continues to grow steadily. However, there are near-term concerns. The company has warned of potential supply shortage of rare earth magnets from China, which is an essential EV component, and this could lead to production disruption which could start as early as from July. But on a positive note, rural demand has been overtaking urban demand, supporting a strong recovery in the two-wheeler market. Additionally, exports have gained momentum, offering a further growth visibility. In June, the export volumes increased by 54% on a YOY basis. At its current valuation of 31.4 times FY27 projected earnings, the stock appears slightly expensive. Therefore, we advise investors to accumulate it in a staggered manner from a long-term point of view.
All right, Kanchi, thanks a lot for that. Well, let's focus on the cement pack. And the commentary that came in from Ultratech yesterday was fairly encouraging. And that's why you're seeing the sector on the whole is buzzing around. Let's run you through a few points now. Q1 was soft for the industry and for Ultratech as well by their standards, because the core business growth was just mid-single digits. Because of inorganic growth, that's why they were at the 10% mark. But otherwise, it was low single digits. So that's one. The second factor is, they have highlighted that price increases in July actually has is evident. And imagine July prices, which is the monsoon quarter, it's higher than June, which is good. They're particularly saying that in South India, things are looking up. And South and East India have seen higher proportion of price increases, while North and West is relatively lower. They also say that the South India is consolidating well and it's in good shape. They made this comment that South could be the new North because maybe North prices have reached those optimum levels. On India Cements, they said that they've acquired the asset, they're focusing on the cost side. Renewable energy is something that they're looking at as well. And that's why the EBITDA per ton in the coming years, that's by 2028, will go to around 1,000 rupees per ton. In terms of capacity, by the end of this fiscal, they'll be at around 212 million tons. But sometime during the course of this year, they are gearing up for the bigger fight. So they're going ahead and they'll be adding capacity. That announcement is due later this year. And in the first quarter, they have paid close to around 200 crores as capex. For the year, they have lined it up at around 10,000 crores. All this commentary from Ultratech Cement actually is keeping the cement stocks excited today. So you have stocks like Dalmia, you have Bidla Corp, Ambuja, all of them are doing well. But brokerages, many of them prefer the largest name, the big daddy. And that's why you have all those ratings that are up for you on the screen. Some of them tweaking their volume estimates for the year. Some of them tweaking the estimates for the companies that they've acquired, like India Cements. Case in point being Nomura that's gone ahead. And they have upped their estimates for India Cement at around 1,000 rupees.
All right, so that's about Ultratech Cement. The Nifty just about holding the green by the skin of its teeth. May slip into the red just as we speak. But one of the stocks which is making the highs of this morning is Titan. We had spoken this morning about Titan going ahead and making an acquisition in West Asia. They've gotten 67% stake in Damas Jewelry at an enterprise value of nearly 2,400 crore rupees. And this deal expands their presence in GCC and West Asia. For a company that is valued at 2,450 crores, what is the revenue that they do? As of FY24, it's 3,400 crores, and that has grown from close to 2,700 crores that the company did in FY22. So there is growth, and Titan has its own ambition of expanding beyond India as well. And they've, signaled that. In the past, they've done about $150 million in terms of annual run rate coming in from international operations. Their own target is $500 million by FY27 and over 500,000 customers. A large part of the diaspora is in West Asia, is in the GCC countries, and Damas is a strong brand out there. What this also does, apart from strengthening their position there and increasing their international revenue, is stems some of the competition that we're getting from Kalyan and Malabar, who are fairly fairly strong in GCC and West Asia as well. So this deal, which the company has done, has also capped the downside that they have in terms of the payment that they have to make if the business grows too much by actually signing about 33% balance stake sale purchase at a predetermined price in by December 31st, 2029 as well. All said and done, Titan doing well on the back of this acquisition, fairly valued, good strong brand, and the stock at the high point of trade. With that, what we'll do is wrap up on this edition of Chartbusters with the news that the Nifty's just moved into the red. Stay tuned. The team of Trading Guard comes up next.
Hello and welcome to Trading Hour live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Hormis Fatakia and Reema Tendulkar. Good morning, guys. Well, we started off the show with some green, but suddenly Nifty has slipped into the red as well. Nifty is off 100 points of the day's high as well at the 25,087 mark. Very individual move that we are seeing today. So be it Eternal, which is surging in how after good set of numbers and management commentary as well. We'll discuss that in greater detail. We do have Titan as well, which is reacting to that acquisition that they have done. And banking names, HDFC Bank, ICICI Bank, they are in the green. They continue to be in the green after the results that they reported over the weekend. So a lot of moving parts today. In terms of sectoral movers, we have some pressure which is coming in from the PSU banking name. So watch out for that one. 0.6% gone on that index. Nifty Pharma as well is down 1%. And a bigger cut or an underperformance coming in from mid-caps today. So the mid-cap index down almost a 200-point decline is what we are seeing there at the day's low as we speak.
Indeed, there has been a bit of a turn in sentiment in the first 1.5 hours of trade. The benchmark indices, the mid-caps, all at the day's low, and the advanced decline ratio too has turned in favor of the losing side right now.
You know, it was the question always was today that whether we would be able to, beyond HDFC and ICICI, whether the index would be able to sustain. And the answer has been no as of now.
But they're sustaining. HDFC Bank and ICICI Bank are still sustaining their gains.
For ICICI Bank, it's a record high today. So, 1482, the record high that it made. HDFC Bank too is now very close to its record high of 2027. So, keep an eye out on both of these names, although both of them have come off the highs of the day. So, that is something that you need to keep in mind. Of course, there are a lot of other results that you need to keep an eye out for. We'll just get to Eternal and Swiggy in just a bit. But if you take a look at some of the other result reactions, Latent View numbers came yesterday. The stock is up 5% in today's session. India Cements was down yesterday after its results, is now up 3.5%. The big number of today, though, to watch out for is Paytm. 3% higher on that stock at the highest point of the day as we speak. Not at the highest point of the day, but yes, 3% higher, and the stock from its February 2024 low, which was around 300 rupees, is now up almost over 3x. So in anticipation of a profit that Paytm could report this time around, considering the fact that it reported a loss due to a one-off last time around. So yes, Paytm, Dixon Technologies is the other one that you need to watch out for.
Dixon, I was just checking. So this time, I think they're expecting about a 90% top-line growth. For the last 4 quarters, Dixon has been reporting 100% plus kind of a revenue growth. So that's been one growth juggernaut, and it continues to roll. This time, it's not 100%, but very close to that, 90%. Though margins are still around the 3.84% kind of a mark.
Yeah, you take 90% any day.
Any day.
You set the
And they say, right, revenue is vanity, bottom line is sanity. So
but yeah, margins
that
have been
improvement
holding.
will be important.
Keep an eye out on the margins as well. They're likely to decline on a sequential basis, although they're expected to remain flat on a year-on-year basis. But the bigger story from last evening was Bajaj Finance, and that is because its MD and CEO Anup Kumar Saha tendered his resignation just 4 months at the helm, and Rajiv Jain has been redesignated as the Vice Chairman and Managing Director. Now, several reports have emerged thereafter on Saha's potential next stint, and Ritu is joining in with more on this. Ritu, where is Anup Kumar Saha likely to be headed?
Well, Hormaz, I wish I had the answer to that question, but at this point, what I can tell you, it could be too early to assume that Anup Saha resigned from his position as the MD of Bajaj Finance to go and take over the top job at IndusInd Bank. Now, remember, we were the first to report that Anup Saha is among the 3 candidates who are in the running for the top job at IndusInd Bank. And while his name being in the mix may have had some bearing on internal dynamics at Bajaj, we understand that the RBI is yet to clear the name for the IndusInd role. So the idea that he quit specifically to join IndusInd could be a bit premature. But that said, the resignation itself has come as a surprise because he was being groomed for the position for the last 18 months or more, and he only took over as the MD in April, and then him quitting the role in just under 4 months is bound to raise questions. Equally important is the fact that Bajaj Finance's long-term MD Rajiv Jain, he's back at the helm, and he's going to serve as the MD for the remainder of his term until March of 2028. Now, while that arrangement is going to provide a smooth transition for Bajaj, the focus is also going to shift to succession planning. Now, remember, Rajiv Jain has spent more than 15 years at the helm of the company. Now, while there are RBI rules that limit bank CEO tenure to 15 years, there's no such cap on paper for NBFC. So technically, Rajiv Jain can continue, but the company nonetheless will be under pressure to groom now the next line of leadership. Now, Jeffries points out, Rajiv Jain will also have to pull back from any advisory role at Bajaj Finserv, focus full-time on Bajaj Finance as the MD. Morgan Stanley also calls this a setback to the succession plan that the company had been executing, but says with Rajiv Jain back at the helm, the situation seems manageable.
Okay, take that point. Important story that we'll be tracking very closely. Thank you so much, Ritu, for joining us with all those important details. With that, let's move on to the other stock of the day, Eternal. Post its commentary and numbers, and other stocks to try and focus on the back of that. Mangalam is joining us with all those details now. Mangalam.
An incredible set of numbers coming in, but more importantly, it's the management commentary which has the street fairly excited. The couple of things that had kept the stock under pressure in the previous few quarters. One was increasing competition in quick commerce, and that as a result of which impacting their overall quick commerce profitability. And second, the slowing down of growth in their food delivery business. Both these concerns were assuaged by the management and were reflected in these numbers as well, where there was stability in the growth rate of food delivery business, which came in at 16%, and the quick commerce business as well saw quarter-on-quarter improvement or reduction in losses. And that's where the management as well went ahead and said that food delivery growth has now bottomed out and they will recover from the slowdown. And secondly, in the very near term, quick commerce, if the competition stays the way it is, they will only see margin improvement from here on. So the worst of margins are behind that as well. And the third major driver for growth for the company will be District, which is the going out business, which will be a near $3 billion business annually, at some point in the next 5 years, with nearly $150 million of adjusted EBITDA coming in on that business. So not only were the numbers good, the management commentary was good as well, and that's where the brokerages followed. So we had positive commentary coming in from a whole host of brokerages this morning, be it something like a CLSA, which has a high conviction outperform rating. We have Goldman Sachs, Jefferies too has upgraded the stock to buy. They have a target price of 400 rupees. And on the back of Zomato's up move, we are also seeing traction on some of these other listed new age players. So direct competitor is Swiggy. If the industry is going through a good patch and is likely to recover from here on, and Swiggy is investors are betting on will benefit from that as well. Remember, Swiggy currently trades at a 45% discount to Zomato on a price to sales basis. So the street may be betting for that discount to narrow. The other stock which is doing well is InfoEdge. Understandably holds about 13% stake in Eternal, and as a result of which their value now stands at nearly 38,000 crore rupees, which is roughly 40% of InfoEdge's own market cap.
Thank you very much for that. Jefferies today has upgraded. CLSA has retained its high conviction outperform with a target price at 385. So ticking the right boxes, growth remains strong, competition pressures appear to have peaked, and this stock is higher in trade, significantly higher. Get into a break. We'll come back and talk commodities. Manisha Gupta joins in on the other side.
Welcome back. Some bit of selling pressure creeping in on the index now. We are 40 points lower compared to where we were at the start of the show, and now holding on to levels of 25,050. So at the lowest point of the day is where the index currently stands. But on the positive side, some of the other movers, of course, Mangalam highlighted Swiggy, InfoEdge, Emcure Pharma is the other one. Almost 5% higher on that stock. GMDC is continuing to move higher on the news of that rare earth developments in the country. So 3% higher on that stock today as well. And some of the other movers on the downside, 361 WAM, that's down at the lowest point of the day. A block deal took place just after market open, and that stock is down 7% in response to that. So shifting focus to the commodity space, Manisha is here with us now, and she's here to talk about how precious are precious metals today.
Thank you for that. Well, overnight was a great market. You saw gold prices gain up by 1.5%. We are trading at around 5-week highs right now. Silver gained up by more than 2% as well, and trading very close to its 14-year highs in the international markets right now. Well, gold not too far away from its all-time high of $3,500 an ounce. And we're looking at a renewed support coming in from the fact that the dollar index is now slipped below 98. There is a 60% expectation that you could be looking at the first rate cut happen in the month of September. And then apart from that, there is very strong investment demand. ETF buying was at record in the month of June, continues to be supportive as well. And the street is also looking at strong central bank buying that has just about continued. So overnight, we did see the gold prices go to $3,400 an ounce. Slight mild profit taking is what we are looking at this point in time. But when you look at the global banks and brokerages, they're all very, very positive going forward in case of the gold prices there. 3,500 is what most of them believe. Actually, when you look at the overall chart there, Citi is the only one that expects the prices to decline below $3,000 an ounce before this year ends. Rest everybody else expects the gold prices to go back to its all-time high. UBS talks about 3,500. CIBC is the most bullish, talking about $3,600 an ounce in the second half of this year. You also have JP Morgan talking about 3,675. Bank of America says that once 3,500 is breached on the higher side, you could be looking at 3,800, and an extreme scenario can take the prices to 4,000 on the higher side as well. Morgan Stanley talks about 3,800 in the fourth quarter of 2025, and Goldman Sachs talks about 3,700 by the time this year ends. So not only are all these banks and brokerages talking about 3,500, which has been an all-time high, but prices above and beyond that as well before we end this year. So bullishness continues.
Okay, so bullishness continues. That's about precious metals. Thank you, Manisha, for joining us with all those details. Let's get a technical check on the markets now. Mitesh Thakkar is joining us for just that. Mitesh, good morning. Thank you so much for joining in. Well, we've seen that fall from the highs on the Nifty. It's close to the day's low as well. What is the next important level we'll be watching out for? Will we consolidate at these levels, or we'll see more pressure? Tell us more.
So on the index, my belief is that we're still, trying to consolidate. Holding on to 24,900 yesterday was important. I think as long as we're above that, good chance that we'll do 24,900 to about 25,250, 300. And post this consolidation, I expect some kind of an up move. Only if we start closing below 24,900, that's the when, you will look at possibly lower levels.
What about
stocks?
Yeah. So on the stocks, Divi's Lab, I think even the pharma pack is looking slightly weak technically. So Divi's Lab is a sell. Keep a stop at about 66.45. Look for targets of maybe around or below 6,500. And that apart, I think on the long side, I do like some real estate names. So I have a buy on Godrej Properties after a good rally. Today is giving some kind of a pullback. So try to enter around 2350, keep a stop below levels of 2320, look for targets of around 2420.
What about Eternal, Mitesh? The stock of the morning, possibly. You still await a better entry point? Run up too fast, too soon?
I see one. I have some positions over there, so there was an interest. But I believe that, Eternal, the highest ever weekly closing which the stock gave was around 302, 303, and there was also one weekly closing at about 298. They were, one was in September 24, the other one was in December 24. I think you will see when the stock hits all-time highs, there's some profit booking. So that's why the stock is off the day's high. But once we get a weekly close about 302, 305 zone, then I think the stock is heading towards 340, 350 as a minimum, and maybe even more.
All right. Thanks, Mitesh, for joining us with those picks. With that, we'll slip into a break. When we come back, we'll be joined by the management of DCM Shriram to discuss their Q1 numbers. Stay tuned.
Welcome back. Markets are blinking red and green, but it's got a downward bias as the morning has progressed. The Nifty is at the 25,069 mark, and Reliance Industries is one of the culprits, perhaps, for this pressure that you are seeing. Reliance Industries has slipped to the day's low and is down close to about 1%, adding to the fall that it had yesterday, which was about 2.5%. But the company on our radar right now is DCM Shriram. Remember they have interests in many sectors: sugar, fertilizer, chemicals. They have a windows, they manufacture windows and doors, which are sold under the brand of Finesta, and lots others. Now, they came out with the Q1 numbers. It was a steady set of numbers. Revenue saw an uptick of 12%, margins expanded. To talk about the quarter gone by and the outlook, Amit Agarwal, Executive Director and Group CFO at the company, is now with us. Thank you very much, Amit, for joining in. So just to get the big picture in and the outlook for FY26, I think last time you spoke about a revenue growth of 10 to 15% and margins in a wide range of 11 to 14%. Is that on track? Could you narrow the margins a bit? Would you be closer to the upper end, lower end? How are the next 3 quarters likely to shape up for you?
Yeah, I think what I had, the trend that I had given, or the range that I had given the last time, we're pretty much on track. We expect a little bit of upward bias, probably in Q3 and Q4. So yeah, we are pretty much on track.
So upward bias on revenues or margins? I mean, could you narrow it down on top line and margins? Yeah. The first half, second half, full year?
Yeah, so see, we have been investing in growth over the last 3 to 4 years. If you see, we have made significant investments of about 4,000 crores in various growth initiatives. Those growth initiatives have started yielding results. Even for the Q1, if you see, majority of the top line as well as the bottom line growth has come from the investment. So that's all, volume driven largely. So we expect that to continue, and therefore the numbers in this financial year should be better. And on top of that, we have a steady pipeline of investments. We have done 2 acquisitions in last 2 to 3 months, and we are exploring more. So I think there's a good pipeline which would lead to the growth of overall business, and therefore we will see good top line and bottom line numbers.
Okay, so you are saying that you'll be growing 10 to 15%, something that you had guided for before, and margins as well between 11 to 14%. Amit, the big talking point has been the ADD on PVC. When is that likely to come? Has there been any discussion on that? And what would price increase be once that ADD imposition comes in? How would that impact your company overall?
Yeah. You see, on ADD, Supreme Court did give a positive judgment where they stayed the order of the Gujarat High Court. And now the Ministry of Commerce is working on studying that again. So we hope something to come in next 3 to 4 months. In terms of the impact, I think the prices should go up by about 5,000 to 6,000 rupees per ton of PVC once the ADD is imposed.
Amit, good morning. Thank you for joining in. In our previous interactions, you've mentioned that a large part of your bottom line going forward is likely to be driven by the chemicals business. But with the volatility that you have mentioned in the caustic soda prices and the fact that you are expecting them to continue to remain volatile going forward, how is that likely to impact the chemicals business and overall your bottom line as well?
You see, what has changed vis-a-vis last 2 years and is that our cost structures are much better. Therefore, our cost of production has come down by about 14 to 15% in last 1.5 years. That's a big plus for us. As far as prices are concerned, they will be range bound. So that range can be anywhere between 26,000-27,000 ECU. Per metric ton to 31,000-32,000. That's the kind of range. So which is we are quite comfortable, given that our cost structure has improved significantly. And then we are growing on volumes. So I think a lot of these factors are playing out well for us.
You spoke about the 2 acquisitions that you closed recently. I think DNV Global Private Limited, which helps in backward integration of your Finesta brand, that's windows and doors. And you've also signed a definitive agreement for 100% acquisition of Hindustan Specialty Chemicals Limited.
Yes.
How much will these 2 add in the coming year? What was the rationale? And you spoke about exploring more acquisitions. So what's the cash in the books and what are you looking by way of M&A in terms of adding to your portfolio?
Yeah. So in terms of these 2 acquisitions adding to our top line, So their existing capability is to add anywhere between 300 to 400 crores to the top line, both these two acquisitions put together. But then, these are small, and our objective of taking up these acquisitions is to grow these businesses, because we always wanted to get into these businesses. The idea was whether we do organic, and which will take us about 2 to 3 years, even to reach that 300, 400 crore turnover. But now we are getting that jump start, and we can grow from here. So I think these will take, let's say, 2 to 3 years to be, really big and adding significantly to our top line. But then we have made a good start. And then in terms of cash available in the books, I think the way we look at our businesses is that what is our debt to EBITDA? Currently, debt to EBITDA is around 1.1, which is very healthy. And therefore, we have enough cash on the books to do acquisitions.
Got it. Amit, one pain point in the business has been the sugar business. Say, be it the macros, be it the conditions that the industry keeps seeing. This is one business that continues to be under pressure. Do you think at some point in time you will demerge it and unlock value in the remaining business? Also, in terms of ethanol blending, what is the maximum limit which is permissible for ICE vehicles now?
So, see, what the government's plan is on the blending is 20%, which they have almost achieved. And what we hear is that they plan to increase the blending program from 20 to 25 and then take it up to 30. So, which is a positive for the industry. But I fully agree with you that sugar and ethanol, the way it is regulated and way certain regressive measures are taken by, either the center or the state government, it does trouble the business. But we are taking a little different approach. We are saying, how do we really strengthen the business on a more sustainable basis, whatever is in our control? So we are working more aggressively now with farmers to increase their yield, which would mean more consistency of sugarcane for our plants, because we are probably able to operate at 80% capacity utilization, given that the cane is not good enough or it's coming down. And also working on the recovery, which is like what is the sugar content in the sugar cane, working with farmers to improve that as well. So I think we would like to work on the cost side or in this business more aggressively than what we have been doing till now to improve the health. That is one part of it. And then we are looking at certain other things, what we can do in this business, which are add-ons to sugar and ethanol, like we did CBG very recently, which is like we commissioned in March. And now it is operating at 92% capacity utilization. So probably we have capability to do a couple of more CBG plants, and few more thoughts are in pipeline. So hopefully this business should be healthier going forward, but not immediately. I think this year I do see it, maybe at same level last year or a little bit under stress.
Amit, does those lots of thoughts translate into potential new product launches as well? You'd mentioned that you've launched 8 new products. What is the kind of incremental revenue you're expecting from these 8 as of now? And is there or are there any further product launches that are lined up, if not in the first half, in the second half of the year?
Yeah, so this is regarding our agri inputs business, Shriram Farm Solutions. So if we see in last 15 months, we have launched close to about 70 new products in our crop nutrition and the crop protection category, other than seeds. Seeds is a regular life cycle where we keep launching new products. Now here, out of this 17, we are getting good revenue, but then it takes time to ramp up these volumes of the new products. Now, if we look at the product that we have launched over the last 3 years, so the total revenue from the new products out of the total revenue that we have in this business is almost about 20%. So which is quite healthy if as a benchmark to have 20-30% of your revenue coming from new products. And our endeavor would be to increase this and therefore we are ramping it up further in terms of introduction. So like as I mentioned, 70 new products in 15 months, out of that 8 were launched in Q1. So we will have a good pipeline going forward as well.
All right, take that point. Amal, thank you so much for joining in with your thoughts and the outlook going forward. That's the word coming in from DCM Shriram. They maintain their FY26 guidance and talk about new launches as well. And that sugar business could either be flat or could actually see some pressure in FY26. We'll slip into a short break now. Up next, we'll discuss the market fundamentals with Jyoti Vardhan Jaipuria, founder and MD of Valentis Advisors.
Welcome back. Well, the index continues to remain where it is, still 30 points lower. But pull up Dixon Technologies reporting results today. That stock is trading was at the last check was down around 0.6%, still hovering around those 0.5% worth of losses. And it's been quiet over the last 2 or 3 weeks. Has seen a bit of an up move of around 5%, counting down to results. It'll be an interesting number to watch out for later in the evening. But let us now go across to Nimesh, who is standing by with an interesting data on how the change of guard at various companies is now leading to their re-rating. Nimesh, tell us more.
We've discussed in the past as well that normally when we see a leadership change, it's a case of a re-rating for the stock as well. So I've looked at the data since the start of 2021, and this is a BSE 500 data. Across the BSE 500 companies, more than 100 companies have seen a change of guard in the last 4-5 years. And interestingly, more than 20 companies have seen a stock price reaction between 30 to 200%. So that's the kind of reaction you see in the stock price, or the re-rating that you see in the stock price. But there are some companies which have given more than 200% return as well in the same period. So I'll start with that list first. The first stock on my list is Persistent System. Look at the kind of reaction to the stock price. The stock is up 850% since Sandeep Kalra took over as a new MD and CEO in October 2020. 850% in the last 4 years. That's the first stock. We've seen a big reaction there. Next in the list is, no, this is not Persistent System. The second on the list is Newgen Software. They got a new CEO in 2021 and the stock has reacted 285%. The third on the list is Himadri Chemicals. That stock is up 500% since the new CEO came in 2022. Again, a big move there. The next stock is Zensa Technologies. Even the company saw a new leadership change in 2023, and since then the stock is up 275%. These are the few names which have rallied between 300 to 800% in the limited period of time. So that's the kind of data, which proves that a leadership change leads to a big re-rating. Remember, this is the BSE 500 data. If I look at NSE, one stock which will stand out for me is Bombay Stock Exchange. It's only listed in NSE, and we've seen a massive reaction to that stock price as well, but that doesn't show up in the data. So now the question is, will the history repeat itself? And that's something to watch out for. Which are the few companies where there has been a leadership change announced, and can that stock see the re-rating in the near future? The first on my list is HUL. A woman CEO now, Priya Nair, has been appointed as a new CEO on July 10. So need to see in the next few quarters whether you see a big re-rating in the stocks like HUL. The next stock is Cyient. Even Cyient announced a new CEO in February 2025. The stock is still not reacted, but we'll have to wait and see as to what the strategy is for Cyient going forward, and will the stock react or re-rate further from here on. Titan, we all know that there's going to be a fresh change of guard from January of 2026. Across the various verticals, you're going to see new CEOs in Titan as well. So Titan will be the stock to watch going forward. Across, as I said, watches business as well as jewelry, there are going to be new CEOs there. The next on my list is Cyient DLM. Again, they've appointed a new CEO in July 1st. So again, fresh appointment, but we'll have to see whether going forward, even that stock re-rates or not. And the last but not the least on my list is Max Financial Services. Sumit Mandal has been appointed as a new MD and CEO of Axis Max Life, which is the insurance arm of Max Financial. They're going to see a new CEO from October of 2026. So again, massive changes are happening, and we've seen big reactions to the stock prices as well. History suggests a change of guard leads to re-rating. So we need to see if there is a fresh change of guard in many companies.
Okay, all right, interesting point there. But a reminder for our viewers, unlock a world of exclusivity, expertise and influence. Become a member of CNBC-TV18 Access, our premium members-only experience on CNBC-TV18.com. The membership includes access to CNBC-TV18's flagship events, interactions with our journalists, along with curated studio tours, e-learning sessions and masterclasses, and curated lifestyle benefits as well.
I take the market conversation forward now with Jyotivardhan Jaipuria of Valentis Advisors, who's joining in now. Jyoti, good morning. Thank you for joining in. What have you made of the earnings season so far, at least for the IT companies that have reported so far? Well, they have been flattered to receive, if you could say that. You still have Infosys reporting results tomorrow. But what about the others, the banking names, the HDFCs and the ICICIs? They have delivered on their numbers. The other private bank was a disappointment because of asset quality concerns. The mid-sized banks face margin issues. What do you make of the banking numbers so far?
Yeah, so when we started the earnings season, expectations have been low. Generally the if we take the consensus numbers, the expectation is we'll do like a 5% earnings growth for this quarter. And so far, if you take the aggregate of the results which are coming in, they're more or less in line with expectation. That if you strip out all the extraordinaries, which is what we tend to do, earnings growth has been flat to like slightly up. Like you said, some of the banks have done better, but there again, there was expectation that the NIMs will be lower because of the interest rate cut which we have seen. And given that expectation, banks have more or less met the earnings expectation. Again, if you look at the IT names, generally everybody was expecting it to be a very soft quarter with guidance also being muted, and that's the way it has really played out. So no major surprises or disappointments, but it's been like a lackluster expectation which is getting met. We're not really seeing any big surprises coming through.
You're saying earnings have been flat to slightly up, right? X of any exceptional items.
Yeah.
Okay, but that's still lower than the expectations, right? Which were in mid-single digits. You said 5%.
Yeah, so but what's happened, Rima, is like the tech companies have come in at the banks. So banks are actually going to drag earnings for this quarter because most of the banks are going to see a drop in NIMs. And because of that, banks actually are contributing negatively to the earnings growth for the quarter. So we've had the banks come in. Some of the other ones which are probably going to be stronger are yet to come in. Like pharma will be probably double-digit growth, so will chemicals, so will cement. So some of these numbers, as they come in, this will probably boost up the average a bit.
Okay. Jyothivardan, I wanted to understand about these big management or leadership changes that are happening across the board, right? And you just heard Nimesh talk about that as well. There's something happening at Bajaj Finance. Then we are also watching out for that announcement or IndusInd CEO. What is your take on this entire process or this entire change that comes by? And in that case, which stock do you think tends to benefit the most out of the ones that Nimesh mentioned and the others as well?
Okay, so I didn't really hear the full thing which Nimesh was talking about. But in general, leadership changes quite often lead to a change in where the company is going. And that's why it's treated positively. If you look at banks, across the world, whenever there's a leadership change, what you find is that initially the new leader tends to do a big write-off in the first quarter where he takes over, or the first 2 quarters where he takes over. And then, he's got a clean slate with him. So then, things start to look very good for him over the next 2 years because he's done a lot of the write-offs on the doubtful debts. So in general, we've seen leadership changes across the world being taken positively by the market because there's a fresh change which comes in. And, ultimately for us, we do track, especially in the banks, when the new CEO going to come or when the existing CEO's term gets over, because that is one indicator of what you really want to do. It may cause some short-term uncertainty on who takes over also.
What about Zomato or Swiggy? Is it a part of your portfolio? Is it a must-have? I know valuations are prohibitive at these levels. I think Zomato is at 70 times forward multiple. But what is the thought process behind these companies?
So, Rima, for us, most of these high valuation, it doesn't fit with our philosophy because we generally tend to have the CEO's philosophy where we want the undervalued stocks which are underperforming and undiscovered type of stuff. So we don't really own a lot of these platform companies. In general, we think all of these companies will grow much bigger than where they are today. It's because, more and more habits are changing of the consumer. And so people want to order in home. And this is platforms that proved like a good way for them to order and get the dining experience without really going out to dine. But it's what you pay for it, what the stocks are valuing today. And on that measure for us, we are actually very, very conservative on valuations.
What about pharma, Jyoti? Because you're counting down to the August 1st deadline when it comes to tariffs. And there have been a lot of news flow with regards to a lot of these pharma names, be it Glenmark, be it Wockhardt. Laurus is at a 52-week high as well. What do you anticipate this time around? Do you believe that this quarter will be able to justify the kind of moves that these stocks have seen despite a potential headwind that's coming in a few days from now?
I would be very happy if the tariffs are frozen in the US. Because, what has been dogging the stock, if you see a lot of them which are not performing, it's just the fear that we don't know what the tariff is going to be. because somewhere there's a mention that it could be as high as 200%, which I don't think is going to happen because, ultimately the US consumer will have to pay a lot of that 200% tariff. So, if we get a closure that we know this is a tariff, it gets easier to, calculate some impact on earnings. And so we know that where the stock should be valued. The uncertainty has been hitting a lot of the US generics. So if you see, pharma has been into two. The US generic companies have actually not done well over the last few months, ever since the tariff talk started. But the rest of the pharma has continued to do well. It's a sector which we like. So, we'll be very happy if we get a closure on the tariffs, because probably some of the US generic names will look interesting after that. We like the CDMO space because that's something which we think has got a multi-year growth ahead of us. So pharma is something which we like, and we would probably buy more if we can, get some closure on the tariffs coming through.
Okay, all right. Take that point. Thank you so much, Jyotivardhan, for joining us and taking us through your sectoral picks, or in terms of the market moves going forward as well. Thank you so much for joining in. Time for a short break. We'll get you more on the markets on the other side. Welcome back. Well, markets continue to be under pressure. So if we pull up a Nifty that is lower in trade at the day's low, actually, it's a 34-point cut that we are seeing right now. And the broader market movers as well. A lot of pressure there, 0.4% gone on the mid caps as well. So let's talk about some of those movers. Tata Power shares, they are in focus. There's some update on Mundra Power Plant. The Section 11 news has come by. Vivek is joining us now with more details and explaining what that means for the company.
Well, that's right. Companies, including Tata Power as well as Adani Power, will be in focus. This on the back of the fact that the Ministry of Power has not extended Section 11 for imported coal-based power plants beyond 30th June 2025. So basically, companies that have power plants in Mundra that were importing coal from Indonesia and which under the Emergency Act of Section 11 were operating on a cost-plus basis now will not be able to get the benefits under Section 11 anymore. So for Tata Power, what does it mean? Tata Power has immediately shut down all 5 of its units as far as Mundra is concerned, and it's a maintenance shutdown since the first week of July itself. Whole host of brokerages have reacted and they've tried to make sense and assess the impact on Tata Power on the back of this particular important development. IIFL says the key reasons for this particular extension not happening is, number one, likely due to the absence of peak power shortages in this particular year, and also the government's keenness to, instead of having a short-term PPA or a cost-plus basis, the government's keenness to go ahead and push for a long-term PPA. So what they're saying is that they're estimating almost 5 to 8% potential hit to their FY26 PAT estimates. They're also estimating a close to 100 to 150 crore PAT impact for each month of operational loss. Axel Capital says that the management remains hopeful of a permanent solution to the Mundra PPA for procuring states in the near term. They believe that the company can recoup the plant availability factor charges if the current shutdown is limited in the range of 1 to 1.5 months. JM Financial says that they expect the company to go ahead and tie up PPAs with the 5 states, including Gujarat, Maharashtra, Rajasthan, Punjab, as well as Haryana. Mundra operated at a PLF of close to 65% for FY25. Again, this particular loss can be mitigated, number one, if the company gets an emergency approval or an extension within 1.5 months, or if there is a long-term PPA solution.
Thank you very much for that. Let's talk about Ultratech Cement. Came out with numbers yesterday during market hours, but the conference call was post-market hours. Nigel joins in with the management comments.
Well, the comments that came in from Ultratech Cement on the con call actually is encouraging for the industry on the whole, because the core growth in terms of volumes for Ultratech as well as for the industry are rather subdued in the first quarter. However, Ultratech is saying for the year they'll grow by close to around 10%. The street will like that number. So volume growth they're expecting to perk up in the next few quarters as spending does ramp up, government push as well does back them up. So that's on the volume. Second, on the pricing front, they're saying that prices in the month of July actually are holding steady in comparison to June. In fact, it's mildly higher in South India as well as in East India, which is very encouraging. Though North as well as West is more or less flattish. But pricing, even holding steady in the monsoon season, actually is telling you that maybe the worst of competitive intensity is a little behind. And the street is willing to look ahead. So we'll see how that goes. But for the time being, that's very encouraging on the pricing aspect. Next, on South India, they're saying South India is in a good space. It's going through a bit of consolidation. It's in a good space. And they also made this comment that South could be the new North. Because remember, North has been the outperformance. Now they're saying South could be the new North, which is encouraging sign on the pricing aspect yet again. Moving to India Cements, they're saying India Cements that's been making losses for the last many quarters. They turned it on in this quarter. And now they have their eyes set on 1,000 rupees per ton of EBITDA per ton by 2028. Thumbs up out there. On their capacity, they're saying by the end of this year, they'll be around 212 million tons. But watch out, because they're going to make a big capex announcement at some time during this fiscal. So that's going to be, a highlight, because what kind of money are they putting on? Where do they see their capacity headed as well? And finally, on the capex front, for the year, they've earmarked 10,000 crores, out of which 2,000 crores has been spent. So give and take everything, the commentary on demand, on pricing, on industry as well is positive. So that's why you're seeing some of the cement stocks actually are taking heart from this commentary that we've got. And on Ultratech, most of the brokerages, they maintain their positive view. And for a couple of them, it's the top buy pick from the cement space.
Top buy call, indeed. All these brokerages have raised their targets on Ultratech. Nigel, thanks a lot for that. Take a short break. More on the markets on the other side. Stay tuned.
Welcome back. Mid-cap index is down 250 points, but look at GMDC. That's soaring to a fresh 52-week high. Stock is up 6.5%. McLeod Russell is locked in an upper circuit, 8%, only buyers on that. Digitide Solutions is up close to about 6.5%. Late revenues tech, Ixigo, the travel platform, has been clearly the stock of the month after it came out with numbers. It came out with numbers at the beginning of the month, at the start of the earnings season. And this month, it's seen a rally of close to about 30-odd%. And AGI Greenpack, we spoke about it. The numbers were strong. Revenue growth of 22%. Profit jump of 42%. And that stock continues to gain ground, 10% up on that. It's time now for a special segment, Quarter Se Quarter Tak. We'll get you the expectations from each sector. And now we'll put the spotlight on the pharmaceutical sector. Ekta joins in with the key expectations.
Well, for pharmaceutical stocks as well as healthcare stocks, expect a steady quarter. Now, for pharma companies, you are expecting around a 10 to 11% growth in revenue and a growth in EBITDA, which would be similar this quarter, along with profit between 5 to 10%. Now, expect the US growth for generic companies estimated at around 3 to 4% Q-on-Q. Growth X of Revlimid generic would be something to watch out for. Now, that would, overall growth in the US would be led by stability in US generic pricing, volume growth in existing products, and a pickup in recent launches. Expect lower Q-on-Q sales in Revlimid generic for companies such as Aurobindo, Cipla, Dr. Reddy's, Sun Pharma, according to analysts, as specialty portfolio growth. That would be the key thing to watch out for. For Biocon, watch for growth in the biosimilars portfolio. Now, the range for domestic growth is wide, anywhere between 8 to even 16%, according to some analysts. Now, domestic-focused firms such as Torrent, Ipca, Alchem expected to see good growth this quarter. And watch for commentary on Torrent's acquisition of JB Chemicals. Now, most API companies are likely to see a volume uptick this time round with an estimated 8 to 9% growth year on year. Expect over 15% growth in some CRDMO companies driven by the likes of Bluejet, Divi's, Loris Labs, Sai Life Sciences. While Syngene and Piramal Pharma could probably see a muted quarter due to inventory destocking on key molecules. Now, moving on from pharmaceuticals to the healthcare front. On the healthcare front, expect around a 20% growth in EBITDA, driven by over around 20% growth in hospitals and around 10 to 11% growth in diagnostics as healthcare companies recover after a softer Q4. Apollo hospitals might see continued impact of international patients slowing from the likes of Bangladesh. Commentary on the recent restructuring will be watched. Expect steady margins for the likes of Dr. Lal's. Watch for recent acquisition integration for Metropolis, which has been on an inorganic drive. Now, let's leave you with the valuations. First, for the pharma stocks, as you can see, Sun Pharma ruling the roost, most expensive, along with a couple of others such as Divi's Labs. So a lot of probably the good news is factored in. For diagnostics, Dr. Lal's as well as Metropolis, FY26 PE stands at around 50-odd times. And finally, for hospitals, the likes of Apollo Hospitals and Max ruling the roost in terms of valuations.
All right, take that point. Thank you so much for joining us with what to expect from the pharma space, Ekta. But let's talk about individual names now. Mahanagar Gas will be reporting its numbers today. Now, do remember the stock is up 17% year to date and is the cheapest in the CGD space as well. It trades at 12.6 times FY27 EPS. A lot happened in this sector in terms of lower APM gas allocation, these players going ahead and increasing prices as well. And that is exactly what will be impacting numbers as well this time. So while revenues are expected to grow by 1.5% this time around, EBITDA is expected to grow by 6%. Margins almost flat or maybe say 100 basis points increase, 21.1% this time. And profits are expected to be up 6.5% for Mahanagar Gas. This time around, the volume growth, that's expected to be flat on a quarter-on-quarter basis. And that explains the muted revenue growth as well. It will be up 9% on a YOY basis. So what will happen here is CNG volumes will grow by 4%, but PNG volumes will fall by 4%. So that is something which will neutralize neutralize the volume impact. But pricing is something which will aid revenues this time. This time around, EBITDA is expected to grow by 6.5%. That is muted versus the earlier quarters because remember there was lower allocation of cheap gas or the APM gas to the entire sector. On the flip side, when they import LNG, so the spot LNG prices, those came off, and that will aid EBITDA or support EBITDA to some level. And also the price hikes that they had taken in the month of April, that is something that will support EBITDA as well. So overall, it's expected to be a muted growth this time around, and that was led by a lot of macro factors, so to say, that will impact the earnings this time around from Mahanagar Gas.
We keep an eye out on them. One of the first among the first of the city gas players reporting results today. Yes, we keep an eye out on this and possibly set the trend as well for the rest of the industry. The other one, the major one reporting results today, other than Paytm, Dixon, MGL, is Colgate-Palmolive, and Mangalam is here with what the street is expecting from them. Mangalam.
Well, you've seen, a lot of these companies do extremely well from the staples side. Colgate, unfortunately, would not be one of them because the stock already has corrected about 40% from the peak, trading at 40 times, and this time around numbers aren't likely to infuse much confidence as well. Revenues likely to decline by about 0.5%, EBITDA decline by about 2.5%, and the net profit declines by about 3% as well. All in all, you're looking at a bottom line of close to 350 crores on a top line of 1,500 crores for Colgate. 0 to 2% volume growth in the toothpaste business, 1.5% decline in price mix due to promotional density. Rural, which contributes about 40% of the company's revenue, recovery out there important to track. Remember, in the previous commentary as well, the management had said they see only gradual recovery, and that too is likely to happen only in the second half of this year.
Thank you very much for that. And what about UBL, Mangalam, United Breweries?
United Breweries is likely to be a good quarter, and that's largely because of a couple of factors. One, it's normalized operations. Seasonally, it's a strong business quarter for them, for the business of beer. And secondly, the raw material prices have been fairly stable as well. So all in all, we are expecting a good growth coming in the overall business. The stock has seen a correction of almost 12.5% from the peak, trading at 57 times. Closer to double-digit revenue growth is what the street is anticipating this time around, with nearly 20% plus volume growth coming in from the premium and above business. So you have about 11% revenue growth. The EBITDA grows a lot faster, so over 30% growth. So the street is anticipating out there in terms of margins, 13% EBITDA growth, and the net profit as well would be in focus. 11.7% is the margin that the street is working with this time around. Two things that will happen. One, Telangana has taken a price hike, so that would be a positive. But on the other hand, Karnataka has increased excise duty, so that would offset. That explains why, despite an 11% revenue growth, margins would be stable at around that 11.7% mark itself.
Okay, all right, take that point, Mangalam. Thank you so much for joining us with what to expect from UBL and Colgate. But we have completely run out of time on this edition of Trading Hours. Stay tuned. Halftime Report is up next.
Mixed signals on the India-US trade deal. Cloud sentiment as do cues from corporate earnings, keeping stocks in check. Realty and healthcare the big drags, while metals, financials and IT eke out some gains.
In a sudden move, Bajaj Finance Anup Saha, MD, resigns with immediate effect. Vice Chairman Rajiv Jain will step in as MD till his term ends in March 2028. The move setbacks the company's succession plan.
Titan inks a deal to pick up 67% stake in Damas, which has a presence in jewelry across the GCC at a valuation of a tad over rupees 2,400 crores. The deal offers Titan an option to buy the remaining 33% stake in the future.
Zomato and Blinkit owner Eternal stock surges on its bottoming out call for quick commerce and its scripting a path to growth and profitability. Peers Swiggy and stakeholder InfoEdge also rally.
SEBI gives Jane Street the nod to resume trading in Indian equities after the latter gives an undertaking to not manipulate the market. Stock exchanges have been advised to closely monitor its activities.
Hello, good afternoon and welcome to Halftime Report coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. With me is Mangalam Malu as well as Ekta Batra. Good afternoon, guys. An interesting day coming in after opening in the green. Yesterday we had seen that green as well. Today seems like a bit of a consolidation. There are a lot of individual movers in terms of earnings that we're seeing coming in. I think Mangalam is going to order food for us now, given everything on his sector is buzzing today. So whether Eternal, Swiggy, Titan, all of them holding on to gain. So Mangalam, where's the treat now?
Well, I will talk about food in just a bit. But, as we speak, I guess, the person who's breaking that story may perhaps get a little more than food for us. Beverages, we have Tilak Nagar, which is on our radar. We'll quickly get Nigel in. Tilak Nagar Industries likely to go ahead and make a purchase of one of the whiskey brands of the country, Imperial Brew. And that's the story. We'll just shortly get Nigel, and Nigel will tell us a little more about that as well. Nigel, you are picking up from your sources that Tilak Nagar Industries is likely to go ahead and grab a big sip of the whiskey market. Nigel.
Well, that's right. Mangalam, it looks like Tilak Nagar Industries is looking for a stiff peg, and that too a whiskey.
Yep.
We understand from sources there could potentially be a deal where Tilak Nagar goes ahead and buys Imperial Blue, which is the whiskey brand which is owned by Pernod Ricard, and they've been searching for a buyer for the last few months or so. Now, what could the valuation be? It could be roughly in that vicinity, very roughly in the vicinity of around 4,000 crores odd. How will they fund it? Well, we understand it could be a mix of equity as well as debt. And as they've already disclosed on the exchanges, that tomorrow they're going to be meeting to consider various options. So we'll have to see what is the mix of this 4,000 crores between debt as well as equity. That'll be important. We know that Tilak Nagar Industries over the last few years, from being a net debt company, actually they've become a net cash company. They have close to around 100 crores in their books. We reached out to both the management, Pernod as well as Tilak Nagar Industries. We're awaiting comments. As they comment, we'll add it, to the highlights. But just a few factors out here. The key number is going to be what valuations is this done and how much of that will be debt. For Tilak Nagar Industries, the reason the stock is buzzing because the street views it positively. As of now, they're only a brandy player. So they'll become a whiskey player as well. So diversification. Currently, they're south-based, more than 80% in the south. They'll become a pan-India player as well. And I was looking at rough numbers. Last year, Tilak Nagar Industries sold around 12 million cases. Imperial Blue sells around 22 million cases. So capacity, the scale itself will go up drastically. Yet we'll have to wait by to see what is the valuation, what is the debt. But we understand probably there could be a big deal in the works with Tilak Nagar Industries looking for a stiff peg, and that too of whiskey this time around.
Okay, all right, Nigel, thanks very much for that. So big deal, and the whiskey market itself, the Indian whiskey market is poised to grow to around $46 billion by 2030. So it's the right sip that they're taking.
I'll tell you one thing. Browns in India, which includes the likes of whiskey and brandy, are nearly 95% of the overall market. So all the conversation that happens around strong growth in tequila, strong growth in vodka, strong growth in gin, strong growth in wine is just 5% of the market. No matter what, Indians are whiskey drinkers, and a large part of South India is brandy drinkers. So there could be a geographical expansion for Tilak Nagar Industries out there as well. What is the kind of debt that they take will be extremely crucial to track. But in the past, Tilak Nagar has said that, their brandy sales, which is about 91% of the business, they plan to take it lower to about 80% organically. And if this deal happens, then that increases a lot more.
I think Vinny, you want to come in on that with regard to
No,
the
I'm
browns
happy
or
with
the
this.
whites?
If it is coming here, brown and white, I'm okay with any of them. So I'm up for it.
We'll wait by for this deal, but it's been in the works for very, very long, and let's see whether or not it does take place. But as of now, sources do indicate that there could probably be a deal, and that could be in the next couple of
But
weeks.
India's alcohol market as a whole is, just on an upward trajectory. You're talking about whiskey with the third largest consumers when it comes to alcohol. And when it comes to whiskey, I think 17% CAGR is what we're growing at. That's the kind of growth
And look at that, Ekta on top of the numbers. Not just dawa, but daru also.
What we'll do is we'll, just last part of the street, I'll be very interested to know how much of that was factored in by them as well. Because if you look at the last 1 month chart of Tilak Nagar Industries as well, on a regular basis, we've seen the stock move higher. And over the last 2 trading sessions or 3 trading sessions, there was that additional benefit that had come in from, the La Maison thing as well. So we'll watch out for that. The Bombay High Court has put a stay on that. So we'll watch out for how the story develops from here on. For now, a 25% up move is what we've seen on Tilak Nagar Industries. Thank you so much, Nigel, for bringing that to us.
Absolutely. That's going to be interesting now in terms of the alcobev industry as well. But, let's shift focus and talk about the IT sector. Now, we had Latent View Analytics, which reported their numbers yesterday. Inline set of numbers that came in, obviously, versus what we're seeing with the estimates. But strong growth in Decision Point. Commentary seems exciting coming in from the con call as well. Now, today we're joined by the management of the company. We have Rajan Sethu Raman, who's the Chief Executive Officer at Latent View Analytics, joining in with us. Good afternoon, sir. And thank you so much for joining in with us on the show. Let's just start by talking about in terms of overall the growth outlook. I want to understand because overall the core business, that's the latent views business, that's seen a muted growth of 0.3%. I'm comparing this on a quarter-on-quarter basis, while Decision Point has seen a much stronger growth, obviously, 16% growth. I want to understand where will this growth go for Decision Point as well as the core business of the company? How is that going to be in FY26? And will Decision Point continue to grow at a faster pace right now?
Good afternoon. You are right. I mean, the core business on a rupee basis was a smaller percentage, but that has also been impacted by the stronger rupee vis-a-vis the dollar. In dollar terms, we did about close to 3%, 2.9% or so. It's a tad lower than what we were imagining it to be at the start of the year. There were a couple of deals which were one-off projects that closed down, and some of the other larger deals have taken some time to fructify. But those deals have come through now, and we see that the second quarter we will not only catch up with what we lost out in the first quarter, but it will be better as well, right, in terms of the overall growth trajectory. Decision Point, if you remember, it has been impacted by the general sluggishness in the consumer goods sector last quarter. Last quarter, they were almost flat. But again, we see optimism and green shoots. We were able to close a few new wins in Europe as well as in the US. And we also see traction with the existing accounts that we are working with. More conversations happening with the CIO, CTO audience, slightly more integrated approaches also to transforming, not cutting across R&D, supply chain, and RGM. So we are expecting that the remainder of the year will continue to be a positive momentum for the consumer goods sector as well.
Okay. All right. So, for FY26, you've been quite positive in terms of your guidance, USD 18 to 19%, shooting towards 25% growth eventually. Where do you stand considering this quarter's performance?
So as I said, while this quarter, the core business was a tad lower, we are already seeing a revival in the second quarter. I mean, some of the deals which we were expecting to close prior to the start of this quarter or early in the quarter, they have been a bit delayed. But we see a much stronger comeback in quarter two. I mean, our quarter two projections internally, what we have at this time, based on the numbers that we see are quite high. And it is in line not only with the 18-19% guidance that we had given earlier, but if things continue in this trajectory, we should be able to go past the 20 number. Now, I don't want to put out a number at this time because we do want to make sure that things come through in this quarter. But overall, in terms of the guidance that we gave earlier, absolutely no concern. And hitting the 18-19%, we should really go past the 20, right, based on what we see.
Okay, so just to reiterate, 18 to 19% is what you're sticking by for FY26. You think that there's a chance that you could probably go to 20%?
Yeah, go past the 20% number based on what we see. Yeah.
So, you did allude to the deal. The deal and the delay, I suppose, is on account of the acquisition of Decision Point Analytics. That was delayed. Has that come through? The street is worried that if that does not come through, then what? Can you give us a sense on that?
Sorry, I didn't get your question. Are you talking about the acquisition of Decision Point Analytics? Or?
That is correct.
No, I mean, the acquisition has been completed last year, right? I mean, we got 70% then, and we acquired a further 10% at the end of the first year. There is an earn-out plan in place, and therefore we'll be looking at this year as well, right, in terms of completing the transaction and getting 100% ownership of the company. But otherwise, we are already working well together, right, and starting to get the synergy benefits as well of having not only the people from Decision Point, but also the capabilities and the solutions that they have brought to the table.
And what about the margins? You spoke about the synergy benefits and you completing the deal, integrating everything. Just wanted to understand on a combined basis, what proportion of synergies have you realized already? What's your margin target for this year and next?
So the synergy benefits from a go-to-market perspective, they are falling in place. I mean, I would say that we are about 80% there. On the corporate functions, we believe that there is more that could potentially be done. That should give us a kicker on the margin front as well. Overall, as a combined business between Decision Point and LatentView Analytics for the year, we are still fairly in range for a 23% kind of a margin number.
Okay. Also, could you talk to us about your different segments, right? Like you said last time also, you had mentioned that the consumer sector was not doing well, and that's why some bit of a delay. Now we're highlighting green shoots. So how much of a recovery could we expect in terms over there? Also, BFSI sector, that is, contribution is quite considerably good now, 12% that is coming in from BFSI. You wanted to grow at 40% as well. That's what you've mentioned in your con call. So I want to understand what will drive the growth in BFSI? Which part? Is it going to be fintech, payments, AMCs? Where are you seeing good traction?
All right, yeah. So firstly, on the consumer goods, as I said, we are seeing traction in terms of taking a more integrated approach across R&D, RGM, and supply chain. And those are the type of conversations that we are enabling. There is good traction on the generative AI front as well. I mean, one of the deals that we won in this quarter was completely on the back of using generative AI capabilities for creating content, not just the text content, but also the audiovisual content that goes into the direct-to-consumer platform, right, of an innerwear apparel company that we are working with. And this is also gaining a lot more traction with Databricks, who's our partner. So we are expecting that we'll be able to take a more integrated, holistic offering into the consumer goods business. When it comes to BFSI, we have seen an uptick in the payments, in the fintech space, rather than in the banking and the insurance. There are a couple of accounts that we have started working with in the banking and insurance space, but we will probably need another 6 months to see a bigger uptick, right, in terms of the size of the deals that we are doing. So early starts there. A lot of the growth that is happening today being driven on the fintech side.
Okay. Also, just one more point. US, 89% of your revenue is obviously from US. You have spoken about, increasing Europe in terms of the size, but still, it's not that much of a proportion that comes in from Europe. So what are the plans for expanding further in Europe? Any strategies that you have? Any acquisitions over there as well?
So Europe has been a bit of a challenge for us. I mean, we have tried a few things. More recently, when I say recently, in the last 6 months, we did take a call that we will just focus on 2 sectors, consumer goods and banking financial services. The green shoots that we are seeing in consumer goods, as well as the growth anticipated in the banking financial sector, there are accounts that we are working with in Europe as well. So therefore, Europe should be a part of the growth story. We had an earlier target of 10% plus in a 2-year time frame. I would want to wait a couple more quarters to see whether we are able to get to that kind of a number in terms of a projection 2 years out. But Europe is looking good. There is also traction in the Latin American market, right, that we are witnessing. One important lever of growth in both these markets would be to partner with consulting firms who do management consulting and strategy consulting work. There are a few conversations that are underway, and I'll be able to share an update maybe after this quarter's results. But the intent is partner with boutique consulting firms who are doing the upfront business strategy consulting, and can we come in as the data analytics partner, right, to grow these markets.
Okay, all right. So we're going to leave it on that note. Always a pleasure. Thanks very much for joining in and speaking with us. So that is late in view. The stock is up around 4% at this point in time. They are confident in terms of the guidance of around 18 to 19% growth for FY26, possibly even shooting above 20%, and margins of around 23%. We'll take a short break, but before that, now it's time to recognize the champions. Get ready for an evening that honors India's most promising SMEs, the champions behind our nation's remarkable progress. From groundbreaking innovation to grassroots impact, these businesses have powered growth, inspired change, and redefined ambition. HSBC presents CNBC-TV18 SME Champion Award Season 2. India's most coveted SME award platform is all set to finally announce the winners on 25th July, 3 p.m. onwards. Welcome back. Well, for the markets, it's quite quiet today in terms of movement, except for the mid-cap index, which is under pressure and underperforming. So down around 0.4% currently for the mid-cap index, with the advanced decline ratio on the declining side. So that's really where the pressure is, the broader markets at this point in time. But Bajaj Finance is in focus as its MD and CEO Anup Kumar Saha has tendered his resignation, and Rajiv Jain has been re-designated as the VC and MD. Now, several reports have emerged thereafter on Saha's potential next stint. Ritu joins in with more details on this story. Ritu.
Well, our sources indicate it may be too early to assume that Anup Saha resigned from his position as the MD of Bajaj Finance to take over the top job at IndusInd Bank. Remember, we were the first to report that Anup Saha is among the 3 candidates who are in the running for the IndusInd Bank CEO role. And while his name being in the mix may have had some bearing on internal dynamics at Bajaj Finance, we understand RBI is yet to clear a name for the IndusInd role. So the idea that he quit specifically to join IndusInd may be a bit premature. But that said, the resignation itself has come as a surprise, given he was being groomed for the position for the last couple of years and only took over as the MD in April, and so him quitting the role in just under 4 months has raised some questions. Equally important is the fact that Bajaj Finance's long-term MD Rajiv Jain is back at the helm, and he's going to serve as the MD for the remainder of his term until March of 2028. Now, while this will provide a smooth transition for Bajaj, the focus will also move to succession planning. Now, remember, Rajiv Jain has spent more than 15 years as the MD of the company, and while RBI rules limit bank CEO terms to 15 years, there is no such cap for NBFC, so technically he can continue, but the company will still be under pressure to groom the next line of leadership. Now, Jeffries points out that Rajiv Jain may now need to pull back from any advisory role at Bajaj Finserv, and Morgan Stanley calls this a setback to the succession plan that the company had been executing. But with Rajiv Jain back in the driver's seat, they say the situation remains manageable.
Okay, Ritu, thank you so much for that. But let's move on and talk about Zomato and Blinkit's owner, Eternal, that has surged in trade. And this is on it saying that maybe we'll see that bottoming out coming in for its quick commerce side of the business. And now it's scripting a path of growth and profitability. Mangalam is joining you with us now to tell us what is fueling this surge. What are we expecting going forward as well? Mangalam.
Well, Eternal in today's trading session have hit a record high. In fact, ever since the company reported the numbers, the stock has rallied about 15% plus. And that, if you look at the reported numbers, then you'll be wondering why. Because the revenue has grown 70%. That's great. The EBITDA has fallen 35%. Margins have contracted to 60 basis points. And the net profit has fallen 90%. Now, here's why. Because a couple of things that the management spoke about are telling you that the worst is behind. One, year-on-year growth has bottomed out for the food delivery business, which implies that it will only improve from here on. And near-term, quick commerce margins too have bottomed out and they will improve from here. So let's take the food delivery business first. Over the last many quarters, the revenue growth had been coming down, and for the first time between Q4 and Q1, the revenue growth has stabilized. This is gross order value growth has stabilized at around 16%, which the management believes is the absolute bottom, and from here on, they are expecting growth to resume. That's a positive. The second part, Blinkit, which was supposed to be the growth driver of the company, continues to be the growth driver, so much so that the revenue growth of 154% has actually made it the largest revenue component in the overall business. But the problem over the last few quarters was EBITDA loss increasing due to competition. Out here, the losses have narrowed quarter on quarter, and this despite the company continuing to expand. So if you look at it, they've added almost 243 stores in this quarter, total stores going all the way up to 1544. And this, while doing so, the losses quarter on quarter have narrowed. So the Blinkit loss trend comes up for you from 178 crores, it's narrowed to 162 crores. And the management believes that in the near term, it's actually likely to see margin improvement. So two growth drivers of the company, both of them fairly in place. Which is the third one? It is District, where the management sees over the next 5 years, it could be an annual $3 billion revenue company with $150 million in annual adjusted EBITDA. So the third factor doing extremely well for them as well. The question, what about the money? Well, in the fourth quarter, they had seen a quarter-on-quarter decline in their cash balance. That too seems to be stemming right now. From the fourth quarter to now, the cash has marginally increased, or cash burn has reduced as well. So all these factors doing well. The stock, which was off its highs, has now moved higher. The next big trigger is because it is now a largely domestic-owned company. They will own inventory in Blinkit as against third-party sales, and that could increase their margins in the quick commerce business by about 1% as well. And when Blinkit rise, it's not just Blinkit, because we have Swiggy, which is trading higher on the back of Eternal's performance, and it trades at a 45% discount to Eternal, so that stock is higher. And secondly, InfoEdge, which owns about 13% stake in Eternal, worth nearly 38,000 crores, or 40% of its market cap, doing well in today's trading session as well. But the data point or the picture that caught my eye was that on the shareholders' letter. It had three businesses, all of them with clear positioning. Zomato for Eternal, aaj kya khaoge? District, aaj kahan jaoge, is the going out business. And Blinkit, finally, aaj kya mangwaoge? Three business propositions, all of them clarified in their shareholders' letter.
Okay, Mangalam, and the last three indicating that you just have to spend on all three of them. So that's where consumerism is heading. But nonetheless, that point is taken, Mangalam. Thanks very much for that. That's on Eternal. In fact, multiple brokerages have been positive on Eternal post the numbers. For example, Jeffries has upgraded the stock to buy and raised the target price to 400 odd rupees. CLSA has a high conviction outperform as well, with the target price of 385 odd rupees. So all round seems to be a good going for Eternal. We'll take a short break, but Sachidanand Utekar from Trade Bulls will join in with some of his trading calls. Stay tuned.
Welcome back. You're watching us here on Halftime Report. The markets come off the highs, considerably off the highs in today's trading session, consolidating lower after having seen a bit of an up move in yesterday's trading session. Though now, after consolidation, it's back just above that green line, and that's led by the Nifty Bank. So if you look at the frontline indices, the Nifty Bank, as well as the mid-cap index, that tells you the story of the day. The Nifty Bank is just about meandering around the 20-day moving average, which is 56,973. Yesterday closed above that. Today, for most part, has been below that, but now just about 40 points away from that 56,973 mark. Where it closes will be extremely crucial, because where the Nifty Bank closes will reflect whether the Nifty goes ahead and conquers the 20-day moving average of around 25,300 as well. But before that, we have today's high to contend with, which is closer to 25,182, and 25,100 call writers for a premium of 70 rupees believe that may still pose some sort of congestion or resistance today. We've seen writing at the 25,100 call and the 25,200 call, which has a premium of 35 rupees, telling you between 25,180 to 25,230 there could be some supply. But at lower levels, 25,000, important psychological level, and also a lot of put writing at 2550, telling you that there is support around 25,000. A lot of long positions added in new age companies. So we just spoke about Eternal hitting a fresh record high. The stock up 11% right now. Info Edge itself up around 3.5% on the back of its holding there. Long positions being added there. And Paytm, remember the company in its update guided for good performance, and it reports its numbers today. The stock is fairly well bid ahead of those numbers, up around 3% right now.
Okay, all right, Mangalam, thanks for that. So that's Paytm, that stock is up around 3%. We have a lot of numbers to reckon with today. We have Colgate, M&M Finance, Paytm, like you mentioned, Credit Access Grameen, United Breweries, Z Entertainment. So there's going to be a lot of focus in terms of what's taking place in the broader markets. But Sachidanand Otekar from Trade Bulls joins in now to discuss what he's tracking this afternoon on the technicals. Sachidanand, welcome to the show. If you could just start by telling us what your Nifty strategy would be considering the consolidation that we're seeing.
Good afternoon, Ekta. Good afternoon, Mangalam. I think it's been a good start for the week. The Nifty has defended its 50-day exponential moving average support at 24,950 very well. We saw some slippages yesterday, but the recovery has been very significant on the daily scale. we have a strong bullish reversal formation. The confirmation of the same would be set once we see the Nifty, scaling towards 25,180, 250 kind of a level. So as of now, I think the range is well defined. It is oscillating between two key moving averages. One is the 50 DEMA, which is at 24,950. And on the higher side, it needs to surpass that 20-day exponential moving average, which is placed at 25,180. But if you look at the placement of its, indicators, especially on the relative strength side, there's a possibility that we may see the Nifty scaling towards 25,000, 250 during this particular week. So hence, we are of the opinion that one should maintain a long bias in the market, though the range is looking like an oscillating range, but within this particular range, the opportunity is purely on the buy side. We are expecting that 25,000 support should hold on at least for the day. Hence, we are recommending, building fresh long positions, keeping a stop loss at 25,010 on a closing basis. Eventually, we may see this Nifty scaling towards 25,250, and we may see it surging towards 25,300 for this particular expiry. When we look at Nifty Bank, the range is a bit broader. 56,400 has been a very steady support. But on the higher side, it needs a confident closing above 57,400 mark. If you look at the overall sequence for the last 3 weeks, it looks like a bullish flag formation awaiting a breakout confirmation. So even here, I think one can keep a stop loss at 56,720 on closing basis and look for building long positions. When we look at stocks, I think we have already seen a very confident breakout from ICICI Bank. After 9 weeks of consolidation, this particular breakout has pushed the stock above that 1460 hurdle. So even here, I think there is a good potential that we may see this particular rally getting extended towards 1540. It has been a significant contributor in the last few trading sessions, and that's why we believe that any declines in this particular counter would again give a good opportunity to create fresh long positions. One can keep a stop loss at 1462 on the lower side on a closing basis. From a trading perspective, we may see a swing towards 1510, but eventually we see this rally getting extended towards 1540. So there will be a buy call on ICICI Bank. And the second stock which has hit our radar is Tata Chemicals. Now, if you look at the overall performance, even here, the stock was struggling to surpass its 200-day exponential moving average resistance, which is placed somewhere close to around 950 kind of a zone. Even if you look at its weekly, price action, it had been, trending lower below its 50-week exponential moving average, which is somewhere close to around 955. So today we have seen a significant price development. We may see this particular rally getting extended towards 1,000 levels. Hence, we are recommending building fresh long positions in a stock like Tata Chemical, keeping a stop loss at 945 on closing basis.
Okay, thank you so much for that. Thank you so much for giving us those views on individual stocks as well as in terms of the market. Just a stock that I want to mark once before we slip into a break is going to be NLC India. That's seen a sudden spike up as well. It's up 5% as of now. We're not seeing much of a news flow here, but as of now, we're seeing a bit of a spike up coming in the last 30 minutes since we started the show. So keep an eye out on NLC India. But on that note, like I said, we're going to slip into a very short break. But here's a reminder for our viewers: unlock a world of exclusivity, expertise and influence. Become a member of CNBC TV18 Access, our premium members-only experience on CNBC-TV18.com. The membership includes access to CNBC TV18's flagship events, interactions with our journalists, along with curated studio tours, e-learning sessions and masterclasses, and curated lifestyle benefits.
Welcome back, and joining us on the show now is Surendra Mehta. He's Secretary at the India Bullion and Jewellers Association. Mr. Mehta, hi, thank you so much for joining in. First of all, your reaction as well onto the BIS notification, and the market still seem to be breaking that down in sense of analysis and impact. My first question to you is on the coins itself, which is stated that only mints and refineries can make it. Is there a change really on that line, and the way the jewelers are perceiving it really?
Well, there is a lot of confusion in the market, and let me, through your medium, let me clarify you and clarify the entire industry that in principle, there is no change in the recent notification or the recent order issued by BIS. What basically it says that coin can be now made by mints and refiners, and if coin are made by mints and refiners, then they are not required to be hallmarked. But if coins are made by jewelers, they are required to be hallmarked. Now, what jewelers normally do, they don't have a facility to make 999 coin. They can always make 995 coin, which is called 24 KS and KF as per BIS standard. But anyways, all 995 purity coins, if made by jewelers, they are required to be hallmarked. There is only this one amendment. There is no other amendment at all in respect of manufacturers of coin. So if the jewelers feel that they cannot make coin, it is not true. They can always make coins. They will have to get this coin hallmarked from the hallmarking agents.
All right, that makes a lot of sense, and that does clarify a lot of things as well. My next question to you is about the Indian demand for 9 carat. I mean, in my earlier conversations to you, you always told me that 9 carat is something that the rural India tends to use a lot, not so much for urban India, but with the way the prices have almost doubled in last 2 and 3 years, do you see urban younger crowd as well going on for this 9 carat, not for investment, but only as fashion jewelry per se?
See, initially when the 14 carat started, the similar talks were there that who is going to buy 14 carats, but then diamond industry opted for 14 carat jewelry because they have been now using along with the diamond only 14 carat gold. 9 carat basically, Manisha, is an option given to a jeweler and customer both. If there is really a market for 9 carat, then that option is available to the consumer as well as to jeweler. Earlier, what used to happen, BIS was not permitting jewelers to manufacture anything below 14 carat. Now, this is an option open. We are not sure whether there would be really a market for 9 carat or not. If the market evolves, then jewelers will manufacture. If the market does not evolve, or the market does not pick up for 9 carat jewelry, probably they will not manufacture. But at least by virtue of this, we are giving option to the consumer because of surging prices. In my opinion, I'm particularly of the opinion that a lot of jewelers have been, misguiding consumers in the rural area and were selling jewelry below 14 carat, non-hallmark, and all those complaints we have been receiving. So that is why through an IPJA, we represented BIS and said that, look, you cannot fix it at 14 carat. You will have to bring it down to 9 carat. And that would probably help consumers as well as jewelers both.
Oh, well, yes, give them an option, and whether they buy or not is purely to the consumers there. But we do understand that it is almost to the tune of 80% of buying that happens in India, or more perhaps, is 22 carats. And then, of course, it's a lot of spread around there. Since we have you with us, what's your sense also on the prices in case of gold? Because we seem to be solidly holding around that $3,300 per ounce mark, with more banks now suggesting that we are going back to 35, 3,600 as well. It only has been about Citibank, which believes that we could go down to 3,000, even lower by the time this year ends. And Citi is the only one really, because everybody else, all other Indian banks, brokerages, analysts, everybody seems to be talking about levels much higher.
Well, Manisha, in my last interview to you, I had specifically mentioned that the gold prices will move and will consolidate in the range of $3,200 to $3,450. And that is what we have been seeing this. But let me tell you, yesterday's movement clearly shows that there is more upward side. And I think this upward side, there is another technical pattern forming, which can probably take gold to 3,800 level also. We'll have to understand 2-3 important things, that Fed is likely to cut interest rate and geopolitical tension still exist, tariffs still exist. and the interest rate can be reduced by Fed any point of time. Apart from these, the central bank buying by countries like China has been continuous. And I personally feel that we are moving towards 3,000.
Prices are higher. I have one final question for you, and this is about bullion hallmarking. I remember in the previous conversation that we spoke about this. So as you said, coin hallmarking, if it is done by mints and refineries, is not required. But bullion hallmarking, because IBJA has been pushing on that one as well. What is the latest there?
There is a steering committee formed for the bullion hallmarking. The steering committee has already submitted its report to the Bureau of Indian Standard. We strongly feel that consumers should not be cheated, and we are insisting because if you bring jewelry under hallmarking, which may be even more than 2 gram, it is required to be hallmarked. Then why not bullion? Because at least to start with the mandatory hallmarking, we are pushing towards hallmarking of bullion above 100 grams, and then slowly and gradually it can be brought down to 5 grams.
Okay, all right. Thanks very much, Manisha, for taking us through that conversation. Well, for the markets, it's quite quiet as we speak, but the Nifty is in fact turned into the green. So just watch out for that. But really, just about very tight range that we're trading in today. 25,099, so just about at that level of around 25,100 for the Nifty. For the Bank Nifty, also flat with a little bit of a negative bias. We'll take a break, but remember to tune in to the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and the Global Lens at 8:30 p.m.
Welcome back to Halftime Report on CNBC TV18. A couple of names from the Nifty 50 that are buzzing in trade. One is Eternal, then the other one is Titan, HDFC Life among the top gainers. But let's talk about Titan, because this has come in, and this gain is coming in after they've acquired 67% stake in Gulf retailer Damas Jewelers for approximately 2,400 crores. Mangalam, Give us more details on this one. What does it mean for Titan? Because the stock surely is holding on to decent gains.
Yep. You know, in the morning, during the top 10 segment, we did expect the stock to do well in today's trading session on the back of this deal. So let's just tell you about the deal. It's acquired 67% or nearly 2/3 of Damas Jewelry at an enterprise value of 2,400 crore rupees. So obviously the net consideration for Titan would be a lot lower than that. You know, the deal will expand the company's presence in the Gulf as well as West Asia, which is Middle East as we know it. Why is this important? Because one, Titan has been looking to expand its international presence. Secondly, there is a fair amount of Indian diaspora in those countries as well. What the street likes about it is the valuation. It's relatively reasonably valued because the business did about 2,700 crore revenue in FY22, moved all the way up to 3,400 crore in FY24. And my sense is that it would have done a lot better given the gold price rise in FY25 as well. So in all practical purposes, you know, less than about 0.6, 0.7 times sales. Important part is the margins. Secondly, the company has said that, you know, they are looking in the past at nearly $500 million revenue coming in from international business by FY27. As of end of FY25, they were at a run rate of close to $150 million. So this itself, you know, accelerates their target to move to $500 million. In the previous acquisitions, what had happened was they had to eventually, for the remainder, pay a lot more than what they had earlier factored in. But now it turns out that the company's clubbed that or, you know, closed that loop as well by signing a path to acquire the balance 33% stake after December 2029. So the good part is it's a good acquisition in a geography which has a lot of diaspora presence and growth in a place where the company is looking to grow already at fair valuations. Add to all of this, not only does it, you know, cement its position outside of India, but also helps stem any sort of competition coming in from players like Malabar and Kalyan, who already have a serious presence in the West Asian markets as well. So all these doing well for Titan. Stock up around 1.5%.
Okay, all right. Thanks very much for that, Mangalam. That's on Titan. Just watch out for Blue Jet Healthcare because it came out with its numbers just a couple of minutes ago and it's a sharp downtake that you've seen for Blue Jet post its numbers. That stock is down around 9% reacting to it. So it's been a sharp downtake that you've seen. The revenue doesn't look too bad, but it is the profit which is coming at around 9.1 crores or 91 crores rather, versus around 110 crores in the previous quarter. So there's been a downtick which has taken place on a sequential basis in terms of profit, though the profit is looking okay on a year-on-year basis. So sequentially, there's a downtick which has taken place in terms of the numbers. In any case, we'll take a short break, but as we do that, here is some good news for our viewers. India's business news leader is now just a click away, introducing CNBC TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC TV18 app now from the Apple Store or the Google Play Store, or just scan the QR code on your screen.
Welcome back to Halftime Report on CNBC TV18. As of now, the Nifty is not doing anything. 25,100 levels, about that mark is what we're seeing the Nifty move. So it moved from the red to the green in this last 1 hour since we started the show. But yes, muted day of trade still continues for the Nifty. But let's talk about United Breweries, Mangalam. That is expected to report its Q1 numbers as well. What are we expecting this time? Anything exciting?
Well, we started the show with whiskey, so it's only fair that we end it with beer as well. And, seasonally, United Breweries sees good performance in the first quarter because it's summer season, notwithstanding the impact that we saw of unseasonal rains on a lot of the consumer durables, summer products. There are a lot of tailwinds that may still lead to United Breweries doing well in, the first quarter this time around. And that's reflected in the kind of stock price move that we've seen in today's session so far itself. It's a good quarter that is expected. Why is that? Ex of excise, the revenue is likely to grow at around 11%. 2,750 crores is what we're expecting on the top line. The EBITDA grows a step higher, 13% growth, which implies margins of 11.7% versus 11.5%. And the net profit also grows at mid-teens. We're looking at a number of 200 crores. Volume growth expected to be between 6 to 8%. But remember, the volumes would be driven by prestige. For them, premium volumes are likely to grow between 20 to 25%. That's something that's been driving the volumes going forward. Summer is seasonally strong for beer, but there has been a slight impact of unseasonal rains. There is normalized operations in Telangana that would support volumes. Increased prices out there would support EBITDA as well. But impact of excise hike in Karnataka, could that offset the increase that we'd see in Telangana on their operational performance or not, is something we'll be watching out for. And finally, what the company does in terms of investments in brand, demand creation and new bottles as it moves into the premium end of things, that may limit margin expansion, which is why we are expecting 11.7% as against 11.5%.
Okay, that's about United Breweries, but it's time for a special segment as well, Quarter Se Quarter Tak, where we bring you earning expectations from each sector. And today, Ekta is going to be talking to us about pharma and healthcare. What are we expecting to see in Q1 FY26? Ekta, over to you.
Well, for pharmaceutical stocks as well as healthcare stocks, expect a steady quarter. Now, for pharma companies, you are expecting around a 10 to 11% growth in revenue and a growth in EBITDA, which would be similar this quarter, along with profit between 5 to 10%. Now, expect the US growth for generic companies estimated at around 3 to 4% Q-on-Q. Growth X of Revlimid generic would be something to watch out for. Now, overall growth in the US would be led by stability in US generic pricing, volume growth in existing products, and a pickup in recent launches. Expect lower Q-on-Q sales in Revlimid generic for companies such as Aurobindo, Cipla, Dr. Reddy's, Sun Pharma, according to analysts, as price pressure increases. Now, for Sun, watch for the specialty portfolio growth. That would be the key thing to watch out for. For Biocon, watch for growth in the biosimilars portfolio. Now, the range for domestic growth is wide, anywhere between 8 to even 16%, according to some analysts. Now, domestic focused firms such as Torrent, Ipca, Alchem expected to see good growth this quarter. And watch for commentary on Torrent's acquisition of JB Chemicals. Now, most API companies are likely to see a volume uptick this time round with an estimated 8 to 9% growth year on year. Expect over 15% growth in some CRDMO companies driven by the likes of Blue Jet, Divi's, Loris Labs, Sai Life Sciences. While Syngene and Piramal Pharma could probably see a muted quarter due to inventory destocking on key molecules. Now, moving on from pharmaceuticals to the healthcare front. On the healthcare front, expect around a 20% growth in EBITDA, driven by over around 20% growth in hospitals and around 10 to 11% growth in diagnostics as healthcare companies recover after a softer Q4. Apollo hospitals might see continued impact of international patients slowing from the likes of Bangladesh. Commentary on the recent restructuring will be watched. Expect steady margins for the likes of Dr. Lal's. Watch for recent acquisition integration for Metropolis, which has been on an inorganic drive. Now, let's leave you with the valuations. First, for the pharma stocks, as you can see, Sun Pharma ruling the roost, most expensive, along with a couple of others such as Divi's Labs. So a lot of probably the good news is factored in. For diagnostics, Dr. Lal's as well as Metropolis, FY26 PE stands at around 50 odd times. And finally, for hospitals, the likes of Apollo Hospitals and Max ruling the roost in terms of valuations.
All right. Meanwhile, thank you for that, Ekta. You've set us the stage for the pharmaceutical space. But meanwhile, just looking at Colgate right now, they've reported their numbers. The numbers should hit the wires very, very soon. On the revenue front, the company has reported 1,434 crores on a revenue plus other income basis. So net profit coming in at 321 crores, which is lower than the CNBC-TV18 poll of 353 crores. I'm just trying to look at some more numbers as well. The EBITDA has come in at 450 crores, which implies a margin of 31.5%. As against street expectations, there wasn't much, in fact, that the street was working with when it came to Colgate. We were looking at, a revenue decline of about 0.5%, 1,490 crores. Instead, the revenues declined by a lot more, 1,434 crores. And the net profit has also been below street expectations. EBITDA, we were working with a number of 495 crores. The company's reported a number of 452 crores. So on all parameters, there has been a miss on Colgate. The stock has already seen a cut of almost 40% from its highs and continues to weaken. So EBITDA at 453 crores, street was working with a number of 495 crores. The revenue of the company actually lower than street expectations. We were working with 1,490 crores. They've gone ahead and reported 1,430 crores. And as a result of which, the bottom line as well is lower. What is it that the company is saying about this? One, they're saying it was a challenging quarter, cycling double-digit growth base. They maintained their investment behind brands, which was in line with strategy. But there have been persistent headwinds from tough operating conditions on account of subdued urban demand and elevated competitive intensity. They also worked towards premiumization, which did well. That delivered strong revenue growth, but at the same time, overall weakness in consumer sentiment and competitive intensity impacting their mass products, and that's reflected in their overall numbers. Colgate down 1.5% on the back of a subdued set of numbers coming in. With that, we'll wrap up on this edition of Halftime Report. You stay tuned. Business Lunch comes up next.
Mixed signals on the India-US trade deal cloud sentiment, as do cues from corporate earnings keeping stocks in check. Realty and healthcare are the big drags, while metals, financials and IT eke out some gains.
In a sudden move, Bajaj Finance Managing Director Anup Saha resigns with immediate effect. Vice Chairman Rajiv Jain will step in as MD till his term ends in March of 2028. The move sets back the company's succession plan.
Titan inks a deal to pick up 67% stake in Damas, which has a presence in jewelry across the GCC at a valuation of a tad over Rs 2,400 crores. The deal offers Titan an option to buy the remaining 33% in the future.
Zomato and Blinkit owner Eternal stock surges on its bottoming out call for quick commerce and it's scripting a path to growth and profitability. Peer Swiggy and stakeholder Info Edge also rally.
Jagdeep Dhankar resigns from the Vice President's post, citing health concerns and the need to follow medical advice. In his resignation letter, he says the decision was taken to prioritize healthcare in light of ongoing health issues. Hello and welcome to Business Lunch live from the CNBC-TV18 Motilal Oswal studio. I am Bamakshi Thoria and with me is Hormaz Patakia. Well, good afternoon to you, Hormaz. It has been a very good recovery from the day's lowest points. I think it is almost a 70 to 80 points recovery coming in for the Nifty. When we look at the advanced decline ratio, though, it is more or less, going 1:1. The mid-cap end of the market, though, is taking a very sharp knock in today's trading session. The mid-cap index is down almost 0.3%, Hormaz.
Results are starting to come in now and you're counting down to some big numbers. The numbers of Colgate flashing on your screen. Mangalam just spoke about it a few minutes earlier. You're anticipating recovery to come in on the second half of the year. So interesting to see. The stock has recovered though from the lows of the day. It'll be interesting to see what the volume growth number throws up for Colgate this time around. But the other earnings that I wanted to just highlight before we move to Zomato is Blue Jet Healthcare. The numbers just came in a few minutes earlier. The stock is down 10%. And even as the numbers year on year look good because there has been an expansion on all parameters, sequentially, the numbers have taken a bit of a knock and the margins are down almost 7 percentage points from the March quarter. And that has resulted in the stock taking a knock after the results announcement. There you can see 10% lower for Blue Jet Healthcare, although significantly higher than its IPO price, which is around 349. So still very much in the money. But today, the stock taking it on the chin. But the big mover of the day, the story of the morning has been Eternal, Zomato and Blinkit's owner, and that is now building on to the gains. At one point was up 15%, still holding on to gains of 12.5%, and that is because of its bottoming out call for the quick commerce business and scripting a path to growth and profitability as well. Mangalam is here to decode what is fueling this surge in Eternal.
Well, Eternal in today's trading session have hit a record high. In fact, ever since the company reported the numbers, the stock has rallied about 15% plus. And that, if you look at the reported numbers, then you'll be wondering why. Because the revenue has grown 70%. That's great. The EBITDA has fallen 35%. Margins have contracted to 60 basis points. And the net profit has fallen 90%. Now, here's why. Because a couple of things that the management spoke about are telling you that the worst is behind. One, year-on-year growth has bottomed out for the food delivery business, which implies that it will only improve from here on. And near-term, quick commerce margins too have bottomed out and they will improve from here. So let's take the food delivery business first. Over the last many quarters, the revenue growth had been coming down, and for the first time between Q4 and Q1, the revenue growth has stabilized. This is gross order value growth has stabilized at around 16%, which the management believes is the absolute bottom. And from here on, they are expecting growth to resume. That's a positive. The second part, Blinkit, which was supposed to be the growth driver of the company, continues to be the growth driver, so much so that the revenue growth of 154% has actually made it the largest revenue component in the overall business. But the problem over the last few quarters was EBITDA loss increasing due to competition. Out here, the losses have narrowed quarter on quarter, and this despite the company continuing to expand. So if you look at it, they've added almost 243 stores in this quarter, total stores going all the way up to 1544. And this, while doing so, the losses quarter on quarter have narrowed. So the Blinkit loss trend comes up for you from 178 crores, it's narrowed to 162 crores. And the management believes that in the near term, it's actually likely to see margin improvement. So two growth drivers of the company, both of them fairly in place. Which is the third one? It is District, where the management sees over the next 5 years, it could be an annual $3 billion revenue company with $150 million in annual adjusted EBITDA. So the third factor doing extremely well for them as well. The question, what about the money? Well, in the fourth quarter, they had seen a quarter-on-quarter decline in their cash balance. That too seems to be stemming right now. From the fourth quarter to now, the cash has marginally increased or cash burn has reduced as well. So all these factors doing well. The stock, which was off its highs, has now moved higher. The next big trigger is because it is now a largely domestic-owned company. They will own inventory in Blinkit as against third-party sales, and that could increase their margins in the quick commerce business by about 1% as well. And when Blinkit rise, it's not just Blinkit, because we have Swiggy, which is trading higher on the back of Eternal's performance, and it trades at a 45% discount to Eternal, so that stock is higher. And secondly, InfoEdge, which owns about 13% stake in Eternal, worth nearly 38,000 crores or 40% of its market cap, doing well in today's trading session as well. But the data point or the picture that caught my eye was that on the shareholders' letter. It had 3 businesses, all of them with clear positioning. Zomato for Eternal, aaj kya khaoge? District, aaj kahan jaoge, is the going out business. And Blinkit, finally, aaj kya mangwaoge? 3 business propositions, all of them clarified in their shareholders' letter.
Well, thanks so much for that, Mangalam. Interesting data out there for Eternal, and no wonder the stock is the star performer of the day. But take a look at Max Financial. Just a short while ago, there were flashes at the bottom of your screen which indicated that sources were suggesting that Axis Bank could pick up an additional 10% stake in Axis Max Life. So resultantly, the stock has surged to the highest point of the day. A very sharp spike coming in on this counter. But let's also focus in on Bajaj Finance then, as its MD and CEO Anup Kumar Saha has tendered his resignation, and Rajiv Jain has been redesignated as the VC and MD. Now, several reports have emerged thereafter on Saha's potential next stint. Ritu joins us with more details. Ritu?
Well, our sources indicate it may be too early to assume that Anup Saha resigned from his position as the MD of Bajaj Finance to take over the top job at IndusInd Bank. Remember, we were the first to report that Anup Saha is among the 3 candidates who are in the running for the IndusInd Bank CEO role. And while his name being in the mix may have had some bearing on internal dynamics at Bajaj Finance, we understand RBI is yet to clear a name for the IndusInd role. So the idea that he quit specifically to join IndusInd may be a bit premature. But that said, the resignation itself has come as a surprise, given he was being groomed for the position for the last couple of years and only took over as the MD in April, and so him quitting the role in just under 4 months has raised some questions. Equally important is the fact that Bajaj Finance's long-term MD, Rajiv Jain, is back at the helm, and he's going to serve as the MD for the remainder of his term until March of 2028. Now, while this will provide a smooth transition for Bajaj, the focus will also move to succession planning. Now, remember, Rajiv Jain has spent more than 15 years as the MD of the company, and while RBI rules limit bank CEO terms to 15 years, there is no such cap for NBFC, so technically he can continue, but the company will still be under pressure to groom the next line of leadership. Now, Jeffries points out that Rajiv Jain may now need to pull back from any advisory role at Bajaj Finserv, and Morgan Stanley calls this a setback to the succession plan that the company had been executing. But with Rajiv Jain back in the driver's seat, they say the situation remains manageable.
Ritu, thanks a lot for that. Keep an eye out on Bajaj Finance and a lot of the other lenders that are in focus as well. Take a short break. More updates from the India-US trade deal talks on the other side. Stay tuned. Welcome back. Now, the US-India trade deal ahead of the 1st August deadline is unlikely, with both nations trying to hold further deal-related talks in New Delhi next month. Parikshit is here with more details on this. Parikshit.
Any interim deal between India and US or a mini trade deal before the 1st of August looks unlikely as of now. In fact, the possibility is likely to be ruled out altogether. This is because the talks between India and United States are stalled on certain key issues. Number one, US President Donald Trump has offered a deal to India which is very similar to Indonesia and Vietnam. And India wants a competitive advantage over these countries and not a tariff arrangement on similar lines. Number two, the deal is also stalled because the US government wants to impose a 20% tariff on Indian goods coming into America. On the other hand, they want zero tariff duty treatment in the Indian market for American goods. This is not acceptable to the Indian side because we want the deal to be a win-win and a reciprocal deal. Also, on agriculture and dairy, we believe that the US administration is still pushing for the inclusion of agriculture and dairy items in any kind of trade deal or understanding before the 1st of August. And India will not compromise on these issues. These are red lines in any trade negotiation. Therefore, currently the Indian side has refused to have any further negotiations, at least this month. Talks will continue for a larger bilateral trade agreement. A US team headed by their negotiator Brendan Lynch will be coming to India in August to try and see if there can be a breakthrough in talks with India. For the moment, there is a 10% baseline tariff that the US has imposed on Indian goods, apart from sectoral tariffs on automobiles, on steel and aluminium. It remains to be seen whether the US will impose a 26% reciprocal tariff on India come the 1st of August if a trade deal before that is not agreed upon.
Well, thanks so much for that, Parikshit. That is something that all of the market participants will be watching out for. But let's also listen in to what the US Secretary Scott Bessent had to say on the pending trade deals.
Talks are moving along, but the important thing here is the quality of the deal, not the timing of the deals. And President Trump has created maximum leverage, as only he can do. And what we are seeing is like these imbalances built up over 20, 30, 40 years, and we are more concerned with high-quality deals than getting these deals done by August 1st. Our trading partners were told that the rates could boomerang back toward the April 2nd levels. We can continue talking then, but again, we're proceeding at pace with the negotiations, but we're not going to rush for the sake of doing deals.
Scott Bessent on the India-US trade deal. But the big domestic development from last evening was that Jagdeep Dhankar has resigned from the Vice President's post, citing health concerns. CNN News 18's Aman Sharma is joining in with more details on this. Aman.
So Vice President Jagdeep Dhankar has resigned. His resignation has also been accepted by the government. The Prime Minister has put out a statement commending the contributions of Jagdeep Dhankar in various positions. But what is the inside story? Is it that the government was upset with him yesterday after he accepted the impeachment motion moved by 65-odd opposition MPs? And did Mr. Dhankar not keep the government in loop about this particular impeachment motion? Remember, senior ministers like JP Nadda and Kiran Rijiju subsequently did not attend the BAC meeting called by Mr. Dhankar at 4:30 p.m. Though now Mr. Nadda and Mr. Rijiju both have said that a message was sent to Mr. Dhankar that they were busy. But this is a surprise series of events. Mr. Dhankar had just spent about 3 years in this post, and his resignation with immediate effect, which he has written to the president and which has now been accepted, throws open a host of speculations. Was he getting too friendly with the Congress leaders? Was he giving them the extra, benefit? Sometimes, it is a complete change of the situation, because just a few months back, the Congress had moved an impeachment motion against Mr. Jagdeep Dhankar in December 2024. What changed completely in the next 6 months, where now there is hushed talk in the parliament corridors that he was being soft, maybe on being too friendly with the Congress leaders. He had met Mr. Mallikarjun Kharge at the VP estate some days ago. Arvind Kejriwal he had met at his residence on Sunday. What has really happened remains under wraps, but it is one thing is very, very clear, that Mr. Jagdeep Dhankar's resignation has come as a surprise and a shock to many, and he is hung his boots just 3 years into his tenure.
Well, meanwhile, protests marked day 2 of the monsoon session of the parliament. Opposition MPs, including Rahul Gandhi and Akhilesh Yadav, protested against the Election Commission's voter roll revision in Bihar. The opposition MPs gathered on the steps of Makar Dwar of Parliament and raised slogans against the electoral roll revision, alleging that it amounts to stealing elections. In a parallel development, the resignation of Vice President of India, Jagdeep Dhankar, under Article 67A of the Constitution, was conveyed in the Parliament. While opposition leaders expressed some concerns about the Vice President's sudden resignation, listen in to some of them.
There was a health scare with regards to his heart and he had undergone a surgery. At that time too, he was back in the chair and he was conducting the proceedings of the House. So this doesn't somehow ring true simply because he was very actively conducting the parliamentary proceedings yesterday. What was the sudden reason for his decision to cite health and step down?
उपराष्ट्रपति का इस्तीफा अचानक है और दुर्भाग्यपूर्ण है.
Well, on to a CNBC-TV18 exclusive then. Axis Bank wants to acquire an additional stake in Axis Max Life. Yash, who's broken the story, is joining in with more details on this. Yash, tell us more.
Well, let's just start with where Axis Bank stands as far as Axis Max Life Insurance is concerned. Axis Bank owns about 19.02% stake in Axis Max Life Insurance. They already have an approval to acquire another nearly 1% stake. This will take their holdings to about 19.99%, approximately 20%. What we've been given to understand is that Axis Bank wants to acquire an additional 10% stake beyond this 20% stake, which they already have the permission to acquire, and out of which 19% is what they already own. What we've been given to understand is that the thinking originally was also to acquire about 30% stake and be a promoter entity to Axis Max Life Insurance. Back then, RBI gave them the approval to acquire only about 20% stake. And now, very soon is what we've been given to understand from our sources, Axis Bank could reach out to the Reserve Bank of India seeking an approval to acquire an additional 10% stake when it comes to the life insurance subsidiary, that is Axis Max Life Insurance. As I said, what this will do is make Axis Bank the promoter entity for Axis Max Life Insurance. And if you see the large life insurance companies, all of them, the top 5, they have banks as their parent entities or the promoter entities. You speak about ICICI Prudential Life with ICICI Bank, SBI Life with State Bank of India, HDFC Standard Life with of course, HDFC Bank as the promoter entity, and now Axis Bank also, likely to walk on the same road. As far as the timeline is concerned, sources tell us that Axis Bank currently is in the process of settling one of the cases with respect to acquisition of the first 20% stake in Axis Max Life Insurance with SEBI. As soon as that particular case ends, it would look to reach out to the Reserve Bank of India for that acquisition of 10% stake. This is likely to be done through a preferential issue and may get as much as 5,000 crore as far as Axis Max Life Insurance is concerned.
Yes. Absolutely, Yash. A very important, sort of news break out there. We'll have to watch for that counter. The stock is up almost 1.4% in today's trading session. But let's take a very short break for now. More news and updates on the other side, so don't go anywhere. Welcome back. You're watching Business Lunch on CNBC TV18. Well, some news from the IMF. Noted economist and IMF's first deputy managing director, Geeta Gopinath, will be leaving the organization at the end of August. She will be returning to academia at Harvard University. The Indian origin economist had joined the IMF in January 2019 as chief economist and was then promoted to first deputy managing director in January 2022.
Now, a day after the Bombay High Court acquitted 12 convicts in the 7/11 Mumbai blast case, the government is set to challenge the court's verdict. The Supreme Court is set to hear the matter on Wednesday after the government sought an urgent hearing. Earlier, the Bombay High Court had slammed the prosecution for not proving involvement of the accused beyond doubt.
As we end today's edition of Business Lunch, we leave you with the visuals of the British F-35 fighter jet finally leaving India 5 weeks after its emergency landing at Trivandrum Airport.
Good afternoon. Welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, is Vivek Iyer. Good afternoon, Vivek. Some recovery from the low, so it's been a little volatile in the last couple of hours. Midcaps continue to be under pressure, and we do have a lot of earnings. We'll discuss that through the course of the day.
That's right. Good afternoon, Sonal. Like you mentioned, very volatile trading session, very stock-specific trading session, and like you mentioned, a lot lined up on the show. So let's start off with the top headlines. Mixed signals on the India-US trade deal, cloud sentiment as the cues from corporate earnings, keeping stocks in check. Realty and healthcare are the big drags, while metal, financials, and IT eke out some gains.
Tilaknagar Industries, the stock gains for the second day. Sources tell CNBC-TV18 that the company is the leading contender to buy Pernod Ricard brand Imperial Blue for a deal worth nearly 4,000 crore rupees.
AGI Greenpack shares surge over 11% in trade following its Q1 earnings. Top line grows 21% on a year-on-year basis, while profit surges 40% during the quarter.
Vardhman Textiles Q1 net profit declines 13% on a YY basis. Margins also contract to 13.7% versus 15% a year ago. The stock falls nearly 3% intraday post results.
Blue Jet Healthcare tanks 10% in trade, reacting to its Q1 results as margin narrows by over 7% sequentially, even as on a year-on-year basis, numbers appear higher.
Those are the top headlines for the markets. The headline index absolutely flat with some negative bias right now. Do remember we were down around 40 points at a point in time. We did see recovery from there, but then again, the Nifty slipped into the red. Mid-caps, though, that index is the one which is underperforming today. We have a 240-point cut thereby. There's been no recovery in the mid-cap index. It's not in line with the benchmarks right now. The Bank Nifty too down in trade. We did see that major move yesterday coming in from the private banking names, be it ICICI Bank or HDFC Bank. But today, the PSU banks, those are putting some pressure in the banking space currently. But overall, it remains a very stock-specific market. Too many earnings, too many conversations happening today.
Too many conversations, a lot of managements saying very important things. A lot of stocks, despite weak earnings, have actually recovered. Names like Havells, that particular stock has recovered. Colgate too, numbers were a miss, but again, the management commentary for H2 is something that seems quite positive. That stock too recovered after the brief dip it witnessed post the results. But this is our special segment, Mid-Cap Movers. Hormaz is standing by the wall to take us to the mid-caps that are moving around in this session.
Choppy benchmarks, but you can't say the same for the broader markets because they continue to remain at the lows of the day. We'll start off with the losers then from the broader markets. In 361 WAM, of course, the block deal that it saw in the morning is still 6% lower. At the lowest point of the day are Aarti Industries and Dreamfolks. And look at the fall you've seen in CMS Infosystems. At the second half of the session has just been a one-way vertical fall for the stock, 4% lower there as well. The earnings reactions, a lot of them have come up just in a few minutes. And look at Blue Jet Healthcare, as you just mentioned, 10% lower, and take a look at the slides in Kirloskar Pneumatic. Numbers were here just a few minutes earlier. Vardhman Textiles too at the lows of the day, and Parag Milk, of course, is a result reaction, 4% lower on that stock as well. Another segment that's sulking today is Pharma. Most of the stocks on the Nifty Pharma Index are trading lower and near the lows of the day. Granules, Aurobindo, Gland, all trading with losses of between 2 to 3%. Among stocks that are bucking the trend today and on good volumes at that, you take a look at RHI Magnesita, 7% higher. India Cements down yesterday, but now up 6% in today's session. And of course, in response to Eternal's moves, Swiggy at one point was up 8%, is off those highs, but still trading 4% higher. And NLC India now has moved to the highs of the day, 5% higher on very strong volumes. And lastly, a pocket that is doing well, though, after Ultratech's results. Although Ultratech is down, most of the other cement names are doing well. Take a look at Dalmia Bharat, Shree Cement, Ramco Cements, all of them at the highs of the day, gains of anywhere between 2.5% to 3.5%. Back to you guys.
Okay, all right. Those are some pockets and individual names which are doing really well. Thank you so much, Hormuz, for joining us in as always. Let's welcome Shrikant Chauhan from Kotak Securities for a technical check on the markets. Shrikant, good afternoon. Thank you so much for joining in. What's the next important trade on the Nifty? Will it continue to be volatile like this? Or what are the charts suggesting now?
Yeah. Good afternoon, Sonal. Good afternoon, Vivek and everyone. Well, for Nifty, it is finding difficulties to sustain at higher levels. But at the same time, we cannot forget that the markets have fallen to their extreme levels, close to 24,900, 850. So I'm of the view that it is going to consolidate for at least next 1 or 2 days more. and later on we may see upward side activity in the market. But broadly, I'm of the view that the market has completed its correction at 24,900, 850. Maybe the market retest these levels again, but overall, I'm of the view that the market has completed its downward activity and is ready to pull back towards 25,300 or 350 sort of levels in the near term. And overall, the trend of the market is in the range of 24,500 and 25,500. So it's a range bound sort of market. But ideal strategy should be to buy on dips. Today, Bank Nifty is not participating, and maybe because of that, the market is not moving upward.
Srikanth, what are your individual trades for the day?
Yeah, Vivek. See, today all these commodities, they are doing really well, and most of these commodities are from the mid-size basket companies. There we are seeing good amount of buying interest. Especially we like GMDC, which is around 457, 460 sort of level. It has crossed its resistance level at 440 with huge volumes. And today we are seeing follow-up activity. So while looking at its overall entire technical pattern, I'm of the view that the stock is heading for at least 500, 530 sort of levels, which will take some time, but it's a positional buy at current levels. The other stock which we like, on which you also discuss, is Ramco Cement. There also we are bullish, and on long-term charts, I mean to say on monthly and weekly charts, if we go through with its technical pattern, then it is forming some very large triangle sort of formation, and it is already above the upper trading range of it. So based on its technical formation, the next level to watch out for would be maybe 1400, 1450, which will take, like I'm going to say, it will take some time, but eventually the stock is heading for those levels. So there also we are bullish, and in last 5 days, if we see the overall setup of the market, then we are seeing good amount of buying interest in cement companies. So broadly, we are bullish on Ramco Cement also.
Okay, all right. So the cement space actually is doing really well today. Thank you so much, Srikanth, for joining in with those picks and individual names. Time for a break now. When we come back, we'll talk about some stock-specific action and the market moves as well. Stay tuned. Welcome back. You're still tuned into Mid-Cap Radar. Let's talk about some mid-caps which are moving around. India Cements, for instance, is up 5.5% right now. The entire cement pack is actually buzzing. The mid-caps do under a lot of pressure. We do have Info Edge as well. We've been talking about that stock through the course of the day. Eternal's results, Info Edge holding that stake in Eternal. Paytm is the one which is up 3%, reports numbers soon. So we will watch out for the profit and profitability commentary that will come by from the management as well. But, you know, Tilak Nagar is one stock which continues to be in focus. There is a story brewing there. Sources tell CNBC-TV18 it's in a leading race to buy an interesting brand. Nigel is joining us now with all those details.
Well, that's right, Sonal. You know, it appears that Tilak Nagar Industries is setting themselves up for a stiff whiskey peg. I say that because they could probably be in the forefront to acquire Imperial Blue from Pernod Ricard. Let's explain to you a few details. What we pick up is that the deal size could be roughly around 4,000 crores approximately, and you'll be wondering how will they fund it. I understand that it could be a mix of debt as well as equity, and they've already disclosed on the exchanges that tomorrow they'll be meeting to raise some money. So in all probability, the money that they're raising is to fund this particular acquisition. But the breakup of this 4,000 crores is something that will be eyed between debt as well as equity. They're net cash company. They have more than 100 crores of cash. So, you know, they're not too leveraged as of now, but we'll have to see how the leverage moves up. The street could view this positively because of a few factors. Currently, Tilak Nagar Industries is only into brandy. Now, if they acquire Imperial Blue, they'll get some whiskey. Currently, they're only into South India. If they acquire this asset, they go pan-India as well. And the scale will be tremendous because as of the last year, they sold only 12 million cases, little less than that. Imperial Blue does roughly around 22 million cases or thereabouts. So put it together, they'll go to nearly around 34 million cases or so. Scale will come about, pan-India presence and diversification. We'll wait by to hear with regard to the contours of the deal as well as the funding plan out there. But for the time being, the stock is quite excited. Though if you look at it from year to date, actually, the stock is more or less flattish. Last 1 month, it's seen a big run. Back to you.
Well, all eyes on Tilak Nagar Industries, you know, post-fundraising and whether this particular news break does fructify. Well, moving on, Ria joins in. AGI Greenpack has delivered its numbers. That particular stock is doing very well. Ria joins in with all the fine print.
That's right, Vivek. AGI Greenpack has reported its Q1 FY26 numbers yesterday. Now, in terms of the revenue, that has seen an increase of over 21% compared to the previous year. Even the EBITDA and the net profit have jumped up by approximately 20% and 40% respectively compared on a year-on-year basis, although the margins have fallen by around 37 basis points. But the company has also diversified into the manufacturing of aluminum beverage cans, and the company is going to build a new facility in Uttar Pradesh for this. They are expecting to produce 1.6 billion cans per year once the entire facility is completed. In phase 1, they are going to add around 950 million cans, which is planned to start by Q3 of FY28. And in phase 2, that will be implemented by March of 2030. Now, the total capex for this project is rupees 1,000 crores, 850 crores to be done in the first phase and the balance to be done in the second phase. And this will be funded by a mix of debt and internal accruals by the company. The management has also commented on this, saying that they have entered the segment with a very clear target of becoming the top player in this segment within the next 1 decade. At the end of Q4 of FY25, the management had also said that they are targeting a revenue growth of around 8 to 10% for FY26, and EBITDA margins will remain in the range of 22 to 25%. But on the back of this positive development and good numbers in this quarter, the stock was up over 15% at one point in the session and still holding on to very strong gains.
Oh yes, 14% higher on AGI Greenpack. Thank you, Ria, for joining in. By the way, Mahanagar Gas's number are there at the bottom of your screen, and it looks like a complete beat, especially on the margin front. The stock has spiked to the day's high. Net profit is higher. On a quarter-on-quarter basis, of course, it's higher by 29%, but it has come in at 324 crore rupees, which compares with the 268 crore rupee poll that we were working with. It is actually a beat which is led by pricing hikes and the spot LNG prices that saw a cut this time around, because volumes, they are absolutely in line with estimates. So volumes have come in at 4.22 MMSCMD, which was the poll as well at 4.2 MMSCMD. That's an increase of 9% on a YY basis. It is flattish on a sequential basis. If we see the CNG volumes, those are up to 8% on a YY basis. The PNG domestic volumes are up 4% on a YY basis and 4% on a sequential basis as well. So it is in line when it comes to volumes. But if we look at the revenues, it's higher higher than the poll, the EBITDA higher than the poll, margins 300 basis points higher than the poll as well, and that is why the stock has spiked. It's a good set that has come by. If we look at the internals as well, even though other expenses have come off, that is one of the reasons for the margin improvement that has come by. Profits are higher, of course. The other expenses have seen a sharper fall, and that's the reason why we are seeing that cost reduction has led to an EBITDA improvement. And if we talk about cost of material consumed as well, we were talking about APM gas allocation coming down, which would have increased their cost of materials, but it is flat on a quarter-on-quarter basis. That means the imported LNG prices that had come down, that helped Mahanagar Gas this time around. Very interesting to watch out the impact on other companies as well, be it the likes of IGL, be it the likes of Gujarat Gas as well, because if it has helped Mahanagar Gas, it would have helped IGL and Gujarat Gas as well. If we can show the stock price of IGL right now, yes,
IGL too near the day's highest.
So it should, because if it is helping something like a Mahanagar Gas, it should help something like an IGL as well, because IGL and MGL mostly have the same sourcing mix, more towards CNG, while Gujarat Gas has more sourcing of spot LNG. And since spot LNG prices had come off, it would help Gujarat Gas as well. So good set of numbers coming in from Mahanagar Gas. It's a top-down beat. Major beat has come in, of course, on the margins. It is led by the price hike that the company took in the month of April, and also because of spot LNG prices coming off. So clearly the concerns around APM gas allocation coming off did not deter the company. Cost controls and also price hikes, something helped the margins for the company, because it's not a volume-led growth again. It is a margin-led growth for the company this time.
Thank you so much, Sonal, for detailing those numbers so quickly for us. All three of the city gas distribution companies near the day's highest point. But with that, we'll slip into a short break. We'll be joined by the management of Bansal Wire Industries to discuss their Q1 results on the other side. Welcome back to Mid Cap Radar. Well, as Sonal just highlighted, the results of CGDs, MGL, IGL, those are the stocks in focus, continue to remain in focus. But we have a very important management. Bansal Wire Industries is in focus. This on the back of its strong Q1 earnings. The company saw revenue surge almost 15%, while EBITDA grew 17%. To discuss the quarter gone by and the way forward for the company, we are joined by Pranav Bansal, MD and CEO, Bansal Wire Industries. Thank you so much, Pranav, for joining us. We'll keep this particular interaction slightly shorter than the last time around, with the midst of a heavy earning season. Number one, last time you spoke to us around a fortnight ago, you had mentioned that a 25 to 30% volume growth is what you're targeting for FY26. Do you continue to stick to that particular target? Any tweaks to your FY26 guidance?
Sure. So our target still remains the same. 30% is the volume growth that we are expecting this whole year. And the first quarter has also gone as per expectation. So I see no reason why we would not be able to do 30%.
Okay, so 25 to 30% growth is something that you will be maintaining. What was the EBITDA per ton in quarter one of FY26 and what was value-added products as a percentage of sales this time around?
So EBITDA per ton was about 7,200 rupees. As per our guidance of 6.5 rupees, we were better off at 7,200. Value-added products still accounted for about 30% of our products.
Okay, so when you are saying that quarter one saw EBITDA per ton of 7,200 rupees versus a guidance of 6,500, do you think you will scale up your guidance in that case?
We still have 3 quarters to go, and our target for this year and next year is again to grab market share. Therefore, it is better if we remain with the 6.5 kind of a rupee margin, because it is a very dynamic world that we are living in, and that's the focus.
So 6,500 rupees per ton is the EBITDA per ton guidance that you have given for FY26. So that is something that you're maintaining. Is that right?
Yes.
Okay, FY26, what is the capex that you have lined up and what is the typical asset turnover? So end of FY26, end of FY27, what is the kind of revenue run rate we can see?
So 26-27, we have taken 600 crores of capex that we will be doing. Majority of this will be backward integration in the Gujarat facility for a 1.8 lakh ton steel plant. And along with that, we are also putting a 60,000 ton wire facility. So this is where majority of the capex will go. This will start coming on stream by the end of 27.
Okay, Pranav, end of FY24, market share was close to 6 to 7%. FY25 end to, I believe you were along a similar run rate. Q1, where do you stand in terms of market share? And with the capex planned, what is the kind of market share that you expect to garner at the end of FY26?
So I think looking at our Q1 numbers, we are already at about 7.2 kind of a market. Okay. And our expectation is, of course, to scale further.
Okay, could you quantify what is it that you expect to scale to?
We want to grow at, as a company, we've grown at 20-25%. So this is the target for the coming years also. This year, we've taken a target of 30%. Next year should also be in a similar kind of a range. So once we are able to reach these kind of numbers, we are looking at a 10% kind of a market share in a very short while.
Okay. What about the capex which is lined up? When do you reach that 100% capacity utilization level? What kind of asset turnover are you looking at from the new capex that would come by?
So, for example, the current facility that we've just put in, the Dagri facility, we are looking at majority ramp-up happening within this year. Some crossing over to maybe next year, first quarter or something like that. And then we are also adding capacities as and when required. Apart from that, the Sanand facility will start operation within FY27, and majority of capacity utilization will also happen within FY28.
Understood that. So capacity utilization at the end of Q1 was at close to 74%. In your industry, does that give you enough headroom for growth? And with the kind of on-stream that you will have at the end of the capex plan, what is the kind of capacity utilization trend that you envisage?
Sure. So in the industry, this is the kind of capacity utilization trend that is being maintained. But for Bansal Wire Industries, we generally have been maintaining about 85 to 90% kind of a capacity utilization historically, which is what we would want to target even today. So we have enough headroom for us to grow within this year, but we will also keep on adding capacities and utilizing them as and when required.
Understood. Pranav, most of the capacity that you've planned, you have pretty significant plans. How are you proposing to fund this? What is the current debt level? What is the current debt to EBITDA? And are you comfortable with these debt levels? And what will be the plan going forward, especially on the balance sheet?
Sure. So debt to equity has remained at about 1.71 historically. Now we are already down to 0.5. So we are at a very comfortable position when we talk about leveraging our balance sheet. Apart from that, what is also important here to understand is in this year and next year, our target has been to generate a lot of free cash. Even the first quarter itself, we've generated 100 crores of operating cash flow, and which should only increase each and every quarter. Therefore, we are trying to fund most of our capacity expansion through internal accruals.
So most of the capacity expansion will be done via internal accruals. 25 to 30% volume growth is what you've targeted for FY26. Thank you so much, Pranav, for joining us, and wish you all the best for the remainder of FY26. Well, a quick market check. A lot of the stocks have actually recovered quite sharply from the day's lowest point. HDFC Life is one particular stock. That stock is near the day's highest point. And Havells, that stock has seen a significant surge, up almost 3% now. But with that, it's all the time we have on this edition of Midcap Radar. Mutual Fund Corner when we return.
Hello and welcome to MF Corner. I'm Sonal Bhutra and with me is Vinny Motiwala, and we are going to talk about multi-factor funds today. A lot is happening in that space and we do have an NFO as well.
Absolutely. So that's clearly what we're going to be putting the spotlight on, and that's going to be the Bandhan EMC's multi-factor fund. The NFO, which opened up on July 10th, will be closing on July 14th as well. But before we jump into, what are the main functions or what is the main aim of this multi-factor fund that Bandhan has launched, we'll talk about what is multi-factor fund and how one should be actually going around operating in this space. What is the diversification you get here as well? And today we're joined by Rishi Sharma, who's the Vice President at Equity at Bandhan AMC, to talk to us about just that. Rishi, good afternoon and thank you so much for joining in with us on the show. Let's just start with the basics, right? What are multi-factor funds and how do they differ from traditional single factor funds or, equity funds that one would look at? What is the difference?
Sure. So factors, as we are aware, are time-tested characteristics like quality, value, low volatility, momentum that try to explain the long-term returns of the equities. When the single factor, in a simple term, you can call them as styles of investment. When the style is working, it's always good to stay with that. But when they stop performing, we don't know what to do. What multi-factor do is they identify or complement factors. They use a rule-based model or approach to mix these factors so that you can get an exposure to different styles at all the time. What will this lead to? This will lead to a better risk-adjusted return for you. Your journey will be much smoother in the market.
Okay, take that point. So it helps in diversification, helps better returns that would come by. But when we talk about these funds selecting stocks, what are the factors like value, quality, momentum, low volatility? What is it a combination of? And how do you use these factors to select stocks in a fund like this?
Sure. So the approach is very simple. You start with your investable universe. It could be any of the indexes or your criteria of having exposure to certain kind of stocks. Let's start with you want to have an exposure to 4 factors of momentum. Momentum could be anything. It could be a price performance based, or it could be earnings acceleration, or it could be value based. Now, value can have different definitions in terms of intrinsic value, where you look at the book value of the company with its market value. You can also look at the relative valuations of stock within the sector, at regional level, within the country, or also at global level. Thirdly, you want to have an exposure to quality. Quality could be defined as the strength of the balance sheet, the strong cash flows that companies is having. And similarly, you want to have exposure to low volatility. Low volatility is simple, but looking at the standard deviation or probably beta of the stocks. That is how you will create factors out here. As I said, you will be having an investable universe. What you need to do is score each of the stocks across these definitions of factors that you have identified. Once you have the scores, now this was all about alpha signals or probably the scoring of the stocks. The next step, how do I mix the stocks on the basis of the scores that I have for all the investable stocks in my universe across the factors? There are a couple of approaches towards that. One is you give a composite score. I know what is the score for a particular stock across the factors. Take an average. In this way, you get an equal exposure to all the factors. At times, what happens is this is one approach where you get factor exposure, but it is not the purest of factor exposure. Many people want a pure factor exposure. What they will be doing is they will be identifying the top performing or top scored stocks across 4 or 5 factors and pick the top n number of stocks, say top 10 stocks across these 4 factors, and build a portfolio for you of 40 stocks. So identifying or signal generation, scoring the stock is the first step. Second step is to build up the portfolio, either taking a composite score or probably picking the best stock across each of the factors to give you a factor-specific exposures.
Okay, that's interesting. Rishi, how do these funds help also with diversification? Because then you will be investing on the basis of these factors, right? So if I have to compare diversification of multi-factor funds versus something like a multi-asset, multi-cap fund, what would the difference in terms of diversification be?
So a multi-cap fund will give you exposure across the market capitalization towards large cap, mid cap, and small cap. Multi-asset will give you exposures across different asset classes. When you invest in multi-factor, you have to think you are investing across the drivers of return. You're getting exposure to equity, but that return of the equity is coming because you are exposed to different styles. What happens? You get exposure to different styles. You're not you're not tied up to only one size or one particular sector when you do a multi-factor allocation of your allocation to the funds.
Okay, all right. So this is what the benefit is when it comes to multi-factor funds. So ultimately, you know, Rishi, the question would be, why would someone own a multi-factor fund? And if we can talk about it from a pro perspective as well, from cons perspective as well, why should one not own a multi-factor fund? If you can throw light on both the aspects of this investment.
As I said, working with single factor fund is always a challenge because factors, when they work beautifully. You enjoy the return that they give you, but when they stop working, you don't know what to do. Now, these factors are very cycle dependent in the market. In a bear market, you will see you want to have exposures to a factor which is like low volatility. You want to have a less fall in your portfolio. Probably when you are in a bull market, you want exposures to a momentum kind of stocks because you want to outperform the market. But when the single factor stop working, you don't know what to do. If you want that, you don't want to take a call on a particular style of investment, and you want to make sure that you participate on the upside, and also you have a lesser drawdown when the styles are not working, then multi-factor is the place to be in. The advantage is when you are exposed to different factors, probably if many of the factors are working, you get a better return. But when factors are not working, your drawdowns will be lower. This will lead to a better risk-adjusted return. When you see a consistency in your return, what happens? Your investor is able to stick with the product for a longer period of time. And we all know the longer we stay in the market, half of the battle is won there itself. You also asked me what are the cons of it. Factors, as I said, generally give you a better risk-adjusted return than the market over the long period of time. So staying with the product is very important. Backtest will show you has been the outperformance over your index or your benchmark, but those are guidance. That is not the guarantee you will be getting those kind of returns. Key is again to make sure that you follow the rules of rebalancing, identifying the factors timely, and follow the process diligently. If you are able to do that, I think the con is no more a con for us.
Absolutely, surely important points taken over there in terms of the pros and cons. And if you stay in the market, you will see good returns. But I want to talk about that return, the part coming in there. Historical performance or any indication that comes in from multi-factor funds, have we normally seen them see an outperformance versus maybe the broader market indices on those sorts as well? And what is the return normally that one could expect here if you're holding it for a decent amount of time?
So our research says that factors do give you a higher premium than the markets and also over the single factors. So multi-factor approach should be able to generate a better risk-adjusted return than the broader market capitalization-based index as well as for the factors. That is for sure. That's what the data tell us. And that data is consistent across the rolling periods also. That's what our experience has been with researching with the multi-factor approach. When we have identified that factors do perform, but there will be cycles when they will be underperforming, but that underperformance generally is not very long compared to single factors.
Okay, all right. So, the ultimate question after pros and cons performance is, who is the ideal investor? Should this be in the core portfolio? Should everyone have some portion allocated to this kind of a scheme?
Hello? If you have an exposure,
Rishi, can you hear me?
Yeah, I can hear you.
Yes, please go ahead.
So if you already have exposure to, say, broader markets, right? What you need to do is, and you're looking for a data-driven, say, satellite alpha. If your core is obviously you have exposure across the 4 or 5 factors, or 4 or 5 market capitalization-based kind of stocks, portfolios of large, mid, and small. You want to generate some different kind of return. What you need to do is allocate a certain percentage of that money to a multi-factor approach. If you're invested 100 rupees, give a 10 to 15% exposure to a multi-factor approach. What it will lead to? It will lead to a differentiated return for you in the 2 ways. Firstly, you will know what is driving the return of that portfolio for you because it's a factor approach. When you are using a factor approach, it tells you what is driving the returns of your portfolio. So it brings more clarity when your portfolio is working and why they are working. Secondly, if you are a seasoned investor, then you can always invest a higher amount and make it as a core factor or a core portfolio of your strategy. The reason is simple, that when it's a core strategy, what it does is it gives you exposure to different styles at one go itself. But for that, you need to be a seasoned investor and you need to believe in that style of investment.
Okay, that's interesting there, Rishi. Thank you so much for giving us those details. But on that note, we're going to actually slip into a very short break. And on the other side of the break, now we'll talk about Bandhan's launch that is coming on the NFO front as well of the multi-factor fund. What are the points and details that we should be keeping an eye out on? We'll continue this conversation with Rishi on the other side. Welcome back. You're still tuned to MF Corner. We still have with us Rishi Sharma as the Vice President Equity at Bandhan AMC. As Vinny was pointing out earlier, Bandhan's multi-factor fund opened on 10th of July and closes on 24th of July. The investment objective is the scheme seeking to generate medium to long-term capital appreciation and looks to invest also in equity and equity-related instruments based on a qualitative model. So we do have the fund manager on the equity side with us. So let's talk about the basics first, Rishi. Can you walk us through how a fund like Bandhan Multi-Factor Fund is selecting stocks? What metrics are used? Say quality, low volatility, value. We did speak about briefly overall, but when it caters just to the Bandhan NFO, what are the things that an investor should watch out for?
Sure. So this particular product will be only investing in the large and mid-cap space. That's the idea. The reason is that the data quality that we have the data quality is not very good at when you look at the small cap. And being a data-driven approach, it's very important that your data is very good and clean. Now, as I said, factors are nothing but different styles of investment or attributes of the winning stock. They not necessarily be just the 4 or 5 factors that we have, that is value, quality, momentum and low vol, which we all are aware. But our research shows that at Bandhan that there are more other factors that can be identified to drive the returns or the factors that can explain the returns of the stock. So at Bandhan, we will be looking at almost 12 factors to start with. What we'll be doing is we'll be ranking all our stocks across these 12 factors at this first level. At the second level, we will be looking at the factor performances. As I said, we have 12 factors. We'll be looking at the performances, all these factors, and pick up the best 5 factors. Now, these best 5 factors are the one which has been performing or being rewarded by the markets over the past couple of period of 6 months or 12 months, as the case may be. Once we identify these top 5 factors, we will be building a portfolio of the stocks that have the highest exposure to these 5 factors. Now, what is the advantage of this? We will be getting exposed to the factors that are working in the market. Idea is just to make sure that you participate on the upside, and probably out of 5, many of the factors might not work for you all the time. But when they're not working, probably out of 5, 3 will not work, 2 will work. They'll lead to a lesser drawdown. Idea is again to make sure that your drawdowns are lesser and you are able to participate on the upside so that you can generate a better risk-adjusted return for your investor. That's how we'll be building our portfolio. This will give us a portfolio of around 50 to 65 stocks, subject to the risk limits in terms of stock-specific sizes and also sector balance. We'll be having a sector balance. Each sector will be having a certain percentage of maximum exposure and a certain percentage of minimum exposure also. That's our approach towards building up this portfolio.
Okay, that's interesting. So 50-60 stocks, sector balance is also what we'll be watching out for as well, maximum minimum stocks. So you're diversified on that front. But Rishi, just want to understand a bit more, because when I was reading about it as well, you all have mentioned it and described it as adaptive. So how does the fund adjust to market conditions, right? Because we've seen so much volatility in recent times. Then, how will this play out in terms with your factors? Because you all will be selecting on some 5-6 factors that you all said out of the 12, the top 5 factors which you all will be picking out on. So how is the changing market condition factored in all this?
As I said, working with factors, they are good on the paper when you backtest it out, but living with them is very difficult. Because when the factor works, it's good. When they don't work, we don't know what will happen. And in the hindsight, we can identify the market cycle. When we are going through a bear market, we don't know we are going through a bear market. It's only after the bear market is over, after a couple of months, we realize that we are going through a bear market and we should have had exposure to a low volatility kind of factors. Now, what we are trying to do is we are not saying that we can predict the cycles in the market and hence the factors. What we are saying is that we have a bouquet of 12 factors. We know which are the best 5 factors that are working right now, and we will be exposing you to that. I might not be right most of the time, but I am hoping that I am right many of the times, so that when I'm performing, my portfolio is performing, it performs the market better than the market on the upside. And when I'm not performing, I should have a lower drawdown. That is only possible when I have more number of factors with me. That is a one diversification level. Second is we will not be rebalancing. We'll be rebalancing this portfolio on a faster basis, probably on a monthly basis. That's what we are thinking to do. And that can give us a better exposures to the styles that are working, as we will be changing our portfolio very frequently, which will increase our exposure to things that are working and decrease to the styles that are not working in the market.
Okay, so when we talk about Bandhan's multi-factor fund itself, how does it differ, say, from other quantitative or factor-based funds already available in the market, both from a Bandhan and from other AMCs? Because at the end of the day, investment can get quite subjective, right? So why would one invest in an NFO like this when there are already products available in the market? So what would you say to that?
What we are trying to bring with this product is consistency in the return. We're not trying to hit the ball out of the park here. We just want to be sure that we are consistent in our performance. So that's what we'll be doing. You talked about a lot of other quant funds and probably the factor funds that are available. They expose you to single factors. So when they are working, they'll be performing well. And we don't know how long should be the underperformance for a particular factor. With multi-factor, what will be happening is that since we are rebalancing at a faster frequency, we will be able to drop a factor when it's not working, and you don't have to stay with that factor for a pretty long time. That's an advantage or difference between us and most of the...
Oh, okay. I think we've snapped the line with Rishi. We'll connect back with him. Okay, Rishi is back with us as well. Rishi, you were talking about it. You were making a point.
Yeah. So I was saying... what is the difference between us and a lot of the other single factor funds? Our factor fund is trying to give you exposure to different styles. The advantage that we bring is probably not all our styles are going to work, not all our factors are going to work, but hoping that majority of them will work. when majority of them are not working, probably 2 or 3 which are working, will make sure that your drawdowns are much lower. When you are working with single factors, the challenge is that you can have a sustained period of underperformance, which can lead to your drag in your returns. In our case, that will not be the case, since we'll be changing our factor exposures frequently on a faster monthly basis.
Right. Rishi, let's also understand, given that there is so much in terms of evolving investor preference that comes in, right? There's so much data, passive funds, smart beta strategies that are there. Where does this fund fit in terms of the product lineup, especially for Bandhan?
Yeah. So Bandhan has a couple of passive funds also. And we also have high conviction active strategies being run at our end. What Bandhan multi-factor fund will do for you is give you a middle path. It will bring a discipline of passive fund, trying to get you active kind of return.
Okay. So when we talk about it being a multi-factor fund, right, are there any sectors or themes within the large and mid-cap space that the fund is overweight on or underweight on? Because that also helps investors make a decision, right?
As I said, the purpose of a multi-factor fund is to keep a balance. The way a balanced diet leads to a good health, a balanced style or balanced factor approach in your portfolio will lead to a good return. So we are a sector agnostic, guys. As I said, we will be having a maximum and minimum exposure to each of the sectors. And we will be exposing you to the factors that are working in the market at any given point of time. That's our endeavor with this product.
Okay, and Rishi, just one word. If someone is looking to invest right now in the Bandhan multi-factor fund, what should the holding time period be? 3 year, 5 year? When do we expect the best returns coming out now?
At least for one business cycle, I always tell everyone, you should, if you're into equity markets, invest at least for one business cycle. That is at least 4 years. If you cannot hold it for 4 years, at least 3 years. Before that, whatever return you get is part of your luck, nothing more than that.
It has to align with your risk, with your goals as well. And of course, long-term investments, as always stated by any fund manager as well, is something that comes to rescue as well. Rishi, pleasure speaking with you. Thank you so much for joining in today and telling us all about this NFO that Bandhan AMC is introducing, and a lot more on the general category as well that would help the investors.
Absolutely. But with that, let's wind down this edition of Mutual Fund Corner on CNBC TV18. Thank you so much from Sonal, myself, as well as the team who put the show together. But don't go anywhere. You have Closing Bell up next to take you through the last hour of trade.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
As of now, Taiwan index, Hang Seng, managing to hold on to gains.
The important thing here is the quality of the deal, not the timing of the deals.
President of India, Jagdeep Dhankar, tendered his resignation to prioritize his healthcare and abide by medical advice.
Support for the Nifty comes in the near term, at least at 24,882, which is nothing but the recent low that the index has seen. 25,160, that's the opening bell. 25,150 actually. The Nifty Bank is up at about 57,120. That's about 1/3% higher.
Now, the earnings season has been, mixed at best.
Suddenly, Nifty has slipped into the red as well. Nifty is off 100 points of the day's high as well at the 25,087 mark.
It could be too early to assume that Anup Saha resigned from his position as the MD of Bajaj Finance to go and take over the top job at IndusInd Bank.
Ever since the company reported the numbers, the stock has rallied about 15% plus.
Some recovery from the low, so it's been a little volatile in the last couple of hours. Mid-caps continue to be under pressure, and we do have a lot of earnings. We'll discuss that through the course of the day.
Well, that is the day so far, and actually at an index level, it's quite a boring day. But there is enough and more single stocks which I think are moving. A bunch of them are CNBC-TV18 exclusives, which we will get to in just a bit. We are coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Surabhi, Rima, and Nigel is joining us from the newsroom floor. Guys, good afternoon.
Hi, afternoon, everyone. So I guess, Prashant, you said it. It's all about individual stocks. So you'd have to say that the market has a tinge of weakness to it. And mid-cap specifically, the mid-cap index has been underperforming through the day.
No, absolutely. Before we go any further, guys, as always, let's just, for our viewers, quickly put out the stocks which we are going to put out over the next 60 minutes or so. In short order, you'll hear the first cut analysis of MGL numbers which came through in the last 30 minutes or so. Colgate, of course, came in earlier. Stock's not moving very much, but we'll sort of revisit that one in terms of what's happening. By the way, mid-cap cement stocks are all buzzing. I mean, the Ramco, the Orient, and a bunch of others as well. The mid-cap back is up between 3 and 5%. What's happening? Ultratech, of course. I mean, there's some bullish commentary. Nigel will address that. Eternal remains the top gainer on the Nifty 50 for the second day running. Greater detail with Mangalam sort of coming through in a bit from now. As I said, you've got a bunch of exclusive coming up as well. So what's the story with regards to Bajaj Finance? Anup Saha has stepped down. And, what's the backstory? Ritu will get us that. We, of course, also will talk about insurance. Max Financial, that is Axis Max Life, that's the correct name. That's going to be in focus. But Tilak Nagar Industries, Nigel broke that story on Tilak Nagar with regards to perhaps them being the front runner to acquire Imperial Blue, the liquor brand from Pernod. And of course, then there is Max Financial Services, what I was saying. Yash will get us details on Axis wanting to pick up an additional 10% stake in Max Life. So lots of individual stocks coming up here over the next 60 minutes or so. Rima.
Right on top is Eternal, 11% up now on Eternal, while Swiggy is gaining close to about 4.5–5%. So big boom coming in these platform companies. ICICI Bank, HDFC Bank, the stars of yesterday extend the up move today. Both those large cap banks are up nearly 0.5%. But say something like an ICICI Bank has come off from the highs. Reliance Industries is struggling for the second day in a row. While the numbers were fine, it's just that the stock had run up too much in the last 3 months. So a bit of a give back. Stock is down nearly about 1%. Other losers include, say, Tata Power, that's down on the back of the Mundra shutdown, Adani Ports, Shriram Finance, Eicher Motors, a couple of stocks with cuts in excess of nearly about 2%. But Surabhi, as you said, right, the weakness is getting reflected more in the mid-cap index, which is down about 0.5%. And even the advanced decline ratio has turned in favor of the declining stocks.
That is right. So just some examples of these declines coming in. One is 361 Wealth Management, but that's also because of a couple of large block trades that happened. So 6% down on 361 Wealth. In general, again, tier 2 financial stocks are losing some ground today. case in point would be something like a PNB, Canara Bank. So that's on the PSU side. There's also, by the way, RBL Bank, which is down another 2% today. JNK Bank is losing about 2%. IDBI Bank is down. So PSU banks are lower. And in general, Tier 2 financials, a little out of favor all over again. But I'm just quickly checking the big boys. If you look at HDFC Bank and ICICI Bank, they're continuing to build on the good form. HDFC Bank still up about 7-8 rupees. ICICI Bank also up about 0.5%. So that split story between large banks, money moving to large banks, moving slightly away from Tier 2 banks, that continues today as well. Nigel.
Well, that's right. Let's go across to Mitesh Thakkar, who joins us to help us out with how is he seeing trade action set up. Hi, Mitesh. Good afternoon. Market's doing nothing. Absolutely nothing. What's the take on the Nifty bank? Because that's giving you a 200-point dip, and that's been the one that's leading the way. Would you buy this dip?
Yeah. So, Nigel, on the index, not breaking 24,900 is what, I've been highlighting that levels. Not breaking that is a positive sign, but we haven't got an upside signal or a strong buy signal on the upside. So I think my initial feeling is that we might do some base building around this 24,900 broadly and 25,250, 300 on the upside. And then, we might look at some kind of a break on the upside. So next 2 days could still be, spent into a contracting manner for the indices. And if it breaks 24,900, then I think another 300-400 points kind of decline could happen on the downside. Similarly, on the Bank Nifty, I think the corresponding levels are slightly lower. We got a low of 56,200, day before yesterday, which is Friday, and Monday also we got a low of 56,250. So that's the first pivot. But the key supports for Bank Nifty are around 55,750. So we might just, hammer around between 57,300 to about 55,750 for the Bank Nifty as well. And therefore, both the indices are not giving very strong directional bias. So trading has to be more of a stock-specific kind of, approach.
So what are those individual names, Mitesh?
Yeah. So Prashant, I have a buy on Havells with a stop at 1555. Would look at targets of around 1,600 to begin with, and then once we cross 1,600, then even eventually higher levels can be looked at. And the pharma as a pack has been looking weak, so I have a sell on Aurobindo Pharma, the stop just about levels of 1125 for targets of around 1,070.
Havells buy, Aurobindo sell. So those are specific names coming up. Mitesh, we'll come back to you in a bit, but let's talk about the first one, right? The first stock. MGL reported numbers just in the last hour or so. Sonal is here. Snapshot first for you. Sonal.
Thank you so much for that. Well, Mahanagar Gas, when the numbers were reported, the stock spiked because it was beat on all parameters. If you look at the numbers, revenues in 1976 crore rupees, EBITDA at 485, which compares with 401, margins 300 basis points higher than what the poll was suggesting, and profits higher as well at 324 crore rupees. On a quarter-on-quarter basis, it's a revenue growth of 6%, EBITDA growth of 28%, margin growth of 420 basis points, and profits up 29%. Now, what aided margins this time around, despite the APM gas allocation that came by in this quarter? First was lower spot LNG prices and also price hikes that the company took in the quarter gone by. The raw material costs were flat on a quarter-on-quarter basis despite the gas allocation cut that happened. The other expenses were down 8% as well. But the revenue growth, that was not driven by any volume growth, because volumes, they were flat on a quarter-on-quarter basis, absolutely in line with expectations. It was largely driven by the price hikes that the company took. So Mahanagar Gas continues to be a margin-based story rather than volume-based story, because this growth has come back on the back of price hikes that the company took. The EBITDA per unit also has come in at a multi-quarter high of 12.6 rupees per SCM. It does have valuation support, 12.6 times FY27 EPS, which is the cheapest in the city gas distribution space. So the stock cooled off from the highs, maybe for the reason that it was driven by price hikes, not really volume. So volume growth continues to be a concern for the stock. But overall, if we look from the operational front, yes, it was better than estimates. Yes, valuations are supportive. But volumes are something that management commentary will be required on.
Okay, all right, got it. Thanks for that, Sonal. So Mahanagar Gas in focus. By the way, M&M Finance numbers on the screen. So the profit is more or less in line. On the net interest income, we were expecting a figure of around 1,900 crores. Actually, okay, 2,200 crores. And what has come in is, again, more or less in line. So it doesn't look too bad from the NII and the profit perspective, at least. Disbursements for M&M Financial were a little lower this time around. We'll see. More details coming up in just a bit. The stock is absolutely flat as it digests those earnings. Well, let's go on now. We have Dharmesh Kant of Chola Securities joining in with some perspective on the market. Dharmesh, thanks very much for joining in. A lot of earnings have come in the last 24 hours, and market reaction is also quite interesting. If I look at, for instance, Havells, the quarter was quite bad because of their, electrical appliances business and Lloyd and the AC business being weak. But the market is choosing to move on and look at the prospects of a recovery in the second half. Your thoughts on this stock? Anything else? So many numbers, Mahanagar Gas, M&M Financial, all on screens. Anything else that really stood out for you in the last 24 hours?
Yeah, good afternoon, Survi. Thanks for having me on your show. Havells numbers were a dismal set of numbers, specifically on the electrical appliances side. And the wire and cable was the only silver lining to the space, and so has been the case with other wire and cable kind of companies, where the growth was good, and the market expectation is that going forward, since it constitutes almost 35% of the total revenue, it will pull it through, and going into the festive season, even the electrical division would start performing. The only dampener has been the AC segment of the Lloyd's business, which had a slowdown of 30-35%. But net, to my mind, for all the oil and cable, companies, the problem is the input prices will definitely go up in Q2 and Q3 because copper prices are up in the international market. Almost 35% kind of appreciation has been there. So anybody who is looking into this segment just at the 15-17% kind of a growth should be mindful of that fact. Other than that, the other numbers which have been through mostly has been disappointment. To my mind, it was a disappointing set of numbers. A slowdown has been there. And the guys who have performed well, for example, Reliance Industries came out with a very strong set of numbers. But traders chose to book profit out there. But I think it's a very good buy at current levels, given the SOTP-based kind of a valuation based on 2 years kind of a perspective. Ours is around 1650 to 1700 kind of a per share price target. It will get re-rated or revised as and when the clean energy visibility comes through in a type of profitability which is there. PSU banks, I would like to highlight here, if you compare them on like-to-like basis as compared to private sector banks, there has been an asset quality improvement in all the PSU banks numbers they have reported. And one significant factor which has been a diverging factor is that the retail business of all the PSU banks have shown a very good growth, be it Bank of Maharashtra, Union Bank, UCO Bank, or Indian Overseas Bank, as compared to your private sector peers who have shown a slowdown in the retail advances growth. Though the stock prices are correcting in today's market scenario, but I think this is a good time to do some cherry picking out there in the PSU basket space. And there, to our mind, I think Bank of Baroda and Bank of India looks pretty good to us.
Got that. Canara Bank, Bank of Baroda, Reliance Industries also perhaps headed higher, 1650, 1700. This time, the Jio performance was particularly strong, not just in line, but perhaps ahead of expectations on volumes and ARPUs. But let's get to the big CNBC TV18 exclusive, where sources tell CNBC TV18 Tilaknagar Industries is leading the race to buy Pernod Ricard brand Imperial Blue. Nigel had all these details. He broke the story. Nigel, fill us in.
Well, that's right. It appears, as per what sources tell us, is that Tilaknagar Industries could be looking at a larger peg, a stiff one, and that could be whiskey. Now, the brand that they're looking at is Imperial Blue, which comes in from Pernod Ricard itself. Now, why is this important? Because the deal size could potentially be close to around 4,000 crores approximately, which on a price to sales basis is not very, very large. It's actually quite a good number. If it's in excess of 6,000 crores, you'll get a little bit more worried. However, the point that we'll be noticing is, out of this 4,000 crores, how much is going to be debt and how much is going to be equity? To raise some money, they've already put it on the exchange over the weekend that they'll be meeting on Wednesday, and there'll be some money that will be raised. So the split of this debt and equity will be important, but around 4,000 crores odd, it looks like quite an accretive acquisition if it does come about. Remember, Tilaknagar Industries, from being a net debt company in the last few years, they become a net cash company. They're sitting on close to around 100 crores of cash. It's going to be important, to track, whether or not this comes through and what does it bring on the table for Tilaknagar Industries. To give you a few numbers, currently Tilaknagar Industries, well, their entire sales, 85% is in South India. They become a pan-India player. Currently, more than 85% of the sales is brandy. They get hold of a whiskey brand which has fairly decent volumes. And on volumes, Tilaknagar Industries sells close to 12 million cases of alcohol. if they get Imperial Blue, then that is nearly around 22 million cases. So scale is what they can get. And that's why, in fact, the street seems to be sniffing this. They've got that verdict in favor of them, versus Allied Blenders. And now this piece of news as well. So year to date, actually, the stock hasn't moved much. It's at the similar price that it was in January. But in the last 1 month or so, the street is sniffing that there could be some potential good news. Dharmesh, what's your view on, this? If it does take place, how do you view the stock? And I think this will be, if it does take place at around $500 million, it'll be the largest that we have seen in the last 10 years. When United Spirits deal happened at around more than $1.5 billion or thereabouts. Your take?
Yeah, Dr. Nigel. I mean, see, the deal looks very exciting. And the fact that it will give Tilak Nagar Industries a pan-India kind of an exposure and at the same time diversification to their portfolio from brandy to whiskey. So, and Pano is a quite renowned brand. Imperial Blue has a good, pan-India market share as well. But the only concern to my mind is the deal structure, how it is they are going to structure the deal, because the balance sheet size of Tilak Nagar Industries as of now is around 1,200 crores and equity is only 900 crores. So this 4,000 crores of deal which they are going to do at the valuation, what kind of a debt equity structure they are going to opt for, and how much of the incremental EBITDA which comes through the sale of Pano brands will get into servicing of the debt part of the Tilak Nagar Industries. So overall, from the long-term perspective, if you are looking at say 5-year, 7-year kind of a perspective, one should be a buyer in Tilak Nagar Industries. The reason being is one of the cheapest liquor stocks available, around 18-19 times kind of a PE multiple with 20 plus kind of an ROEs, whereas others are far more expensive. So, deal structure is the only caveat, how much debt and equity is going to play into it. But otherwise, my sense is one should be a buyer into Tilak Nagar Industries, given the fact that this deal goes on the table.
Okay, all right. It's a busy day for me, Dharmesh. By the end of this week, maybe I'll have to try out a couple of those brands. That said, let's get your view on some of these cement companies. The big boy, UltraTech Cement, they came out with a set of numbers. But for UltraTech Cement, post their numbers, you look at their con call to get a sense of how industry is facing. And we know that the first quarter, is always, it's been a bit of a soft one. And the hope is that things pick up from here on. And going by what they are guiding of a 10% growth on a year-on-year basis, the street is quite convinced that demand is going to pick up. Next up, they're saying on pricing, July prices are little or at par or a little bit higher than June, which is encouraging because it's a monsoon season, right? And in particular, they say that south part as well as the west, the south and east of India, out there pricing has been strong. So that's encouraging as well. Now, they're targeting 212 million tons by the end of this fiscal. But what's giving even more confidence is they're saying they're going to announce another capex, which is telling you they're gearing up for a longer runway. So the street likes all of this. Let's focus on a few stocks. Dalmia Bharat, going by the numbers that we have had, even with Sagar Cement and the others, Nuvoco as well, they have exposure to South as well as East India. And both those two, the pricing has been quite good and both those two numbers have been quite good. So the street is optimistic. Top line growth, not too much. EBITDA growth will be very, very good. What plays out for them is that they have exposure to these regions, which will help them in pricing. And they've been focusing on the cost parameters as well. So both those two will work in their favor on the EBITDA front. However, the problem is there won't be any operating leverage that will play out. So that'll be a bit of a dampener. So that's about Dalmia Bharat, why it's up and about in trade today. Now, UltraTech, they spoke about the South market. They said the South market is getting consolidated and it's in very good shape. And they go on to say that South could be the new North. Now, that's very, very encouraging because for the last few years, everyone's been optimistic on North India. And the read-through could be that Ramco Cement, well, it could be bracing itself for better times. They've been doing deleveraging on their balance sheet. And now the numbers could look up, which will help them in terms of cash flows as they scale up capacity. And finally, India Cements, the numbers look quite good. The street was a little bit disappointed, maybe on the volumes parameter. But UltraTech Cement has given a guidance on India Cement. And after many quarters, they turned profitable on the EBITDA front, which is good. They're also planning on scaling up the green power, which is renewable energy and WHRS, from 5% to 85%, which will bring down the cost of production and take the EBITDA per ton to around 1,000 rupees per ton. So put all this together, after seeing profit taking yesterday, India Cement has resumed its up move. Dharmesh, what do you like from the cement pack?
Yeah, Nigel, definitely UltraTech Cement. I was speaking to a few of the dealers in South as well as East India. And surprisingly, this time around, South has been very, aggressive and positive as far as the pricing is concerned, and they were able to take price hikes. And the theme which emerged from after the interaction with the dealers was that UltraTech has been able to manage the market well. They have been the market leaders in any geography you talk about pan-India presence. Either they are number one or number two players. Others, they keep on changing from number 2 to number 4, number 5. Like in Bihar itself, this Shree Cement has dropped quite down the ladder with the Damia Bharat as well. So Damia Bharat is supposed to be a East India kind of a cement company, but they are losing market share quite largely. Going by the sense which we got with our interactions is that 10 to 12% kind of a volume growth is very likely. The only thing, the price hikes have to be taken with a pinch of salt, because there's a term called price equalization where, kickback comes in. Almost the entire price hike which they take comes back to them after a month of a lapse through this a price equalization kind of a mechanism. Other than that, to our sense, 10-12% kind of a volume growth is gettable, and UltraTech is consolidating its position fast. Valuation has been a concern. It has always been a higher valuation multiple kind of a company, but going by the way the market leadership is getting, they are able to consolidate on it. So topic would be UltraTech, and Saga Cement. One can look at it with the kind of a turnaround numbers they have shown, and it's available at around $65 EV per ton. So quite cheap, 20-30% kind of a price appreciation can always be there. So these are the two companies which we are liking at the moment in the cement space.
Okay, that's a firm take on cement. But Dharmesh, before we let you go, we do have to talk to you about food and quick commerce. That is literally the theme of the last 24 hours, right? And I think the question before investors is Swiggy or Zomato or both or neither. But it's a long wait, and it's not been easy for investors to hang on, wait and see 300 back on the board on Eternal today. Do you like the stock? Again, Swiggy, Zomato, either or, none, what?
Sorry, my take is none. The reasons are very simple. You will see a tapering down in the growth run rate in next 2 years. There are a lot of competition happening, and a lot of talk was done about tier 3 and 4 kind of cities, but local vendors and local kirana shops, everybody is having their voice in place, and there you don't need even a Yulu bike. A bicycle can do the job for them. So, this is a business where the maximum operating margin you can get is 2 to 3% kind of 5% is the higher side of the margin level. And looking at, say, Eternal's valuation as of now, it's like 3 lakh crores of market cap. And if you discount it at, say, 25% kind of a CAGR going forward, so to attain a 25 kind of a PE multiple, they need to deliver 12,000 odd crores of profitability. That is the PAT numbers, which to my mind in next 5-6 years is very difficult. And most of the profit which is coming in on the PAT level is through the investment book. 13,000 odd crores of investments is doing the bulk of the lifting for the profitability. So, for the sake of it, to be in the space, you can still enjoy the ride. It can go up by 15-20%. But I think it will have the same fate as like Avenue Supermarts from 21 till now. The last high price has never returned. Though the company has been doing well, they have been delivering numbers, but the valuation will play a catch-up kind of a role. So same is the take on both Eternal and Swiggy. So from our side, it's a total avoid.
Well, lots of numbers and, very good to hear that perspective from you and that explanation as well. Dharmesh, thanks very much for joining us. This is the first of many conversations that we hope we'll have. Thank you very much for being here on the program. We'll take a quick commercial break here. We're going to come back in just a bit from now and, have Rupen Rajguru of Julius Baer talk to us about what he's making of things. But Hormuz is also with us with some unusual movers, the big movers, which we've not sort of touched upon so far. That's coming up.
Welcome back. It's time now for Hormus joining in with, he's at the big wall with all the buzzing stocks at this hour. Hormus.
Now, the good part about data is that it always gives you some new nuggets every single day. Start off with some of the earnings reactions. And first up on the negative side, though, Kirloskar Pneumatic is one of them. And that stock is down almost 9% after its results on very heavy volumes. This is turning out to be the first potential year of negative returns since 2019. It's turned negative on a year-to-date basis after today's fall. And between 2019 to 2024, the stock is up almost 4x during this period. So it's coming off from those levels. Margins took a bit of a hit this time around during the quarter, and the stock is falling on high volumes as well. It's 6 lakh shares traded, a 20-day average of 1 lakh shares. The other negative reaction in earnings today has been Blue Jet Healthcare. Numbers came out just a few minutes earlier. It's locked in a 10% lower circuit ever since. And since then, the stock, though, has 22 lakh shares been traded, a 20-day average of just 3 lakh. But despite this lower circuit, the stock remains comfortably above its IPO price. The IPO price was 346, so still 162%, a handsome return on those numbers. Now take a look at the positive side of the earnings reactions that have come out since then. Look at SML Isuzu. Now the stock, since Mahindra & Mahindra announced its results, the stock is the acquisition, it's up almost 108% from the 27th of April, and from the open offer price, which is 1554, the stock is up a cool 138% from those levels. So another 10% upper circuit today, and that too after some very strong results that the company reported. 163% higher in 2025. The next best year is 2014, which is 172, but at this rate it will be well on course to beat its best performance since 2003, when the stock was up almost 250%. The other mover in terms of earnings reactions today is AGI Greenpack, and take a look at the volumes here. 50 lakh shares traded already compared to a 20-day average of 84,000. The stock is up 15% after its results that were reported last evening, and this is the best month that the stock has already had in 2025 so far. And the last stock on the list today, and that too is a mover or volume-led mover, RHI Magnesita, is a best single-day gain since May of 2024. This 7.5% move has also ensured that the stock turns positive on a year-to-date basis and has also had 90 lakh shares traded compared to a 20-day average of 1.9 lakh. So earnings reactions are plenty, but then you have stocks like RHI Magnesita doing well on very, very strong volumes as well.
Wow, Hormuz, every time you come in and stand on that wall, you wake us up like that. We're saying Nifty is flat, nothing is happening in the market. Listen to Hormuz, there's so much going on. Fabulous, fabulous. Thank you so much. Yeah, plenty of action beneath the surface, right?
No, absolutely. And you know, it's a sampling of what's going on. And Hormuz, thanks very much for that. Rupen Rajguru is with us, Julius Baer. Rupen, good to have you here. Thanks for joining us. You know, I think top of the list for you is still financials, NBFCs and gold finance companies, etc., etc. And why not? As you know, we had this, we had a CNBC-TV18 Prime event a couple of days back, and with this gentleman who runs a large $40 billion entity out of the US venture fund, and he said, well, you know, don't fight regulators, don't fight the government. If the government wants something to happen, you know, go along. So in that, if I were to use that analogy here, in the case of financials, the RBI is certainly very focused on pushing growth through. There are naysayers who say that, well, and anyway, forget that. I know your view, which is that you like financials, and this kind of sort of ties in there. What within that space, Rupen, are you most bullish on now? Because things change, right? I mean, stocks have done well, especially even the larger private sector banks after earnings, etc.
Yeah, hi. Afternoon, Prashant. I think as you very rightly articulated, and from an India perspective, you know, and just to add to what you said, you know, while India is a structural story, so what are the 2-3 pockets wherein you can play India? And I think BFSI stands right at the top. And you're right, while last year, from a regulatory standpoint, when things were overheating in certain segments, the RBI, the regulator, came out with a set of regulations to tamper on the growth expectation, particularly on the unsecured loan side. And when probably things are turning, the other way around, the RBI has also rightly acted upon, and now the focus is clearly on the growth side. So having said that, in the current environment, while the large banks, both from the public sector bank and the largest private as well as on the public sector side, the stocks have done reasonably well. At the current juncture, since now the rate cut transmission is underway, while we are already seeing some NIM pressures which are there, but still the growth has been pretty good. We are positive stance while continues towards large private sector bank, but incrementally we also like NBFCs because purely the NIM compression there will be far lower than the banks. And if RBI wants growth, I think in an environment historically with an easy liquidity and lower rates, NBFCs tend to outperform. And also sub-segments like gold financing clearly is something which we are very positive on the secured lending side. And the other segment which we are positive are affordable housing. So while at the mortgages business, overall the competitive intensity is very high. But in the affordable housing segment, companies which have found its niche clearly are doing pretty well. Their asset quality is holding up, and the growth is pretty robust. So that's the other segment within the NBFC pack is what we like. So just to sum up, we like the segment and certain subsegments on the NBFC sides, gold financing, as well as on the affordable housing.
Rupen, hi, afternoon. The last time we spoke, you also were getting constructive on IT because you thought it would be a good defensive bet. But now Q1 earnings are not matching up, at least for large cap IT companies. All of them have reported negative growth. The outlook is still uncertain for the second half of the year. So what is the positioning now on tech?
Hi, afternoon, Rima. So tech as a pack, while we divide into both large caps and mid caps, so usually, the correlation of performance from a stock market perspective is, related to the Nasdaq movement. Usually, that's the trend we have seen, and particularly, you are right. This quarter, the commentary clearly, while the talk on deal wins have been there, the TCVs are pretty healthy. But the execution on the ground is not happening. The discretionary spending is not happening as much as what we would have liked it to happen. And probably, I think I would say I would not blame the US companies because while currently, the markets are back to all-time high, but still the uncertainty around the US macro remains. So companies out there are taking a pause and not going aggressive on the discretionary spending side. Having said that, purely from a stock market perspective, historically we have seen, particularly on large cap ITs, typically at say 22 times forward multiple is when, if the growth is not very high, that's the time one should take some money off the table. And when it gets into 18, 19 PE multiple, typically that's the time to add into it because of the quality of balance sheet they have, the payout ratio they have, the dividend deals becomes very attractive. So that's the typical range. So to answer your question, till such time we get a clear indication from the growth side, which right now is lacking, I think it will remain in the range. And as I said, between that PE price band, it will become a buy and sell. And that's where we are in. Today, as we speak, probably we are in the neutral zone because we are in that 20 odd multiple side. So it's neither a buy or a sell as we speak.
Hi, Rupen. Good to see you. And as always, the last few times you joined, you said cement is is making it to your list. And the numbers have been good. Do you think this is the start of further gains out here? Because the sector actually has been quite sleepy. And it's lucky to get away with not too much of cuts in FY25. Pricing was awful. Demand wasn't great. Couple of one-offs as well. How do you approach this theme? And what do you like?
So hi, Nigel. Afternoon. So yes, you are right that cement as a sector last year was probably, so to say, a disastrous year from an overall profitability perspective. And if you just take a step back and look through what was happening in last year, wherein the two large groups were on acquisition spree. So during the entire period last year, the pricing was pretty weak. And so despite no other negative event, the margins collapsed. So the only segments or the stocks which did well till last year was the companies which were either getting acquired or probably the possible candidates because of potential re-rating, and the large, particularly the one set of a large promoter group which has seen a significant re-rating. So the middle segment was getting ignored. So the other companies which are not aggressively acquiring and they were probably not a takeover target, those were struggling. So if you recollect in our last conversation, we said we like that segment and we continue to like those companies which are in that number 3 to number 5 bucket as far as the companies are concerned. And yes, I think you also rightly said that the pricing discipline is coming back. So this is one of the few industry in which consolidation has already taken place, but the pricing has not come back. In fact, if you look through the last 5 years, also the pricing has been pretty, hardly there has been any pricing growth in the cement segment. So that we believe now pricing discipline is back, and hopefully we will not get into the scenario of price cuts. And I think the region which was most affected, which was the south region, is finally seeing a smart comeback. And I think next 2 to 3 quarters, the growth will be pretty good. And hence cement as a segment we like. And probably the middle segment is where we like, wherein we believe, because that segment had got significantly derated, and there we'll see some bit of re-rating.
Okay. All right, Rupen, we'll leave it on that note then for today. Thank you very much for joining in. Good to get that perspective from you. By the way, in the meantime, a couple of interesting updates coming in from Delhi. One pertains to the EV policy. Remember, IGL had taken a sharp knock because the new policy was talking about a transition to EVs very, very aggressively and very quickly. Well, that's not happening. And now it's become official as well. The Delhi government has extended the current EV policy till March 2026 to facilitate wider public consultation. So it's official. That sword that was hanging on IGL, perhaps for the time being, has been withdrawn. The other is a FinMin statement. Again, questions to Parliament that are being answered. Share of unsecured retail loans is relatively low at 25% of total retail loans and 8.3% of total gross advances. This is the government speaking in Parliament, addressing certain concerns around unsecured loans. Some important updates to keep on our radar. Well, on that note, let's take a very quick break. Come back on the other side. We'll, of course, as usual, have Nimesh join in with all the D-Street chatter and then some final trading calls with Mitesh coming up as well.
Welcome back. Well, a couple of stocks actually are catching your attention as we speak. You have JTL Industries. Yesterday as well, there was a large trade that took place. Even today, the volumes are very, very high. However, in the block data, I've not seen any name that's come out there. But the volumes are extremely massive today as well as yesterday. Remember, the past quarter's numbers actually were very uninspiring. However, they've given a positive commentary with the second half of the year. Some part of the street is buying into it. Nuvama's positive on the stock, in fact. But they've scaled down their expectations as well. So volumes very, very high on that one. But it's 3 p.m. today. So let's go across to Nimesh, who's joining in to tell us about D Street chatter. Nimesh, what are you picking up?
Well, Nigel, another lackluster day of trade, extremely narrow range, and it looks like there is a lack of participation as well. When I talk to some large dealing rooms, the feedback is that the volumes have also dried up. Overall activity also seems to be on a lower side in the last couple of days. I think it's all about earnings, and you're seeing big reactions to it. Zomato being a classic example today. In 2 days, it's up 20% on the back of the numbers that they've reported. But the more important part is the reaction to mid-cap stocks in today's market. I was just looking at something like that Blue Jet, and stock is reacted 10%. The numbers are not bad. I mean, prima facie, the numbers look quite okay.
Kirloskar and Pneumatic.
Exactly, it's down another 10%. So you're seeing a lot of those kind of reactions to individual names. I think so. Earnings is going to be a big theme to track, at least in the very near future. From a flow perspective, again, a mixed day, a bit on the negative side is what I understand. Surprisingly, there is a bit of selling in the PSU names as well. I'll talk about that in my chatter list as well. Again, I think Infosys will be a big trigger to watch out for tomorrow. Surprisingly, there was a Citi note in the morning. They've removed the negative catalyst on a lot of the large cap IT stocks. So maybe if there is a surprise from Infosys on the upside, you will see a bit of covering as well in the IT names. So that's something to track in tomorrow's market. Technically, 24,500 is a big resistance on the upside. We've been saying this. So net, it's all about earnings and reactions to earnings. But otherwise, it's been a dull day, even from a flow perspective.
Well, that's right. Nimesh, will be interesting, the point you're making on tech, because that's what could be the trigger that the street requires. Yeah. And also, I think Reliance Industries, technically, that 20 DMA is around 50 rupees away from here. Correct. So I think besides the Nifty Bank, these two I'll be tracking. But what about individual stocks?
So a lot of names in the individual basket to do well. The first stock is Zomato. We've all been talking about since morning. Mangalam has explained as to why the stock is reacted 10%, even in today's market. But this move is backed by very strong FI buying, is what I understand. So expect very high delivery volumes in Zomato in today's market. Across all FI desks, there was buying interest today. So that's the first name. The second stock is CPSE ETF. This is surprising. After a long time, some bit of flow interest in a CPSE ETF basket, and that's on the negative side. And maybe that explains a bit of softness in a lot of the PSU bank names in today's market. So a lot of them are part of the PSU ETF basket, and hence there is a bit of softness there. The third stock is GMDC. That's been a rank outperformer in the last 15 odd days. Again, anticipation of earnings could be strong, but for GMDC, the big trigger is the rare earth opportunity, and something which the management may speak about after the earnings call. So that's something to track there. And the last name is Britannia. For second day running, I understand there is buying interest. So a large global fund seems to be accumulating Britannia at these levels, and hence delivery-based buying for the last couple of days, and that's the case today as well.
Nimesh, thank you very much for that. So that is the sort of information which is coming in as far as specific stocks are concerned. Z is down about 5.5% as things stand right now. Vamakshi is here with details. Numbers came out earlier. Vamakshi, tell us.
Well, Prashant, to begin with, we were working with already muted expectations, given that Q1 was a seasonally weak quarter across players, given the shift to IPL-led advertising expenses. And, Z has missed those muted expectations this time around, which is why the stock is reeling under pressure as of now. Take a look at the ad revenues. They dipped by almost 17% on a year-on-year basis. The street was working with a 14 to 15% year-on-year dip. Now, the subscription revenues, which had been growing for 8 consecutive quarters until Q4 of FY25, have also dipped this time around to 0.6%. In fact, when you look at other sales and services, they're also seeing a sharp cut of almost 64%, and that is because there were no major movie releases from Z this time around. So therefore, when you look at the revenues, it's a downtick of almost 14% overall, and it's a 6% miss as far as our own estimates are concerned. On the other hand, when you look at the margins, they've managed to improve by 40 basis points, and that is because the total operating expenses have dipped by almost 14% on a year-on-year basis. So therefore, the company has been highlighting that they have been undertaking cost control measures, and that is flowing through the margins. The margins have come in a tad bit better than what the street was anticipating. The net profit, though, when we look at it on an adjusted basis, keep in mind that Q1 FY25 did have some exceptional items, but there are no exceptional items in Q1 of FY26. But after adjusting for that, there is a decline of almost 7% on a year-on-year basis. And the decline in the net profit is actually supported partly because the other income for the company saw an uptick of almost 32%. So thereby it is offsetting some of the decline in net profit, but overall can't take away from the fact that it's a miss as far as street expectations are concerned.
It absolutely is. And if you put two and two together, promoters are not getting to increase their stake in the company, at least not through that warrant route. Numbers are bad. What about leadership? What about pulling the company out of the funk? We'll see. But thanks very much, Ramakshi, for getting us the updates on this one. ZE is sliding quite a bit now at the session lows. Okay, let's go back to Mitesh and get a sense of stocks and ideas. Mitesh, your calls, and just throw in a word on Z as well, because in between there was a lot of excited trading around Z, you know, when this whole thing was that whether promoters will be increasing their stake or not. Now that's been shot down, plus bad numbers. Just levels to watch on Z as well.
I think Z started from about 100 or 105 odd levels and then went to about 150. It's now getting into the corrective mode. The bigger bottoms are around 125 to about 120 zone is the support range. So I think Z might actually, test those levels of 125 to about 120, and maybe the decline will be arrested over there. On the stock side, I have an STPT on Granules with a stop at 480 for targets of around 468, and a VTST call on Hindalco with a stop at about 685 for targets of 700. Yeah.
Okay. All right. Got it, Mitesh. Thank you very much for that. Thank you for the calls. You have a good evening. We'll connect again with the markets tomorrow morning. Let's go across to Yash, because Yash has got an exclusive for us. It seems that Axis Bank wants to hike its stake in Axis Max Life insurance company. Let's get more details going. Yash, what are you picking up?
Well, Surabhi, rewind, to a couple of years ago. The original plan which Axis Bank had was to acquire about 30% stake. Back then, it was, of course, called Max Life Insurance. Now it's Axis Max Life Insurance. But the Reserve Bank of India back then had given an approval only for a 20% stake. What we've been given to understand from our sources now is that Axis Bank is likely to express its intention through a proposal to acquire additional 10% stake when it comes to Axis Max Life Insurance. Now, why is this another 10% important? Because the moment you cross 25% is when you're classified as a promoter entity of an insurance company. And this another 10% stake which Axis Bank wants to acquire will give the bank the promoter entity status for Axis Max Life Insurance. Axis Bank feels that all large banks have insurance subsidiaries. You speak about ICICI Prudential Life with ICICI Bank, SBI Life with State Bank of India, HDFC Life with, of course, HDFC Bank. And Axis Bank currently is not promoter to one of the insurance subsidiaries, which it wants to achieve. Currently, SEBI is investigating a matter into Axis Bank. This was relating to the first 20% stake that it had acquired. And we've been given to understand from our sources that as soon as that investigation ends, Axis Bank is likely to reach out to RBI expressing the intention to acquire that additional 10% stake. At the current price, this 10% stake could be worth about upwards of 5,000 crore rupees. It could be done through a preferential issue of shares, which will be issued in favor of Axis entities. And that could get that money, that is upwards of 5,000 crore rupees, into Axis Max Life Insurance, which is the life insurance subsidiary. We've written to Axis Bank, we've written to Axis Max Life Insurance on this story. We are still awaiting a response from both parties.
But that's a really important caveat, Yash, that you added. Obviously, this will require the RBI's blessings. And Axis Bank has its own issues that it's been dealing with in terms of NPA recognition. You're saying they've not yet approached the RBI, but they eventually will, right?
They've not.
That's what you're hearing.
They've not approached the RBI. What I was told by my sources is that they're waiting for the SEBI investigation to end. Once that is put to an end is when they expect to reach out to the Reserve Bank of India for this approval.
Absolutely. Yash, thanks very much. And that SEBI investigation is about, that earlier 20% that Axis bought. I mean, if you remember, there was all that controversy about the price at which it was bought and whether, this was, there was some sort of a quid pro quo, etc. So we'll have more on this as we go along, but there are regulators involved, SEBI first, and then, of course, there's the RBI as well. Jay Bala of Cash the Chaos is with us. Jay, good to have you with us here on the program. Thank you for your time. Will we see a move, Jay? Because at least on the index level, moves have largely disappeared. What is your sense, near term?
Yeah, that's right. Thank you for having me on the show, Prashant. We are looking for a print of 25,332 on the Nifty 50 to confirm that the market has bottomed. But the structure is ideal for the markets to drop to up to 24,400 and then resume the uptrend. So watch 24,332. If it's a print is enough. If that were to happen, we can say the bottom is in. The market is possibly looking for Reliance to stop dampening the sentiment. If that happens, there is a possibility that we are looking for a reversal in the markets. Just Reliance needs to just pause falling. Once that happens, things might start looking up.
Okay. Sorry, you said Reliance needs to stop falling. Any key levels on Reliance?
I would want Reliance to hold above 1397, which is the June low. So as long as the stock can hold above June low, this fall will fall within the parameters of a normal correction. So that's pretty close, less than a percentage away. So that's a very strong support in my opinion. So that's the support level I'm tracking for Reliance.
Jay, hi. What are the big bank charts indicating to you? Because contrary to a lot of expectations, at least on the fundamental side, the large bank earnings have worked better for the street. Those stocks have had a good 2 days in terms of reaction. So is there anything interesting you're seeing either on the bank Nifty, any bank trades at all?
Yeah, there's a very interesting setup on the Nifty Private Bank Index. Yesterday's low is very likely to hold, and the price structure is indicating a possibility of banking index scaling to about 29,000 from its current level of 27,000 odds. So we saw SBI cross 837, but it didn't close there. But if that were to happen, I think banking index can offset whatever dampener Reliance is throwing to the market. So and pretty soon, I'm sure Reliance will also join the party, but it's going to be slightly offset by private banks and Nifty PSU banks in the very short term.
It's a stock-specific market, Jay. What about individual stocks? I think you have a call on Manappuram as well as Exide. Normally, I hear a couple of cash stocks from you, and some of them just go rocket. But what's the outlook on both these two?
Yeah, thanks, Nigel. We saw Schneider Electric at fresh 52-week highs. It's still got further room to go. I'm expecting something like 1,100 to 1,400. I've been bullish since the 25th of May. But fresh stocks, when it comes to Manappuram and Exide, I just want to put a note that I find it difficult to find fresh buy candidates. So you might want to allocate much lower than your usual allocation. With that in mind, bullish on Manappuram with a stop loss of 259, possibly crossing 300. And bullish on Exide. It's got a inverse head and shoulders breakout, but it's just consolidating just above the next neckline. And I'm bullish on the auto sector too. If auto sector were to cross 24,200, I'm sure auto ancillaries like Exide, Amara Raja, and TVS Street Chakra will start rallying. So Exide stop loss 370, possibly heading to 440.
Just rattle off the names again without the levels, Jay. There's Exide.
Yeah, 370 stop, object to a 440.
And which are the others? The stocks themselves, the names?
TVS Street Chakra, I'm bullish on it. And even Amar Raja, I'm bullish on it. Mostly auto ancillaries. And the level to watch on the Nifty Auto Index is 24,200.
Okay, auto banks basically on Jay's radar. Just stay with us. We'll take a quick commercial break here. There's the last 10 minutes of trade left. So coming up in just a bit. Back with Jay.
Provisions, in fact, rose almost 94% year on year, which is why you're seeing the impact on the bottom line. Now, this, the bank says, is because of a technical impact, which is linked to a change in its provisioning policy.
NPA classification happens on days past due criteria, and then there is qualitative criteria, which is agnostic of days past due. We have not changed any day past due parameters because they are driven by regulation. The qualitative parameters, as we have previously indicated, we benchmark to most prudent in market on an annual basis.
Axis is down 5%, as you can see.
RBI found that the bank's NPA recognition policy was too lenient. While the bank was compliant with RBI's income recognition and asset classification norms on paper, we understand the regulator felt that the bank's internal policies were not aligned with the spirit of the regulation.
Axis, we were just discussing. After Ritu's story is down another 1%.
Welcome back. Well, the markets have not done too much, but individual stocks, Tilaknagar Industries suddenly saw a big volume spurt. The stock has moved higher. We'll have to wait by to see what are the plans with regard to the fundraising and how they use that money as well. So we'll have to keep an eye on that. But there's a big volume spurt just in the last 15 minutes or so. If we can get a bar up, actually, it'll tell you the picture out there. Let's get back to Jay Bala though. Jay, what about the tech index? Fundamentally, numbers are being missed. But then after that, some of them are saying that the second half of the year will be good. And actually, some of that is getting bought into. I recall, Tata Technologies was one stock that did see buying post its numbers and a couple of other names as well. How is the chart looking on the tech index?
Yeah, I've been quite skeptical on the tech index, but the move from the April low has happened in 5 steps. 5 steps usually signal a trend reversal, but there are haunting possibilities. But I'm still skeptical on the tech index, but I'm not bearish. So as long as 36,200 to 35,200 holds, the tech index can reverse from here. Infosys, it's got again a similar structure to the Nifty IT index. It's got a 5-step move from the April lows. So if Infosys manages to hold above 1518, that's quite bullish. And since the expectations are quite low, there's a possibility that we could get a surprise. So if the Nifty IT index crosses 40,000, things can start getting really bullish, and I might have to revise the consideration that I've had for the last few weeks that it's a counter-trend rally. I might have to turn more bullish on it. And even as things stand, I'm not bearish, but just more neutral to taking this as a trading rally more than an investment rally.
Okay, some more stocks which are moving up. MRPL came out with numbers yesterday. There was a big loss. The stock corrected. It's bounced back 4% higher on that because brokerages say that Q1 was impacted on account of shutdowns, a near 45-day shutdown. But Q2 should be a lot better, and that stock is seeing a bit of a rebound. M&M Financial, which just came out with their numbers as the show started, is up nearly 1.5%. In-line numbers, largely. Gaurav is telling us there is a NIM expansion, net interest margin expansion of 20 basis points on a quarter-on-quarter basis that the street must have liked. It's pushed the stock higher, though credit cost too has seen a bit of a spike. And remember, Paytm comes out with numbers later today, and Paytm is up nearly about 4%. Generally, all platform companies are higher. Swiggy and Zomato, Eternal, but Paytm too, ahead of numbers, is seeing a lot of interest. Jay, any thoughts on Paytm, the stock that we just discussed, or anything in the NBFC pack?
Yeah, I was contemplating coming up with a pick on PB Fintech. I liked it today, but it was slightly. I was slightly hesitant on it because it was not a very clear structure. But if yesterday's low holds for PB Fintech, it might try to push for fresh 52-week highs. So keep track on that. Paytm has got a very strong momentum, and I'm sure the next pullback will be bought into. So the risk reward, although is quite wide, currently trading at 1,059, the stops are about 900. So that's the downside here. So if a pullback could help and could bring the risk reward much better. So one more sequence of higher high pending for Paytm.
Any cement stocks? India Cement's up 7%, Ramco, Shree Cement, KCP, Digvijay. Across the board, stocks are flying.
Yeah, I've been bullish on cements, and I've been pointing out for quite some time that cement stocks are likely to do well, and it's got a spillover from Nifty Realty Index. So right now, pay attention to ACC, and likewise, ACC has got an interesting breakout, but the risk rewards aren't there. Otherwise, I would have picked it as a stock for a pick today. It's got Ambuja Cements hasn't got a similar setup. But Shree Cements and even JK Lakshmi Cements, they're all looking quite good. But they've all moved. Now, I've been bullish since early May, mid-May. So it's a bit late, but the rally is still there. There is still strength in the cement space.
Yeah, no, absolutely. By the way, Nigel was mentioning Tilaknagar. Any thoughts on this one? It's basically it's back at highs, right? Or has it? I think these are new levels, new high levels. January 25, the stock had gotten to about 457. It's at about 473 now. But I mean, technically, Jay, I don't know if you have a view, but there's a deal here, perhaps, and we'll have to wait for the contours of that one, which we reported. Jay?
It looks quite bullish, ultra bullish, I would say. But stop losses are placed about 330, 340. So not an ideal risk reward. But yeah, it looks quite bullish. Momentum is very similar to Paytm. I would say, in fact, I would say it's slightly more bullish than Paytm. This probably has got two sequences of higher high on the weekly time frame, not on the daily time frame. So, so it can get really bullish. Say something like 800, it can even close to doubling from here.
Oh, wow. Okay. Well, I think, Jay, just hang in there. We're going to come back to you after wrapping up markets, right? 1,600 stocks down, about 1,240 stocks higher. That is the overall NSE declines to advances ratio. On the Nifty, there was one Eternal and then everything else far down below. Eternal up 10-11%, and the next gainer was up 1.5%. So no real comparison there in terms of what went on. So the other gainers were HDFC Life, Hindalco, and Titan, all in the range of 1 and 1.33%. On the downside on the Nifty, there was Shriram Finance down, actually three names with 2% cuts. Shriram Finance, Aishur, and Geo Finance, which lost a little bit in terms of trade. Pretty, flattish, sideways, drifty kind of close across the large indices is what we've had. Rima.
Okay, Sam, in the mid-cap action, Eternal, of course, higher. Swiggy moved up. Swiggy ending with a gain of nearly about 6%. GMDC spiked. AGI Greenpack reacting to numbers, 14% up. Tilaknagar, we've been talking about it. That's been a big mover. Stock higher by nearly about 14%. But on the way down, Z Entertainment post numbers took a hit. 361 WAM after the block deal under pressure. And a couple of these mid-cap banks, so PNB, RBL Bank, IDBI Bank, all on the back foot.
Okay, today not a great day for financials overall. When the PSU banking index has actually been among the weakest. And not just that, a lot of the other NBFCs, other financials as well, for instance, Geo Financial, on the weaker side today. Overall, a weak day for mid-caps. No denying that. Some of the names which have lost ground would be a Blue Jet Healthcare after numbers, as we've seen. Zeev, of course, we've mentioned, down about 6% as well. So a bit of a tough session, particularly for the broader market. The Nifty once again below the 25,100 mark. Well, that's where we take your leave on this edition of Closing Bell. Many thanks for being with us, but do stay tuned because all the market action continues. Up next is Markets Forward. A range-bound session sees the Nifty and the Sensex end flat. Over 30 stocks end in the red. Broader markets underperform blue chips. The Nifty Bank as well as the mid-cap index end 0.5% lower.
Zomato and Blinkit owner Eternal stock surges on its bottoming out call for the quick commerce, and it's scripting a path to growth and profitability. The peer, Swiggy, and stakeholder InfoEdge also rally.
In a sudden move, Anup Saha resigns as the MD of Bajaj Finance with immediate effect. Vice Chairman Rajiv Jain will assume additional responsibilities in the interim. Sources say it is premature to assume that Saha's resignation is linked to the top job at IndusInd Bank, where he is one of the 3 contenders. That's an exclusive.
Hello and welcome to Markets Forward, your go-to show where we tell you what went on with regard to today's trading action, and we'll set you up for tomorrow as well. Surbhi and myself will guide you through the next half hour of the show. Hey, Surbhi.
Hi, Nigel. Well, a bit of a disappointing day for the Bulls. They would have wanted to see them build on because yesterday they bought from the lows and it was a much better looking screen. But of course, today we didn't have much of that. We have, plenty to cover. Just a quick word on the market before we get to it, and that's the screen that we're talking about the Nifty finally ending, lower. Why I've put those 2 stocks is just examples that this was a very, very stock-specific market. The index did nothing, but individual stocks are moving all over the place. And Eternal is just one such example. Remember, we were talking about the stock same time, same show, 24 hours back. But look at the move today, 10% up. And we'll tell you why this happened. And likewise, Tilak Nagar Industries, it's a story that Nigel broke. So individual stories, news flow, earnings moving individual stocks, but at the index level, fairly quiet. Having said that, I just want to point out one trend, that overall there was a lot of selling in financial stocks today, barring HDFC Bank and ICICI Bank. If you look at PSU banks, NBFCs, smaller banks, tier 2 banks, once again, there was a fair amount of red on the screen.
All right, yeah, but let's run you through first what we have lined up on the show for you today. We start off with all the movers and shakers. Hormuz Aman will be waiting by on that. Eternal shares, they touched record highs in today's trading session after a solid Q1 showing. While Bajaj Finance, well, it grabbed the headlines on the back of a leadership change. Tilaknagar Industries as well surged in trade on the back of a possible stake buy. In Imperial Blue, last but not the least, we'll delve into all the key market cues you need to track for tomorrow's session. But as promised, Hormuz is already geared up, taking strike first up to tell us about all the movers and shakers. Hormuz, take it away.
Well, there were some of these names that actually knocked it out of the park in today's trading session. As you mentioned, Eternal being one of them, 10% higher, making a record high today, a 3 lakh crore market cap as well in today's session. Of course, there were some that were knocked over as well. The Entertainment being one of them, with a disappointing ad and subscription revenue performance, so 6% lower on that stock. AGI Greenpack on very strong volumes, ending 14% higher. Blue Jet and Kirloskar Pneumatic too, some of the earnings casualties of today's trading session. Some of the other newsmakers today, of course, 361 WAM was on the back of a block deal that took place in today's in early morning trade. Havells India, of course, after the double upgrade that came in from BOFA earlier in the day, and that resulted in a recovery from the lows of the day. Tilaknagar Industries, of course, Nigel's Newsbreak. SML Isuzu continues to move higher from M&M's open offer price, and GMDC too at almost a 5% pop in today's session as well. Pharma stocks were a bit of a sulk in today's session. Most of the stocks on the pharma index ended lower today, losses of anywhere between 1.5% to as high as 3.5%. A similar reaction seen in the PSU banks as well. The top sectoral loser in today's session, and all of the stocks on the PSU bank index ending lower, 2 to 4% were the losses seen in today's trade. And lastly, in a wobbly market like this, there are still stocks that are at a 52-week high, most of them being cement names. Look at Ramco Cements, Dalmia Bharat, Shree Cement, and of course Nelcast too. A 10% move in today's session at a 52-week high. Back to you guys.
Okay, all right, thanks for that. So, yeah, good to see some little specks of green here and there, because at the index level, things were pretty much either directionless or lower. Okay, let's move on. Like we were saying, it's all about individual stocks. So straight away getting to the action. Zomato and Blinkit owner Eternal rallied a whopping 11% today after scripting a path to growth and profitability. Remember, yesterday Mangalam was telling us how the numbers were above estimates. Today, there were a lot of brokerage notes that were sounding very optimistic on these stocks. Mangalam is here with the details. Mangalam.
Well, Eternal in today's trading session have hit a record high. In fact, ever since the company reported the numbers, the stock has rallied about 15% plus. And that, if you look at the reported numbers, then you'll be wondering why. Because the revenue has grown 70%. That's great. The EBITDA has fallen 35%. Margins have contracted to 60 basis points. And the net profit has fallen 90%. Now, here's why. Because a couple of things that the management spoke about are telling you that the worst is behind. One, year-on-year growth has bottomed out for the food delivery business, which implies that it will only improve from here on. And near-term, quick commerce margins too have bottomed out, and they will improve from here. So let's take the food delivery business first. Over the last many quarters, the revenue growth had been coming down, and for the first time between Q4 and Q1, the revenue growth has stabilized. This is gross order value growth has stabilized at around 16%, which the management believes is the absolute bottom. And from here on, they are expecting growth to resume. That's a positive. The second part, Blinkit, which was supposed to be the growth driver of the company, continues to be the growth driver, so much so that the revenue growth of 154% has actually made it the largest revenue component in the overall business. But the problem over the last few quarters was EBITDA loss increasing due to competition. Out here, the losses have narrowed quarter on quarter, and this despite the company continuing to expand. So if you look at it, they've added almost 243 stores in this quarter, total stores going all the way up to 1544. And this, while doing so, the losses quarter on quarter have narrowed. So the Blinkit loss trend comes up for you from 178 crores, it's narrowed to 162 crores. And the management believes that in the near term, it's actually likely to see margin improvement. So two growth drivers of the company, both of them fairly in place. Which is the third one, it is District, where the management sees over the next 5 years, it could be an annual $3 billion revenue company with $150 million in annual adjusted EBITDA. So the third factor doing extremely well for them as well. The question, what about the money? Well, in the fourth quarter, they had seen a quarter-on-quarter decline in their cash balance. That too seems to be stemming right now. From the fourth quarter to now, the cash has marginally increased or cash burn has reduced as well. So all these factors doing well. The stock, which was off its highs, has now moved higher. The next big trigger is because it is now a largely domestic-owned company. They will own inventory in Blinkit as against third-party sales, and that could increase their margins in the quick commerce business by about 1% as well. And when Blinkit rise, it's not just Blinkit, because we have Swiggy, which is trading higher on the back of Eternal's performance, and it trades at a 45% discount to Eternal, so that stock is higher. And secondly, InfoEdge, which owns about 13% stake in Eternal, worth nearly 38,000 crores or 40% of its market cap, doing well in today's trading session as well. But the data point or the picture that caught my eye was that on the shareholders' letter. It had 3 businesses, all of them with clear positioning. Zomato for Eternal, aaj kya khaoge? District, aaj kahan jaoge is the going out business. And Blinkit, finally, aaj kya mangwaoge? 3 business propositions, all of them clarified in their shareholders' letter.
All right, thanks a lot for that, Mangalam. Well, let's welcome our guest on the show. We have Jay Bala of Cash the Kiosk, as well as Mayuresh Joshi, Director Research at MarketSmith India, who joins us. Hi, gentlemen. Thanks a lot for joining in. Jay, what are you making of today's action? Boring day, huh? I mean, when you move 20 points higher, 20 points lower in the full session. But we have seen in the past that, the Nifty Bank actually is giving you those buying opportunities. You think so, or would you stay away?
That's right, Nigel. It is a boring market, and each day, in fact, from last week to this week, there has been not much progress on either direction. The fact that the markets are falling in a slow pace, that's a good sign. This is continuing signal that this is a correction. And the banking index, the private banking index in particular, yesterday's lows is pretty important, and the signal from the private banking index is that it's likely rallying to somewhere close to 29,000 plus. So I'm sure that sentiment will spill over into the private sector bank, and that will also join the rally. So at the moment, we want to see a print of 25,332 on Nifty to see and conclude that the correction is over. We could see a further drop to 24,400 if that doesn't happen, but that will be a completed price structure, and it's just a matter of time before the Nifty resumes its uptrend.
Okay. All right. Got that, Jay. Let's get to Mayuresh as well. Mayuresh, good to have you on. Just going back to that story, I mean, Zomato, Eternal, and what a performance by the stock. Do you think the worst is over?
I think that is the belief, Surabhi. And again, I think just to add to Mangalam's point, I think today's stock action indicated, क्या आज आपने stock खरीदा है? क्या आप stock खरीदोगे? Was the question asked by Eternal to the market itself. Obviously, I think the data points put out are sounding a lot more optimistic, both in terms of the food delivery business where the losses are coming off. The cash balances now seem to be a lot more stable. And expectations in terms of the targets set for District seem to be huge. So I think if they're able to achieve anything close to that over the next few quarters, I think the kind of action that you've probably seen in the stock today, that action might very well continue. So yeah, anybody holding on to a stock like Eternal should continue.
Okay, all right. Thanks a lot, Mayuresh. But let's shift focus to the banking space. Bajaj Finance gained on the back of a leadership change. Anup Kumar Saha, the MD and CEO of Bajaj Finance, has tendered his resignation. Rajiv Jain has been re-designated as the Vice Chairman and Managing Director of the firm. Ritu Singh joins us to run us through a quick analysis on that. Ritu.
Well, our sources indicate it may be too early to assume that Anup Saha resigned from his position as the MD of Bajaj Finance to take over the top job at IndusInd Bank. Remember, we were the first to report that Anup Saha is among the 3 candidates who are in the running for the IndusInd Bank CEO role. And while his name being in the mix may have had some bearing on internal dynamics at Bajaj Finance, we understand RBI is yet to clear a name for the IndusInd role. So the idea that he quit specifically to join IndusInd may be a bit premature. But that said, the resignation itself has come as a surprise, given he was being groomed for the position for the last couple of years and only took over as the MD in April, and so him quitting the role in just under 4 months has raised some questions. Equally important is the fact that Bajaj Finance's long-term MD Rajiv Jain is back at the helm, and he's going to serve as the MD for the remainder of his term until March of 2028. Now, while this will provide a smooth transition for Bajaj, the focus will also move to succession planning. Now, remember, Rajiv Jain has spent more than 15 years as the MD of the company, and while RBI rules limit bank CEO terms to 15 years, there is no such cap for NBFC, so technically he can continue, but the company will still be under pressure to groom the next line of leadership. Now, Jeffries points out that Rajiv Jain may now need to pull back from any advisory role at Bajaj Finserv, and Morgan Stanley calls this a setback to the succession plan that the company had been executing. But with Rajiv Jain back in the driver's seat, they say the situation remains manageable.
Okay, all right. So leadership change at Bajaj Finance, and of course need more clarity on what the final plan really is. Thank you for that, Ritu. Well, with that, let's move on. And this is a CNBC-TV18 exclusive. We're learning from sources that Axis Bank may seek RBI's approval to buy an additional 10% stake in Axis Max Life Insurance. Yash is here with the details. Yash, what are you picking up?
Well, Surabhi, that was the earlier plan from Axis Bank as well, to acquire 30% stake. But unfortunately, RBI back then only gave an approval for a 20% stake, which has been done by Axis Bank in Axis Max Life Insurance. Now, what we've been given to understand from our sources is that Axis Bank is likely to express its intention through a proposal to the Reserve Bank of India once again to acquire another 10% additional stake when it comes to Axis Max Life Insurance. This 10% would be important because it will make Axis Bank cross the 25% mark in Axis Max Life Insurance, making them a promoter to an insurance subsidiary, that is Axis Max Life Insurance. What we've been given to understand is that at this point of time, market regulator SEBI is already in the process of running an investigation as far as Axis Bank is concerned that pertains to the previous 20% which they had acquired, and that is on the case of pricing of that 20% and the disclosures there. But according to our sources, Axis Bank is of the view that once that investigation concludes, right after that, they would want to approach the Reserve Bank of India, expressing their view to acquire additional 10% stake in Axis Max Life Insurance. This could be done through issuance of preferential shares towards Axis Bank, and it could bring as much as about 5,000 crore rupees. That is as per the current CMP of Max Financial Services when it comes to Axis Max Life Insurance. So that'll be very important and a positive move for, of course, Axis Max Life Insurance, the insurance subsidiary, and as well as Axis Bank, because like ICICI Bank, HDFC Bank and State Bank of India, they also get to be the promoter entity for an insurance subsidiary there.
Always interesting one, Yash. Thanks a lot for joining in and filling us in on that story. Mayuresh, how do you read the story?
I think it has always been in the works, Nigel. So I think to a certain extent, what kind of development happens specifically after RBI has asked Axis Bank to fill up with SOX is going to be very, very interesting. At the same time, I think the intent from the bank has been very clear, that they might just keep on adding up in terms of their stake as far as Max Life is concerned. And therefore, I think what developments take place specifically from the regulator are going to be very, very interesting. So let's see what the regulator says on this.
Okay, all right, gentlemen, it's early in the week, but time for a drink. I'm going to ask you your view on the stock Tilaknagar Industries, because we here at CNBC-TV18 picked up some source-based information that there could possibly be a deal in the works. That is, Tilaknagar Industries could be looking to pick up a stiff peg, that is, and that'll be whiskey actually. That is, they're looking at buying Imperial Blue brand from Pernod Ricard. So we'll have to see whether or not this happens, but sources indicate there could possibly be a deal on the cards. What is the valuation of this particular deal? It could possibly be close to around 4,000 crores approximately. How will they fund it? Well, they'll fund it via a mix of debt as well as equity. And for this purpose, they are going to be having a meeting tomorrow, a board meet to raise some capital. So we'll have to find out the fine print of that particular thing. What is the mix of debt and what is the mix of equity? As of now, we know Tilaknagar Industries is sitting on a net cash. Remember, a few years ago, they were heavily net debted and they brought it down to a net cash, which is quite phenomenal in itself. What does it bring to the table for Tilaknagar Industries? Currently, they're only in South India. If they actually get this brand, then they'll get pan-India presence. Point number one. Point number two, last year they sold 12 million cases. Imperial Blue sells 22 million cases. So their capacity itself, their scale will go up by nearly around 2.5 to around 3 times odd, which is very, very large. And currently they're only brandy. 85-90% is only brandy. If they get this asset, they'll become a whiskey player. So it could be a big scale opportunity if in case this deal comes through. We've reached out to both the managements, not got a response as of now. But we'll keep an eye out on this because this could probably be a $500 million deal, which is the largest we've seen in more than 10 years when United Spirits as well as Diageo did that deal. Mayuresh, not asking you about your preference of alcohol, but what do you make? If this deal happens, then what's your take?
Very interestingly put, Nigel. And the facts that you took out obviously will work in Tilak Nagar's favor. But again, I think the overhang that is happening with the state government, with the Andhra or the Telangana state government, what comes out of that, I think that can become an overhang or a headwind for the stock itself. And obviously, I think if this deal does go through, the pointers that you're putting forward, the diversification in terms of product mix, geographical diversification, revenue expansion, all those facts stand in place. But again, one, the actual contours of the deal. Second, I think the overhang, as I said, in terms of their existing issues that they're facing with the government, that just got raised, I think, a day or a day before, I think might just act as an impediment going forward. So as a disclaimer, I think within this alcohol beverage space, I think we continue holding Radico in our global and local portfolios.
Okay, all right, indeed. That was Tilak Nagar Industries. Quite a big mover today. Gentlemen, thanks very much for joining in and giving us your advice on all the stocks that we've discussed. I just wanted to mention one more sharp mover today was Z Entertainment, and this is after numbers came in, and numbers were weaker than what the market had estimated. There you go. That's the stock for you. Sharp decline, and at 6% lower. The ad revenue, forget growth. The ad revenue was down 17%, a lot more than what the market had in mind or had penciled in. And even the subscription growth, there was hardly any versus expectations of a 4-5% growth at least. So disappointing numbers from Z, taking the stock down today. Well, with that, we'll hit a quick break, come back on the other side, and then we'll get you all the top corporate voices along with the events to watch tomorrow.
Welcome back. Well, let's focus on the top corporate voices of the day. First up, Havells gained despite a challenging quarter. Speaking of CNBC-TV18, well, the firm's management said that while tertiary demand remains subdued this quarter, the overall demand trajectory strengthened in the second half of the fiscal year. That's the expectation. The firm also had robust volume growth in cables as well as wire segment, while no significant market share losses have occurred. The management also highlighted a strong performance by Lloyd. While revenues remain steady, margins have seen a significant improvement, doubling over the period.
PNB Housing Finance reported a healthy set of numbers in the first quarter. The management is quite bullish about the outlook on net interest margins, attributing the improvement to growth in the affordable and emerging segments. The management also indicates that any potential rate cut benefits may be passed on to customers, with an impact of up to 10 basis points expected in Q2. The firm has also shared a positive outlook on the asset quality and expects to maintain it between 1 to 1.1%. It has guided for retail loan growth of 18% this year.
Finally, Angel One gained in trade after it said that its first quarter performance was the result of solid execution. It also added that it was difficult to predict how investor behavior would change with stricter regulations. The firm said that the macro fundamentals were still intact and it would not worry about daily or monthly gyrations. It also said that the adjusted EBITDA margins came in at 34% in the first quarter and it could improve to around 40% by the end of this fiscal.
Okay, all right. So those are all the corporate interactions. But before we wrap up today, let's get you some of the key events and earnings to watch out for tomorrow. Ria is here with the details. Ria.
Well, yes, let's take a look at the key events to watch out for tomorrow. In terms of the economic data, watch out for the core CPI coming out of Japan. In the US, we have the existing home sales for the month of June, as well as the crude oil inventories coming out. And in the Europe, watch out for the consumer confidence data. Back home in India, lots of earnings to watch out for. 3 Nifty companies, Infosys, Dr. Reddy's Laboratories, as well as Tata Consumer Products. Some other companies as well, Aditya Birla Real Estate, Bajaj Housing Finance, Coforge, SRF, Persistent Systems and Syngene International, among others. There are 6 companies that are going to be holding board meetings tomorrow to consider fundraising proposals. Those include IndusInd Bank, SRF, Tilak Nagar Industries, Aditya Birla Real Estate, Aurum PropTech and Borosil Renewables. Some other stocks to watch out for as well. Mahindra Logistics will trade ex-dividend in the ratio 3:8. It is also the last day to buy shares of Cholamandalam Investment and Finance, CG Consumer as well as Hero Motor to be eligible for their respective dividends. In terms of IPOs, we have Westbridge Capital-backed IndiCube Spaces rupees 700 crore IPO set to open tomorrow. They've set the price band between rupees 225 to 237, and G&G Electronics is also going to launch its rupees 460 crore IPO tomorrow. 4 other events to watch out for. US President Donald Trump will speak at the Winning the AI Race event in the US. The Commerce and Industry Minister Piyush Goyal is going to visit the UK on July 23rd and 24th for the signing of the India and UK FTA. The ECB will also hold a 2-day meeting starting tomorrow. And lastly, the BOJ Deputy Governor will deliver a speech and hold a news conference tomorrow.
Thanks a lot, Ria. We're set for tomorrow's trading session then. But on that note, we'll have to wrap up on this edition of Markets Forward. Don't go anywhere. More news and updates coming up on the other side.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The Sensex and the Nifty end with marginal losses. After a range-bound session, the Nifty manages to hold above 25,000. Banks and mid-caps see sharper cuts. A trade deal between India and the US before the 1st of August deadline is unlikely. Sources say the deal stalled after the US proposed 20% tariffs on India and expected zero tariffs in return, similar to Indonesia and Vietnam. Access to agri and dairy sectors remain a flashpoint. That's an exclusive. In a sudden move, Anup Saha resigns as the MD of Bajaj Finance with immediate effect. The Vice Chairman Rajiv Jain will assume additional responsibilities. Sources say it's premature to assume Saha's resignation is linked to the top job at IndusInd Bank, where he's one of the 3 contenders. That's another exclusive. Axis Bank eyes an additional 10% stake in its life insurance joint venture with Max Financial Services, may seek RBI approval to acquire stake, which will help Max Financial raise 5,000 crore rupees. Axis Bank would become the promoter of the company if the deal goes through. Another exclusive this evening. Tilaknagar leads the race to buy the popular whiskey brand Imperial Blue from Pernod Ricard. Sources say the deal is likely to value Imperial Blue at around 4,000 crore rupees. Another exclusive tonight. Vice President Jagdeep Dhankar's surprise resignation with 2 years left in his term on the first day of Parliament session creates a flutter in the corridors of power. Sources say tensions with the government over Dhankar backing an opposition motion to impeach Justice Verma could have led to his sudden exit. Just 10 days ago, Dhankar had said he will complete his term barring any, and I quote, divine intervention. The second day of the monsoon session of Parliament is a washout. Opposition parties protest over the voter roll revision in Bihar and the aftermath of the Pahalgam terror attacks. The Supreme Court begins hearing the presidential reference made by Draupadi Murmu, conferring the powers of president and governors, issues notice to the union government and all state governments. Murmu had made the reference following a Supreme Court order that prescribed a timeline of maximum 3 months for the president to consider a bill referred by a state's governor. India startup airlines are struggling to take off. Air Kerala, Al Hind Air and Shank Air neither have any aircraft nor a flying permit. All 3 airlines got regulatory approval in 2024 and were hoping to take to the skies by the middle of 2025. After 62 years, the Indian Air Force will retire the MiG-21 fighter jets. A ceremonial send-off to the aircraft, dubbed as a workhorse, will be held in September. We do have a packed show lined up for you, but straight to the day's market action. The Sensex and the Nifty closing flat after a range-bound session. Broader markets underperforming, with the mid-cap slipping over 360 points, so closing 0.5% lower. The Nifty Bank closing 200 points lower, absolutely flat there, both for the Sensex as well as the Nifty. Shriram Motors, Eicher Motors, Adani Ports dragging the index lower today. Now, market regulator SEBI has granted approval to US-based trading firm Jane Street to resume trading in India. This comes after Jane Street completed the directive to open an escrow account and deposit the unlawful gains of 4,844 crore rupees before the deadline. However, Jane Street will be closely monitored by stock exchanges during the ongoing SEBI probe. Remember, the ban was imposed over Jane Street's alleged market manipulation in the derivatives segment. Now, shares of Zomato's parent Eternal hitting a record high on renewed optimism over its quick commerce business Blinkit. In its first quarter earnings, Blinkit had reported higher order value compared to the food delivery business. Shares of rival Swiggy also jumped nearly 5% in trade today. Eternal's management said growth and margins have bottomed out for the near term. The rally came despite a steep decline in net profit, which came in at 25 crore rupees in the June quarter. However, revenue up 70% to over 7,000 crore rupees. On to more earnings. FMCG giant Colgate has reported a weak set of numbers in the first quarter, missing street estimates across most parameters. Net profit declining nearly 12% to 321 crores. Revenue dipped over 2%. The company's management anticipates a gradual recovery in the second half of the year. The big story this evening, a trade deal between India and the US before the 1st of August deadline is unlikely. Remember, this is a deadline set by President Trump, saying that if you don't comply and put a deal in place by then, well, then you'll be hit by tariffs. Now, sources say the deal stalled after the US proposed 20% tariffs on India and expected zero tariffs in return. This is similar to the deals that the US has done with Indonesia and Vietnam. Parikshit standing by with the exclusive details. So, Parikshit, it doesn't look like there is a deal imminent at this point in time? What seems to be the issue?
Any interim deal between India and US or a mini trade deal before the 1st of August looks unlikely as of now. In fact, the possibility is likely to be ruled out altogether. This is because the talks between India and United States are stalled on certain key issues. Number one, US President Donald Trump has offered a deal to India which is very similar to Indonesia and Vietnam. And India wants a competitive advantage over these countries and not a tariff arrangement on similar lines. Number two, the deal is also stalled because the US government wants to impose a 20% tariff on Indian goods coming into America. On the other hand, they want zero tariff duty treatment in the Indian market for American goods. This is not acceptable to the Indian side because we want the deal to be a win-win and a reciprocal deal. Also, on agriculture and dairy, we believe that the US administration is still pushing for the inclusion of agriculture and dairy items in any kind of trade deal or understanding before the 1st of August. And India will not compromise on these issues. These are red lines in any trade negotiation. Therefore, currently the Indian side has refused to have any further negotiations, at least this month. Talks will continue for a larger bilateral trade agreement. A US team headed by their negotiator Brendan Lynch will be coming to India in August to try and see if there can be a breakthrough in talks with India. For the moment, there is a 10% baseline tariff that the US has imposed on Indian goods, apart from sectoral tariffs on automobiles, on steel and aluminium. It remains to be seen whether the US will impose a 26% reciprocal tariff on India come the 1st of August if a trade deal before that is not agreed upon.
Parikshit, many thanks. Now, in what would bolster India's arsenal, the Army has received the first batch of the Apache fighter helicopters from Boeing. In a post on social media, the Army said the induction of the Apache attack helicopters will significantly boost its operational capabilities. It is the end of an era for the MiG-21 fighter jet. After more than 6 decades in service, the combat aircraft will be formally retired in September with a ceremonial farewell. The aircraft played a vital role in the 1965 Indo-Pak War, the 1971 Bangladesh Liberation War, the Kargil conflicts of 1999 and the 2019 Balakot airstrikes. The MiG-21 squadron was also alert during Operation Sindoor, so it's a goodbye to the old war horse. The British Royal Navy's F-35B fighter jet, which was stranded in Kerala for over a month, flew out of Thiruvananthapuram airport this morning. The fighter returned to the skies after being repaired by a team of engineers from the UK. The stealth jet was forced to make an emergency landing after a hydraulic fault and power issues forced it to divert from its carrier, the HMS Prince of Wales. The aircraft will now fly to a British aircraft carrier in Australia. The big corporate story: in a sudden move, Anup Saha has resigned as the MD of Bajaj Finance with immediate effect. Sources have said that it is premature to assume that Saha's resignation is linked to the top job at IndusInd Bank, where he is one of the contenders. Ritu joins us now with the details. Ritu, Saha is one of the 3 names that the RBI is looking at this point in time, but it would be premature to assume that he does get the top job at IndusInd.
Well, our sources indicate it may be too early to assume that Anup Saha resigned from his position as the MD of Bajaj Finance to take over the top job at IndusInd Bank. Remember, we were the first to report that Anup Saha is among the 3 candidates who are in the running for the IndusInd Bank CEO role. And while his name being in the mix may have had some bearing on internal dynamics at Bajaj Finance, we understand RBI is yet to clear a name for the IndusInd role. So the idea that he quit specifically to join IndusInd may be a bit premature. But that said, the resignation itself has come as a surprise, given he was being groomed for the position for the last couple of years and only took over as the MD in April, and so him quitting the role in just under 4 months has raised some questions. Equally important is the fact that Bajaj Finance's long-term MD Rajiv Jain is back at the helm, and he's going to serve as the MD for the remainder of his term until March of 2028. Now, while this will provide a smooth transition for Bajaj, the focus will also move to succession planning. Now, remember, Rajiv Jain has spent more than 15 years as the MD of the company, and while RBI rules limit bank CEO terms to 15 years, there is no such cap for NBFC, so technically he can continue, but the company will still be under pressure to groom the next line of leadership. Now, Jeffries points out that Rajiv Jain may now need to pull back from any advisory role at Bajaj Finserv, and Morgan Stanley calls this a setback to the succession plan that the company had been executing. But with Rajiv Jain back in the driver's seat, they say the situation remains manageable.
Thanks very much, Ritu. Another CNBC-TV18 exclusive this evening. Axis Bank eyes an additional 10% stake in its life insurance joint venture with Max Financial Services. It may seek RBI approval to acquire stake, which will help Max Financial raise 5,000 crore rupees. Axis Bank will become the promoter of the company if the deal goes through. Shares of Tilak Nagar Industries rallying in trade today. This after CNBC-TV18 reported that the company is leading the race to acquire Pernod Ricard's whiskey brand Imperial Blue. Sources add the deal is likely to value Imperial Blue at around 4,000 crore rupees. The acquisition is likely to be funded by a mix of debt and equity. As of FY25, the company has a cash balance of 107 crore rupees. Tilak Nagar Industries and Pernod Ricard have not responded to CNBC-TV18's query yet. Shares of Titan surging after its subsidiary signed a definitive agreement to acquire 67% stake in UAE-based Damas Jewelry. The deal is valued at $283 million and is expected to be completed by Jan 2026. The acquisition paves the way for Titan to expand into 6 GCC markets, including the UAE, Saudi Arabia and Qatar. The big national story, Vice President Jagdeep Dhankar's surprise resignation last evening on the very first day of the monsoon session has created a flutter in the corridors of power. Now, Dhankar still has 2 years left in his term. In a letter addressed to President Murmu, the former Vice President says he will be resigning as Vice President with immediate effect to prioritise healthcare and to abide by medical advice. Sources say tensions with the government over Dhankar backing an opposition motion to impeach Justice Yashwant Verma over the cash-at-home row could have led to his sudden exit. Dhankar is the first Vice President in close to 40 years to resign mid-term. Before him, B.V. Giri and R. Venkatraman had resigned as Vice Presidents as well, but only to contest the presidential elections. In a 24-word statement, Prime Minister Modi said, and I quote, Jagdeep Dhankar ji has got many opportunities to serve our country in various capacities, including as Vice President of India, wishing him good health, end of quote. Opposition leaders raised questions over his surprise resignation. Congress President Mallikarjun Kharge said, and I quote, only he knows the reason. We have nothing to say on this matter. Either the government knows or he knows. It is up to the government to accept his resignation or not, end of quote. Dhankar's 5-year tenure was originally set to end on August 2077. Just 10 days ago, Dhankar had also said that he intends to complete his term barring, and I quote, any divine intervention. Take a look.
I will retire at the right time. August 2027. Subject to divine intervention.
हम उनकी अच्छे स्वास्थ्य की कामना तो करते हैं, लेकिन कहीं ना कहीं ऐसा प्रमाण होता है कि केंद्र सरकार और उपराष्ट्रपति के बीच में जो उनका रिश्ता है दोनों के बीच में वो पहले जैसा नहीं रहा.
Vice President, we wish him the best of health, but a little more elaboration on the circumstances which have led to this decision. Even though it might be a personal decision, but since he holds a public office and there are 146 crore Indians who would be equally interested and invested in knowing the facts, a certain amount of elaboration will help.
दुखद है, दुर्भाग्यपूर्ण है, चौंकाने वाला है. मैं उनसे आग्रह करूंगा वो पुनर्विचार करें.
So Vice President Jagdeep Dhankar has resigned. His resignation has also been accepted by the government. The Prime Minister has put out a statement commending the contributions of Jagdeep Dhankar in various positions. But what is the inside story? Is it that the government was upset with him yesterday after he accepted the impeachment motion moved by 65 odd opposition MPs? And did Mr. Dhankar not keep the government in loop about this particular impeachment motion? Remember, senior ministers like JP Nadda and Kiran Rijiju subsequently did not attend the BAC meeting called by Mr. Dhankar at 4:30 p.m. Though now Mr. Nadda and Mr. Rijiju both have said that a message was sent to Mr. Dhankar that they were busy. But this is a surprise series of events. Mr. Dhankar had just spent about 3 years in this post, and his resignation with immediate effect, which he has written to the president and which has now been accepted, throws open a host of speculations. Was he getting too friendly with the Congress leaders? Was he giving them the extra, benefit sometimes? It is a complete change of the situation, because just a few months back, the Congress had moved an impeachment motion against Mr. Jagdeep Dhankar in December 2024. What changed completely in the next 6 months, where now there is hushed talk in the parliament corridors that he was being soft, maybe on being too friendly with the Congress leaders. He had met Mr. Mallikarjun Kharge at the VP estate some days ago. Arvind Kejriwal he had met at his residence on Sunday. What has really happened remains under wraps, but it is one thing is very, very clear, that Mr. Jagdeep Dhankar's resignation has come as a surprise and a shock to many, and he is hung his boots just 3 years into his tenure.
Well, that seems to be leading to more speculation on what resulted in that immediate resignation of the Vice President of India, Jagdeep Dhankar. Proceedings of the monsoon session of Parliament disrupted for the second consecutive day. Both houses were adjourned as opposition members held protests demanding a discussion on the voter roll revision in Bihar. Opposition parties also sought a discussion on Operation Sindoor, President Donald Trump's statement on the ceasefire, and the Air India plane crash in Ahmedabad. Opposition leaders also protested in the Bihar Assembly against the voter list revision. The leaders hitting out at the Prime Minister and Bihar Chief Minister Nitish Kumar for allegedly trying to remove voting rights of the people ahead of the Assembly elections. We will head into a break, but up next, India's startup airlines are struggling to take off. Air Kerala, Al Hind Air and Shank Air neither have any aircraft nor a flying permit. More details when we return. The death toll from the crash of a Bangladesh Air Force jet into a school building in Dhaka has now risen to 31, 25 children there. About 170 have been injured in the incident. As per a statement issued by the Bangladesh Air Force, the training fighter jet experienced a mechanical fault moments after takeoff. Israeli forces continue to pound Gaza. More than 60 Palestinians, including 11 aid workers, have been killed in the last 24 hours. Tanks were seen tearing through the southern and eastern districts of the enclave. The foreign ministers of 25 countries have called for an immediate ceasefire, saying suffering in Gaza has now reached new depths. Ukrainian President Zelensky has said that Russia and Ukraine will hold a new round of peace talks in Istanbul tomorrow. However, Moscow has not commented on the scheduled peace talks. The 2 rounds of peace talks that took place in the city in May and June led to a series of prisoner exchanges. This comes as Russian forces struck 3 Ukrainian cities in overnight attacks, killing a child and wounding at least 24. Geeta Gopinath will step down as the Deputy Managing Director of the IMF in August. In a statement, the IMF has said she will return to Harvard University as a professor of economics. IMF's Managing Director Kristalina Georgieva said that Geeta Gopinath's replacement will be announced in due course. Gopinath joined the organization in 2019 as its first female chief economist and was elevated to the Deputy Managing Director in 2022. Swedish furniture retailer IKEA has named Patrick Antoni as the CEO of its India operations. Antoni will take over from August this year. He will also take over as country retail manager and chief sustainability manager. Antoni has over 2 decades of experience at IKEA and previously served as deputy CEO of IKEA India. He will replace Suzanne Pulver, who stepped down after 28 years with IKEA. Air India says it's concluded precautionary checks on its fuel switch in all of its Boeing 787 aircraft fleet. The airline has confirmed that no issues were found in the locking mechanism of the switches. Air India said it started the inspections on the 12th of July, a month after the Air India plane crash, and completed it within the prescribed time. Now, India's startup airlines are struggling to take off. 3 carriers, Air Kerala, Al Hind Air and Shrunk Air, got their regulatory approval from the Civil Aviation Ministry in 2024, and they were hoping to launch by the middle of 2025. But months later, none of them have inducted even a single aircraft, and their air operator certificates remain out of reach. Madhiya is standing by to tell us what's delaying their takeoff. Madhiya.
Well, according to DGCA sources, Air Kerala, Al Hind Air are in the phase 3 of their certification process, where manuals and operational documents are being evaluated. Shrunk Air, meanwhile, is yet to even submit a formal operational plan. The big roadblock is finding a plane. Until these airlines bring in at least 1 aircraft, they cannot move to phase 4, which is demonstration flights, and ultimately move to the last phase of certification and securing the air operator permit. So why are they struggling to get a plane? Foreign lessors are reluctant sending their aircraft to startups in India, fearing their plane will be stuck here if the airline fails to survive. And this reluctance is due to past disputes involving aircraft repossession and weak enforcement of the Cape Town Convention. The Cape Town Convention, remember, is an international treaty that protects aircraft lessors. It ensures they can quickly take back their planes if an airline defaults or shuts down. Go First's bankruptcy is the recent example where lessors had to move the court to take their aircraft back, despite India being a signatory to the Cape Town Convention. A senior official at one of these startups told CNBC-TV18 that lessors are asking for massive deposits, sometimes 12 months of rent upfront, or proof that the airline has about 200 crores in the bank. The delay in securing planes is not the only headache. These startups have also hired employees for the key positions like CEO, CFO, head of security, head of safety, pilots, cabin crew. The official told us they're incurring a cost of 1.5 crores a month on salaries and overheads, and there is no clarity when they will start flying. Now, Air Kerala and Al Hind Air had earlier told CNBC-TV18 about starting operations with ATRs that are 70 to 80-seater aircraft, and then bring in the narrow-body planes like the A320 or the Boeing 737 MAX to eventually focus on the Gulf routes. These airlines had targeted mid-2025 to commence operations. As the official told us, the AOC process, the Air Operator Certificate process, can't move forward without aircraft, and lessors are reluctant to be the first ones with a new Indian carrier. And with half of 2025 done, will these airlines take off in 2025 at all? That's the big question.
Well, that certainly is the big question, and we don't have the answers just yet. Madhiya, many thanks for joining us. Torrential rains and landslides in Himachal and Jammu and Kashmir have claimed at least 4 lives. Over 400 roads were blocked across Himachal, with Mandi district bearing the brunt. The IMD has stated the intensity of the torrential rains across Himachal is beginning to decrease and is expected to stabilize by Wednesday. Now, the Supreme Court has begun hearing a rare presidential reference made by Draupadi Murmu, the President of India, concerning the powers of the President and governors. President Murmu had made the reference following a Supreme Court order that prescribed a timeline of maximum 3 months for the President to consider a bill referred by a state's governor. Ashmit is here with more on the Apex Court's direction to the centre. An unprecedented move, Ashmit. Take us through what the Supreme Court has said.
Well, the Supreme Court is clearly saying that this is a matter which will have sweeping implications across states, and therefore asking for opinions coming in from all states on this matter. Now, it all began with opposition-ruled states, the likes of Tamil Nadu, Kerala, Punjab, raising the question before the Supreme Court in multiple petitions against their respective governors, saying that these governors are blocking state legislation by sitting on bills indefinitely. Taking note of these matters, in one particular case involving the state of Tamil Nadu, the Supreme Court had given a sweeping judgment whereby it directed the governor as well as the President of India to decide on these deferred bills in no more than 3 months. That's a 3-month deadline that the Supreme Court has prescribed. Now, that is what led to a big backlash. In fact, the now former Vice President Jagdeep Dhankar had slammed this decision by the Apex Court, at one point even referring to the special powers under which the Supreme Court had acted, calling it a nuclear missile against democratic forces. So that was the nature of backlash that the Supreme Court had seen. And then subsequently, we saw President Draupadi Murmu make a presidential reference to the Supreme Court, which is basically in the nature of asking the Supreme Court on an issue of legal, a complex legal issue was raised. A number of questions. It all boils down to whether or not the Supreme Court can issue such a direction, can give a deadline to the President of India. That's the question that the Apex Court is dealing with. Now, a bench usually of no less than 5 judges hears such presidential references. Today was no different. A bench headed by the Chief Justice of India, Justice Gawai, he took charge of this matter. He's issued notice to all the states, asked them to come back with their response. The next hearing in this case will be next week on July 29th.
Ashmit, many thanks for joining us. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned. We're back in a moment with more.
Hello and welcome to Commodity Champions. I'm Manisha Gupta. Well, the precious metals have continued to gain amid uncertainty over the US President Donald Trump's tariffs as the August 1st deadline for trade deal nears. The gold prices have hit a 5-week highs, while the silver prices are trading near 14-year highs. A weak US dollar index, expectations of a Fed rate cut in September, and a growing central bank demand for gold is also supporting the precious metals. Some brokerages see gold prices hitting $3,800 an ounce in the fourth quarter of 2025. Meanwhile, the global demand and diamond prices are witnessing a sharp decline amid stiff competition from the lab-grown diamonds. To discuss the outlook on gold, diamonds, jewelry, I am now joined by Colin Shah. He's Managing Director at Kama Jewelry. Thank you, Colin, for being with us. And first of all, your sense on the gold prices itself, because barring Citi, which talks about prices at $3,000 an ounce by the end of this year, even declining further below, almost everybody else from Bank of America to UBS, JP Morgan, everybody's talking about 35, 3,800 and 4,000 in an extreme scenario as well. What is your, first of all, sense on the gold prices going forward from here?
Thanks, Manisha. My sense of the gold price going forward, like I've been saying, I guess, every week on your program, is that it's going towards 4,000. Maybe it's 6 months, 9 months, or a year down the line. But it's definitely going northwards, considering everything which is happening globally. Uncertainty continues, and even though there is a deadline of August 1st, by the looks of it, I mean, we're on the 22nd and doesn't seem like most of the major trading partners are anywhere near signing a deal. So the uncertainty is going to continue. There is going to be high tariffs again, 1st August onwards. And, I guess gold, silver, commodities will continue to go up, unfortunately. There may be slight corrections along the way as some other good news comes in. But all in all, it seems like we're going to continue in these uncertain times for the next 2-3 quarters for sure.
Colin, what is your sense then on the 9-carat hallmarking that has been now allowed by BIS? Does that tell you that, or does that tell us rather, that with the gold prices doubling in last 2 to 3 years, the demand could be shifting to not just lightweight but low caratages as well?
Yes, that'll happen for sure. See, I guess India, like any other market globally, is price point conscious. And 8, 9, 10 carat and 14 carat has been popular in the US and Europe for many, many years now. So it isn't new. India traditionally was a 22 carat market, which became 18. 14 did get a little more popular in the last couple of years. But with gold price going up 35%, I guess 9 carat will become a norm in the entry level price point jewelry, especially jewelry which retails between 10 and 25,000 rupees. So I think it's here to stay. It's a welcome step that hallmarking also has come in. And it did happen because there was a lot of retail demand for 9 carat. So this Diwali, I'm sure there's going to be a lot of 9K jewelry across the board.
There are some concerns, though, Colin, that 9-carat jewelry would be high on making charges because the wastage would be high. And then, of course, the kind of designs and the kind of making that you would be looking at perhaps could take the prices higher. What is your sense?
See, whether it's 9-carat jewelry or, the other caratages or platinum. See, in the end, it'll be at a price at which it's affordable for the consumer. So while I agree with you that the making charge may be higher in terms of percentage or a per gram basis, but still the relative price point of the jewelry will be quite low compared to 14 or 18, especially in today's gold rate. So there will be a benefit for the consumer from that point of view.
So what are you foreseeing then in the coming festival season, wedding season? How have you seen the month of July? Because this is the beginning of a new quarter and the beginning of a second half of this year as well. Is July more stable? Do you see August picking up even better?
See, April, May, June, the volumes were down significantly. But in value terms, most of the retailers made up, a slight growth over their last year numbers, in value terms. But volume was down. July, the first week was a little slow, but the last 2 weeks, it seems retail has picked up a little bit pan-India. So we are optimistic, with IIJS, our next, the big exhibition coming up end of the month. The trade is quite optimistic that season will be better than what they anticipated, say, a couple of months back.
Any number that you are willing to give out on the next couple of quarters, because that is where most of the action happens?
So the number, again, in volume terms, will be, I think, significantly lower than last year, because of the 35% price hike. So, but in value terms, we will see a 5 to 10% growth overall. So I think that's what it looks like right now, especially for a couple of reasons that I guess see a lot of, like, on your program and what's happening in the financial markets is luckily a lot of our, I guess, large companies and mid-sized companies have gone with IPOs on the manufacturing side and the retail side. Plus, on the lab-grown side, if you see, there's been a lot of private equity and venture capital, VC funding, which has happened. Now, with all the capital infusion which has happened in our industry, there's a lot of retail being set up across the country. And as the square foot for retail for jewelry is increasing, there is obviously an uptake even in demand for the manufacturers. So overall, the industry will also increase because there's so much more retail space being created.
Colin, coming on the diamond side as well, and the last couple of years we've been talking constantly about it, haven't been so great. It's been a slowdown. For the year 2025, the push from the natural diamond as an industry has been huge, not just in the Indian markets, but globally, with accords being signed, with monies being pooled, and the kind of campaigning and marketing that we've seen as well. On ground, what is the kind of conversion that you have seen till time?
See, what we are seeing, I think last year was maybe when natural hit rock bottom. I would like to believe that, most in the industry believe that, it was maybe at its lowest point in terms of pricing and consumption. But this year, if you look at the January to June results of even the luxury brands like, LVMH or Van Cleef, on the jewelry side, okay, they've all had a 10% growth this year. So it seems like, especially on the luxury side and the natural diamond side, 25 will be a much better year than 24 was. So it seems even we'll see a little, I guess, increase in pricing, especially on the smaller goods come Diwali, because there is a shortage in certain sizes and certain clarity, especially what works in the luxury end and on the Asian side. And I guess with all the promotions, like you said, which are happening between the Natural Diamond Council, De Beers, the miners, retailers, I guess we will see a much, I think, positive season compared to last year.
A final word on platinum, really, because that also seems to be making news and doing well. Do you see a considerable demand shift in sense of jewelry for platinum, or do you think it continues to be minuscule, and within that you could be looking at some gains?
See, as an overall percentage of the pie, platinum is a smaller percentage compared to the overall gold business. But we must not forget that even the number of tons being mined in platinum are relatively smaller compared to gold. Having said that, platinum has built a significant niche for itself on the Indian side. The prices have appreciated quite nicely in the last 5-6 months. So I guess the consumer, which did not see much appreciation compared to gold in the last couple of years, is seeing that on the platinum front. Another big shift we are seeing is that men in India are leaning towards platinum in a nice big way because of all the promotions that PGI has done, especially with the cricketers. And I guess now this is here to stay. So the men's category will predominantly be platinum across India. And as men are buying more and more jewelry, which they are, whether you see the Met Gala or even globally, the trend is that men's jewelry is like a trend this year, and it will continue. So I guess as the men's jewelry category increases, the platinum consumption also in India will increase significantly. And the customer which was looking for appreciation has seen it this year. So there's a certain amount of optimism and positivity that we're seeing around that category, which will definitely help the platinum consumption come this Diwali.
All right. So when it comes to gold and diamonds and lower caratages and the numbers and platinum, men buying more jewelry, it all does look positive as we get into the festival season that kickstarts from the first week of August. Colin, as always, thank you so much for joining in, giving a sense on your prices and, of course, the trends in the Indian markets therein as well. Well, on that note, it's time for a short break, but don't go anywhere. The discussion continues when we return. Welcome back. You're watching Commodity Champions, and from gold and diamonds to lab-grown diamonds, and that also continues to make a lot of news. We are now joined by Smith Patel. He's director at Green Lab Diamonds. Smith, hi, thank you so much for joining in. Well, as Colin was telling us before the break, that 2024 perhaps was a rock bottom when it comes to natural diamond prices and consumption as well. Within that period, how would you say that the lab-grown diamonds have performed, and how has 2025 been for you till time?
Perfect. Manisha, the lab-grown diamond has seen a trajectory growth in terms of caratage since the past few years, like you know. Of course, there has been a price correction that has taken place, but the positive figures are that in 22-23, 4.3, India exported 4.3 million carats. In 23-24, it was 7.32 million carats. And last year in 24-25, it was 15 million carats. So that's almost double of carriages that has been exported from India every year. And I'd also like to say the past 2 months, like I told you, in 22-23, it was 4 million in the whole year. In the last 2 months, we hit 4.5 million carats of net exports from India. So that is a very positive sign, showing that like everyone in the world, they have started to accept lab-grown diamonds. And like we have spoke about earlier, like the creativity and the designs that have been exported from India, especially in the studded jewelry market. 2 years ago, we exported $400 billion worth of jewelry that is lab-grown studded. And last year, we hit $1.1 billion. So that trajectory shows that the acceptance of lab-grown diamonds around the world is also increasing. And it's a very positive sign for the whole economy and the artisans that work in this industry for sure.
Smith, what is the sense on prices from here? Because a lot of people tell us that we perhaps have seen the bottom here as well. From here on, it perhaps could be consolidation, even some gains. Yes. What's your own sense?
So when this industry started, there were very few suppliers of this industry, and people did have an early movers advantage where they could charge according to the demand. Now, because there is no sense of monopoly and the technology has increased, it has become a cost plus kind of a situation where companies are adding value in their verticals by perfecting the art of cutting and polishing, by creating new designs, by adding value in different verticals, and then surviving or even thriving. So that has been a very healthy environment. I would like to say the industry is in right now. The price correction did leave everyone in a little sense of panic, but after it has stabilized, we see a potential of growth. And the caratage that has been exported are a positive sign of that.
What about the Indian markets then? Because we did see a pickup here as well. I mean, I remember speaking to IGI not too long back, which they said that Indian penetration, Indian demand seems to be on the stronger side, especially for high caratages. How have you read the Indian market till time?
The Indian market overall is a very positive sign. I would like to say that because a lot of companies, like Colin mentioned, that there is a lot of retail space that is opening for particularly lab-grown diamonds. We have seen investments of up to $15 to $20 million that companies are getting to expand their retail space around India. And those companies are, of course, they are, adding a lot of value to this industry by creating unique designs and allowing customers to buy things that they had never seen before. So we see a lot of positivity in the Indian market. The mom and pop stores that have been selling gold jewelry and in traditionally gold jewelry, they've been adding value to their products by introducing a little bit of lab-grown diamonds, which has shown positive results. So we expect in the coming IIJ show that a lot of these retailers are going to start thinking of adding a lot more lab-grown diamonds to offer to their consumers.
Smith, IIJS is one part of it, but we do understand that GCK, Hong Kong show, I mean, the interest or the buying enthusiasm around lab-growns has been quite positive.
Yes, around all countries, I would like to say, for the first time, we've seen a 30% market share in the UAE exports as well, which we had never seen. It was always 15%, and last year we saw a 30% jump in the Middle Eastern market. So that has been a positive sign. The JCK market, we got customers from around the world, not only the US, which is already doing well in the lab-grown space, but countries around Americas as well, where people are coming and seeing designs, they're introducing lab-grown diamonds to the majors. We've had a very positive show, both JCK and the Hong Kong, and hopefully even the IIJs in the future will be as positive.
Smith, what is the best growing market right now when it comes for lab-growns? What is the best caratages that seem to be doing well?
I mean, US is still the largest market for us, but the positive sign is like countries like Middle East, they turned from 15% in the year 23-4 to 30% last year. So that is showing that people in that region is also accepting lab-grown diamonds, and of course there's a different kind of merchandise mix per se. They are preferring larger stones. They want heavier designs than the America. So there are two different markets. The niches are different, but they are both moving positively.
And what caratages seem to be doing better? And just to get a sense right now, Smith, what does a carat of lab-grown cost currently?
Right. So again, like I said, that the cost is value addition. It depends on the cut, purity, the color that people are offering, of course. So now it has become a design kind of a situation where all different companies that are incorporating their qualities can charge different prices. Since the prices are stable, cost is something which we really talk less about in this whole industry, and it is all becoming the number of quantities, the number of designs, the efficiency in which you can deliver to the customers, those kind of topics. Hence, it has become more healthier.
Smith, also with the way GIA changed its way of certifying naturals vis-a-vis lab-growns, how have you seen that conversation?
I mean, in the end, certification is a transparency to the end consumers. I personally believe that move is bringing in less transparency to the end consumers. So I'd like to congratulate companies like IGI and GCal who are increasing their parameters of grading lab-grown diamonds. We would like to say that if the stones are getting better, you don't stop grading them. You add parameters where consumers are even more transparently understanding what they are buying. And that's the initiative these other labs are taking. And we are looking forward to working with them and seeing how they encourage the consumers to buy better products, to buy graded products and trust what they're buying.
When it comes to the whole gamut of industry, how are you looking at the festival season as well? Because we've seen gold also go down on lower caratages. Gifting is in, festivals are in, and then of course we'll soon be getting into the wedding season as well. So what are you planning? What are you launching? How's work with you?
So, we have our retail space, ICICI, that is doing really well. We have already opened 4 retail spaces in Delhi, in Hyderabad, Bangalore, and Jaipur. And we are going to expand more. And what we are seeing is the consumers are loving the lab-grown products because they can buy so much bigger for a less value per se. And, this is truly Sone Pe Suhaga. As the gold prices are rising, adding a little more diamond to the design, making it a little heavier. The brides are happier and we see a positive sign. Hence, we are expanding our manufacturing capacity. We will be double the size of what we are by the time we speak the next year.
All right. Oh, I hope, Smith, we speak before that as well. But clearly, the kind of numbers that you've shared with us in sense of export of lab-grown clearly have been doubling. The prices are more stable right now and the demand and penetration, of course, on the higher side. As always, thank you so much for joining in, Smith, and weighing on the lab-grown diamond space there. Well, with that, we'll move ahead. And remember, Tanishq has partnered with De Beers Group to launch India's first Tanishq Diamond Expertise Center. The facility introduces in-store diamond evaluation technology aimed at enhancing transparency for consumers. The move comes amidst Tanishq's push to boost the natural diamond segment. I caught up with Amit Pratihari, MD of De Beers India, and Ajoy Chawla, he's CEO of Tanishq, on the sidelines of the event and started by asking them about their strategy behind the move.
Actually, diamonds has been Tanishq interest for the last 25 years. Currently, with the rising prices of gold and the significant amount of narrative confusion in the market around natural and lab and prices of diamonds, we felt it is important that we need to educate customers and empower them. Let them know what they are buying and let them understand the value of what they are buying and how do they distinguish the natural from the lab and how does she figure out, go beyond the 4 Cs and what is the sparkle and the story behind diamonds. So that's the purpose of doing this.
Second half, Amit, how does that look right now? Because we do understand that a lot of work is being done. The first half was kind of okay, but the second half really matters now. What are there any projections that you guys are putting out in sense of demand, sales, with all this work that is happening? How are the conversions looking like?
I think second half is quite optimistic view what we have, because if you look at the Diwali, Dhanteras, it goes up till Jan, Feb, till next year. I think that is the high value months, I would say. And our partnership with Tanishq is quite clear how our approach we're looking for India particularly. India is no more a well-kept secret. It is everybody's aware that India is growing, economy is growing. We expect another India getting added up in next 5 years. We're a $4 trillion economy. By 2030, it is going to be almost $7.9 to $8 trillion economy. We see higher disposable income. And when you come to jewelry segment, the projection decent Deloitte report it is saying from $90 billion in 2025, it is going to be $235 billion by 2035. And diamond share, in spite of we are selling diamond for almost many years or century, still the diamond penetration is below 15%. So I think what partner we can get better than Tanishq? They are the market leader, they're jeweler for India. They have a good share of diamond. I think this partnership is to bring transparency and confidence in the chaotic world what currently we are living with, making sure that the customers are more confident about what they buy.
Ajoy, how concerned are you with the lab-grown diamond steep rise that we have seen? Has the disruption being dusted with, and the market's back now?
No, I think we are at a very early stage of the diamond market in the first place. And within that, lab-grown is a recent phenomena in India. So it currently is probably less than 2 to 3% of the overall diamond jewelry. We think the natural diamond market has a lot of promise, given that the penetration is so low. And given that India is one of the fastest growing natural diamond markets for the world. We are now the second largest market and growing at a very rapid clip. So for us, the natural diamond story is just beginning to play out. And we believe that lab is a different segment and it may hopefully bring in more customers into the category. But natural itself is a very big story that we think is a very important piece.
So Ajoy, when it comes to credibility, you're working towards that, and trust and awareness and certification, etc. Would you say that, what percentage would you put when it comes to Indians that are being aware of that?
Very few. I can tell you that even amongst diamond buyers in India, there is a lot of confusion. Many of the people who buy from us, they say we buy because you're Tanishq and you're from Tata. But now we want to tell them, don't take our word for it. Come to the expertise center, let a trained gemologist explain to you what it is so that you're buying with full knowledge and empowerment and awareness. And there are so many others who are out there who are probably aspiring for diamonds but are very confused where to go. How do I know this is real? And how do I know that I'm not going to be fooled into something which is maybe, under the 4 C's, it should be the sparkle in the diamond which should stand out for her. So we think it's a great opportunity, and we believe that the launch of the Tanishq Diamond Expertise Center will not only build empowerment, but will also strengthen the trust, not just in Tanishq, but in the category of diamonds.
Another thing that the consumers are quite confused about really is the prices. Where do we stand there?
So I think pricing is more to do with B2B. I think retail prices are still holding strong. And we are already seeing an early sign that prices at the B2B segment, it is already holding and getting stronger in certain segments. So I'm not worried about the pricing in terms of a long-term view. I think we're quite optimistic that these prices will going to be stable and strengthen forward.
I'll wind this down with one final question. Second half, any more launches coming in, new themes?
There will be, but for us only one quarter is over. So we still have 3/4 of the year still there, and we have just begun the year. So I wouldn't say second half, I would still say we have 9 months of the year to go. And it's a silent period, so I can't say more. Thank you. So much. Thanks, Manisha.
All right, well, that's Tanishq and De Beers telling us that the season is just about begun, and they're looking at very strong numbers coming in the second half, higher value months these are, and they're expecting that the natural diamonds industry will continue to see more penetration into the Indian markets. But with that, that's all the time that we have on Commodity Champions. Thank you for watching.
Hello, welcome to News Center. I'm Parikshit Luthra. Vice President Jagdeep Dhankar's surprise resignation late last evening on the very first day of the monsoon session has created a flutter in the corridors of power. Dhankar still had 2 years left in his term. In a letter addressed to President Draupadi Murmu, Dhankar said that he will be resigning as Vice President with immediate effect to prioritize healthcare and to abide by medical advice. Sources say tensions with the government over Dhankar backing an opposition motion to impeach Justice Yashwant Verma over the cash-at-home row could have led to his sudden exit. Dhankar is the first vice president in close to 40 years to resign mid-term. Before him, V.V. Giri and R. Venkatraman had resigned as vice presidents as well, but only to contest the presidential election. In a 24-word statement, Prime Minister Narendra Modi said, and I quote, "Jagdeep Dhankar ji has got many opportunities to serve our country in various capacities, including as the Vice President of India. Wishing him good health." End of quote. Opposition leaders raised questions over his surprise resignation. Congress President Mallikarjun Kharge said, and I quote, "Only he knows the reason. We have nothing to say on this. Either the government knows or he knows. It is up to the government to accept his resignation or not." End of quote. Jagdeep Dhankar's 5-year tenure was originally set to end on August 2027. Just 10 days ago, Dhankar had said he will complete his term, barring any divine intervention.
I will retire at the right time. August 2027. Subject to divine intervention.
हम उनकी अच्छे स्वास्थ्य की कामना तो करते हैं, लेकिन कहीं ना कहीं ऐसा प्रमाण होता है कि केंद्र सरकार और उपराष्ट्रपति के बीच में जो उनका रिश्ता है दोनों के बीच में, वो पहले जैसा नहीं रहा.
Vice President, we wish him the best of health, but a little more elaboration on the circumstances which have led to this decision. Even though it might be a personal decision, but since he holds a public office and there are 146 crore Indians who would be equally interested and invested in knowing the facts, a certain amount of elaboration will help.
दुखद है, दुर्भाग्यपूर्ण है, चौंकाने वाला है. मैं उनसे आग्रह करूंगा वो पुनर्विचार करें.
To take this forward, we are now joined by Ratan Sharda, political analyst, Sandeep Shastri, national coordinator of Lok Niti with us, Manisha Priyam, political analyst. Thank you very much for joining us. Sandeep Shastri, if I can begin with you. Jagdeep Dhankar accepting an opposition-backed motion to remove Justice Verma. Do you think this was the only issue which perhaps may have led to his ouster, or do you think there's more than what meets the eye?
Parikshit, if one were to read between the lines, I think there is much more to the issue. Past history of politicians in India shows that when they are not in good health, power is what keeps them in good health. We have had people who are not in good health coming to power and then improving their health tremendously. So I think there are possibly a range of factors which have come in the way of, have been responsible for the former vice president to have taken this decision. And this is the first time it's happening in the history of the Indian vice presidency that a vice president resigns on health grounds. And it's a little difficult to buy that as the total argument. Now, health may have been the final factor, but I think there are a range of factors which could include his not so healthy relations with the opposition, the possible embarrassments that the frequent face-offs with various institutions that he had during his vice presidency. I think all these factors combined together and could have caused this, because even yesterday, if you see, he had a range of regular programs and then within an hour he takes this decision. So I think there is much more than what actually meets the eye when it comes to his decision to resign as vice president.
Right. Manisha Priyam, yesterday we saw how union ministers, Kiran Rijiju, also JP Nadda, did not attend the 4:30 p.m. meeting of the Business Advisory Committee. We believe that Jagdeep Dhankar was upset for these two leaders not being there. At the same time, we also saw a high-level meeting being chaired by the Prime Minister where top union ministers were present. They were discussing important parliament-related issues. What do you think may have led to things going absolutely south in a couple of hours?
So, one can talk about many reasons and behind the scenes, etc. I always believe that something as dramatic as this, when you have a very important session of the Parliament of India, this was the first session after the tragic incidents at Baisaran in Pahalgam, after our war with Pakistan, after Operation Sindoor. And so this was not an ordinary session of Parliament. It would not have been that much of a surprise for me had the resignation been taken or tendered ahead of the session convening. But on day one, when the erstwhile Vice President had presided over the opening session of the Rajya Sabha, and all eyes of the country were on what was going on in the two houses of Parliament, in the Lok Sabha and in the Rajya Sabha. At the end of the day, at the end of a day of business, then to have seen the resignation, I think all eyes will be on what went on inside the House as the most important circumstance leading up to the resignation. And I do believe that the leader of the opposition, Mallikarjun Kharge, standing up and raising the issue of Operation Sindoor and asking for information to be placed to be reposed in the House of Parliament in the Rajya Sabha as he was speaking. And you saw the way Minister Jagat Prakash Nadda, who's also the leader of the House, rose up to counter, which it is his right. These are, remember, two opposing parts of the political divide. But I think there was something in there in that, conversation or interaction or debate or skirmishes between the opposition leader in the Rajya Sabha and the leader of the ruling party. And that definitely was something where you saw that the role of the chair itself was diminished, especially as the minister made the comments that his remarks would be taken on. Now, this may add up and stitch up with much more that may have gone on. Remember, the Business Advisory Committee is not something that happens in front of the eyes of the people of India. It's not open for us. We only read about it or hear about it. But I think there was something in there. There may have been many things that may have upset, Dhankar, or that may have upset the government. But there were many things that Dhankar had done, which definitely supported this government. In his role as the chair of the Rajya Sabha, he definitely kept the opposition in a tight leash, kept debates moving, especially as per the advice of the Business Advisory Committee. So now then, to look at this may have been at fault, or the parliamentary affairs ministers were not taken into confidence, and that the issue of the leading members of the judiciary being put under parliamentary scrutiny was coming up. These are all explanations. These are all in the realm of possibilities where Jagdeep Dhankar may or may not have taken a stance, but it does seem that it's been an exit of a kind that has not been known in India's parliamentary politics, that on day one of an important session of parliament, at the end of closing day of business, the last line said by the Vice President were not those at the house of the Rajya Sabha, but those that he tweeted and the letter that he sent to the Honorable President of India. And that's what the people of India will continue to wonder about. But at the moment, of course, we think of many reasons, and here many of us, our colleagues,
and Manisha Prem, and I'll put this question to Mr. Ratan Sharda. Ratan Sharda, Prime Minister saying Jagdeep Dhankar got many opportunities to serve the country in various capacities, including Vice President. We wish him good health. And the Prime Minister's statement came more than 12 hours later after Jagdeep Dhankar put up his resignation letter. This clearly shows that something was wrong, and even the Prime Minister was sending out a message.
Parikshit, I would tend to agree with you that things are not as straight as being put up. There was some conflict somewhere, both on the opposition side as well as on the ruling side, because Modi ji generally is very gracious and very elaborate in his praise. But in this case, it is quite cryptic compared to his otherwise very open-hearted compliment to people. So probably something that happened suddenly didn't go well with Modi ji. Maybe he was not the reason. Maybe he faced the consequences of something else that happened. But I would like to say that when you say that health-wise politicians improve, Mr. Dhankar's job was not very easy. It was very, very, very stressful. We have never seen a more boisterous and more disruptive opposition in the last 8 years of the Indian Parliament. And in the numbers, they are quite as good as the NDA front in Rajya Sabha. So never let him in peace. It was they threatened, they impeached him, they called him names, they never heard him. Small issues are blown out of proportion. He was ridiculed on the steps of the parliament. All these things actually would take toll of any person, however healthy he is. So I think there is a grain of truth in his health. And as I said, the beginning of the parliament, the session, his sudden realization would have disturbed people. But I think health could be one of the causes because nobody has faced such a hostile opposition sustained for many years. Right. Nobody has been abused that way. Okay. But things will come out slowly.
Mr. Sharda,
not do much of a kind.
Right. Let's move on to the other question that comes next. Who could be the candidate, the lead candidate for the vice president's post next? A lot of speculation about Nitish Kumar, speculation about Rajnath Singh, JP Nadda, Nitin Gadkari, even Shashi Tharoor for that matter. These are all names that are doing the rounds in the media, in political circles. What do you feel on who could be the likely contender for this post right now?
It's for me.
Yes, Mr. Sharma.
Well, actually, only lesson that people have learned in last 11 years of Modi ji's term is not try to outguess him. So even guessing what he will do next about this would be making myself look very foolish. So I would not guess. Anything is possible. I can simply rule out people like Rajnath Singh and people like Nitish Kumar, surely because nobody like to disturb the equation in Bihar at this delicate moment when the opposition is sparing, ready for a fight and is all feeling very alive and very alert. So they would not like to disturb that particular piece. Then Rajnath Singh is doing fantastically well as a defense minister. And there are not many good ministers in the cabinet. You could say, you could count them on your fingers. I don't think he will disrupt him also. So we can just keep on guessing, but I would rather stick to wait and watch.
Okay, wait and watch. Sandeep Shastri, what do you believe on how the BJP will come to the decision on who should be their candidate? Do you think it'll be something to do with the next set of assembly elections, especially Bihar?
Parikshit, you mentioned several names. I am sure all of them are praying that their names are not mentioned on television or on social media. Because one of the key factors in BJP decision-making is the surprise element. Nobody had spoken of Jagdeep Dhankar when his name came up for vice presidency. So, and this is true about Ramnath Kovind or Dhankar, quite a few cases. So I think there will be that element of surprise when it comes to who will be the vice presidential candidate of the ruling party. There will be several calculations. Some people argue the Bihar elections may be a key factor, but I think clearly Nitish Kumar, because of health reasons, is not going to be in the race. Neither is Rajnath Singh nor Nitin Gadkari because they are too important to be relieved from governmental responsibility. But I think there will be very serious political calculations, caste calculations, regional calculations, which will go into the BJP's choice.
Right. Manisha Priyam, final thoughts to you. Do you think that this exercise of choosing the vice president, election of the president, will also be followed up with the BJP parliamentary board meeting? Or are we likely to see the BJP parliamentary board meeting in the next few days where the BJP president would be chosen, where possibly we will see some sort of discussion on who could be the next vice president? There's been a lot of talk of cabinet reshuffle. There is a lot of speculation about all these facts, but how do you think things will pan out now?
One thing I can say that I don't think letting go of the vice president was an easy decision. Had it been an easy, premeditated decision, as I have held, it would have been done before this session of the parliament. but that it had to be taken at the 12th hour of day one of the monsoon session means that the decision had to be taken, and any discussions about who could be in his place will happen now. They will begin now. I don't think that the Bihar elections are that much of a consideration as far as the leadership of the Rajya Sabha is to go. I think it would be of foremost importance for the BJP to understand as to how they will maneuver the business of the Rajya Sabha, given the fact that this government is faced with, a slender lead with their coalition partners in the Lok Sabha. So I think what they will look for is deft political management to the advantage of the government, and therefore a very trusted person within the government, in my understanding, would be given the reins. The only other guess that I would like to hazard, and that's of my personal account really, I think the most important consideration will be deft and tight political management, flow management of the House. That will be my first thing. But the second part is obviously that the BJP has been going very high about women's political leadership. They've already put Draupadi Murmu, the President of India, as a woman political leader from disadvantaged social categories. But I think the other part could be that they could still hazard, given the fact that 2029 is going to be a women's bill-led election year for the BJP and for all of the political
parties. So you could
parties.
have a women candidate being pushed up. All right, we've run out of time, but thank you, Manisha, Priyam, Sandeep Shastri, Ratan Sharda for joining us on the program. We're taking a short break, but coming up, after 62 years, Indian Air Force will retire the MiG-21 fighter jets. A special discussion with Air Marshal Anil Khosla, former Vice Chief of Air Staff, when we return. Welcome back. You're watching News Center. It's the end of an era for the MiG-21 fighter jet. After more than 6 decades in service, the combat aircraft will be formally retired in September with ceremonial farewell. The aircraft played vital roles in the 1965 Indo-Pak War, the 1971 war, the Kargil conflict of 1999 and the 2019 Balakot strikes as well. The MiG-21 squadron was also on alert during Operation Sindoor. Joining us right now to take this forward is Air Marshal Anil Khosla, former Vice Chief of Air Staff. Thank you for joining us, Air Marshal Khosla. Let me begin by asking you, you've flown this aircraft. What do you think meant to fly this aircraft? How was it? And how did it really change the dynamics in the subcontinent when India acquired it way back in 1963?
Yeah, Parikshit, you have asked me 2 questions about the thrill of flying this aircraft, and secondly, how it made the difference in Indian skies. So going by the first, I've flown extensively. I've flown 1,000+ hours on this aircraft. And that was my first aircraft on which I became fully operational way back in 1982, I mean. So this aircraft flying was very, very exhilarating and thrilling. And having said that, it was demanding, very, very highly demanding, because this aircraft, if you see, is like a rocket. You know, if you see the shape of the aircraft, it's like a rocket with a slight amount of wings put on it. And that gave it a capability of accelerating very, very fast. So when you engaged or heat, it gave you a lot of thrill, and it gave you the kick in the the aircraft accelerating very, very fast. And that is what it was meant for. It was meant for air defense roles, where it could accelerate very fast, it could achieve very high speeds, and it was a second generation aircraft where it could go up to Mach 2. And the biggest thing in this aircraft was that you have to be always with it. That means it needed a lot of skill, it needed a lot of presence of mind, and it needed total concentration to fly this. And the most thrilling part was the way you could throw it around during combat. Those days were the visual combat with guns and small missiles, short-range missiles. Okay, that was about the flying part of it. And as you said earlier, it was inducted into the Indian Air Force in 1965, around that time. And after that, it became a mainstay. At that time when it was inducted, it was the first supersonic aircraft jet which was inducted into the Indian Air Force, and much needed, because our adversary Pakistan was already flying F-86 and American supplied F-104, these two aircraft. And at that time, it made a lot of difference in the Indian Air Force capability as well as capacity to orchestrate war if required.
Air Marshal Khosla, I'd also like to ask you, were there points in the 1965, 1971 Kargil War where this aircraft was a game changer?
Yeah, so 1965 actually was too early for it to take any active part, because it was still being inducted, the training was going on, and the numbers were very few. So 65, although it took part, but not much, and mainly in AD, air defense duties, for which it was meant for. But it made a difference in the sense it created a sort of a deterrence for the enemy, and the enemy, wherever knew that MiG-21s are there, tried to avoid it rather than getting embroiled with it. 1971, it made a lot of difference. By that time, it had evolved. Indian Air Force was fully trained, had inducted fully into its dynamics of air warfare, and it was used in many roles, ground attack as well as air defense, as well as recce, electronic warfare, you name it. If you remember the famous photograph of a rocket attack on Dhaka Governor's House, which is considered to be the turning point in the war, and Bangladesh being born. So it took it participated majorly in 1971 war. Thereafter also it has been taking part, like you mentioned, Balakot, where if you remember Abhinandan having shot down F-16 with that MiG-21.
Right. You know, Air Marshal Khosla, a question coming in from our managing editor, Shireen Bhan. I believe you've served under her father, Air Marshal Bhan. Could you tell us about your call sign while you were flying this fighter, the MiG-21?
Yeah, so actually I've flown this aircraft extensively in 24 Squadron. That time it was in Ambala in 1980s. And TACD I've flown, I was associated for almost 11, 13 years. And Marshal Bhan was also there. He was the AOC. And of course, I've seen Shireen as a child. So these call signs actually keep changing unless you become a CEO. When you become a CEO, like I commanded a Jaguar squadron, that time my call sign was Dragon 1 because the Dragon was the name of the squadron. So the call signs keep changing when you change your squadrons, especially at junior ranks. But I have remember Marshal Bhan very fondly, and we served together in quite a few appointments.
Right. You know, recently this aircraft also became notorious. It was often known as the flying coffin because of the large number of crashes. Why do you think this was happening, and why did we end up using this aircraft for such a long time?
Yeah, again, you have put two questions in one. One is the, the infamous name given to it. And secondly, why did we prolong it so much? And prolonging it so much is also part of the reason why these accidents took place, because there is a time comes when, you have to retire these old machines, because keeping them alive and keeping them flying becomes difficult because of the supply chains, because of the spares and old technology, etc., etc. Now, coming to your first question specific, actually, it got a name because of 4-5 reasons. There was a time when there was a problem with the aircraft when HL was licensed manufacturing it, and we had a spate of accidents. And that drew the attention of the media. The second thing is, it was a mainstay of Indian Air Force. Almost at a time 800 plus aircraft were flying. So if you take the quantum of flying, the number of accidents is not so great. But it comes into the limelight. Third thing is, there are so many variants. In MiG-21 itself, there are 5 variants. Then there's MiG-23, MiG-27, MiG-25. Any accident which took place in MiG series, the media started reporting as MiG-21. So due to these reasons, it got a bad name as such. Coming to the second part of your question, that why did we continue flying? Obviously, there are again multiple reasons. Firstly, we didn't acquire any fighter aircraft for quite some time, which we should have done to replace it. And secondly, our Tejas program, indigenous, which was supposed to replace MiG-21, took very long to fructify. And these are the two major reasons now. With the adversaries we have, we cannot come down below minimum deterrence level. So we had to continue flying these aircraft for a longer duration than required.
Okay. Right. And of course, the Tejas aircraft will now start getting delivered. And it was the US which had delayed the delivery of the GE engines for these fighters, which has delayed this entire indigenous program. Thank you very much, Air Marshal Khosla, for joining us on the program. With that, it's a wrap on this edition of News Center. More news and updates continue right here.
Zindagi ek safar hai suhana. We've all been fortunate that our wives are smarter than us. All 3 of us met our wives at work. I can now die a peaceful. I actually shook hands with Mr. Bachchan.
I said, Pagal hai, yeah. He threw me a googly, which I was not prepared for. He said, how dare you leave family?
You look at Mike and say, what's happened? I said, sir, your zip is open.
Winds of change are blowing through India Inc. More than a dozen companies, including HUL and Nestle, will see a change in leadership within a few days. More than 140 companies listed on the NSE saw a change in the corner office last fiscal. Now, while that number looks large, it accounts for just over 5% of all the companies listed on the NSE. But another change is blowing through industry, and that is the shift towards a professional CEO. In fact, in a candid interview with CNBC-TV18, Marico's Harsh Mariwala explained why he chose a professional CEO over his own son, but this was, of course, dating back several years. Dilip Piramal of VIP Industries, in another candid conversation on CNBC-TV18, opened up on why the younger generation does not seem to be interested in running the company, and hence he has decided to exit. Now, this leaves us with a few questions. How will this shift towards professional CEOs impact India Inc.? Why is the next generation not so keen on growing the family business? And if it's not, will we see more promoters exiting? This is the editor's playbook, and each week our team of editors will put the spotlight on the most compelling events across the world and try and decode what they could mean for India. I'm Shireen Bhan. With me, our crew, Prashant Nair, Nimesh Shah, Surbhi Upadhyay and Sriram Iyer. But before we begin, here are those candid moments with top business leaders on balancing the interests of the organization and professional management as well as the family. Here's a look.
In the last 5 years, we have not been doing well. We've had a management, I would say, crisis in the last 2-3 years. And our market shares are going down. And the younger generation is not interested in the management. So what do I do?
Indian families, now they are realizing that their children are not going to be interested to succeed. There are more exciting opportunities the subsequent generations want to pursue. And they all want to call out something as their own rather than taking the reins from their father or grandfather.
I think if you look at Indian businesses, there is an expectation that your children will step into your shoes in terms of the role. My son also thought that he will step in. My wife also thought that he will step into my shoes. But I deviated from the normal practice. I am grooming him to take over Marico's chairmanship from me over a period of time.
Well, several interesting and important questions here that we will hope to address on this edition of the Editor's Playbook. Guys, they're connected, but they're also separate in many ways. One, of course, is the change that we see on account of people retiring, their tenures ending, and so on and so forth. Sometimes replacements are forced because of underperformance. There's another story that's playing out at this point in time, which is the apparent reluctance of the next generation to take forward family-owned businesses, which is forcing promoters to look outside, look at possible exit opportunities. And then there's the other aspect, where you may retain control, but act as a strategic investor. As Harsh Mariwala explained to me, he decided to do when he put Shogato in charge of Marico. His son Rishabh joined the family office, but now he's grooming Rishabh to become the chairman of Marico and succeed him. So they continue to hold control, but the company's been run by a professional CEO. So Nimesh, before we address all of these issues, let's look at what the data is telling us in terms of the CEO churn that we're likely to see.
So Shireen, first on the number of changes that has already been announced, but largely, at least for the last 5 years, I was looking at the BSE 500, which is not a very large universe, but a sizable universe. And within that, the data very clearly suggests that the change in CEO has generally led to a re-rating in the stock price. For some of the whatever reasons, but the stocks have actually outperformed. So as I said, it's a very small sample of BSE 500 companies. But look at the kind of performance the stocks have given. The first stock on my list is Persistent. They announced a new CEO, Sandeep Kalra, in 2020, October 2020, and since then the stock is up 850%. That's the kind of outperformance we've seen in a stock like Persistent. Similarly, Newgen Technologies, the stock is up 300%. Himadri Chemicals, a small company, but they got a new CEO in 2022, and since then the stock is up 500%. And there's a long list: Aegis Logistics, Welspun Corp, Zensa Technologies. In fact, I was looking at the data. Nearly 20 companies in that 100-odd companies which have seen a change of CEO, they've given an average return between 30% to 200%. So that's the kind of outperformance we've seen in the companies. Yes, there will be some outliers where some stocks don't do well or the companies don't do well, but that's only 10%
of generally the basket of companies that we track. Now the important one. In 2025, some big announcements have already been announced in terms of CEO changes. The first and big company is HUL, right? Priya Nair is going to head as a new CEO there. Root Mobile, Titan, Cyient DLM, Max Financial Services, L&T, Mindtree. There are so many such companies where already the CEOs have been announced, or they're going to take over, in the months to come. So this is a basket to watch out for in terms of outperformance. But the past data clearly suggests that any change in CEO normally leads to a big rating in the stock price, and they generally do very well.
I guess the market perhaps...
that's a whole bunch of stocks that have seen a re-rating on account of that. And obviously, it will also have to reflect in the performance of the company. If performance doesn't keep pace with the promise of what change will bring about, we wouldn't have seen those kind of returns as far as the stock prices are concerned. Surabhi, you wanted to make a point?
No, I was just adding to Nimesh's list, Shireen. In fact, I mean, to take this forward, there's Lever. Obviously, Lever is the marquee change because the first time in the company's history, 90+ years, that a woman is finally taking charge. And Priya Nair is going to come in. And this was the outlier. In a lot of the other cases, for instance, I mean, I looked at some of the other FMCG names like Mr. Suresh Narayanan, but he's exiting because he's simply retiring.
He's completed his tenure. He's had a 10-year run, and he's now handing over the baton.
Absolutely. But in Lever's case, it was interesting. Mr. Rohit Java's tenure was a lot shorter than what people would have perhaps anticipated. And the company note cited that he's moving on for personal and professional reasons. And it's coming at a time where growth is the biggest challenge for these companies, right? I'll throw one more very interesting example where the market suddenly got excited. This is Avenue Supermart. We know, again, growth is a challenge for some of these big retailers as well. And Neville Noronha, not sort of continuing or renewing his contract. The contract is ending and there's no renewal there. The new person coming in is Anshul Aswaha, and this is happening in February of next year. Now, Anshul is coming in with, 3 decades of FMCG experience. So again, the hope being that some of these new names will bring in new energy, new expectations. I'll give you one small example from this week, Shireen. Arvind Fashions. Yes. Now, Arvind Fashion, the stock popped up 8-9% just earlier this week because of the CEO change. Yeah. The new lady coming in, and again, women leadership here, Amisha Jain is coming in. And she has 25 years of experience, and she's come from a lot of global brands, including Levi's, there is Nike India, McKinsey, Motorola, and the market feels that she'll give some new ideas and really jumpstart things at Arvind Fashion. So just some examples. There's a lot of change going on, and the market is excited about the new people who are coming in.
No, I was just wondering whether we can sort of combine Nimesh's historical data and your forward-looking data. And for our viewers, can we come up with a list of, say, 3 companies,
which are going to outperform?
2 or 3 companies which will outperform? Is there a way we can do it? Now, it's not our job to do it, but I'll give you just a frame of thinking. And this came from Persistent, Nimesh. Sure. Persistent, Mr. Anand Deshpande is the founder. He's himself a technologist. He's actually a pretty visionary guy, right?
Technocrat, correct.
But he ran the company from 2000. I mean, for what 15 years before that. I just looked at on my phone the price chart, right? From 2010 to 2020, 10 years, actually more, to go back a little bit more, the stock did nothing. I mean, 100 to 150, 170, right? And then 2020, the new CEO comes in, who's done a fantastic job, and we speak with him on earnings, etc. all the time.
This shows up in the numbers as well, Prashant. Yeah. So look at the...
So but there are 2 things. One, he took over when there was this huge IT boom.
This whole COVID, guys, you have to give him that.
And there was that tailwind. Well, but to be fair, he did a fantastic job as well. My point is that the companies that you mentioned, can our viewers take out... I mean, well, at this point in time, we are wiser in hindsight, but at this point, is there anybody to tell? Yeah. I mean, this is the company to put your money on. So, maybe this is one way. Huge underperformance in the past. Maybe that gives you a bit of a springboard to do well.
So again, Prashant, my data only says that it's a good starting point for somebody to identify a stock for a potential winner. Absolutely. If there's a change of guard, you potentially...
let me give you one example from my list. So, I mean, how do you try and project something into the future? You can only make intelligent guesses, I suppose. So in certain cases, and again, this is no indication of any stock price performance or any company performance in the future, I'm just going back to my list. So let's go back and look at what's happening with the Anshul at Avenue. going back and looking at Anshul's track record, I mean, he's been known as the master in terms of e-commerce and digital strategy.
Exactly.
Where he's been earlier. I mean, all the years that he's spent at HUL, particularly in the home and personal care business. So if some of that, and maybe that's a niche that DMart is looking to break and
that is
reach.
something which is missing
It's
in
the
DMart.
E-commerce challenge that you have to take on.
Exactly.
So here's a specialist coming in, and let's see what that leads to.
That's exactly what maybe R.K. Damani wanted, right? I mean, he's grown organically in a very brick and mortar format for very long.
Yeah.
Now he's facing the challenge of e-com.
Absolutely.
And you can feel it. You can see in the stock prices as well. The stocks are not doing good. The numbers have been quite weak as well. So they need a fresh.
You should have picked somebody from Flipkart or Zomato or something like that.
To actually look at e-com.
Why HUL?
I think that there are legitimate reasons for why people may be considering bringing in fresh blood and fresh energy today, because the market has changed. I mean, look, for the FMCG sector, it's been a difficult period. It's been reflected in volume growth and so on and so forth. But look at how the landscape has changed. What was the big moat for companies like HUL? It was their distribution might. You just didn't have anything else available on the shelves. That's completely changed today now with the D2C, emergence of D2C brands, with the emergence of e-commerce, now the emergence of quick commerce. Distribution muscle is perhaps not the kind of leverage that you enjoyed or the benefit that you enjoyed previously. So I think you need to rethink, you need to reimagine, and you also perhaps need to get muscle that understands the workings of this new environment, and perhaps that's weighing on some of the decisions that we're seeing. But, this is one aspect. But the other aspect, and we brought up Renuka Ramnath's conversation that I had there, along with Dilip Piramal, I think that's the other big focus area to look at. What is happening with the Indian promoter? What is happening with Indian promoter groups? Is there an intergenerational transition, a massive intergenerational transition that we're seeing? We've heard Uday Kotak talk about it as well. In fact, he was the first one saying, look, the next generation now is interested in managing money, not managing business. But does that also then throw up opportunities for investors? I mean, now Dilip Piramal selling VIP to multiples and a bunch of other investors. Let's look at that piece as well and what that could potentially mean from a market's perspective.
So last 2 years, 2023 and 2024, we've had humongous amounts of promoter exits. I mean, the numbers are very, very large. They will come up on your screen. 2025 so far, by the way, that number already stands at, this is the first half of 2025, almost 65,000 crores.
Yes.
So you're going to end up at this pace, promoters are going to sell shares in their companies to the tune of 1,20,000, 1,25,000, 1,30,000 crores. The 23 and 24 numbers are on the screen as we speak, right? So these are very large numbers. What has happened over the last 3 years? Promoters across all NSE listed companies used to own about 44%, right? India is a very peculiar market. US, there are lots of companies where
zero promoter holding.
No promoter holding.
No promoter
completely
holding.
institutionalized. India is a very different market, but it's changing. 44% promoters. 3 years back, that number is now 41 point something, around 40 basically, around 40 odd percent, largely. Now, what are they doing, right? They are exiting and Nimesh and I have spoken about this a lot in the past. A lot of this money is coming back.
Back to the market, yeah.
But there's no way to tell how much money is coming back. But there is one sort of indication which we can get. Family offices.
Yeah.
Family offices are not a new concept. They're a very old concept. I mean, but I mean, I think it's got popularized in the US in the 90s and it's come into India in a big way. From 2018, when there were 45 family offices, that number now is almost 300 family offices and assets under management. And I picked this up from a Julius Baer report. $30 billion is managed by these family offices.
That's what they're now forced to reckon.
That's huge, right?
That's huge.
So why family offices? Preserve wealth, succession planning, separate business from personal
diversification.
Personal wealth, enable global investments, professionalize, of course, money management, etc. And this Julius Baer report talks about 50% plus portfolio in growth assets. I mean, across these family offices, 25% plus exposure to PE, VCs, VC, big bets in AIFs, private credit, REITs, and diversification, risk-taking, etc. So there's global aspect as well. A lot of these guys are based out of Gift City, which enable them to access global markets as well. So, I mean, the short point is a lot of this money is coming back into the market. And I think as Shireen said, maybe managing money is easier than managing businesses. Correct. It is.
This is
Make money, lose money, but it is.
I wrote about this, Nimesh, because when Shireen mentioned Uday's tweet a couple of months ago, and I think we had written a piece, I had written a piece on this and reacting to what he had said about all these Nepo kids not wanting to run a business, which I think is fair because there is too much pressure on them. And we have there is an opportunity, like Shireen said, for policymakers also to review that what is the incentive on capital versus what is the incentive for effort. And so your income tax and your corporation tax is much higher than your capital gains tax. And as long as there is, incentive, like if you can just make $10 billion from capital, and it will be taxed less. But the same thing you have to do as a business, then you'll be taxed more, there is a lot more effort, there's a lot more anxiety, and you are carrying the weight of your family name on your shoulder. So your margin for error is much less. So obviously they will choose to just put up a family office and manage the money.
But who
wants to take the risk?
I have a slight counter view to this. Ultimately, if you're saying that you're going to manage a family office and you want to buy somebody else's company, if everybody is managing family office, who's going to run the business?
People from tier 2 and tier 3 cities. Your Vijay Shekhar Sharma
make money if a promoter is putting in his hard effort.
I'm saying your Vijay Shekhar Sharmas and Ritesh Agarwals and other people.
I think if we go one layer deeper in the debate, and you guys raised the point about the US being a different market where you have far more, many professionally run corporations. And Shireen, maybe your thoughts on this, because you speak to leaders across the spectrum, right? So India till now has been a very promoter-driven market, promoter-driven businesses, sweat and blood and animal spirits and all of that. I mean, in all your conversations, do you see maybe an evolution towards a corporatized model? I mean, will professional boards, professional companies still be able to fire and inspire the same animal spirits? What do you pick up in all the people, global and local, that you speak to?
At the end of the day, there's something to be said about having promoter-driven entities because, your blood, sweat and tears are invested. You have skin in the game. But there's equally something to be said about companies that have promoters but are run by professional CEOs, have strong independent boards that help the company design and play out their strategy as per the needs of the market. So I don't think it is it's one versus the other. But I think what is important today, and how many times have we had this conversation? I don't like the word Nepo kids, Sriram, but I don't like labels.
Yeah, the Nepo kids have embraced
in general,
it.
But I just feel like, there was always this thing that, what's the big deal? You're the son of the promoter, so now you've become the CEO and so on and so forth. It was always looked at with a little bit of sort of like, I wouldn't say disdain, but it was looked at, okay, what's the big deal that you've done? And now, if that person is turning around, the kid is turning around and saying, I don't want to do what my father and my grandfather and so on and so forth have done. I'd much rather either turn entrepreneur into
which I support,
different from
which
what
is the great point,
is, or run a family office or whatever the case is. I'm saying if it is in the interest of the organization, and I go back to Harsh Mariwala's point, he said the reason why he got Shogato in over a decade ago when he decided to step down and not his son, because he felt his son was not ready for the job, was not ready for the role at that point in time. He said, I was absolutely sure that I would ensure that the organization's interest preceded my interest as a promoter. And I think if that is how promoter-run families are approaching succession, so be it. It's good for everybody. It's good for the companies involved. It's good for investors. It's good for all stakeholders. So I'm all for the fact that if bringing in a professional actually ensures better performance and delivers on growth, why not?
Why not?
Which is what Mr. Piramal said, right? He said, I'm selling it to a private equity entity. And by nature, by definition, private equity is in it to make returns, to run the business well, and to create shareholder value.
I think one company we speak to, and Shireen, you speak to all the time, is Mahindra and Mahindra.
Absolutely, right? I was about to
look at what Mr. Mahindra has done.
Exactly.
He stepped away, given up control. Anish has taken over the last 4 years, has done a phenomenal job. I mean, he's basically gotten rid of loss-making businesses.
When a change of CEO comes in, you have to look at the stock.
And again, during COVID, right? I mean, around that time is when he took over.
And again, he was very clear. The day he started, he was very clear. His first goal will be to make sure that there is proper capital allocation, and that is something which a lot of investors took a leap of faith and invested in, right?
So many businesses, SsangYong, all this. I mean, he kind of sort of whittled all those down and focused on the core.
In the last 4 years, he's shown in the numbers.
Coming back to Sriram's point and this idea that if the next generation of Indian promoter families are not running businesses, who will? There are plenty of people. I mean, if there is one thing that I'm absolutely willing to bet my money on today, and I wish I had the opportunity of being able to do it 23 years ago when we started Young Turks, is India's startup ecosystem. India's aspirational quotient has changed. There is capital. All of these family offices are willing to write out checks, and there is an aspirational Indian that is willing to do the heavy lifting when it comes to setting up enterprise. We need to make it easier for them. We need to make it a lot easier. It's not easy starting up a business in India. It has gotten easier, but it's not easy starting up a business in India and running it to any kind of scale. That's the opportunity, and that is where I believe, the government's policy intervention, attention, and all of that also needs to focus on. But that is another, we could do a whole other show on that, but
absolutely.
That's another aspect.
That is exactly what I just want to add to that, Shireen. Essentially, in simple words, what I'm trying to say is this arbitrage between the incentive, the benefit of for capital as a capital investor versus somebody who's investing their effort. That gap has to shrink and come closer to zero. That's the short point. So if you still want to be an financial investor...
People in the investors are going to throw things at you, Sriram.
That's fine. It's an opinion.
Don't push that line.
That's a risk. The gap between... there should be equal appreciation of effort as much as there is capital. That's all there is for capital.
I just want to throw one last thought as we wind this up, guys. One sector, and we've listed a whole lot of CEOs changes, MD changes that are happening next 6 months. None of the large cap IT services figure in that list. And that is the one sector that's going through the biggest amount of disruption, existential questions in front of them. So we hope current promoters, current management, professional or otherwise, they get through and they ride through the challenge.
That is why I was about to tell you that, when you compare that persistent data of outperformance, and you compare with all the IT companies, I'm not saying Persistent did well because of the COVID lows and whatever. Since then, in terms of numbers, in terms of growth, this has been the best performing company as far as the growth is concerned. So something that, Sandeep has done well in terms of going out and taking right decisions and reaching out to the right sorts of...
But I won't be surprised if tomorrow a bunch of these... there is a need for all... Like right now, technology is like sort of ubiquitous, right? It's a requirement for everyone. So whether you're a retailer, whether you're a manufacturing guy, whether you're making shoes, whether you're making nuts and bolts, everybody is going to need some guy to lead the technological disruption and the transition. And a lot of these people, I wouldn't be surprised if some of them move into different companies. And
that's an interesting point, because look at who's coming in place of Suresh Narayanan at Nestle. It's somebody from the tech universe that's actually coming into FMCG, because the nature of the game has changed as far as FMCG.
Which is why I asked why DMart chose somebody from HUL and why not from a Flipkart or a Walmart or some other Actually, on a lighter...
Brick and mortar experience combined with, I think, digital
on a lighter
experience.
note, FMCG and IT are quite similar nowadays.
In terms of numbers, at least.
Everything is IT now. Return ratios are high, cash flows are high,
growth.
but P&L growth is very slow. So,
See, no matter what your...
IT companies like 0% growth these days.
No matter what you're selling, your product officer is a techie. so that's a fundamental,
But, I just want to end by saying that, while we're talking about change and we're talking about churning people perhaps every decade and so on and so forth, I'm going to come back to the fact that, look, don't link it to tenure, link it to performance. For all of our sakes, we've all been around for more than 10 years. So for all of our
That's the theme of the month. That's the theme of the month.
It's running into decades now.
But Shireen, like you said, your point on the
for the
startups.
sake of self-preservation.
Yeah. I think Shireen,
Absolutely.
we have the capital now. I think I want to summarize what everybody has said into one line. Prashant pointed out that we have the capital now. The family offices have bulked up. That money has to go somewhere. And like you, Shireen, pointed out that there are people in young entrepreneurs, aspiring entrepreneurs, who are waiting in the wings in smaller cities, etc., who are going to take whatever comes their way because they have a point to prove. Yeah. This capital has to flow there. Yeah. The only thing...
It's actually flowing, Shriram.
Correct, it is.
It
has to flow there.
The avenues have opened up. Look at the SME platforms. Look at like how family offices are putting in money in unlisted companies. There is ample liquidity which is there for smaller India Inc. to capture and grow.
So to what I'm saying is, for anybody who wants to throw things at me I'm saying let this money is going from the people who have the wealth to people who want to do the things.
Who have the idea and the ambition.
Correct. And I'm asking the government, don't come in the middle and take it away. That's all I'm saying.
That's a new angle now.
Fair enough. Fair enough. That point is well taken. But we've given you some ideas on this program on the changes that are underway, the winds of change that are underway in terms of leadership. Some, as I pointed out, on account of tenures getting over and so on and so forth. Some on account of apparent need for leadership change to keep pace with the current environment. And some, of course, because the promoter family has decided to exit or has decided to professionalize. But all of these are going to be interesting developments, and these stocks will be stocks that we will watch closely. And let's see which hypothesis plays out. But Prashant, Surbhi, Nimesh and Sriram, thanks very much. As always, it's been fun. We'll see you again on the Editor's Playbook. Till then, from all of us here, goodbye. Thanks for watching. Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening: the Sensex and the Nifty end with marginal losses. After a range-bound session, the Nifty manages to hold above 25,000. Banks and mid-caps see sharper cuts. A trade deal between India and the US before the 1st of August deadline is unlikely. Sources say the deal stalled after the US proposed 20% tariffs on India and expected zero tariffs in return, similar to Indonesia and Vietnam. Access to agri and dairy sectors remain a flashpoint. That's an exclusive. In a sudden move, Anup Saha resigns as the MD of Bajaj Finance with immediate effect. The Vice Chairman Rajiv Jain will assume additional responsibilities. Sources say it's premature to assume Saha's resignation is linked to the top job at IndusInd Bank, where he's one of the 3 contenders. That's another exclusive. Axis Bank eyes an additional 10% stake in its life insurance joint venture with Max Financial Services, may seek RBI approval to acquire stake, which will help Max Financial raise 5,000 crore rupees. Axis Bank would become the promoter of the company if the deal goes through. Another exclusive this evening. Tilaknagar leads the race to buy the popular whiskey brand Imperial Blue from Pernod Ricard. Sources say the deal is likely to value Imperial Blue at around 4,000 crore rupees. Another exclusive tonight. Vice President Jagdeep Dhankar's surprise resignation with 2 years left in his term on the first day of Parliament session creates a flutter in the corridors of power. Sources say tensions with the government over Dhankar backing an opposition motion to impeach Justice Verma could have led to his sudden exit. Just 10 days ago, Dhankar had said he will complete his term barring any, and I quote, divine intervention. The second day of the monsoon session of Parliament is a washout. Opposition parties protest over the voter roll revision in Bihar and the aftermath of the Pahalgam terror attacks. The Supreme Court begins hearing the presidential reference made by Draupadi Murmu, conferring the powers of president and governors, issues notice to the union government and all state governments. Murmu had made the reference following a Supreme Court order that prescribed a timeline of maximum 3 months for the president to consider a bill referred by a state's governor. India's startup airlines are struggling to take off. Air Kerala, Al Hind Air and Shank Air neither have any aircraft nor a flying permit. All 3 airlines got regulatory approval in 2024 and were hoping to take to the skies by the middle of 2025. After 62 years, the Indian Air Force will retire the MiG-21 fighter jets. A ceremonial send-off to the aircraft, dubbed as a workhorse, will be held in September. We do have a packed show lined up for you, but straight to the day's market action. The Sensex and the Nifty closing flat after a range-bound session. Broader markets underperforming, with the mid-cap slipping over 360 points, so closing 0.5% lower. The Nifty Bank closing 200 points lower, absolutely flat there, both for the Sensex as well as the Nifty. Shriram Motors, Eicher Motors, Adani Ports dragging the index lower today. Now, market regulator SEBI has granted approval to US-based trading firm Jane Street to resume trading in India. This comes after Jane Street completed the directive to open an escrow account and deposit the unlawful gains of 4,844 crore rupees before the deadline. However, Jane Street will be closely monitored by stock exchanges during the ongoing SEBI probe. Remember, the ban was imposed over Jane Street's alleged market manipulation in the derivatives segment. Now, shares of Zomato's parent Eternal hitting a record high on renewed optimism over its quick commerce business Blinkit. In its first quarter earnings, Blinkit had reported higher order value compared to the food delivery business. Shares of rival Swiggy also jumped nearly 5% in trade today. Eternal's management said growth and margins have bottomed out for the near term. The rally came despite a steep decline in net profit, which came in at 25 crore rupees in the June quarter. However, revenue up 70% to over 7,000 crore rupees. On to more earnings. FMCG giant Colgate has reported a weak set of numbers in the first quarter, missing street estimates across most parameters. Net profit declining nearly 12% to 321 crores. Revenue dipped over 2%. The company's management anticipates a gradual recovery in the second half of the year. The big story this evening, a trade deal between India and the US before the 1st of August deadline is unlikely. Remember, this is a deadline set by President Trump, saying that if you don't comply and put a deal in place by then, well, then you'll be hit by tariffs. Now, sources say the deal stalled after the US proposed 20% tariffs on India and expected 0 tariffs in return. This is similar to the deals that the US has done with Indonesia and Vietnam. Parikshit standing by with the exclusive details. So, Parikshit, it doesn't look like there is a deal imminent at this point in time. What seems to be the issue?
Any interim deal between India and US or a mini trade deal before the 1st of August looks unlikely as of now. In fact, the possibility is likely to be ruled out altogether. This is because the talks between India and United States are stalled on certain key issues. Number one, US President Donald Trump has offered a deal to India which is very similar to Indonesia and Vietnam. And India wants a competitive advantage over these countries and not a tariff arrangement on similar lines. Number two, the deal is also stalled because the US government wants to impose a 20% tariff on Indian goods coming into America. On the other hand, they want zero tariff duty treatment in the Indian market for American goods. This is not acceptable to the Indian side because we want the deal to be a win-win and a reciprocal deal. Also, on agriculture and dairy, we believe that the US administration is still pushing for the inclusion of agriculture and dairy items in any kind of trade deal or understanding before the 1st of August. And India will not compromise on these issues. These are red lines in any trade negotiation. Therefore, currently the Indian side has refused to have any further negotiations, at least this month. Talks will continue for a larger bilateral trade agreement. A US team headed by their negotiator Brendan Lynch will be coming to India in August to try and see if there can be a breakthrough in talks with India. For the moment, there is a 10% baseline tariff that the US has imposed on Indian goods, apart from sectoral tariffs on automobiles, on steel and aluminium. It remains to be seen whether the US will impose a 26% reciprocal tariff on India come the 1st of August if a trade deal before that is not agreed upon.
Parikshit, many thanks. Now, in what would bolster India's arsenal, the Army has received the first batch of the Apache fighter helicopters from Boeing. In a post on social media, the Army said the induction of the Apache attack helicopters will significantly boost its operational capabilities. It is the end of an era for the MiG-21 fighter jet. After more than 6 decades in service, the combat aircraft will be formally retired in September with a ceremonial farewell. The aircraft played a vital role in the 1965 Indo-Pak War, the 1971 Bangladesh Liberation War, the Kargil conflicts of 1999 and the 2019 Balakot airstrikes. The MiG-21 squadron was also alert during Operation Sindoor, so it's a goodbye to the old war horse. The British Royal Navy's F-35B fighter jet, which was stranded in Kerala for over a month, flew out of Thiruvananthapuram airport this morning. The fighter returned to the skies after being repaired by a team of engineers from the UK. The stealth jet was forced to make an emergency landing after a hydraulic fault and power issues forced it to divert from its carrier, the HMS Prince of Wales. The aircraft will now fly to a British aircraft carrier in Australia. The big corporate story: in a sudden move, Anup Saha has resigned as the MD of Bajaj Finance with immediate effect. Sources have said that it is premature to assume that Saha's resignation is linked to the top job at IndusInd Bank, where he is one of the contenders. Ritu joins us now with the details. Ritu, Saha is one of the 3 names that the RBI is looking at this point in time, but it would be premature to assume that he does get the top job at IndusInd.
Well, our sources indicate it may be too early to assume that Anup Saha resigned from his position as the MD of Bajaj Finance to take over the top job at IndusInd Bank. Remember, we were the first to report that Anup Saha is among the 3 candidates who are in the running for the IndusInd Bank CEO role. And while his name being in the mix may have had some bearing on internal dynamics at Bajaj Finance, we understand RBI is yet to clear a name for the IndusInd role. So the idea that he quit specifically to join IndusInd may be a bit premature. But that said, the resignation itself has come as a surprise, given he was being groomed for the position for the last couple of years and only took over as the MD in April, and so him quitting the role in just under 4 months has raised some questions. Equally important is the fact that Bajaj Finance's long-term MD, Rajiv Jain, is back at the helm, and he's going to serve as the MD for the remainder of his term until March of 2028. Now, while this will provide a smooth transition for Bajaj, the focus will also move to succession planning. Now, remember, Rajiv Jain has spent more than 15 years as the MD of the company, and while RBI rules limit bank CEO terms to 15 years, there is no such cap for NBFC, so technically he can continue, but the company will still be under pressure to groom the next line of leadership. Now, Jeffries points out that Rajiv Jain may now need to pull back from any advisory role at Bajaj Finserv, and Morgan Stanley calls this a setback to the succession plan that the company had been executing. But with Rajiv Jain back in the driver's seat, they say the situation remains manageable.
Thanks very much, Ritu. Another CNBC-TV18 exclusive this evening. Axis Bank eyes an additional 10% stake in its life insurance joint venture with Max Financial Services. It may seek RBI approval to acquire stake, which will help Max Financial raise 5,000 crore rupees. Axis Bank will become the promoter of the company if the deal goes through. Shares of Tilak Nagar Industries rallying in trade today. This after CNBC-TV18 reported that the company is leading the race to acquire Pernod Ricard's whiskey brand Imperial Blue. Sources add the deal is likely to value Imperial Blue at around 4,000 crore rupees. The acquisition is likely to be funded by a mix of debt and equity. As of FY25, the company has a cash balance of 107 crore rupees. Tilak Nagar Industries and Pernod Ricard have not responded to CNBC-TV18's query yet. Shares of Titan surging after its subsidiary signed a definitive agreement to acquire 67% stake in UAE-based Damas Jewelry. The deal is valued at $283 million and is expected to be completed by Jan 2026. The acquisition paves the way for Titan to expand into 6 GCC markets, including the UAE, Saudi Arabia and Qatar. The big national story, Vice President Jagdeep Dhankar's surprise resignation last evening on the very first day of the monsoon session has created a flutter in the corridors of power. Now, Dhankar still has 2 years left in his term. In a letter addressed to President Murmu, the former Vice President says he will be resigning as Vice President with immediate effect to prioritize healthcare and to abide by medical advice. Sources say tensions with the government over Dhankar backing an opposition motion to impeach Justice Yashwant Verma over the cash-at-home row could have led to his sudden exit. Dhankar is the first Vice President in close to 40 years to resign mid-term. Before him, B.V. Giri and R. Venkatraman had resigned as Vice Presidents as well, but only to contest the presidential elections. In a 24-word statement, Prime Minister Modi said, and I quote, Jagdeep Dhankar ji has got many opportunities to serve our country in various capacities, including as Vice President of India, wishing him good health, end of quote. Opposition leaders raised questions over his surprise resignation. Congress President Mallikarjun Kharge said, and I quote, only he knows the reason. We have nothing to say on this matter. Either the government knows or he knows. It is up to the government to accept his resignation or not, end of quote. Dhankar's 5-year tenure was originally set to end on August 2077. Just 10 days ago, Dhankar had also said that he intends to complete his term barring, and I quote, any divine intervention. Take a look.
I will retire at the right time. August 2027. Subject to divine intervention.
हम उनकी अच्छी स्वास्थ्य की कामना तो करते हैं, लेकिन कहीं ना कहीं ऐसा प्रमाण होता है कि केंद्र सरकार और उपराष्ट्रपति के बीच में जो उनका रिश्ता है दोनों के बीच में वो पहले जैसा नहीं रहा.
Vice President, we wish him the best of health, but a little more elaboration on the circumstances which have led to this decision. Even though it might be a personal decision, but since he holds a public office and there are 146 crore Indians who would be equally interested and invested in knowing the facts, a certain amount of elaboration will help.
दुखद है, दुर्भाग्यपूर्ण है, चौंकाने वाला है. मैं उनसे आग्रह करूंगा वो पुनर्विचार करें.
So Vice President Jagdeep Dhankar has resigned. His resignation has also been accepted by the government. The Prime Minister has put out a statement commending the contributions of Jagdeep Dhankar in various positions. But what is the inside story? Is it that the government was upset with him yesterday after he accepted the impeachment motion moved by 65 odd opposition MPs? And did Mr. Dhankar not keep the government in loop about this particular impeachment motion? Remember, senior ministers like JP Nadda and Kiran Rijiju subsequently did not attend the BAC meeting called by Mr. Dhankar at 4:30 p.m. Though now Mr. Nadda and Mr. Rijiju both have said that a message was sent to Mr. Dhankar that they were busy. But this is a surprise series of events. Mr. Dhankar had just spent about 3 years in this post, and his resignation with immediate effect, which he has written to the president and which has now been accepted, throws open a host of speculations. Was he getting too friendly with the Congress leaders? Was he giving them the extra, benefit sometimes? It is a complete change of the situation, because just a few months back, the Congress had moved an impeachment motion against Mr. Jagdeep Dhankar in December 2024. What change completely in the next 6 months, where now there is hushed talk in the parliament corridors that he was being soft, maybe on being too friendly with the Congress leaders. He had met Mr. Mallikarjun Kharge at the VP estate some days ago. Arvind Kejriwal he had met at his residence on Sunday. What has really happened remains under wraps, but it is one thing is very, very clear, that Mr. Jagdeep Dhankar's resignation has come as a surprise and a shock to many, and he is hung his boots just 3 years into his tenure.
Well, that seems to be leading to more speculation on what resulted in that immediate resignation of the Vice President of India, Jagdeep Dhankar. Proceedings of the monsoon session of Parliament disrupted for the second consecutive day. Both houses were adjourned as opposition members held protests demanding a discussion on the voter roll revision in Bihar. Opposition parties also sought a discussion on Operation Sindoor, President Donald Trump's statement on the ceasefire, and the Air India plane crash in Ahmedabad. Opposition leaders also protested in the Bihar Assembly against the voter list revision, the leaders hitting out at the Prime Minister and Bihar Chief Minister Nitish Kumar for allegedly trying to remove voting rights of the people ahead of the Assembly elections. We will head to a break, but up next, India's startup airlines are struggling to take off. Air Kerala, Al Hind Air and Shank Air neither have any aircraft nor a flying permit. More details when we return. The death toll from the crash of a Bangladesh Air Force jet into a school building in Dhaka has now risen to 31, 25 children there. About 170 have been injured in the incident. As per a statement issued by the Bangladesh Air Force, the training fighter jet experienced a mechanical fault moments after takeoff. Israeli forces continue to pound Gaza. More than 60 Palestinians, including 11 aid workers, have been killed in the last 24 hours. Tanks were seen tearing through the southern and eastern districts of the enclave. The foreign ministers of 25 countries have called for an immediate ceasefire, saying suffering in Gaza has now reached new depths. Ukrainian President Zelensky has said that Russia and Ukraine will hold a new round of peace talks in Istanbul tomorrow. However, Moscow has not commented on the scheduled peace talks. The 2 rounds of peace talks that took place in the city in May and June led to a series of prisoner exchanges. This comes as Russian forces struck 3 Ukrainian cities in overnight attacks, killing a child and wounding at least 24. Geeta Gopinath will step down as the Deputy Managing Director of the IMF in August. In a statement, the IMF has said she will return to Harvard University as a professor of economics. IMF's Managing Director Kristalina Georgieva said that Geeta Gopinath's replacement will be announced in due course. Gopinath joined the organization in 2019 as its first female chief economist and was elevated to the Deputy Managing Director in 2022. Swedish furniture retailer IKEA has named Patrick Antoni as the CEO of its India operations. Antoni will take over from August this year. He will also take over as country retail manager and chief sustainability manager. Antoni has over 2 decades of experience at IKEA and previously served as deputy CEO of IKEA India. He will replace Suzanne Pulver, who stepped down after 28 years with IKEA. Air India says it's concluded precautionary checks on its fuel switch in all of its Boeing 787 aircraft fleet. The airline has confirmed that no issues were found in the locking mechanism of the switches. Air India said it started the inspections on the 12th of July, a month after the Air India plane crash, and completed it within the prescribed time. Now, India's startup airlines are struggling to take off. 3 carriers, Air Kerala, Al Hind Air and Shrunk Air, got their regulatory approval from the Civil Aviation Ministry in 2024, and they were hoping to launch by the middle of 2025. But months later, none of them have inducted even a single aircraft, and their air operator certificates remain out of reach. Madhiya is standing by to tell us what's delaying their takeoff. Madhiya.
Well, according to DGCA sources, Air Kerala, Al Hind Air are in the phase 3 of their certification process, where manuals and operational documents are being evaluated. Shrunk Air, meanwhile, is yet to even submit a formal operational plan. The big roadblock is finding a plane. Until these airlines bring in at least 1 aircraft, they cannot move to phase 4, which is demonstration flights, and ultimately move to the last phase of certification and securing the air operator permit. So why are they struggling to get a plane? Foreign lessors are reluctant sending their aircraft to startups in India, fearing their plane will be stuck here if the airline fails to survive. And this reluctance is due to past disputes involving aircraft repossession and weak enforcement of the Cape Town Convention. The Cape Town Convention, remember, is an international treaty that protects aircraft lessors. It ensures they can quickly take back their planes if an airline defaults or shuts down. Go First's bankruptcy is the recent example where lessors had to move the court to take their aircraft back, despite India being a signatory to the Cape Town Convention. A senior official at one of these startups told CNBC-TV18 that lessors are asking for massive deposits, sometimes 12 months of rent upfront, or proof that the airline has about 200 crores in the bank. The delay in securing planes is not the only headache. These startups have also hired employees for the key positions like CEO, CFO, head of security, head of safety, pilots, cabin crew. The official told us they're incurring a cost of 1.5 crores a month on salaries and overheads, and there is no clarity when they will start flying. Now, Air Kerala and Al Hind Air had earlier told CNBC-TV18 about starting operations with ATRs that are 70 to 80-seater aircraft, and then bring in the narrow-body planes like the A320 or the Boeing 737 MAX to eventually focus on the Gulf routes. These airlines had targeted mid-2025 to commence operations. As the official told us, the AOC process, the Air Operator Certificate process, can't move forward without aircraft, and lessors are reluctant to be the first ones with a new Indian carrier. And with half of 2025 done, will these airlines take off in 2025 at all? That's the big question.
Well, that certainly is the big question, and we don't have the answers just yet. Madhiya, many thanks for joining us. Torrential rains and landslides in Himachal and Jammu and Kashmir have claimed at least 4 lives. Over 400 roads were blocked across Himachal, with Mandi district bearing the brunt. The IMD has stated the intensity of the torrential rains across Himachal is beginning to decrease and is expected to stabilize by Wednesday. Now, the Supreme Court has begun hearing a rare presidential reference made by Draupadi Murmu, the President of India, concerning the powers of the President and governors. President Murmu had made the reference following a Supreme Court order that prescribed a timeline of maximum 3 months for the President to consider a bill referred by a state's governor. Ashmit is here with more on the Apex Court's direction to the centre. An unprecedented move, Ashmit. Take us through what the Supreme Court has said.
Well, the Supreme Court is clearly saying that this is a matter which will have sweeping implications across states, and therefore asking for opinions coming in from all states on this matter. Now, it all began with opposition-ruled states, the likes of Tamil Nadu, Kerala, Punjab, raising the question before the Supreme Court in multiple petitions against their respective governors, saying that these governors are blocking state legislation by sitting on bills indefinitely. Taking note of these matters, in one particular case involving the state of Tamil Nadu, the Supreme Court had given a sweeping judgment whereby it directed the governor as well as the President of India to decide on these deferred bills in no more than 3 months. That's a 3-month deadline that the Supreme Court has prescribed. Now, that is what led to a big backlash. In fact, the now former Vice President Jagdeep Dhankar had slammed this decision by the Apex Court, at one point even referring to the special powers under which the Supreme Court had acted, calling it a nuclear missile against democratic forces. So that was the nature of backlash that the Supreme Court had seen. And then subsequently, we saw President Draupadi Murmu make a presidential reference to the Supreme Court, which is basically in the nature of asking the Supreme Court on an issue of legal, a complex legal issue was raised. A number of questions. It all boils down to whether or not the Supreme Court can issue such a direction, can give a deadline to the President of India. That's the question that the Apex Court is dealing with. Now, a bench usually of no less than 5 judges hears such presidential references. Today was no different. A bench headed by the Chief Justice of India, Justice Gawai, he took charge of this matter. He's issued notice to all the states, asked them to come back with their response. The next hearing in this case will be next week on July 29th.
Ashmit, many thanks for joining us. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned. We're back in a moment with more.
Hello and welcome to Startup Street. I'm Shruti Mishra and with me is Arundhati Ramanan. These are the top headlines from the startup space. Zomato's parent Eternal hit a record high on renewed optimism around Blinkit, which reported higher order value than food delivery in Q1. Rival Swiggy shares also rose nearly 5%. This rally came despite net profit falling to 25 crore rupees, while revenue surged 70% to over 7,000 crore rupees.
Paytm reports a net and EBITDA profit for the first time, net profit of 122.5 crore rupees during the June quarter compared to a loss of 839 crore rupees last year. Revenue up 27.7% from last year to 1,917 crore rupees.
Cure Foods leads 2 crore rupees pre-seed funding round in fitness startup App Club. The firm will use the investment to bolster their signature coaching programs and build a back-end team to manage 10x scale. App Club is aiming to generate 1 million ARR by 2026.
Alphabet, faced with unprecedented threats from AI rivals, will be keen to assure investors this week that the company's own spending on the technology is helping it dig a deeper moat around its search and advertising businesses. Alphabet is expected to report a near 11% jump in total revenue for the second quarter, as per LSEG data.
US tech giants Meta, X and LinkedIn have lodged an appeal against an unprecedented VAT claim by Italy that could influence tax policy across the 27-nation European Union, Reuters reported. This is the first time that Italy has faced to reach a settlement agreement after bringing tax cases against tech companies, resulting in a fully fledged judicial tax trial being launched. Well, those are the headlines we've been tracking for you this evening on What's Brewing Today. Ahmedabad-based Social Pilot, a bootstrapped and profitable social media SaaS platform, has been acquired by Swedish digital giant Group One in a deal valued at over $50 million. Now, founded in 2014 by Jimit Bagadia and Tejas Mehta, Social Pilot has hit nearly $10 million in ARR, all on customer revenue with no external capital. On What's Brewing Today, we decode one of India's biggest venture-free SaaS exits and the story behind Social Pilot. Joining me now is its co-founder, Tejas Mehta. Tejas, welcome to Startup Street. Now, before we talk about the acquisition, let's understand the core product. Social Pilot helps small businesses manage their social media presence efficiently and affordably. That's what you claim. How do you do that without the complexity or cost of enterprise tools? If you could take us through your offerings first.
Arutari, thank you for having me on the segment. Social Pilot, as you rightly mentioned, is a social media management platform. At the core, we help SMBs focus on their social media publishing, social media inbox management, comments management, etc., and then social media analytics. We have recently added capabilities around reviews management and local listings management. Now, very importantly, in order to compete in this market, we make this product about customers. It's not about us, it is about them. It is about their needs. And we focus on what is a customer asking for. We do this with a combination of strong user research team and a strong product team, which works closely with the customers to understand their problems, their processes, their needs, and how to best address this. This is how we kind of keep the product very simple without incurring a lot of costs.
All right. Let's talk about the acquisition. What drew Group One to Social Pilot and what made you say yes to them? And will Social Pilot continue to operate independently? And what does this mean for your roadmap, your team, and your users?
Absolutely. I think multiple factors played a role in determining the fitment. At the core, both the organizations have very similar DNA. Customer centricity is core to us. It's core to Group One as well. We focus on simplicity, they focus on simplicity, and our ambitions are to scale globally. This was, I think, a match made in heaven, so to say. Specifically, I think Group One appreciates the need for social-first nature in this marketing mix in today's world. They really loved our product, and then they also liked our core engineering and product teams. So I think multiple factors played in this acquisition.
And you will continue to operate independently?
Absolutely. Social Pilot will continue to operate independently as a brand. We obviously will have a lot of support from Group One. Our roadmap will continue to focus on user needs and additional focus with integration on Group One's products. Our team will get a much larger canvas to play on. So I think it's a win for our customers. It's a win for our team as well.
Okay, so headquartered in Sweden, Group One provides cloud hosting, website services and marketing tools to over 2 million SMBs across Europe and other global markets. So like you mentioned earlier, Social Pilot complements its existing product suite. But what is the kind of impact you hope to make now after this acquisition? What's in store?
Our ambitions have grown drastically. We are targeting at 100 million revenues in the next 3 to 5 years, along with Group One's help. We want to offer our products to their customer base, and we want to offer their customers their products to our customer base as well. Together, I think we have greatly grown our ambitions to 100 million revenues in the next 3 to 5 years.
All right. Now, Tejas, in a world obsessed with VC funding, you chose a different path. No external capital, no dilution. How hard was it to stay bootstrapped, especially in a competitive SaaS space? And also take us through your revenue model. How are you making money?
Arundhati, let me tell you this. It's not easy bootstrapping. It wasn't easy 10 years ago. It's not easy today as well. But we remain bootstrapped, and we are able to win because of our obsession with customers and building customer-first products. We have to be very efficient in deploying our cash, and we have to build a very strong team in order to reach our mission and vision. We have to have a creative playbook. We cannot just follow a VC-funded startups playbook. We have to be very creative in strategy and execution. We essentially created our own playbook for winning here. That's how I think we're able to survive. In terms of, please go ahead.
Yes, you've built a global customer base across North America, Europe, Asia, and a remote-first team. So Tejas, tell us, how did you scale globally without the push of VC money or an army of salespeople?
Again, our product is very customer-focused. Our marketing is 100% inbound. We do a lot of great content marketing, a lot of great SEO. That is how we are able to grow 100% without worrying about VC money or salespeople.
Again, if you could just give us a bit more about the revenue model bit.
Absolutely. We are 100% SaaS business. All our customers are either monthly recurring revenue or annual recurring revenue. There is no services or one-time revenue. And everything is through the SaaS softwares that we offer.
All right. Give us a snapshot of where the business stands today. If you could take us to the current business growth numbers, your current user base, and the revenue target. Of course, you've given us that $100 million target for the future.
We are currently hovering around 10 million in annual recurring revenue.
Yes.
We plan to grow 15 to 20% this year. We have over 13,000 customers globally. And we are focused on 100 million as a number. Our team is focused on 100 million as a number in the next 3 to 5 years. That's our goal.
Well, on that note, it's time for me to wrap up this conversation. Tejas, many thanks for joining us on Startup Street today, and wish you the very best for all your growth targets.
Thank you for having me, Arundhati.
In a major boost to India's deep tech and semiconductor ambitions, Bengaluru-based Myotic Semiconductor has raised $4.15 million in seed funding to transform how analog chips are designed. Co-led by India partners and Xfinity Venture Partners, the round backs Myotic's bold mission to bring generative AI into the heart of chip development, cutting-edge design cycles from weeks to days, and with a founding team behind products that have sold over 1 billion units globally, Myotic is betting big on making India a key player in the trillion-dollar semiconductor space. Joining us now to discuss this further is Girish Rajendran, the co-founder and CEO of Myotic Semiconductor. Girish, thank you so much for taking time out and being here with us on Startup Street. Myotic is solving a complex, highly specialized challenge in analog chip design, right? For those who are unfamiliar with what this means, can you sort of explain to us what exactly do you do and why is it such a game changer for the semiconductor industry?
Yeah, thank you, Anthony. Let me start by explaining the semiconductor industry. So as on date, the industry itself is around $600 billion. And this is expected to grow to around $1 trillion plus by 2030. There are 3 key segments. One is the manufacturing, fabs, the fabrication. Then there are design houses, the chip design. And then there is another aspect, which is a software offering that is used to do the design, right, as well as aid the manufacturing. So what the sector that we play in is the last one, the software field. The product that we are developing is a co-pilot that is going to accelerate the chip design process.
Absolutely. You've just raised this $4.15 million in seed funding, right? What will this capital be used for, and how soon can we expect your Gen AI Copilot to go live in the market?
Yeah. So the capital that we raised from India and Xfinity partners, this will help us to accelerate our hiring and to quickly go out with our solution. And our plan and the target is to hit the market by early next year.
Sure. Okay, so early next year is when you're looking at that. But now the analog chip design has largely remained manual and resistant to automation, right? So what makes now the right time to introduce Gen AI into this workflow?
Yeah, one key aspect is the new advancements in Gen AI that has enable techniques by which you will be able to aid the designers by building a co-pilot without making them learn new programming languages, right? And making it extremely user-friendly. That is one aspect. Second is it can also help compress the data in a good way by which they can easily access what they need. So there are two aspects. Yeah, the user-friendliness wouldn't have been possible a few years ago, but yeah, now with this advancement in AI, it has become possible.
Sure, I know you're also targeting specifically the analog IC market first, right? What are the specific use cases or sectors like, automotive or telecom where you see the earliest adoption?
So our plan is to start with the communication segment, the communication devices. That would be our first vertical that we are going to target. And of course, as the platform stabilize, we will be expanding it to the other domains like automotive and so on.
All right. And, your core team has built and shipped products that have sold over 1 billion units globally, right? So how does that depth of experience sort of shape your approach to building this new platform?
Yeah, of course, myself as well as the co-founder said, we have been in this semiconductor industry for more than 2 decades. And what that helps is we do know what are the key pain points, right, in a design cycle. Due to the chip development, the design, the ramp to production, we understand what are the key pain points. And it is what is it that is critical to solve today to accelerate this.
Sure. And, India has been pushing hard on semiconductor self-reliance. Where do you think Meotic fits into this larger national vision? And are there any partnerships with government or public sector entities in the pipeline?
Of course, the schemes by government, be it the direct schemes like DLI as well as the indirect schemes like the fund of funds, those are all very helpful for the startups. Of course, we also expect in future to be part of some of these. And
sure.
In general, it is a good momentum in terms of the semiconductor, the visibility that that this industry is able to garner today.
All right. And you're building something that could massively reduce design cycles and lower the barrier to entry for analog chip design, right? Could this sort of open up the space for newer, smaller players globally?
If you are talking about the customers of our products, smaller companies that can come up and challenge, use our product and accelerate their product cycles, yeah, of course, that is one possibility. If your question is more related to competition, of course, there also we expect enable companies, startups to come up in future in similar field.
Sure. And what about revenues? Can you take us through what you're clocking and where do you hope to end this year?
So as I mentioned earlier, we expect the first product launch to happen early next year. So that would be a good time to discuss more about the revenue plans.
All right. All right, Girish, thank you so much for taking time out and being here with us on Startup Street. We wish you all the best on this journey going forward.
Thank you. Thank you for having me.
On that note, it's time for us to head into a short break. But coming up, Luma Fertility is blending cutting-edge science with compassionate care to transform reproductive health in India. The startup has raised $4 million in fresh funding. We put the founder on the hot seat to find out more. Stay tuned.
Zindagi ek safar hai suhana. We've all been fortunate that our wives are smarter than us. All three of us met our wives at work. I can now die a peaceful. I actually shook hands with Mr. Bachchan.
So I said, Pagal hai, yeah. He threw me a googly, which I was not prepared for. He said, how dare you leave family?
You look at my mic and say, what's happened? I said, sir, your zip is open.
Welcome back. You're still with us on Startup Street. India's fertility landscape is undergoing quite a revolution, and leading that charge is Luma Fertility. The startup blends cutting-edge science with deeply human care to redefine how India approaches reproductive health. Now, with $4 million in fresh funding led by Peak 15 Surge and backing from marquee names like Amida Shah and Vijay Taparia, Luma is gearing up to scale its full-stack tech-enabled clinics and bring empathy back to fertility care. Joining me now to discuss this further is Neha Motwani, the founder of Luma Fertility. Also with me is my colleague Shruti. Thank you so much for joining us on the show, Neha. You know, first up, what kind of gaps in India's current fertility ecosystem were you most determined to solve when you started Luma?
Thanks for having me. And I think, this actually goes back to my own journey. And I think, having been through fertility treatments myself, I saw the gaps which were very, very evident. And I personally felt like the experience side was extremely broken, right? Right from somebody trying to access fertility services to the entire journey when the treatment happens. And what we saw globally when we benchmarked, we actually realized that technology in IVF has really not changed in the last sort of 30, 40 years. But what really can make a massive difference, because it's a very difficult journey in itself, is how do you make the patient sort of feel cared for, feel supported. And I think the huge gap that we are trying to sort of bring in form of care that is given to the patient, technology and AI solutions that are added into the journey that actually makes the entire, experience very wholesome.
Absolutely. And Neha, this is Shruti quickly stepping in. Like Arundhati mentioned earlier, you've just raised $4 million in seed funding. How do you really plan to deploy this capital across tech, clinical expansion and patient experience that you were talking about in the next phase of growth? If you could give us a sense of that.
Yeah, Shruti. So basically, I think, for us, we want to actually approach this, city by city. We've launched our first flagship clinic in Mumbai, in Bandra. It's a 6,000 square feet place. It's a large sort of flagship unit at our end. We want to scale that up and really prove that patient experience can be delivered at the level that we are looking at. So for us, patient experience is not just 2 words, but it's really redefining the way the patient is treated, whether it is egg freezing, whether it is a fertility consult or IVF, right? And I think once we sort of prove that, the idea is to launch 2 more clinics in Mumbai. From a capability perspective, we are investing a lot in technology. We already have an app. We already have a website that actually books real-time appointments with our doctors. And our plan is to extend that technology with deeper AI, deeper analytics, and really, merge what we are seeing in terms of the care team and the patient-centric approach to how we are managing the fertility journey along with technology. As we do that, of course, once we are extending our services outside of Bombay, we will then look at expanding across all metro cities.
Sure, absolutely. But speaking about tech there, like you pointed out, Luma is branded as both tech-enabled and patient-first, right? If you could sort of walk us through how your clinic model integrates empathy and innovation at every step.
Yeah, and I think, what happened for us is that when we looked at, what are the gaps in the market, we actually started with my own experience and extended that with about 200 women that we spoke to personally. And these are women from across India who've actually been through this journey. And what we realized is that there are actually multiple friction points, and we actually have detailed those 55 friction points that we believe every patient sort of goes through. And the idea for us was to actually solve for each and every sort of friction point. But the major sort of difference is that we've looked at everything, whether it is the center design, whether it is technology, whether it is the doctor consult, or really the treatment steps with the patient at the center. So it's really, in that sense, consumerism in healthcare, which is re-architecting the entire journey with the patient at the center. And You're absolutely right. I think empathy and compassion comes right at the core of what we are sort of doing, along with transparency and ethics, right? There's a lot of taboo associated with fertility as a subject. So we also want to ensure that there's privacy, confidentiality when somebody actually goes through this treatment.
Absolutely, that's important. But Neha, if you could now break down how Luma's revenue model works. Is it primarily procedure-based, or are there subscriptions and bundled services as well? Take us through, also if you could tell us what you're clocking currently and where you hope to end this year with.
Yeah, sure. So I think we've just started, Shruti, and I think it's literally month 2 at the clinic. So we are meeting a lot of patients, and we're actually in process to also doing a lot of treatments. From a revenue model perspective, I think we're a full stack physical clinic, and for us the revenues come from the patients who come in. Our patient acquisition strategy is primarily B2C, and we're seeing amazing traction, especially on the egg freezing side, where we are literally starting with raising awareness for women to understand where they are on the fertility timeline, and then knowing if egg freezing is the right step for them, and also initiating a preconception consults for couples to really know if they are wanting to plan a baby, how should they go about it. So our revenue model will evolve as we go along, but it will be centered around treatments and procedures that we are able to do at the clinic. And as we go along, of course, the idea is to break even in the next 8 to 9 months. And once we break even the first center, we will look at launching the other 2 centers, like I mentioned.
So you plan to break even in the next 8 months is what you're saying. So, you're sort of looking to expand post that. So what's the roadmap for the next 12 to 18 months? Will you replicate the Bandra flagship model or adapt it by city? And, what are the cities on your radar after Bombay?
We definitely want to be in all the metros. Our plan is to be in Pune, Hyderabad, Gurgaon, Bangalore, Chennai. But like you said, I think the model is going to evolve. We do believe that a flagship clinic, especially the way we've created it, which is literally like a center of excellence, and it has everything full stack, right? So from a pharmacy to our lab, we have a huge cryo chamber. Our lab is completely transparent, so you can actually see through what is happening inside the lab. And this sort of flagship experience that we've created, we want to replicate each of these flagship clinics across cities. And maybe the other set of centers will be smaller, and we'll also look at a hub and spoke model, which is something that has worked well. But like it's a very, very competitive market, and there are incumbents out there. There are almost 100 clinics in each of the metro cities that we're talking about. So we're very cognizant on the fact that our differentiators need to play out, and we need to actually build as we see more traction on the egg freezing side as well as on the IVF side. One flagship clinic as we scale, we'll actually learn further and we'll take it from there.
All right. On that note, I'll have to wrap up our conversation. Many thanks, Neha, for joining us on Startup Street, and wish you the very best with all your expansion plans.
Thank you so much, Shruti. Thanks, Arundhati.
Well, with that, it's a wrap on this edition of Startup Street, both from Arundhati and me, Shruti. More news and updates continue on the other side. Stay tuned to CNBC TV18.
Welcome to Indonomics. The June CPI number coming in at a 6.5-year low of 2.1% has led to a few things. One, most economists have revised down their average CPI forecast for FY26, this year that is, to 3.2 to 3.3% against Reserve Bank's forecast of 3.7%. Second, many are penciling in another rate cut. Third, most are not expecting it in August itself. And fourth, above all, bankers and bond dealers are watching Reserve Bank's liquidity policy. How much liquidity Reserve Bank will add or remove from the system and when will determine bond yields and the rate cut transmission. Now, equity investors in banks are still penciling in about 12% credit growth on hopes of a 10% nominal GDP. that may be up for threat. And they're also penciling in an end to the rate cycle. These are what equity investors are penciling in. So today on Indianomics, we have three experts to help us understand how growth, inflation and liquidity may pan out. I have with me Saugata Bhattacharya, Senior Fellow at the CPR, Center for Policy Research, more importantly, MPC member. Neeraj Gambhir, the Group Executive and Head Treasury Markets and Wholesale Banking at Axis Bank, and Samiran Chakrabarti, Chief Economist at Citi India. Gentlemen, good morning and thank you very much for joining me in what's a very crucial conversation. Saugata, first your thoughts on the CPI number, deflation in food inflation and core as well, pretty much under control.
So hi, Lata, thank you very much for having me on your show. So a couple of observations. Yes, the CPI food overall headline and food inflation numbers came in a little lower than what markets had been expecting, but this has begun to emerge as a trend for the last 3 or 4 CPI prints. We have seen this happening. This, to my mind, is very much a one-off. One, as everybody now already knows, I mean, this is partially due to the base effect of a very high inflation print, 5.1% in June of last year. So the next 2 inflation prints are likely to be higher headline prints. Overall, we are in a very good place, very good position in terms of inflation. As you mentioned, I think inflation for the year is likely to be lower than the RBI, the current RBI forecast. So that definitely gives us room, gives room for the RBI, the MPC to continue with the easing cycle. It's just that the pace is unclear. On core inflation, which is what is probably important from a policy making point of view. I think the 4.55% that we have seen in June is likely to peak out, given the fact that base rates, the base effect of core inflation, has been increasing. So I mean, I don't expect a dramatic increase in core inflation, given the fundamentals that are driving core metals prices, commodities prices, etc., seem also to be in a good position. They are very unlikely, particularly crude prices, are unlikely to increase. So I think from the inflationary point of view, I think monetary policy is in a good position. But again, I mean, there are multiple other things to consider.
Okay. Well, Samiran, you're the person in the among the people I spoke to with the lowest inflation expectation for July. Your number is 1.1. So tell us your trajectory. Does it get much below what Reserve Bank has forecast in June?
Thanks, Lata. So yes, we are looking at a 1.5 kind of CPI for August, but this will be which will come out in August for the month of July. But this will probably be the trough on the inflation trajectory. We are now looking at the July-September quarter to be averaging about 1.9%. But at the same time, we think that all the stimulus that is going into the economy, that with a little bit lag will start impacting demand also. So we have actually built in a slightly higher momentum in core inflation for the last quarter of the year. And that's why our last quarter average headline CPI is marginally ahead of the RBI's current forecast at around 4.7%. Altogether, the full year average is about 3.2%. The critical part, which always is very difficult to forecast, is the vegetable price trajectory. But other than vegetable prices, I think most of the non-veggie food prices are behaving very, in a very benign way. So given how the monsoon has panned out, we think that trend is going to continue as well. So overall, it seems to be, at least in the near term, a very low inflation path that we are going to follow.
Okay. Neeraj, what are the markets expecting from Reserve Bank? If the number, as Samiran is putting it, is going to be 1 point something, maybe even lower than 1.5, will they go ahead and cut despite the neutral stance?
So I think given the inflation outcome and given what Samiran has said, I think the markets are broadly in line with the fact that the next reading is going to be a low reading, but after that we'll see some recovery in inflation numbers, some pull-up in inflation numbers. But given the expected outcome on inflation, despite that, I don't think the markets are expecting a rate cut in August, as you yourself mentioned in the initial part of this program. The key reason is twofold. First is that Reserve Bank has already front-loaded a lot of monetary policy action. I think given what they did in the last policy, it was much more than what the market had expected. And I think with that size of monetary policy impetus given, I would guess the Reserve Bank would like to wait a little bit longer before taking the next step. Second is that the action on the liquidity front is also a little bit unclear. There is ample liquidity in the system. There is approximately 3 lakh crore surplus in the system currently. If Reserve Bank does not conduct variable rate reverse repo auctions, then all this liquidity will sit in the SDF, which is where the rate is 5.25. But if Reserve Bank continues to do VRRs and keeps on, it will effectively pull the overnight rate up towards the repo rate. So currently the market is expecting Reserve Bank to continue with the VRRs and pull the overnight towards repo rate, which basically means that, there is an implied 25 basis point hike in the overnight rates, right? So these are the two forces which are kind of playing out, which is why you're seeing bond market to be very, very stable at this point in time.
Okay. Yeah, I agree. Moving more towards 5.4, actually, the call rate from below 5.25 some time back. Saugata, I'm going to ask you two quick questions because you're not going to be with us after the break. Our discussion will continue. One is, how should central bankers think of inflation? Should they think of the fact that all through 2025, we are going to have 3% or below inflation, which means the real rate is more than 250 basis points? Or should they think of the 1 year forward, in which case 1 year ahead you may have a 4% plus? What should be the standard way of thinking?
So, I think this question has been settled in multiple papers, theoretical, academic discussions, and Samiran put it very, very clearly. That it's not just the next couple of prints, the next quarter. You have to look at it over the course of the year, probably across the cycle. Again, I still go by the RBI's forecast, but even there, it does seem to be on an upward trajectory after, say, from the third quarter onwards. So obviously, this is not. You hear the argument that it's best to cut the policy rate before start with another easing, make another easing move before inflation starts moving upwards. I don't think that's a correct argument because obviously the monetary policy easing cycle, as the name implies, is over the course of the cycle.
Okay.
So you have to consider that. On top of that, you have to look at various other measures which might impinge on core and headline inflation going forward. The inflation growth trade-off, global uncertainty, volatility, etc. So I think caution that I at least particularly keep talking about. I think that needs to be very much in place in looking at the path of monetary policy.
Okay. Let me pack two quick questions before you leave us. One, do you personally think that there is space? Because if you look at current inflation, there seems to be a lot of space. If you look at 1 year ahead, you can even argue there is no space. And the governor's statements can be interpreted either way in his interview to me. That one question. And the other one, would growth move the RBI more? And are you worried about growth? In the sense, the WPI number came in at deflation. It came in at minus 0.3. So, is there a growth scare as well?
So again, growth is definitely the impulses that you see, the data, the high frequency data that you see, definitely suggests that some ambiguity on growth. It's not very clear. I still go by the 6.5%, the forecast for FY26 growth. If we actually do grow at 6.5%, I think we are okay in this current market with the amount of elevated uncertainty that still remains. We have no idea where the overall tariff situation is going, where the trade situation is going. I think we are in a good position in terms of growth. Of course, we need to support growth given the space that the inflation trajectory even over the course of the year provides. But I think at this point in time, as Neeraj mentioned, I think the liquidity support that the RBI has provided, I think that's a far more critical thing in terms of looking at transmission, in terms of credit growth. In terms of credit growth, which is an important part of the monetary policy cycle target, the objective. I need to point out that it's not just bank credit. I mean, the overall flow of resources in the corporate sector, that's I mean, the amount of money that's been raised to the corporate bond market, I think is very, very, very high this time and is expected to remain high. Transmission has been faster in the corporate bond market. So, I mean, we need to look at the overall flow of credit, not just from the bank credit side.
Fair point. So you see space for a further fall in rates?
In short, yes. Yes, I see space, but that obviously depends on multiple factors going forward, particularly inflation.
Okay. Well, thanks a lot for that, Saugata. We'll take your leave. Neeraj, Samiran, please stay on. Quick break, and we are back with more questions. Welcome back to Indianomics. This one has been triggered by the ultra low or unexpectedly low CPI number that we got for June of 2.1, with a large part of the economists community now expecting the full year inflation to be as low as 1990 levels, 3.2%. The resultant impact on what RBI might do in terms of liquidity and rates is what we are discussing. We had Saugata Bhattacharya, the MPC member, plus Neeraj Gambhir and Samiran Chakrabarti speaking to us. Neeraj and Samiran, thank you very much for staying on. Samiran, if you can analyze the impact on credit growth, do you think that the Reserve Bank needs to do more in terms of both liquidity and rates to push credit growth? There are a lot of people who are expecting only single digits. Can Reserve Bank make a difference with liquidity?
So it boils down to how you are looking at credit growth, whether you are looking at it from the demand side or you are looking at it from the supply side. Our sense is that the demand side is still weak on the credit growth front, and that's because of two broad reasons. One is that the interest sensitivity of segments of credit demand is often low. There are only a handful of them where the interest rate sensitivity shows up in a big way. And the second is, as Saugata was mentioning, the borrowers are looking at alternative sources of funding, including corporate bond, ECBs, et cetera, as well as a large chunk of equity funding, which is replacing probably debt funding. So I think the demand side would not be the trigger for credit growth to improve, but we should not be ignoring the supply side. There is substantial amount of liquidity that has been given to the banking system. At some point of time, the banks will try to offload this liquidity onto the system. This can happen through the NBFCs who have a larger feet on the street. So through the supply side, the first trigger for credit growth could come in. So I will not be surprised if the credit growth numbers inch up to 12-13% at the back end of the year when the full effect of this monetary transmission takes shape.
Okay. What's your sense, Neeraj? I mean, put on your banker's hat and think, what will a punishing amount of liquidity, every day bankers forced to give money to the Reserve Bank at 5/4 or even maybe if there is a rate cut at 5% to RBI, would that be trigger enough to force bankers to lend? In the last cycle, of course, it was very long ago, in the 2000 to 2004 rate cutting cycle, you did not see credit offtake up until 2004. It took 4 years. And then, of course, credit growth jumped to 25%. But rates falling from some 10% to 6.5% did not increase credit growth. Bankers remained cautious or borrowers remained cautious. What's your sense now?
So my sense is that hoping that this dose of liquidity and the rate cuts that Reserve Bank has done, coupled with the fact that government is doing spending on the capital side, there is some front loading of subsidies. So there is a push towards increasing sort of demand, even though I agree with Samaran, the demand side is looking a bit weak. I think all of these factors will combine to give us a better outcome on credit in the second half of this year. Currently, the credit growth is at about 9 or 10%, somewhere in between, and we will slowly inch up towards 12%. I still don't see it going significantly beyond 12-13% for this year, because the demand from large corporates, the demand from overall corporate sector still continues to be somewhat weak. Now, when will monetary policy deliver? I think it's an open question. There is no clear timeline. I've seen at least 4-5 cycles now. Each cycle is very different. And the drivers of credit growth in each cycle are also very different. I think if you remember, between 2012 to 2014, the big driver was infra spending, right? So between 2017-18 to 2020, the driver was retail lending. So every time we've seen a slightly different driver of credit growth. We'll have to see this time around in the revival sort of leg of credit, which sort of segments play their bigger than usual part in terms of driving it back. But I think I would expect that as liquidity settles down in the system, as the rates settle down in the system, they have done to a large extent on the lending side, but also from banks' perspective, the cost of funds steadily comes down. There will be some impetus to bring the credit growth back towards 12-13% numbers by the end of this year.
Okay. A two-part question for you, Samir. And actually, I'll put it in two separate questions. One, this 12-13% number is coming into question more because now the nominal GDP is going to be very low. If we are going with a 3.2% CPI and a lower WPI, then the nominal GDP perhaps will not even touch 9. It could be even sub 9. And then the credit growth, if it is 1.1 times nominal GDP or something like that, we may not get beyond, maybe barely make it to double digit. Is that an argument?
So first, we are not talking of kind of average credit growth here. We are talking more about what the credit growth would be, exit credit growth type of thing. And that, to some extent, will benefit from a bit of base effect of last year when in the latter part of the year, the credit growth actually tapered off. So from there, the favorable base should help. And, there are times when the system is trying to push higher credit. It's not for the first time that we will be seeing that credit growth will be substantially higher than that mechanical rule of X times nominal GDP growth. It could possibly be the case, but my bigger worry actually is that to what extent the non-banking channels of credit and equity would drive the financing rather than the banking credit. As Neeraj said, that there could be different pockets of credit that could emerge, not the traditional ones.
No, fair point. NBFCs are more nimble. And since there's a banking system is actually negative year-on-year terms in terms of their loans to NBFCs, maybe that route will fire. But Samiran, a more general question on growth. The Reserve Bank can be moved to cut if it genuinely perceives danger to growth. Is the 6.5 in danger? Is even 6.3 in danger in terms of growth rate?
Right now, for the April-June quarter high-frequency data, I think we are tracking somewhere around 6.5 only on GDP growth. We will get to see the corporate results now, which have a large bearing on the final GDP number. So we might have tweaked the number a little bit here and there to adjust for it. The open question is that when this tariff-related uncertainty settles down and whether the average tariffs settle down at 20% for US or at 25%, depending upon that, we might see the global headwinds. We have to consider that to what extent that creates a downward bias. But at the same time, I think the markets are generally underappreciating the size of the stimulus. There's a 30 basis point of GDP coming out of tax cut. Our estimate is 40 basis point of GDP is the immediate impact of the 100 basis point rate cut on household borrowing. And then there could be about 30 basis point more coming out of higher credit growth. So altogether, about 1% of GDP, monetary and fiscal stimulus is there in the system. So that should show up in numbers at the latter part of the year is what our call is. So not thinking that the growth outlook is necessarily very bearish.
Okay. There have been economists who are telling me that even in Q1, while latter part, even in Q1, if the normal GDP is C plus G plus I plus net exports, especially service exports, have done well. Goods exports were flat even last year. So in terms of input into GDP, exports have not taken away anything, plus government spending much better than last year. So we could get a good growth number. And therefore, we are coming to Neeraj's forecast or the bond market's forecast. If the expectation is that growth is not under threat, and the RBI argues in its own mind that when I go to the August policy, I will have a July CPI which will be 1.1, if you're right, Samiran. So there will be more pressure on me in August, so why should there'll be more pressure on me in October, so why give away the rate cut now? So be that as it may, Neeraj, if there is no rate cut in the August policy, but the governor sounds dovish, saying that, if inflation surprises on the downside, etc., how will the bond markets react? Because bond markets have been, completely ignoring any chances of rate cut or low inflation. They're still sitting at 6.3, a good 15 basis points higher than the low before the June policy. Do you see any fall in bond yields?
Okay, let me just answer this in terms of what the expectation of bond market from MPC is. I think the base case or the general expectation is for no rate cut in August. Obviously, the tonality of the MPC and the language around the forward-looking view on inflation, the forward-looking view on growth is what the market will be watching out for. And I think given what we've seen in terms of data and given the commentary that even Samiran talked about, I think there is a case that you could build a case for an October rate cut, but I think between August and October also we'll have some more data. So my guess is that the Reserve Bank would likely wait until October, see data between July, August and October and see how things are playing out, particularly on the growth fund, before taking a call on the October rate cut. As far as bond market is concerned, unless and until it gets a very clear signal from Reserve Bank that the next rate cut is going to happen, I don't expect a meaningful slide in bond yields. I think we will be in a very range-bound mode, around 6.25% to 6.3%. All the positives have been discounted. Good liquidity has been discounted. If anything, the overnight rates are now going to inch up towards 5.5 possibly. So I don't see a significant positive momentum, but at the same point in time, no reason for yields to actually go up from where we are right now.
Okay. Well, we'll have to leave it at that. I might just tell you that there's one more positive. One person told me before, when I was preparing for this interview, that the borrowing calendar for the next second half may have much fewer 30 to 50 year tenor because, you're getting such an attractive rate at the lower end. The government may rethink, or the RBI may advise it to bring it down. Then there is a bit of a rally perhaps at the steeper end of the curve. Let's wait and see. Many moving parts here. Samiran, Neeraj, thank you very much for continuing with this conversation and helping our understanding of what to expect from the Reserve Bank in terms of inflation and growth numbers, as well as how the bond market will behave. That's it on this edition of Indianomics. Thanks for watching.
Let's talk money.
Hello and welcome to this week's edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Now, it's been a news and noise-heavy first half of the calendar year. Markets have been volatile, yet resilient. They've been dealing with all the war and tariff developments that have been thrown around. But one thing that investors have perhaps rediscovered in 2025 is that making money is not a straight line process. So it's a good time to revisit some of the ground rules of portfolio planning and also talk about why a portfolio shouldn't be too skewed towards any one particular asset class, even if that asset class is equity. Today on the show, I have with me Alek Yadav of Sanctum Wealth, who will tell us the 5 mistakes to avoid in our portfolio. And of course, then he'll also shine a light on how hybrid funds perhaps can help us enhance overall returns just that little bit. Alek, great to have you back on the show. So thank you so much for being here.
Thank you so much. Thanks for having me again.
So I want to start with a dipstick mood check first.
Yeah.
Because this has been, like I said, it's been so noisy, right? All kinds of news.
Yeah.
And you don't know, tariff, and Mr. Trump is telling you that the whole world has to be reset, and geopolitics. What is the feedback you've received from clients? What are they saying? Are they still buying every dip?
Sure. Yeah, so I think there's a little bit of concern that is there amongst investors as well, you know. So they're afraid from committing too much of capital at this point of time. However, what has happened is that the last quarter was such a one-way run, you know, that they're also fearful of missing out on the rally. So I think most of them are staggering, and that's what we're suggesting clients, that instead of fully staying away from equity, stagger the money over a period of time so that you get participation, and if there is a correction in the market for whatever reason, then that could be an opportune time to add more to equities.
So there is fear of missing out, but there's also fear of participation. So it's like, you know, twin fears working together.
Exactly.
But in generally, I mean, as a house call right now, when you talk about any broad portfolio advice, so I know it'll be different for different individuals, but generally, are you fully overweight on equity? Is it more equity skewed? Gold has done so well. So I think people are just asking themselves these questions: that where should I be? Where should my money be?
So we have been overweight gold for a while, for actually the last 2 years. Actually went overweight when Ukraine and Russia crisis broke out in 2022, and we've been overweight in gold since then. Now I think we're starting to book a little bit of profit because it's been a stellar rally for gold. So we're booking a little bit of profit. We're adding a little bit to equities. If you look at Indian markets, things have only improved. The macro environment has become better. The government is starting to spend. RBI has cut rates by more than 1%, and is also supporting liquidity by doing open market operations. So the overall macroeconomic environment in India is improving. On the other hand, the earnings sort of bottomed out in the last quarter. I think the expectation is that they will keep improving quarter on quarter, and the second half of this financial year should be a better year. And that's why we're saying that slowly, gradually add to equities and don't miss out on the rally. If there is correction for whatever reason, it is likely to emanate from global market risk. Use that opportunity to add to equities.
So equity would be the one big asset class that you're advising that investors should they should putting in their money. What else, just in terms of asset classes?
Yeah, so that's one. Gold, we still have some allocation. We're not fully taking out.
How much?
Generally, our model portfolio allocation is about 10%. We were right now at closer to 12%, slightly overweight on gold. And on the debt side, we are saying that, you know, maybe it's time to book out money from duration and add to, you know, conservative debt like corporate bond funds, and using income plus arbitrage as tax efficient vehicles to take allocation to debt.
Okay, so that's the overall thought process with respect to where the money should be parked. That's the sanctum view. But now I want to get to the exciting part, because the way Alok has done this is that he's going to encapsulate all the mistakes we end up making in, like, you know, a panch ka punch. So the 5 to avoid. Take it away, Alok.
Yeah. So I think the first one, that we typically see in client portfolios is over concentration or over diversification. You know, so generally investors who have been investing for a long period of time. HNI investors who have a larger portfolio, they tend to end up accumulating too many mutual funds. We've seen in client portfolios with 40, 50 mutual funds as well. And as we know, each of these mutual funds have about 50, 60 stocks. So you overall end up owning like 1,000 odd stocks, almost the entire market. That's too much of diversification. On the other hand, you know, newer investors who started new, they end up doing 2, 3 mutual funds, maybe 4, 5 mutual funds, and have a concentrated portfolio. There again, what happens is that, you know, if there is a good experience with one fund, you got it at the right time, you end up owning 20, 30% in that one mutual fund. So that's too much concentration. Our ideal, this thing is anywhere between 5 to 15% allocation to one single mutual fund, which means around 8 to 12 mutual funds on the equity side is more than enough, and that should cover for you.
8 to 12 funds. Because this is something that people always grapple with, and sometimes people have multiple advisors. So you have one portfolio with one and another with the other.
Exactly.
So you're saying no more than 8 to 15 funds.
Yes, that's